Expect that to change today. Oil prices down, gas prices down, yields down, and you're looking at a weaker dollar as well. European stock futures then pointing to gains of 2.3%. Here in the UK, FTSE 100 futures, there may be a bit of a drag from weaker oil and that sector, but so far you're looking to add 129 points. The session in Germany is looking bright as well, within the context, pointing higher by close to 2% so far. Lizzie, individual stocks that you're looking at.
Tom, you flagged the FTSE. We keep an eye once again on the energy space. As you say, oil prices down more than 9% now on WTI and Brent, so the energy names set to be on the back foot. In Germany, we watch Volkswagen after its earnings, and in London we have Persimmon, very exposed to the cost inflation and interest rates impacted by the war in Iran. Anna.
So, looks as if these markets then will be on the front foot this morning, expecting to see gains of 1–2% perhaps on some of the major markets. Maybe the ones that fell the hardest bounce the furthest this morning. We'll certainly look for the DAX to do some of that heavy lifting as in terms of the upside for equity markets this morning. Yesterday was all about higher oil prices. It was all about inflation expectations, bond yields going higher, with all of that in the mix. Today looks like the opposite of that. We're substantially lower on the oil price. Energy stocks could therefore be to the downside, but everything else perhaps we saw moving in the opposite direction yesterday, and that might be the same in today's session. So London is open and it is up by 1.2% this morning. The Stoxx 600 is up by just over 1%. Perhaps there's quite a bit of volume going through on the DAX, for example, so we're waiting for that market to open up. Tom, what do you see on the sectors picture?
There has been that mirror image in terms of the energy sector. Right now it's in negative territory. Not a big surprise, of course, what we're seeing around Brent, WTI and gas prices as well. So currently energy is the biggest loser, down 2.2%, close to 2.2%. On the upside, the biggest gains coming through from the banking space as you start to see yields down and readjustments, those gains that you're coming to see in the bond markets, pairing the losses that we saw yesterday. So banks with that relief as well, up 3.3% as a sector. Travel and leisure also gaining 2.4%. Again, on the comments from President Trump seemingly pointing to potentially an end to this conflict in Iran. Basic resources also gaining 2.3%. The other sector that is near the red is telecoms. Modest gains of 0.4%, but again, every sector so far in positive territory, pretty convincingly so, apart from energy down 1.8%, Lizzie.
We're still waiting for a few of the names that we'd flagged earlier to open, but in the energy space, Shell down 2.4%, BP about the same, Total about the same as well. So as you say, it's a reversal of the moves that we had seen when oil was up, but the banks the outperformer, and some of the names doing best are those that struggled the most previously. So UniCredit, Banco Santander and SocGen all up more than 4% this morning.
We are seeing movement in gilt markets then. We were watching for this, and just like we've seen in the rest of Europe, we are seeing those gilt yields coming down. So at the 2-year down by 9–10 basis points, out to the end of the curve down by 9 basis points or so. So across the curve, just like in the rest of Europe, we are seeing those yields coming down. Let's get another take on these markets. Paul Markham joins us, Investment Director and Head of Global Equities at GAM Investments. Paul, really nice to have you with us. Let's talk about risk appetite this morning, because it seems as if the market is trying to buy the dip of yesterday and doing that at the start of the trading session. It does seem difficult maybe to join all of the dots between what we've heard from the US administration last night and what their stated aims were going into this. But we are maybe reassured by this narrative that President Trump wants a shorter conflict. Is that going to be enough to sustain risk appetite, do you think? What are you watching for next?
I think the phrase Taco Tuesday sort of sums it up, really, and the idea that this will be a sustained rally from here, for me, is quite difficult to believe. I think that there will be a relief bounce. After that, I think the questions come around in the same way as they were before. We had the whole conflict, which is around where US monetary policy goes from here, whether or not rates can be cut this year, and that is now much more of a question. And I think that will really drive sector performance going on for the rest of this year. So I think for now, I would be relatively cautious. I think that markets can push on a little bit, but I think the war isn't over yet, so we'll wait and see.
Yeah, absolutely. So in terms of where the sector's in focus, I mean, are you still thinking about loading up on those sectors that would do well in a higher oil, higher inflation environment? Is that still the mentality, or is it a buy the dip because the war is going to end at some point soon?
Well, the difficulty with the stagflation environment, which was really what the conditions were for the last week or so, is it's very hard to buy anything which really makes any positive, absolute progress in that environment. So, and it's really clear that, for example, the wrong kind of spike in bond yields came around for the banks to perform, for example, which is why they're outperforming on lower bond yields this morning, which is different to what you would usually expect. So I think, I would sort of pretty much stay pat where we are, actually, which is we've been long technology, we've been short banks, and we've been fairly constructive on some of the industrial names which benefit from the AI trade, really. So that's really where we are, and we didn't really get too much sucked into getting too many changes because you can get whipsawed.
Let's say you have a weaker euro, but also the higher oil price. Are there some sectors whose earnings will turn out better for that combination?
Yeah, I mean, clearly the European oil leverage names specifically are going to do very well in that environment. A higher oil price is usually negative for the euro, so those two things should go hand in hand.
But the weaker euro is a tailwind for some.
Yes, I mean, the weaker euro should be a tailwind for the market in general in the Eurozone because, I mean, it is dominated by exporters. It's very hard usually for European equities out with the last year or so when the domestic stocks have done well because they've been so beaten down and were very cheap. But generally, Europe doesn't self-start economically. It needs China or the US to be economically strong in order to perform. And they usually takes its cue from those. So I would expect if we have a global positive market environment, the European markets to do fairly well, and I think they'll probably shrug off higher oil prices, apart from certain domestic consumption stocks.
Are you surprised that European defence stocks haven't been doing better in all of this? I asked another guest this recently, and she was saying that it's partly because higher oil prices will benefit Russia, that they haven't been doing so well. But surely, if that is to Russia's benefit, you would expect Russia to make new targets and there to be a need for more defence spending.
Well, one of the issues is capacity in defence, actually. And even if demand is very, very high, if you can't fulfil the orders, then there's a sort of limit to how far you can go with that. There was an IPO recently, a company called CSG, which went pretty well. The stocks have, I mean, BAE has done quite well. The sector has performed, but it hasn't really gone as well as you may have expected it to. And so I think that's probably just down to the fact that there is a capacity constraint. And there is also a little bit still of a question mark, as Trump has talked very frequently about, as regards the final point of arrival for GDP being spent on defence.
Paul, you said for now you're sitting on the sidelines, essentially. What pulls you off the sidelines? What specifically would you need to see to pull you off the sidelines? Would it be President Trump announcing victory? Would it be the Iranians saying they're ready to negotiate? What specifically would pull you back into these markets?
I think that the biggest positive for markets will be when there is the end to the air attacks, when the whole kind of big headlines around the war end. Sadly, I think that if we end up with an Iraq-style situation in Iran, which is a sort of civil war, I don't think markets will be too concerned about that. And I think the regime change is the objective of this conflict. So I think, if that is achieved, I think that will be positive for markets. And then we go back to the same themes as we mentioned before around what happens for the rest of the year with monetary policy in the US, for example. So I think we go back to those themes, and I think that the war then becomes less important in the eyes of the market.
How are you hedging right now? Do you want to buy cash or move into cash? Do you want to buy gold? What's your hedge?
Well, gold, in theory, should work. It hasn't worked so well during this, and the reason for that is previous outperformance, but also, of course, the cost of carry, which with Treasury yields spiking has been quite expensive. I think if we go back to that whole question mark around the robustness of US institutions, around the question marks around US monetary policy, gold could push on. And there are quite a few price targets in the market around 6,000 an ounce, which would be 20% probably from here. So I think that could work as a trade. Gold miners don't work so well because you tend to find emerging market currencies rally at the same time, and the cost basis of the gold miners spike as well. So that's not always the best way to play. It's probably best to buy physical or ETFs.
But we are looking back for all kinds of parallels with history, and this is this is not military action involved here, but during COVID, we saw some stocks did fine because they had lots of pricing power, and that became evident, and the market was rewarding those companies with pricing power. So even though there was an inflationary environment, which maybe not everybody was enjoying, certainly, some stocks managed to make the most of that. I mean, are you leaning into that kind of pricing power narrative once again as we worry about inflation?
Well, in the early stages of inflation, pricing power is a positive. As inflation becomes embedded, it's actually the lower quality companies that do better. It's the deeper cyclicality, it's the companies which probably have a more commoditized product base, because the rising tide lifts all boats, if you like. So I think that early on with that, yes, that's true. It is certainly the case now with this, if we do sit in this environment of a much elevated oil price for much longer, we are going to start to see real world impacts in terms of inflation. And that's something which the UK has already been suffering, but it's going to be spread more widely, I think. So in that case, you probably do want to buy stocks which are able to benefit from that, and you would imagine that some of the commodity suite would be in the sweet spot for that.
Is it a good time to double down on renewables? You've got energy security in focus, AI's energy needs as well.
It's a good point. I mean, I think that the problem there is political, and there are two reasons for that. One is that you've had governments backing away from some of that patronage of new forms of energy. And secondly, in an inflationary environment, woe betide anybody that has an election, because the cost of living will spike, the cost of mortgages will rise in the developed economies, and it's going to be a tricky period to get re-elected. And that means the policy around renewables will be very difficult to discern, and that's something which would lead me to be a little bit cautious on that.
I want to go back to the FX story, because we're seeing that weakness in the Bloomberg Dollar Index today. That has changed, of course. We've seen very strong. It's been the clearest hedge, essentially, for these markets. But can I just assume, given what you've outlined for us, that the dollar goes back to being challenged after this conflict, that this is going to be short-lived in terms of the gains for the greenback that we've seen in the last week or so?
I would say so, Tom. Yeah, I would agree with that. I think that the question marks around whether or not Walsh is a hawk, as the suspicion was when he was first hired, if he is confirmed as Fed chair. I think the fact that Trump has shown himself to be willing to circumvent institutions in the US, I think, does lead to some question marks over the dollar. And of course, if there is, some lasting inflationary impacts, that might be positive for yields. But if Trump is insistent on pushing the Fed very hard to cut rates, that's going to be quite a bonfire to be throwing petrol onto. So I think from that perspective, I would imagine there will be a challenging time for the dollar once this is over.
We've got inflation out of the States tomorrow, haven't we? At the beginning of this week, it looked as if that might fail to cut through because of everything that's happening in the Middle East. You seem as if you're a bit more focused on that Fed narrative and where rates go. And do you think that can be something that guides market sentiment then this week?
I think this week, if it goes in the wrong direction, then it's just going to confirm all the fears the market already has, and you'll see, probably some significant spike at the short end. We've already seen a bear steepening in the Treasury market, and that could be further sort of difficult territory, I think, for the Treasury market. So it depends, to be honest, Anna, with the headlines around tomorrow's inflation number as to what happens in the meantime around what's happening with the conflict. Yes. But I think if it's, as I say, if it's the wrong number, it will be taken badly.
And if the Fed can cut, do you think that the ECB would be reluctant to be diverging from it?
Yeah, I mean, it's going to be. I mean, the European economies and European equity markets are very much in favour of usually of a weaker euro, and a strong euro doesn't tend to be that successful for Europe. So I think they would feel pressure to do that. And the inflationary environment in Europe is relatively benign. We recently saw French inflation come back down to 2%, which was one of the last outliers, really. So I think there will be space to do that.
Paul, are we looking at a stagflationary environment in the US?
In extremis, yes. I don't think in reality it's not. I don't think this is looking like the 1970s just yet. I mean, you've got to go through a lot more pain for that to arrive. But I think that the fear, particularly if you have a Fed which is not really being allowed to do what it thinks it needs to do, and you have a much higher energy price, there is a danger of that coming through.
Okay, Paul, great to see you. Paul Markham, Investment Director and Head of Global Equities at GAM Investments. Thank you. Well, let's check in on the core six, shall we? How these six stocks are performing this morning. We've been discussing defence. Rheinmetall is weaker, 0.25% this morning. So is Novo Nordisk, down 0.6%. But LVMH up 1.6%. Joining the relief rally that we've been seeing across European equities, as is ASML, Schneider and Nestle. But let's get some of the individual stocks that are moving with Jennifer Creary. Jennifer.
Yeah, of course, it's no surprise that oil is reacting today after comments from US President Donald Trump saying that the war in Iran would end, quote, very soon. We've got Shell down 2.3%, BP down 2.5%, Total Energies down 2.3%. Also worth mentioning a bit of M&A action happening with Shell. Shell agreeing to sell Jiffy Lube and its subsidiary, Premium Velocity Auto, to Monroe Capital Partners for $1.3 billion. So those shares reacting off of the back of those various bits of news. Next up, we're going to flip over to defense as well. Also one of the losers from today's session. Rheinmetall down 0.3%. BAE Systems down 1.4% as well, off of the back of easing geopolitical tensions with the war in Iran. Next up, we've got Volkswagen as well. That's up 2.6% this morning. That's after fairly bearish comments from management. Volkswagen saying that it expects returns to remain under pressure this year on the back of higher raw material costs, intense competition and geopolitical tensions, but investors shaking off some of those concerns, boosting that stock higher. Next up, we've got Hugo Boss. That's up 5.5% as well. Hugo Boss, the German fashion retailer, its sales and profit for the full year beat expectations. Also, its sales outlook was ahead of the midpoint. Analysts noted the broad-based nature of that sales beat, and it says it indicates a very successful festive season. So those shares up off of the back of those results.
Jennifer Green, thank you very much indeed on some of the individual names on the move this Tuesday, touching in on VW, and we're going to be getting more details from Volkswagen reporting full-year earnings, as Jennifer was saying. We're going to hear from the CFO, Anton Antlitz. That is next. Stay with us. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Welcome back. We are 18 minutes into your Tuesday trading day. European stocks up currently 1.7%, snapping 4 days of losses. US futures also pointing higher, modestly so, up 0.3% on the S&P E-minis. Investors leaning in to these comments from President Trump in terms of a timeline around the war with Iran. A shortened timeline is what the president is flagging.
Well, one of the gainers this morning is Volkswagen. Shares are up 2.7% at the moment. It's said that it expects to remain, returns to remain under pressure this year as higher raw material costs, intense competition and geopolitical tensions combine for a challenging outlook. The CFO, Arno Antlitz, says that operating margins aren't sufficient in the long run as Europe's largest automaker targets more sales in the US. He's been speaking to Bloomberg's chief European correspondent, Oliver Crook, earlier this morning.
2025 was indeed challenging. We saw geopolitical tensions, tariffs, and increased competition in the global market. And against that backdrop, we brought 30 new models to our customers. We took some significant step in restructuring the company. And last but not least, we achieved a solid cash flow of 6 billion, more than 6 billion, and thus contributed to the financial robustness of the group. But part of the truth is also our operative result was down, and our margin was only 4.6%, even adjusted for one-offs and for restructuring. And this shows that the challenge in our industry, and this challenge continues for 2026.
And thinking about 2026, I mean, a lot of those challenges, as you've mentioned, are not gone, right? There's difficulty in the Chinese market. There is also difficulty in the U.S. market with tariffs. And increasingly, I think you'll have more difficulty in Europe because you have, for example, BYD, which will now be making cars within the EU tariff barrier starting in the next couple of months. So in terms of cost cuts, because this will be a focus for yourself and for investors, where are you going to be able to save on costs? And you've just, you've tallied the number of job cuts that you've had, 50,000 announced for 2020. 30. Are we going to have more job cuts, and where else will the cost cuts come from?
No, you're quite right. This was a lot of elements you mentioned. Yeah. We have to prepare for a more challenging competition also in Europe. The good news is so far, even with the new competition coming in, we even slightly increased market share in Europe. We stand by 25%, and the electric cars are even slightly better positioned. We even exceeded the market share of combustion engine and achieved a market share of 27%. So every fourth vehicle in Europe comes from the Volkswagen Group. So the electric cars are very well received. But you're quite right. We have to prepare for a more intense competition. So we have to continue to work on the cost side, reduce costs, reduce complexity, and draw even more group synergies. And this is exactly what we concentrate on in the next month.
And so where are you looking to save those costs? There's often been reports that you'd like to bring costs down an additional 20% by 2028. Is that correct? Is that the sort of ballpark that you're aiming for? And where will you be able to find those cost cuts?
First and foremost, we have to fully implement the current programs. So the current programs, they are well known, and you know them. It's, for example, Volkswagen AG, it's Audi and Porsche. Volkswagen AG, we want to reduce headcount by 35,000 until the end of 2030. And so in the first wave, we launched brand by brand. We launched, or group by group, we launched a significant program. So the next step should be drawing even more on group synergies, reducing complexity in the group, and so find they are the next level of improvement. This is how we want to continue.
And then thinking about the market in China, I saw from the results down 6% in 2025. What is your expectation for China in 2026?
We expect a flat market, basically. We are market leader in China in the combustion engine, but we have a very weak share in BEVs. But now, with all the new cars coming in from our tech partnerships, with significant better product substance, with 40% less cost than our current electric vehicles, we want to regain and re-engage also in the electric market. And the first cars hitting now the showroom March, April, and we bring 5 new models until Q3.
And then thinking about this, the situation, the war in Iran, obviously a lot of people have difficulty getting their arms around what it means for the European economy, for inflation and these sorts of things. For a company like Volkswagen, what is the immediate effect of the war in Iran on your, for example, energy costs, looking at your supply chains?
First and foremost, it's obviously concerning for our partners in the region or our customers and their families. In terms of business, I must say so far the effects are limited. In terms of energy supply of gas and oil, we normally work with long-term contracts, so the effect is limited there. And so far, we also see no major supply constraints, at least for the moment.
Oliver Cook, Bloomberg's Chief Europe Correspondent, speaking with Volkswagen CEO Arno Antlitz and ending the conversation there, talking about the influence of war in Iran and what that is doing to the wider Middle East region and what that means for their business. And that's something of a theme that's going to be running through a lot of the corporate earnings that we're dealing with. We've got a few of them hitting the Bloomberg terminal this morning. My eye caught by Linton Sprungley, the chocolate maker, because they too are citing geopolitical uncertainties as they report numbers. So they've adjusted their expectation for sales growth, and that growth number is going to be 4 to 6%. So they pulled that down from the previous number. Further out, they're looking at 6 to 8% sales growth. But in the short term, they do see that there will be an impact on their business from geopolitical uncertainties, from the effect in the region. And so that is a down weight on their share price this morning. The stock down by 7.7%.
And you referenced COVID earlier and the point that these companies, these corporates were tested and they're being tested again. And you pointed out that there was relative resilience, at least in pockets of the corporate space, in terms of being able to maintain these margins. But once again, corporates have been tested on the energy front, on the input front, on the FX front as well. Hugo Boss coming through. And this stock is up pretty significantly. We've got some analysts coming out with some lines on the back of what Hugo Boss has been reporting in terms of sales and profits for the full year ahead of consensus. RBC noting that the full-year sales and earnings were ahead of consensus and supported by improved sales growth in all regions and channels, and also by wholesale timing shift benefit. That's the line from RBC. JP Morgan saying that better fourth quarter retail performance and no expected forecast.
Said that the conditions in the housing market have been supportive recently. They reported a rise in annual sales and profit, but we have to say they must be enjoying gilt yields down this morning as part of that global relief rally.
Because they were not enjoying them yesterday. Real estate was the worst performing sector in Europe yesterday, and that had a lot of the house builders in it. So we're seeing a bit of a bounce back there. But to your point, Lizzie, about gilt yields, certainly at the short end, we are quickly rethinking the panic we had about higher rates in the UK yesterday, unwinding some of that, and we see 2-year gilt yields down by 14 basis points this morning.
Yeah. You're back below. You were above 4% at one point on the 2-year yesterday, and at one point yesterday the markets were pricing in an interest rate hike from the Bank of England. That has now been wiped out. To your point, markets again pricing in some easing, much more modest, of course, than prior to the conflict, but that's there anyway. In terms of energy prices, gas prices are down again. They're down today, down 14.5% in terms of European gas futures prices, and of course oil prices are lower, and that is the key catalyst for the session.
Coming up on the programme, as President Trump signals an end to the Iran war, at least that is his intention for it to end soon. We speak to Charles Myers from Signum Global Advisors about the possible end game for the conflict. What's happened to the goal around regime change? We'll get further details. This is Bloomberg.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and as you can see, European stocks are playing catch-up to that relief rally that we saw on Wall Street yesterday, off those comments from President Trump saying that the war in the Middle East will resolve very soon. Underperformance here in London because we've seen oil down, and of course the FTSE is exposed to energy, but oil weaker is the reason that we're seeing relief around the world. We've seen it in Asia, and we're set to see it in the Wall Street session today as well. Tom, what are you seeing under the hood?
Yeah, let's get a little bit more granular then. Of the 600 members in the Stock 600, 540 in positive territory, which tells that story that Lizzie was outlining for us. On the downside, 54, and amongst those will certainly be the energy names on lower oil prices and gas prices today. Volumes are up, and that has been reflected, up 25%. Let's flip the board and have a look then in terms of some of the gainers coming through. So, possibly on expectations that there will be some relief around supply chains. We're not there yet, of course. The Strait of Hormuz remains largely and effectively closed. ASML, though, is up 5%, maybe on some of that optimism, justified or not, about the Trump timeline around this conflict. Banco Santander is gaining 5%. That seems to be on the news that the chair, Anna Botin, acquired 2.9 million euros worth of shares last week. That may be one factor. The other factor, of course, is going to be the rally in bonds that we're seeing with the yields down, and that is supporting the broader banking space. Persimmon is also benefiting from lower yields, the rally in gilts, and also some strong results in terms of what came through for 2025, and an upbeat outlook as well for that house builder, up 10%. On the downside, let's flip the board and have a look what's happening in the energy space. Again, it's a mirror image from what we saw yesterday when the oil majors rallied on higher prices and that remarkable historic day in the oil markets yesterday. Today, of course, oil prices are down, and so that is weighing on the names like Shell. Total down 2.5%. Rotor, this is a different story. It's a holding company, and it's down after a subdued outlook, lower than the projected dividend. It's down 9.5%. Anna.
Let's get an update on some of the other stories that we're tracking this morning, Tom. Apple increased iPhone production in India by about 53% last year to get around US tariffs on imports from China. The company now makes a quarter of its iPhones in India. That's around 55 million devices. Anthropic has sued the US Defense Department for declaring it a risk to the American supply chain. The declaration was made after Anthropic refused to bow to Pentagon demands to remove safeguards on its technology. The AI giant says it's being excluded from government business for disagreeing with the US administration. And TSMC sales rose 30% in the first 2 months of the year, buoyed by the robust pace of AI infrastructure construction prior to the outbreak of conflict in the Middle East. Analysts on average expect a 33% increase in the first quarter. The go-to chip maker for NVIDIA, AMD and Broadcom serves as a barometer for the global AI industry.
So, President Trump says the war with Iran would resolve, quote, very soon. No, he didn't say, or he said he didn't think and believe the conflict would be over this week. Take a listen.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay. And with respect
Very soon. Look, everything they have is gone, including their leadership. In fact, there are two levels of leadership, and actually, as it turns out, more than that. In fact, there are two levels of leadership, and even actually, as it turns out, more than that. But two levels of leadership are gone.
So what is the potential end game to the Iran conflict, and are we getting closer to that? Let's bring in Charles Myers, founder of Signan Global Advisors, joining us around the desk. Charles, thank you for your time. The markets seem to think that this president is now looking for an off-ramp. Are they right?
Oh, absolutely. We've had a base case of a very short war, 1 to 2 weeks. I think that with the price action in the oil and gas markets yesterday, in the U.S. bond market, it's really sort of forced the president's hand a little bit to look for off-ramps. And he, I think in the next 5 to 6 days, will declare victory. Victory, as everyone knows in war, is subjective and really defined by the winner. And I think it will be three things. We prevented Iran from getting nukes, nuclear weapons. Secondly, we've decimated their ballistic missile program, and third, we've kept the Strait of Hormuz open. So I think that the worst of the kinetic part of this war, we could hit Israel one more time very hard in the next 3 or 4 days, but the worst of the kinetic part will be over by the end of this week.
Hit Iran, presumably.
Sorry, Iran, sorry.
Yeah.
Yes, Iran.
Well, you mentioned Israel. What is the relationship right now between, is there tension between Israel and the US in terms of how far to pursue this? You see a 5 to 6 day time frame for this conflict coming to an end. Is that how Israel looks at it as well?
Well, I think for Israel, at the end of the day, they're working very closely with the U.S. I've never believed the narrative that they dragged the U.S. into this war. I think what Israel will do when we get to this off-ramp, when we talk about getting to some kind of ceasefire or the beginning of talks, Israel will pivot to trying to finish the job in Lebanon. They're going to continue the war with Hezbollah. I think they could invade Lebanon. As part of that, I think it's going to be absolutely brutal, but I think that that's one of their other objectives that will become a priority once we wind down this war in Iran.
You said that President Trump will claim victory in 3 areas, Charles. One of those was keeping the Straits of Hormuz open. I mean, on the nuclear weapons, it might be more feasible to tell whatever story suits. But on the Straits of Hormuz, there's plenty of visibility as to what's going through there. And we hear from those in the shipping industry that insurance is not the only thing that's needed, not even naval accompaniments are the only thing that's needed. At the end of the day, if the captains don't feel safe going through, they won't go through. I mean, what really keeps that or even reopens that? Because it does seem to be effectively closed.
Yeah, I'd say a couple of things. One, again, when President Trump declares victory or that he's won, it just means that the worst of the kinetic part is over, I think, by this weekend. Again, acknowledging there could be another short-term major hit on Iran by the United States and Israel. On the Strait, I think President Trump was very clear that we will literally take it over, so to speak, which I think is not only providing the insurance backstop, which is really moving very quickly at the moment in the U.S., to provide that coverage, but secondly, to divert some of our ships, probably starting this weekend, Navy ships to help with escorting. So again, we're not completely out of the woods at the end of this week. Once victory is declared, there will be ongoing volatility. The Strait will remain a major focal point of concern, volatility, possibly a couple drone strikes, but I think you'll see the U.S. military presence pivot to much more to the Strait to try to ensure safe passage or at least passage.
Yes, and the 3 areas that you said that President Trump will declare victory on didn't include regime change, crucially, and that was something that he has mentioned in the past. I mean, you can tell 2 different stories right now, can't you, around regime change? You can say the son of the previous Ayatollah has been appointed, that's not regime regime change, or you can say, as President Trump did in that clip, 2 levels of their leadership have gone, which sounds more like he's building up to argue that maybe there has been regime change. How on earth do we unpack the intention there?
Yeah, so 2 things. On regime change, that was never the U.S. objective. That was Israel's objective. That's an example, based on your earlier question, of where the 2 countries' objectives might actually have differed.
He did talk about it when he made that first press announcement, first public statement about the war initially. He said this will be an opportunity for Iranians to rise up.
Oh, absolutely. But I think, like in Venezuela, this was really never about democracy for the United States or for the White House. I think this was about leadership change, domestic stability, continuing to allow oil and gas to flow. And so on your question on regime change, I think this is an example where President Trump has moved the goalposts a bit. It's now no longer one of the top 3 objectives, and he could claim, because the Ayatollah was killed, that in part involves leadership change. I actually think Israel is going to still go in and do exactly what they said, which is probably assassinate this Ayatollah as well. And so there is still, again, after this weekend, plenty of concerns and volatility, one of which will be another wave of assassinations possibly. So the leadership change and who's going to run the country is not yet resolved. I think that does take longer, but at least leadership change or regime change is no longer a key objective preventing us from getting to an off-ramp.
Well, what is your view of the new Ayatollah? Because, I wonder if he's worse from the US perspective than his father. I wonder if the fact that we're reporting he's a hardliner makes him perhaps easier to negotiate with for Trump because he has those credentials as a hardliner at home.
Yeah, look, I think, just objectively, they're both pretty terrible people, objectively. And I'd say that in the case of the son who's just been elevated, he just lost his father, his mother, his wife, and one of his kids, one of his sons in the attack. This is a very big deal. This is a very angry person. So I would expect him to continue to toe a very hard line based on who he is and what he just went through. I'm not sure it matters. Israel has been incredibly clear they will assassinate him if necessary, or remove him if necessary. And I think that as part of the broader leadership of Iran for the future, the religious leadership question has not yet been settled.
Well, yeah, what is the end game that markets should be bracing for? Is it just going to be a period of prolonged instability when it comes to the regime?
No, I would take the other side of that. I think, yes, there will absolutely be volatility. Again, the United States and Israel have not taken out and will not be able to take out Iran's drone program, for example. So we're looking at, I think, from this weekend onward, really kind of flare-ups in more of a terrorism way in the Gulf and in the Strait. But on the leadership question, I can tell you that the United States will not allow the new religious leader, the new Ayatollah, to go on TV and say death to America, death to Israel, and continue to take a very hard line. I think if he does that, his tenure will be very short.
Charles, can I just get your view on what this does to the domestic politics of the US under the time frame that you have outlined for us? Where does Trump come out of this with stronger support, or does he come out of this damaged as a result of higher prices as we lead up to the midterms in November?
It all comes down to timing. So he promised a relatively short, military operation. I think it's a war, but and the polling is very clear. A majority of Americans are against this. And he knows that. So again, if this drags on, if I'm wrong or we're wrong, and this drags on for weeks and weeks, then the polling will really hurt him in the midterms. The 3 things that I'm watching most closely, even this week, and we have since the beginning of hostilities, to try to determine at which point, what's the inflection point for an off-ramp? It's really 3 things. If the price of oil went above $100 and stayed there for a week, the president would pivot automatically to off-ramp or to ending the war and declaring victory. Secondly, if the 10-year yield went to 4.5, huge problem for the consumer, not to mention the bond market generally. And third, too many U.S. casualties, meaning 30 or 40 U.S. casualties. Any one of those 3 things would force the president to seek an off-ramp. I think oil, we got one of them, which was oil the last 2 days. But overall, the American people, if this is short, meaning a couple weeks, will be more than fine. The biggest issue is the price of gasoline because it affects every American household. I can tell you the White House is laser focused on that issue, and that's another reason we think this war will be relatively short.
And Charles, you're talking very much in the terms of the US deciding when this ends, and that might be the case based on military might. What is the risk that that's not the case, though? I mean, you've already set out why many in the Iranian regime might be very angry.
Yeah, I would say that what's probably underestimated in the analyses or the base, some of the cases out there on a longer war is how much harder the United States will hit Iran militarily. I think that we've moved even more hardware, even more sophisticated airplanes. So the possibility of a major strike on nuclear sites, military sites, government buildings, and another wave of asymmetrical cyber and assassinations is very real, even in the next 5 or 6 days. If this war were to be protracted beyond that, I would expect the United States to hit even harder militarily. The United States is not going to get dragged down or bogged down in a long-term war in Iran, given our military, along with Israel's superiority in this war. And lastly, I would just say, in this war, there's only one outcome, partly to your question. Iran will lose. They're up against the two most sophisticated, most powerful militaries in the world. So again, back to the first part of our discussion, if Iran is absolutely going to lose, what does lose look like, and what is the timing?
Charles. Really interesting context in terms of framing how we should be thinking about the next few days and the next few weeks when it comes to this war with Iran, of course, this US-Israel war. Charles Myers, thank you very much indeed, Chairman of Signum Global Advisors. Coming up, the Iran war, of course, remaining the dominant theme in commodity markets. We're going to get more insights and bring in Tulan Nguyen from Commerzbank on oil, but also soft commodities as well, around the choke point of the Strait of Hormuz. That is coming up. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. The reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
Welcome back. This is the opening trade. 8:46 here in London. Now, oil has tumbled after the US President Donald Trump says that Iran war will end soon. President Trump faced mounting pressure over a conflict that's upended global energy markets and sparked concerns about inflation. globally. Let's bring in Thulan Nguyen, who is a commodity and FX research head over at Commerce Bank. Thulan, nice to have you with us. Let me ask you about where you see oil prices settling then. We've got Brent down at 91.95, fluctuating a little bit, but down 7% versus the close of yesterday. We've been on a real incredible round trip when it comes to oil. Where do you see the next move for oil here?
Well, obviously, it's really difficult to say at the moment because everything depends on how the situation in Iran evolves. And obviously, we've come down, as you said, because U.S. President Trump has signaled that the war will end soon. Whether that will be the case will be decisive. So obviously, if the war indeed ends in, let's say, the next 2 weeks, I would expect the oil price to come down further. Not as much as we've seen a rise in it, but I would expect it to settle at least initially around $80 per barrel. And then as time goes on and basically shipping in the Strait of Hormuz normalizes, then I would expect it to come down to the levels we've seen prior to the outbreak of the war.
Okay, well, that's interesting because some have said that 80 is the new floor because $100 a barrel once oil has passed that level can mean that oil is quite sticky. So interesting that you see it going below that, Thulan. I also want to ask about other commodities because, of course, it's not just oil that's been impacted by the closure or effective closure of the Strait of Hormuz. How damaging is the war for the likes of wheat and corn and sugar, especially if this, in fact, does become a protracted conflict?
Well, obviously, the impact is more indirect in that basically wheat, for example, prices are rising because farmers will face higher energy costs, higher transportation costs, and this will basically inhibit production over the medium to long term. This is something that we've also seen after the outbreak of the war in Ukraine. But basically, this will impact crops in the coming season. And the same goes for the other soft commodities. As far as soybeans are concerned, for example, here one of the main drivers is the fact that because of the higher oil prices, biofuels become more attractive. And basically, this pushes the soybean production in terms of switching to biofuels. But obviously, all of these effects are going to subside if indeed the war in Iran ends. And we are already seeing this correction in the other commodity markets. And I would expect this correction to unfold in the soft commodity markets today and in the next couple of days. But as I've said, obviously, if the war in Iran does not end very soon, I think we could run into some issues regarding scarcity. For example, fertilizer is one issue. The Gulf region is a large producer here, particularly urea, and this could pose some problems in certain countries such as India. But as long as the war does not extend to a couple of months, I think this will only be a short phase of higher prices.
Thulan, let me bring this back to the oil price that underpins all of this, whether it's fertilizers or the ability to produce many of these agricultural products. Do we need to rethink the demand impulse for oil on the back of potentially weaker global economies coming out of this conflict?
I think so. I think this is also one factor which I think will determine prices going forward, and that's why I said that I would expect oil prices to come down below $80 per barrel going forward if the war ends, because even if we only have this short period of turbulence, I think this will impact over global demand, and so this will additionally weigh on the oil price. in the next couple of months. And that is also the case, obviously, if we have a prolonged war, obviously, right? Because then, yes, we have supply disruptions, but at the same time, we have significant impact on demand. So that's why I wouldn't expect oil prices to skyrocket beyond $140 per barrel, even if this war extends.
Tu Lan Nguyen, thank you so much for joining us. Commodity and FX research head over at Commerzbank. Good to see you. Well, let's get more on today's big market moves with Skylar Montgomery-Koning from our MLive team. She joins us now. Skylar, you've been writing that the heightened volatility is going to continue to be a headwind for global equities. Why?
I think we don't really know what the kind of fundamental backdrop is in terms of we don't know how long the conflict will go on, but we do know that markets have been whipsawed by the headlines around it. And we know that volatility, particularly in the equity space, has risen as a result of that. Now, that's a headwind for global markets because it means that for equities, for example, you need a higher equity risk premium because your cash flows are more uncertain. You have a more volatile asset, so you want a greater compensation for holding that. You also have the standpoint of it just naturally tightens financial conditions. So that means that, yes, your equity risk premium rises, but credit spreads widen as well, and that means you get less buybacks, less issuance. And then the third kind of point is that it can trigger mechanical de-risking. So we've seen de-risking in bouts, but if you look at something like a risk parity strategy, that naturally has to own less equity. As volatility rises, you get higher margin requirements, et cetera. And so if you have this environment where we have continued uncertainty, which seems the one thing that we can guarantee, you'll likely have continued high volatility, and that's a squeeze in itself.
Skylar, Signum's Charles Myers telling us earlier that he sees this conflict being resolved, or at least President Trump coming out and saying, we're done, in the next 5 to 6 days. What is the market reaction to that?
I mean, it's very positive, I would say, because you're going to get complete retracement of those oil prices. You're going to get equities undoing some of the losses that we've seen. It's more of a case for stronger global growth, less inflation, so then your yields are pulling back as well, which is better for equities. I'm just unsure how you can say that with a high level of certainty. I don't think the situation's changed quite a lot. We've gotten a bit more cheered up by this idea that maybe you'll get reserve releases from G7. I don't think that can counteract what's coming out of Hormuz. And then also, you know, we've always known that Trump didn't like higher oil prices, but I don't know what's changed in terms of the reaction function or what's actually changed on the ground in the last 24 hours to mean the Strait of Hormuz will open sooner.
Yeah, the markets will have to ask itself tough questions about what it means to end a war, because President Trump will have his own definition. The Iranian people and the Iranian leadership will have their definition. Israel may be on a different page, and the markets will have to come to their own conclusion. Is it all about the Straits of Hormuz and whether that remains effectively shut, or whether that reopens, and that's going to be the thing that really matters to markets?
That's absolutely the number one thing that matters to markets, because the feed through that you get to other markets beyond commodities is through your supply shock. So it's the fact that you have higher energy prices, higher gas prices, et cetera. That means that you get higher inflation and lower growth, which feeds into your equities and bonds coming down. It feeds into your impact in terms of energy exporters doing better than energy importers. And so anything that you see around supply coming back online, particularly, as I said, with relation to, you know, G7 reserves potentially being released, that can have a pullback in the market from the kind of risk-off move. And that's definitely what we're watching more than kind of conflict on the ground, because you can get conflict in places that don't have rich commodity markets, and there isn't a big market impact as a result of those.
Okay, Skylar Montgomery-Koning from our MLive team. Thank you. As we look at Brent prices at $92.49, down 6.6%. WTI $88 a barrel. European gas prices, in terms of the futures picture, also lower by 14% so far.
Yeah, and on stocks, we've got energy stocks, the only sector in negative territory today. Just a reversal really of yesterday's move. So energy is the only one in negative, down by 0.9%. The banking sector, as we were talking about with Paul Markham earlier on, really under pressure yesterday, bouncing back today. That sector up by 4.2%, as there was the threat of that sort of wrong type of interest rate hikes yesterday seemed to weigh on the banking sector, and today we get some relief from that.
Of course, we're catching up to the rally yesterday on Wall Street here in Europe, but US futures pointing higher again today. S&P E-minis and Nasdaq futures both up more than 0.3%, but it's relief around the world: Asia, Europe and the US. That does it for the opening trade. Bloomberg Brief is up next. This is Bloomberg.
Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersetchi. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Sorry.
It's 5 a.m. in New York City, 9 a.m. in London. Good morning. I'm Julie Fine in for Vonnie Quinn with your Bloomberg Brief. Let's get you started for the day. Stock recovery losing steam. Equity futures waver and oil slides after a dizzying start to the week. That as President Trump floats removing oil-related sanctions and predicts that the Iran war would resolve very soon. And Gulf nations agree to deeper oil production cuts as the Strait of Hormuz remains almost at a standstill. For a check on the markets, here's Christina Aquino.
All right, thanks, Julie. It is green on the screen at the moment, as you can see, across-the-board rally for U.S. equity futures. The S&P 500 up 0.2%. NASDAQ futures up 0.3%. A lot of those tech names have been under pressure over the last week, rallying today. Russell futures also up today about 0.1%. Let's take a look at the bond market as well. Going the other way, yields are now down as the inflation pressures from the Iran war easing a little bit after that climb down from President Trump overnight. Two-year yields just down about 1 basis point here across the board, really, for the 10-year and 30-year yield as well. Let's take a look at the energy complex as well. We're also seeing a climb down there as some signs of de-escalation emerge from the Iran conflict. Crude across the board lower here, down about $6 or so for Brent, trading around $92 per barrel. Remember, that got over $100 yesterday, and as a result, the Bloomberg U.S. dollar index down a little bit here, 0.2%.
Christina Aquino, thank you. And for some stocks to watch, here's Obir Omar.
Good morning, Julie. Let's start with TSMC and SanDisk. Now, these are two sides of pretty much the same coin here. TSMC reported some numbers, and it's about 30% higher when it comes to sales over the past 2 months of the year. So that's January and February before the events that happened in the Middle East. Now, SanDisk is one of those stocks that are benefiting on that news. TSMC provides chips to the likes of NVIDIA, AMD, and Broadcom, and so that is quite positive news for the hardware story that's already seen some gains this year, discounting the past couple of days on Mideast tensions. But we move on, we flip the board to another industry, and I've gone by for a while without speaking about Bitcoin, but Strategy Inc. is this company that is benefiting from the gains that we've seen in which is above $70,000 today. It's actually doubled down on Bitcoin, buying about over $1 billion in Bitcoin yesterday. So the stock is, that is reflected in the stock. Investors are looking favorably at that, up 2.7%. And then finally, on the back of the Mideast tensions, we look at some of the oil majors. Yesterday was a good day for them. Today, all of them are going down in the pre-market trade, and that is on the back of Brent pulling back from the gains we've seen yesterday, about $93 a barrel now on what is happening in the Middle East and President Donald Trump's comments on easing the war. Julie, back to you.
Thanks, Abir. And coming up in this hour, former Israeli Prime Minister Naftali Bennett joins us for a conversation on the war. Later in the hour, we'll discuss the implications of the supply shock coming from the Middle East with Wei Li of BlackRock. But first, President Trump hints at a possible end to the war with Iran.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay, and with respect
Very soon. Look, everything they have is gone, including their leadership. In fact, there are two levels of leadership, and even actually, as it turns out, more than that. But two levels of leadership are gone.
Oil continuing to fall from Monday's high as the Gulf countries deepen their oil output cuts, with the Strait of Hormuz still near shut. Let's go to team coverage with Bloomberg EMEA News Director Will Kennedy, Sam Dagger in Dubai, and Mika Solner of Bloomberg Government in Washington. Will, I want to start with you. Give us the latest on these production cuts.
Good morning, Julie. What these production cuts show is that despite the president's words, at the moment, with no end to the war and the Straits of Hormuz still effectively closed, the costs for the oil market and the oil industry continue to mount. They represent about 6% of global oil production, which is currently shut in, and that's happening because tankers can't load, tankers can't get out of the Strait of Hormuz, and so that oil has nowhere to go and has to stay in the ground. So the market is more optimistic about the outlook after Trump's words last night, but until those ships start moving, the implications, the impact for the oil industry, for the oil market, will continue to build.
Well, I'm curious, President Trump has also floated waiving some oil-related sanctions. So what kind of impact are you looking at there? What can we expect?
So this would focus both on Russia and perhaps even Iran down the line. Those two countries are under sanctions. Their oil output is sanctioned, but in truth, most of their oil has still been getting to global markets because over the last few years, they found buyers principally in India and China. So it will help ease the flow of oil out of the Middle East, out of Russia, if it comes into pass, but it will be marginal on the impact of global oil supply. It won't be a game changer for the global oil price.
What other measures are the White House considering?
Yeah, I think that White House officials are still in deep talks about what exactly they can do to try and ensure that these prices don't rise. But I can say for one thing, I mean, there is an alignment right now in terms of how this is going to impact the president's standing ahead of November. And they're very, very cognizant, as we just heard the president speak, about oil prices. And I think that they understand that increased foreign intervention and can ruffle those feathers. I know that it was steady after Venezuela, but I think that they're very closely monitoring the situation.
And Sam, can you give us the latest out of Iran this morning with all the changes?
Absolutely. Good morning. I mean, obviously, a lot more confrontation and defiance from Iran. We heard this morning, according to Iranian state media, the spokesperson for the Islamic Revolutionary Guard Corps saying that as long as this war continues and the attacks on Iran continue, not a single liter of oil will be allowed to be exported from the region. Those were his words. And obviously, yesterday we had the naming of the new supreme leader, and we've had reactions from the leadership in Iran itself. Ali Larijani, who is one of the most powerful figures in the regime, coming out and saying that, the selection of the new supreme leader, Mujtaba Khamenei, the son of the late Ali Khamenei, who was killed on the first day of war, is proof that that we're still here, and that America and Israel tried to put us, according to his words, in a dead end, but we've bounced back. And he's basically also had more defined comments directed at President Trump, saying that Americans must know that they will have to pay a price for what they did. We also had the foreign minister of Iran, Abbas Araghchi, addressing Gulf states, saying that you actually should not be complaining because he said your territories are being used to attack us. And this morning here in the Gulf, we have the Ministry of Defense of the UAE announcing that it has intercepted more Iranian missiles and drones being fired at the UAE. The same in Saudi Arabia. It said intercepted missiles and drones being fired at the eastern province and around an airbase outside of Riyadh. And we had the Ministry of Interior in Bahrain saying a woman was killed overnight in an attack on a civilian part of the capital, Manama.
Thanks to Bloomberg's Will Kennedy, Sam Dagger, and Mika Solner of Bloomberg Government. And the war with Iran sparking concerns around supply chains. Bloomberg spoke to the Volkswagen CFO earlier today as the car maker released its earnings.
It's obviously concerning for our partners in the region, or our customers and their families. In terms of business, I must say so far the effects are limited. In terms of energy supply of gas and oil, we normally work with long-term contracts, so the effect is limited there. And so far, we also see no major supply constraints.
Joining us now is Bloomberg's Oliver Crook, who conducted that interview. What do you think the effect the Iran war is having on the supply chains?
So I think this is one of the big questions that we've had and we've been trying to get our arms around ever since the war started here in Europe is what is the effect going to be on European companies, on supply chains, particularly industrial companies, as well as on inflation in the continent. I caught up with some of the ECB Governing Council members last week, and basically they said they didn't really know, that they really couldn't get their arms around the story and what the impact would be on inflation. So it was good to have an opportunity to speak to one of the largest industrial companies here in Europe. And you heard it there from the Chief Financial Officer of Volkswagen, Arno Antlitz, saying that basically because of how they've structured their situation with energy, they have long-term supplies, long-term contracts, that the shock and the increase that we've seen in gas prices is not going to have an immediate effect on their P&L and on their earnings. That being said, those are some of the upstream sort of concerns, the input costs for Volkswagen. There's also questions about commodities, being able to get, for example, that aluminum supply, get the actual deliveries of the cars, much of which are shipped on cargoes on ships across the open seas, which obviously are constrained by the situation in Iran. But for the time being, they say that the constraint, that they are not being terribly affected about it. That being said, if this were to be prolonged, he is concerned about the fact that this input cost could go up for all of their suppliers. Their suppliers could raise prices. And of course, there's the question of consumer sentiment. If there's higher inflation in Europe, higher concern in Europe, are you really going to go out and buy a car?
I'm also curious what else stuck out to you about the earnings.
Yeah, if you want to look at the earnings from Volkswagen, if you're looking for green shoots and a sort of positive story on the German industrial story, you did not find it in Volkswagen earnings for 2025. They gave their full year results. We should say that the operating profit for Volkswagen, it was the lowest it has been since 2016. That was the throes of Dieselgate. Same thing on margins. We saw the margin come down to 2.8% for selling cars throughout the year of 2025. Again, that's the lowest since 2015, I should say, in the throes of Dieselgate. That being said, they took a lot of one-off write-downs in terms of EVs and sort of pivoting their strategy, so that should not be represented in the year to come. That being said, a couple other stats for you. They only sold 266 Porsches last year, and the margin that they had on Porsche was 0.3%. That means that they basically made no money selling Porsches. The year before, the margins were 14.5%. That sort of illustrates the difficulty that Volkswagen is experiencing, not just in the American market because of tariffs, but also in the Chinese markets, where we had a sales decline of 6% last year. That puts the question of cost cuts squarely in focus, and that's what I asked the CFO of Volkswagen. Where is he going to find those cost cuts? Have a listen.
We have to prepare for a more intense competition, so we have to continue to work on the cost side, reduce costs, reduce complexity, and draw even more group synergies. And this is exactly what we concentrate on in the next month.
So cost cuts are squarely in focus for Volkswagen. Just a final word, the only sort of market, one of the main markets we saw actual growth last year was in Europe at 5% growth. That being said, in the next couple of months, you're going to have BYD, the EV maker from China, making cars within the European Union, within the tariff barrier for the first time. So competition is going to heat up here. And one final point, and this I found really very interesting, is when Volkswagen and the ways in which they're trying to find growth, we understand that they're going to be teaming up with defense companies. So Volkswagen could be making vehicles for the battlefield, which is part of one of the industries that's really outperforming here in Germany.
Interesting interview thanks to Bloomberg's Oliver Crook. And now on to the other top stories trending on the terminal this morning. The war in Iran hit some of the world's biggest hedge funds. Millennium and Point72 lost hundreds of millions of dollars last week due to the broad sell-off. Millennium lost $1.5 billion. Belsanni declined by 3.5%. Point72 lost 1.1%. A top Pentagon official sees little chance of reviving the Anthropic AI deal. Defense Undersecretary Emil Michael told Bloomberg that Anthropic's lawsuit challenging the government's decision to declare the company a supply chain risk was an expected reaction, but it wouldn't alter the Pentagon's decision. TSMC sales grew 30% in the first 2 months of the year, buoyed by the pace of AI infrastructure construction. Revenue in January and February rose to about $22.6 billion. The go-to chip maker for NVIDIA, AMD, and Broadcom serves as a barometer for the global AI industry. And coming up, former Israeli Prime Minister Naftali Bennett joins us. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. See, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Julie Fine in New York. Let's head over to the Middle East. Bloomberg's Jumana Bersachi with the former Israeli Prime Minister Naftali Bennett. Jumana.
Thank you, Julie. Yes, good afternoon, good morning, everybody, and thank you for joining our show. I'm going to start with the news of the day. President Trump indicating that he may want to end the war, quote, very, very soon. What does that mean for Israel's military objectives? Should the U.S. decide to end the war in the coming days, how would Israel respond?
Well, President Trump has been clear about the goals of this war. The primary goals are to dismantle Iran's nuclear capabilities and ballistic missile capabilities. And create an opportunity for the Iranian people to change their own life and fight for freedom. Can you hear me?
Are we seeing divergent? I can hear you. I just want to reiterate this point. Are we seeing divergent objectives between what the U.S. want to achieve and what Israel want to achieve from these military operations?
No, it's the same goal. The goal is to turn Iran from a nuclear and ballistic missile threat into just a regular country that stops threatening its neighbors. Both the United States and the Israeli Air Force have worked over the past 10 days to sort of clip off those capabilities, but we need to ensure that it's a permanent change and that Iran doesn't go back and nuclearize itself.
And how long, in your own assessment, is that going to take? Are we talking days, or are we talking weeks, or are we talking months here?
As long as it's necessary. Look, the Israeli people are paying much of the price because we're the ones who are being hit by missiles and rockets and in shelters. But we understand that if we didn't act now, then 2 years from now, we'd have a monster so strong that we wouldn't be able to act anymore. So we have the perseverance to see this through.
Iran's messaging has been one of defiance. The nomination of the new supreme leader, who's the son of the late supreme leader, they've hit back, not just at Israel, but at Gulf states as well. We're seeing mounting economic costs, a lot of damage and disruption to global energy markets. Did you underestimate the ability of the Iranian regime to hit back?
Quite the contrary. It actually proves precisely the point. Iran's regime is a formidable regime that's been working on this for 47 years. This war didn't start 10 days ago. It started 47 years ago when Iran declared America the big Satan and Israel the small Satan and started its industry of death and destruction. So it's taking time. 47 years to dismantle takes a few more days or weeks, as much as is necessary.
Do you see this as the final war that Israel is going to engage in with Iran? Because, of course, you know, there was the 12-day war last June, and here we are in another situation where there's another attempt to, quote-unquote, finish off the job, as many of your peers have said. Do you see this as the last war?
Well, we would very much hope that the outcome of this war is that Iran's regime decides that they're not going to continue enriching uranium, that they're not going to continue producing more and more ballistic missiles. But one way or another, we will always need to defend ourselves against looming threats.
And you've spoken in the past about what a weaker regime would mean in terms of empowering everyday Iranian people. There are no signs yet that Iranian people are once again taking to the streets. Do you think that that can actually happen in the absence of ground troops being committed to Iran?
Look, we cannot tell the Iranian people what to do. We can create the environment that would allow them to uprise. We are weakening the seams of this regime. We're weakening the apparatus. It's growing weaker and weaker, and there won't be a more opportune moment than now. But ultimately, it's their decision, not ours.
You've spoken about striking the head of the octopus, and indeed, we saw that in the early days of the operation, some key personnel at the top, right at the top, taken out. But as we know, there are several layers to the regime's power structure. What would it take to dismantle them?
Well, the head of the octopus is the entire Iranian regime. And if it falls, then all its tentacles will just dry out. It means that Hezbollah won't get the $1 billion a year and will dry out. Hamas, Islamic Jihad, the Houthis, the Iraqi arm of Iran. So if you cut the head of the octopus off, you solve 70-80% of the problems in the Middle East. That's why this campaign is just so important. I've been pushing for this for about a decade now, that we shouldn't be fighting the tentacles. We should go to the head of the octopus, and now we're doing it. And it's the most important and effective, potentially effective campaign that could be.
You're saying that you've been, advocating this for many years now, but are you going to be the politician who reaps the rewards from this, or is it going to be the current Israeli Prime Minister Netanyahu, obviously heading into crucial elections later this year?
This is not at all about politics, and you're right that Netanyahu is my opponent. I'm his opponent, and I think that I should become the next Prime Minister of Israel. However, on this issue, there is no daylight between Netanyahu and myself, no daylight within Israel, and no daylight between Israel and the United States. We stand together to dismantle the world's biggest nuclear threat, which is Iran.
Let me ask you about one of those tentacles that you just mentioned, Hezbollah. And because there's a new front that's opened up in Lebanon, what would be an acceptable outcome for Israel? Would it be enough for Hezbollah to disarm, which is what the Lebanese government are now publicly advocating for, to put down their arms but remain a political party? Or would that not still be an acceptable outcome for Israel?
As you said, disarmed Hezbollah, from our perspective, if there's no military component there, and they cannot threaten our people in the north, that's what we want. We don't care about the internal Lebanese politics. We do insist that we don't have a monster as a neighbor.
Okay, I'm gonna round up with one question, which I think is very crucial as well, given the missile interception over Turkey. You in the past have referred to Turkey and said, we should not turn a blind eye to them, suggesting they may be more aligning more closely to a regional axis, including Iran. But obviously the tables have turned in the last 24 hours, with Turkey also having to intercept some of the missiles that have been directed towards them. Let me just ask you whether there's a risk of further confrontation with Turkey based on comments that you said in the past.
Well, we need to ensure that Erdogan doesn't create a new alliance of radical Islam Sunni version, meaning an axis between himself, Julani, Qatar, and Hamas. We've been facing for many decades the Shiite radical Islam, and I hope that Turkey doesn't choose to foment terror and Islamism in its power. It's up to Turkey ultimately. If they seek peace, we definitely want peace. But if they try and surround us with terror, we will not sit idle.
Thank you, former Israeli Prime Minister Naftali Bennett. We appreciate your time.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion, and now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City and 9:30 a.m. in London. Good morning. I'm Julie Fine in for Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stocks rise and oil slides after a dizzying start to the week. That as President Trump floats removing oil-related sanctions and predicts that the Iran war would resolve very soon. And Gulf nations agree to deeper oil production cuts as the Strait of Hormuz remains almost at a standstill. For a check on the markets, here's Christine Aquino.
All right, Julie, it is still very much a green kind of day here, at least when you're looking at equity futures. Again, U.S. futures across the board really rallying, extending those gains that we've seen earlier. The S&P 500 futures now up 0.3%. An outperformer is the NASDAQ 100. That's up nearly 0.5%. Again, a reminder, some of those chip stocks, some of those big tech names really bearing the brunt of the sell-off that we've seen over the last couple of weeks, so rallying in a big way today. And of course, Russell futures still very much in the green, 0.3%, as those economy-sensitive stocks also gaining here. Let's take a look at the fixed income space. A little change here at the moment. Maybe yields trending slightly higher here as investors now try to figure out what this means for the fixed income and inflation outlook in particular. Now, let's take a look at energy as well. We've seen crude, again, climbing back down from that over $100 level. Brent crude now trading at $90 per barrel, 88 cents, down about $8 at the moment here, Julie. So very much a climb down from the moves that we saw on Monday.
Christine Aquino, thank you so much. And for some stocks to watch, here's Obir Abu Omar.
Good morning, Julie. Some pretty tranquil morning this morning compared to what we saw yesterday. But some interesting macro stories when we dig behind the scenes. Now, we've got TSMC, which had earnings today, and it suggests that sales over the first 2 months of the year were up 30%. Now, that's leaving an impact on stocks that depend on hardware. SanDisk is one of them. It's had a whopping increase over 100% since the start of the year. Adding to those gains, we see TSMC pairing some of the gains from earlier. But TSMC is the chip provider for the likes of NVIDIA, AMD, and others. Now, if we flip the board and look at Strategy, it's up 3.3% in the pre-market trade this morning. Now, this is a story where Strategy yesterday bought over $1 billion in Bitcoin. Bitcoin is doing quite well since the start of the war in Iran. And speaking of the war in Iran, Iran, we turn to some big oil companies. We flip the board and we look at the likes of Chevron, Exxon. They were among the best performers in the S&P 500 yesterday. Today, not so much, pairing some of those gains from earlier as President Trump's message towards the war in Iran eases some of the pressure on Brent crude prices that are around $90 a barrel now. Julie, back to you.
Thanks, Sabir. And joining us now is Wei Li, Global Chief Investment Strategist at BlackRock, alongside Bloomberg's Market Today Managing Editor Christine Aquino. Thank you so much, both of you, for being with us. I want to start with what happened yesterday. President Trump signaled the end of the war. S&P rallied. Oil came down after hitting records. Love to start with your reaction to that.
Thank you for having me. I think the cure for higher oil price is higher oil price, right? But more broadly, I think yesterday we saw again immutable laws in action. Last year, we framed kind of market uncertainty around immutable laws, i.e. things that are so fundamental to workings of economy and markets that they cannot change very quickly in the near term, and they can actually influence outcome. So one such immutable law is supply chain and the fact that it cannot rewire within a short period of time. And the Middle East conflict is not just about energy and oil supply disruption. It's about fertilizers, it's about food prices. My colleagues were flagging to me about the helium prices going higher, a lot higher as well. So that is one immutable law that can govern and shape the outcome. And the other immutable law is debt servicing cost through the feedback loop that is spiking yields. So the takeaway here is really that it's somewhat similar to last April, I would say, which is that uncertainty does not automatically mean risk off. Predicting the blow-by-blow policy announcement is extremely difficult, but appreciating immutable laws governing how economies operate can really help us narrow near-term paths and also around conviction of risk-taking, especially as we have seen again and again that markets have gotten quite used to and really easily influenced by near-term extrapolation.
All right, Wei, I know that one of your views, of course, is underweight long-duration treasuries. I'm sure that view is working out quite well at the moment. But against that context, what do you make of the current environment and the market's outlook on the inflation premium? Is that something that you think is becoming more permanently embedded, or is this something that could still be transitory, as some Federal Reserve officials last week have alluded to?
Well, there are quite a few pieces driving inflation dynamics in the near term and the longer term. In the near term, obviously, the duration of the Middle East conflict would have a significant kind of impact on near-term inflation expectation. But here the key is that even without a prolonged disruption through Middle East, the shock could still be enough to disrupt the low inflation, low interest rate narrative that had been dominant in markets until very recently. So that's definitely something that we're watching for. Over the longer term, I'm paying very close attention to wage dynamics because ultimately, if the average hourly earnings are still kind of topping expectations, growing at 3.5% 3-month annualized pace, which is more consistent with core inflation kind of getting closer to 3 rather than 2. When that is the case, we definitely cannot be complacent about inflation longer term. So all of that actually paints a picture of sharper trade-offs facing the Fed as we head into the next Fed meeting.
Yeah, you just touched on that. Inflation, of course, coupled with the war, it does cast some doubt on whether the Federal Reserve will be able to cut rates and the ECB could actually raise them. So
right now, markets are pricing 1.5 additional cuts for this year. We see no reason to push back against it. Labor market could still give the Fed some cover to keep cuts, but obviously offsetting that is inflation pressure from wage dynamics. So the growing division within the Fed is really a feature of this environment, highlighting the tougher trade-offs facing the Fed on the one hand between inflation, on the other hand between debt sustainability. So we don't see reason to push back against the market pricing about 40 basis points of additional cuts for this year for the Fed and for ECB for that matter, because of the more vulnerability of the European economy to energy shock, right? So if the disruption were to persist into months rather than weeks, which was not our base case, and now looking even less likely, but if that were to happen, we run the scenarios, it would push inflation higher in Europe by almost 1%, and the equivalent in the US is half that, right? So Europe being more energy reliant would be more susceptible to that, which is why the market dynamics is diverging a little bit in terms of pricing for the ECB versus the Fed.
All right, Wei, we don't have a lot of time, but beyond Iran, of course, markets were already dealing with private credit scares, AI scares, and now we have geopolitical conflict. Do you think we're at a tipping point here in terms of risk appetite? Is this something that could fundamentally change the way investors approach risk moving forward?
Well, I would say that what governs our asset allocation and risk appetite is really what I started this interview with, immutable law. So in the near term, headlines can be very volatile and can be really quite scary, but ultimately kind of what could function as a feedback loop is consideration around kind of the consequences of global supply chain needing to rewire very quickly. Can that really happen? And also the consequences of spiking yields, what that do to debt servicing dynamics, and understanding that allow us to keep our risk on view through recent days of market volatility, and we're sticking to it right now. And we don't talk about it as much, but actually the fundamental picture is holding up really quite okay. You look at earnings, the last quarter of earnings, US markets are surprising to the upside. Tech in particular, they grew earnings year on year close to just shy of 30%. I know market narrative shifted from the immediate kind of quarter to quarter earnings to longer term terminal value, but ultimately this is an environment where AI transformation creates winners and losers, and market sentiment can drive indiscriminate pressure, and that creates tactical dislocations and opportunities to be active.
Thank you so much for joining us, Wei Li of BlackRock. And now I want to go to the top stories trending on the terminal this morning. The war in Iran hit some of the world's biggest hedge funds. Bolsani, Millennium, and Point72 lost hundreds of millions of dollars last week due to the broad sell-off. Millennium lost $1.5 million. Point72 lost 1.1. A top Pentagon official sees little chance of reviving the Anthropic AI deal. Defense Secretary Emil Michael told Bloomberg that Anthropic's lawsuit challenging the government's decision to declare the company a supply chain risk was a, quote, expected reaction, but it wouldn't alter the Pentagon's decision. A quarter of Apple's iPhones are now made in India. It increased iPhone production in the country by about 53% last year to get around U.S. tariffs on Chinese imports. India has offered subsidies to help offset cost disadvantages faced by manufacturers. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay, and with respect
Very soon. Look, everything they have is gone, including their leadership. In fact, there are 2 levels of leadership, and even actually, as it turns out, more than that. But 2 levels of leadership are gone.
President Trump hinting that the U.S. and Israel were making significant progress in the war on Iran. Joining us now from Washington is Mika Solner of Bloomberg Government. Hey, Mika, what measures is the administration considering right now?
Yeah, so White House officials are weighing their options in terms of how they can bring down the price at the pump. One of the options that they're looking at is potentially a pause on the federal tax on gas. Now, that would require congressional approval, and it actually did not work under President Biden, who did attempt that same effort to bring down gas prices a few years ago. But another option the administration is looking at is potentially tapping into emergency reserves that the U.S. has that was created in the 70s. Now, that comes with its setbacks as well, as it can potentially tap into infrastructure funds, although it would bring down the gas prices for consumers.
And President Trump weighing several options to tame those surging gas prices. Can you go into that?
Yes, as I laid out, I think these are the 2 main options that the White House is looking at. The pause on the gas tax, or potentially looking into the emergency reserves and distributing it that way. But the president is very aware that this is an issue for him. The White House officials have seen the polling when it comes to the strikes on Iran, and that they remain unpopular with the public. So they're making sure that there is no long-term effect about gas prices so close to the midterms at this point, even though it's still months away. I think people are going to feel that in their pocketbooks, and while they try to make affordability a #1 issue.
And some Senate Democrats threatening to stall in the Senate until the president's team explains the war.
Yeah, there's a handful of Senate Democrats who have threatened to basically kind of hold the chamber at a standstill until there's more transparency from the administration. A lot of the briefings from officials, including Secretary of State Marco Rubio, have been behind closed doors. That has been a complaint from Senate Democrats, even some Republicans who say that they want these open door hearings and more answers in terms of what are the administration's goals, what are the clear their objectives, but most importantly, I think, what is the timeline for their efforts in Iran? So I think that, that's one way that Democrats in the minority can kind of utilize the power that they have to try and put pressure on the administration.
Thanks to Mika Solner of Bloomberg Government. And oil prices drop as Gulf countries deepen output cuts, shaping about 6% of global supply. The Strait of Hormuz remains at a near standstill. Bloomberg EMEA News Director Will Kennedy joins us now. Will, this has been a very difficult few days. However, there was some rebound yesterday as the president tries to decide what happens next.
That's right. Oil had an extraordinarily volatile day yesterday, one of the most volatile day in the market's history, a record fall from the intraday high to the closing price yesterday, all the way up to almost 120 and all the way back down to 92. The market took a lot of solace from the president's comments because if this war ends soon, the market will be able to begin the process of getting back to normal, getting that oil out of the Strait of Hormuz. But today, we've had an illustration of the fact until that happens, the problems in the oil industry will mount, as you're showing there. The output cuts that this situation is forcing on the big Gulf oil producers because they have nowhere to store the oil that they're producing are increasing. And at the same time, we had the Aramco CEO, Amin Nasser, talk during their company's earnings presentation and say that if this continues, it risks a catastrophe for the Middle East oil industry. So the stakes remain very high. At the moment, the market is taking the president at his word that it will end soon. But if that slips, if it continues, the problems will come back into focus for traders.
President Trump, of course, also floating waiving some oil-related sanctions. So what kind of impact are you thinking here?
Well, the two countries that are under sanctions are Russia and Iran itself. In terms of Russia, we've already seen some relief, which has allowed India to buy Russian oil without sanction. They had been a big buyer that had to walk back under the pressure of sanctions. Buying Russian oil again allows them to replace some of the oil that's been lost, and there's lots of Russian oil on ships. So that is one safety valve for the market, which is helping to relieve the worst of the pressure. And it may be down the line, if the war is settled, if the president finds a way to talk to the regime in Iran, that he would like to see oil sanctions lifted on Iran, but that's some way off. But he's clearly had in his mind throughout this some similar situation to Venezuela, where they replaced the leadership and they took control of Venezuelan oil. But again, that's a long way off. So it's important, but I think it's marginal to alleviating the current problems in the oil market.
Thank you, Bloomberg EMEA News Director Will Kennedy. I want to turn to tech now. U.S. shares of TSMC rising in pre-market after posting a sales growth of 30% on continued global demand for AI hardware. For more, let's bring in Bloomberg's Neil Campling. Neil, take us through those results.
Yeah, so if we look at January and February combined, you had 30% growth year on year, which is moving towards where the street are at for the first quarter, where analysts expect 33% growth in Q1. Basically, February was lower than January's growth, but that's all affected by the timing of the Chinese New Year. But clearly that taken with the numbers and also with other anecdotes, such as NVIDIA's recent guidance and HP Enterprise's revenue growth last night as well, is clearly continued spending on AI driving those results, which is another positive in terms of the tech AI hardware trade.
Oracle earnings on deck after the market close. What are we expecting?
I think one of the main things we're expecting is volatility around the results. Expectations are for a 10% swing on earnings, either negative or positive, and I think very much as a case of what will they say again about that AI capex. I think personally it's probably too early to get a read on the longer term outlook because it's not their fiscal year end. That will come after May's results. But clearly with the equity down 50% from where they were in September and the cost of their debt in terms of CDS spreads going up significantly in recent months, there's going to be focus on free cash flow, which has been negative, and the levered balance sheet, which sits in contrast with other big cap tech stocks. So that outlook in terms of the spending and relative to where the growth rates can be which is lower than many of the big cap peers. They're going to be sort of certainly watches for the numbers and the tone on the conference call and analyst questions.
Thank you very much, Bloomberg's Neil Campling this morning. And coming up, we'll get you set for your trading day with economic data and earnings on deck. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is obviously concerning for our partners in the region or our customers and their families. In terms of business, I must say so far the effects are limited. In terms of energy supply, of gas and oil, we normally work with long-term contracts, so the effect is limited there. And so far, we also see no major supply constraints.
Now a look at what's ahead today. First up, ADP weekly unemployment numbers are out at 8:15 a.m. New York time. Then Treasury will auction $58 billion of 3-year notes at noon. And Oracle earnings come out after the market close. We'll have a market check here shortly. Let's start right now. We're seeing the intraday is up. S&P futures are up again. NASDAQ 100 futures are up. Intraday Russell 2000 futures are up 8.60, which is good news after what we saw yesterday. The 2-year yield is up. The 2-year yield is down. The 10-year yield is up, and the U.S. 30-year yield is up, which is making much better after what we saw with everything with oil yesterday, and everything seems to be coming back slightly today. Take a look at crude and Brent crude and the U.S. dollar responding from yesterday. Oil again was up over $100. Now it's under 90. So we're seeing these numbers improve slightly after everything that we saw. That's it for the Bloomberg Brief. Surveillance is ahead. This is Bloomberg.
such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There is spectacular amounts of volatility.
It feels like we should kind of sit on the sidelines for a moment here.
The market is looking for just what the off-ramp could be.
This doesn't feel like the beginning of a great year.
Eventually, that volatility will create great buying opportunities.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, following crude volatility.
This was just an excursion into something that had to be done. During this brief disruption, we're way ahead of schedule, and it's going to be ended soon. And if it starts up again, they'll be hit even harder.
The president's verbal intervention slamming the brakes on a major oil rally, even as key producers across the Middle East are continuing to cut output, and Iran's military is showing little sign of looking for an off-ramp. We begin this hour following a wild swing in crude from almost 120 at the highs before plunging into the 80s at the lows. One line from the president, whipsawing investors, "I think the war is very complete." Pretty much. The verbal intervention capping energy markets, the reality on the ground curbing some of the enthusiasm. Across Saudi Arabia, UAE, Kuwait and Iraq, oil production cuts are totaling about 6.7 million barrels per day. The squeeze on supply continues.
My question is, how tradable is this market? As you mentioned, on a fundamental standpoint, that's about 6% of the overall market supply in the world. That is a significant hit. At the same time, people can look past that if they can understand some sort of forward trajectory. Well, good luck with that when it can be dictated by a single comment.
Amin Nasser, Saudi Aramco. This quote right here. I've spoken to Amin in the past, pretty conservative guy. Not the kind of guy that makes things sound more dramatic than they actually are. This one by far is the biggest crisis the region's oil and gas industry has ever faced.
Yeah, and he goes on to say there would be catastrophic consequences for the world's oil market the longer the disruption goes on. So once again, this is about the timeline, not necessarily just the production output cuts right now, which goes to the statements that are whipsawing markets in record form. At what point can you get a sense of an off-ramp until there is real policy behind it?
Just go through things piece by piece in the last 24 hours. Direct verbal intervention from the president. We saw the G7 finance ministers open to releasing reserves. A report from Reuters that the White House is considering a range of offsets as well, and a vague throwaway line about sanction relief as well. But what have we actually done? The answer to that is not a lot.
Which is the reason why I think there is some skepticism. And again, it goes back to how much conviction can any trader have when you have a $36 swing in Brent crude in one day, the second biggest on record. You start looking at those types of swings. You start looking at the fact that Millennium, Balyasny, and .72 have all suffered massive losses. You think about momentum bets that have been stopped out. At this point, this is a difficult market to get conviction, and that's the reason why, even if there are statements that sound good, you are not going to get the stability that so many investors are looking for.
Looking for stability in the equity market. Equity futures right now in the S&P positive by about 0.2%. Coming up this hour, we'll catch up with Nate Turth of Manulife, with markets whipsawed by geopolitics. Stephen Kirk of the Council on Foreign Relations as the president signals an early end to the war, and Stephen Schork of the Short Group following crude's biggest intraday swing on record. We begin this hour with our top story. President Trump saying the Iran war's objectives are nearly complete and the war could be resolved very soon. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, good morning.
Hey, John, good morning. Well, President Trump is suggesting an early end to the war, but cautioned that it's not over yet. The president maintains that the U.S. is ahead of schedule in achieving its military objectives, but went on to say he doesn't think that the conflict will resolve this week. He says the U.S. military campaign will not stop until he is satisfied that Iran will not be able to obtain a nuclear weapon, saying in part, quote, the U.S. has won in many ways, but it hasn't won enough. Now, the president did also threaten to expand the list of military targets to electricity infrastructure if disruptions to the Strait of Hormuz continue. He reiterated the U.S. Navy stands prepared to escort tankers through the critical waterway, which remains effectively shut with no finalized plans from nations to safeguard ships. And new this morning, Bloomberg News now reporting that it appears electronic warfare is jamming signals in the Strait. As oil remains top of mind, as you mentioned, the president mentioned yesterday that we could see some oil-related sanction waivers, though he didn't provide many details beyond saying that he discussed the possibility in a phone call yesterday with Russian President Vladimir Putin. John, people familiar with the matter tell us here at Bloomberg News that the administration has been mulling several potential options to help out with prices in recent days, including a potential federal gas tax holiday or even dipping in to emergency reserves. I will point out we got a statement yesterday after President Trump's comments from the IRGC maintaining that it will continue to block oil exports until the U.S. stops attacking Iran.
Tyler Kendall with the latest. Tyler, thank you. There's a story I often tell about August 2019 when the President of the United States, you know where I'm going, don't you? When the President pretended he had a call with the Chinese. And it was always about the signal and not about the substance. Because for a lot of people, that meant the president was looking for an off-ramp. It wasn't about whether the call had happened or not. The Chinese never verified the call. And I wonder how similar things are this time around. The difference between the signal and the substance. The signal is, for many people in this market right now, they believe the president is looking for some kind of off-ramp to confront this massive move in the energy market. The problem with this, unlike the tariffs, where the president was in almost total control, this isn't just about the US. It's also about Israel, and it's also about Iran. And to sit here and say things are going to end soon takes more than one person to say things are going to end soon.
At the same time, I think people are just trying to get into the mind of President Trump and hope that that's enough, but you're absolutely right, it's not.
Let's get to the view on Wall Street this morning. Nate Turth of Manulife writing, we could see economic growth diminish if policy uncertainty increases, corporate profit margins get crimped due to higher energy input costs, and higher gas prices will act as a consumer tax. Nate joins us now for more. Nate, good morning.
Thank you for having me.
What is the price for all this volatility?
I mean, I think the reality is we have a big pogo stick going on, right? We have a lot of up and down, and we don't have a lot of forward traction. And the uncertainty is very, very high. I think the price is that we live in a world where volatility continues to be the theme, at least in the near future. This, to your point earlier, the signal is there, as in everyone wants this to conclude quickly and the duration of it to be limited. But the reality is the on-the-ground activity and the idea that multiple players are involved could lead this to last a lot longer than many people think.
You've heard the comparisons to 2022 and this moment right here. What do you think the major differences are?
I think the comparison is that you have energy prices going up. what we don't know yet is the duration of that or the infrastructure and how wide that is, let alone the escalation, right? There's three big things there that we don't have the answer to. 2022, we saw this dynamic where oil went up for a period of time. We saw interest rates go up for a period of time, and then eventually things pass. I think this time around, you're probably in a similar scenario where you do see some damage in the equity markets for a period of time, but ultimately we flow through it and we have to focus again on the underlying fundamentals, which are going to be much more positive.
Well, people are treating this as though it's an inflationary shock, the way that 2022 was. Why don't you see it exactly that way?
Well, this time I think, one, we've experienced it before. And the markets, as they've seen one thing before, they start to accept the fact that that's a possibility and are less concerned about it. The other thing I think when you think about it is when we look at the dynamics here, oil, while very important to economies globally, there is solutions to this, and we do think there will be a de-escalation at some stage. It's a question of timing, right? And the longer we stay at high oil prices, let's say 100 or above, the more impactful it is to growth rates and inflation. We believe that from a developed markets perspective, if you stay above $100 a barrel for, let's say, a handful of months, you're arguably going to decrease growth rates by about 0.5% a year, and you're going to increase inflation rates about a 1% per year for most major economies. That's very detrimental to the markets, both from an interest rate policy perspective, but also from an equity perspective.
It's been treated like a stagflationary shock, which includes people selling long-term bonds. It seems like what you're talking about is somewhat of a different prescription. Why?
Well, I think why it's a bit different is I think this is short term. I don't think this is a secular theme that we are going into a stagflation period that's going to last multi-years. I do think ultimately you're going to have central bank policy members look through this and say, hey, we care more about jobs, we care more about growth, and we're willing to look through a temporary shock attached to higher oil prices if necessary. That's not their preference, but they were willing to if it's necessary. And ultimately we get to a point where we have energy prices get back to a level that's more stable and not at this 90 plus or 100 plus level. And I think that's where the market is hoping for, and I think that's what most policy as well as political members out there think. We will still be in an environment where we will get to a solution here where we don't have to see the worst case scenario.
What do you think that means for the stock-bond correlation?
I think that's a problem. I think the stock-bond correlation has been a problem and will continue to be a problem. And this is why we continue to look for ways to improve portfolio construction beyond just relying on interest rates or lower interest rates being your insurance policy.
Where do you go then?
You go to areas like commodities as an example. That has been a good hedge in these types of environments. You go to things like gold, which maybe is not working as well in the short term here, but has been working very well over the last couple of years. And you look at other types of alternatives.
Why do you think gold's not been working well?
I think gold hasn't been working well partly because it had been working well, right? It had worked very well for the last 2 years. You had a lot of players in there. Some of those players decided to exit either for liquidity reasons or for reasons that they made a lot of money and they want to protect their profits, right? And then you also had what appeared to be the two classic things that did work, which was the US dollar, and you had the overall dynamics of the market, such as oil, because that centerpiece of the geopolitical concern work. And so the trades moved into that.
If I'd asked this question 12 months ago, you would have thought I was insane. Is 5K a good entry point to buy gold?
I think it is.
Yeah, 12 months ago, that would have sounded nuts, but now this is a good opportunity.
I do. We still believe that secularly we will see higher gold prices over the next several years.
Going forward, I'm just wondering if you are ratcheting back your returns profile more generally overall, whether you think that investors have to expect that in a reindustrialized world with a higher rate of potentially inflation, but also lower growth, this means that you're just not going to get the same kind of returns.
You absolutely have to dial back your expectations. The reality is we are now in a world where equity valuations are high. We have uncertainty around yields, and they may not go down a lot. And so I think your expectations for total return from your portfolio, whether it's from the fixed income side or the equity side, have to be lower than what we've seen over the last 20 years.
Is the U.S. still the safe haven market?
I think for the time being it is. But I do think once we get through some of this more geopolitical dynamic right now, I think we are going to go back to a trade where you do see diversification outside the U.S., dollar dynamics start to be more on a back foot, as in dollar starts to depreciate again. So we think ultimately over the next several years, you are better served having a more diversified portfolio. But in the short term, US dollar is a safe haven trade that does provide some level of hedge.
Nate, it's good to see you. Thanks for dropping by.
Thanks for having me.
Nate Tuff there of Manulife Investment Management. That inverse correlation between the dollar and risk really started to kick in over the last few weeks, which flew in the face of some of the things we heard, 2 months ago in Davos, Switzerland, south of the US?
It was potentially the most painful trade that could have happened, given how offsides everyone was caught, and it only escalated the strong dollar position. And now you're seeing all these notes flood in saying, now the feeling is those have all been washed out, get long the dollar, and here we are starting the year all over again.
The international stock story has been quite a ride. The Nikkei and the South Korean Kospi getting absolutely hammered in the last couple of days. The Nikkei 225 in Tokyo actually bouncing back this morning, higher by 2.9%. Equity futures doing just about okay on the S&P 500. Up next on the program, I'm going to end to the war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so.
Up next, Stephen Kirk of the Council on Foreign Relations, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
One line for the President of the United States: I think the war is very complete. Pretty much. Equity futures look like this, a big bounce off Monday's low. Equity futures positive by 0.2% on the S&P 500. On the Nasdaq, up by 0.3 on the Russell, up by 0.1%, just about avoiding a third day of losses to kick off Monday trading. A kick-off trading this week, and what a ride we've seen already in the commodity market. At the highs, almost 120. At the lows, in the 80s. Brent crude down by 7% this morning at $92 a barrel. Now, a few weeks ago, 92 meant something. That was much higher than where we were. But 92 compared to where we were Sunday evening, that's a bear market.
It's amazing that the market can decline by 10% purely on President Trump saying, I think the war is very complete, pretty much, as you just said, saying that the U.S. is very far ahead of schedule. Then he went on to say, we haven't won enough, and that the conflict won't end this week. So a very difficult backdrop for people to get any confidence in.
Some contradictions in those statements yesterday, but ultimately the market heard what it wants to hear. Under surveillance this morning, I'm going to end to the war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion. We're winning very decisively. We're way ahead of schedule.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so. We could call it a tremendous success right now as we leave here.
So here's the latest this morning. President Trump hailing significant progress in the Iran war, saying the military objectives are pretty well complete. Joining us from Dubai is Bloomberg's Jumana Bassetti. Jumana, do the facts on the ground contradict the statement for the president in the last 24 hours?
Well, I think everyone in the region is taking it with a pinch of salt, and not least because the messaging coming out of Iran continues to be one of defiance. Just in the last hour, we had the Speaker of the Iranian Parliament put out a post on True Social saying that they have absolutely no desire to go for a ceasefire. Overnight, the Iranian Foreign Minister Abbas Araghchi also once again warning neighboring countries that if they hosted U.S. assets, they would be liable to attacks. And they say they should not complain if the Iranian missiles destroy U.S. systems on their territory. And indeed, even though we've spoken about the intensity and frequency of the attacks coming through from Iran onto GCC countries as having diminished over the course of the last few days, that doesn't mean that they're still not firing drones. These are being intercepted. Over here in the UAE this morning, we also had a missile interception alert overnight in Bahrain, more damage being leveled at residential buildings, some civilian deaths coming through. Saudi Arabia is still intercepting missiles as well. So there are still ongoing attacks going on in the background. At the same time, when you think about the economic disruption, for all intents and purposes, the strait is still closed. And a spokesperson for the IRGC said that not 1 liter of oil is going to pass through the strait so long as the U.S. and Israeli military operations continue. And I just want to draw on some really noteworthy comments that we had from a very influential industry leader, the Aramco CEO, making some comments on the earnings call today and calling this catastrophic. He said the disruption that we're seeing could have catastrophic consequences for the world's oil markets the longer that this goes on, and it will be more drastic for the global economy. And then he adds, while we have faced many disruptions in the past, this one by far is the biggest crisis the region's oil and gas industry has faced. So just to give you the severity, the magnitude of the type of disruption that we're seeing, and no letting up in sight, I will say, despite the President Trump's comments overnight.
Hey, Jumana, it's quite a statement. I couldn't agree more. Jumana Bassetti there, leading our coverage out of Dubai. Jumana, stay safe. The hopium came yesterday. The reality check out of the Middle East came this morning.
Yeah, on two fronts, on both the IRCG and their comments about how it's not over till they say it's over, but also this idea of output cuts that are significant and some of the projections coming from the oil executives in the region.
Almost 7 million barrels of oil per day production cut that we've seen across several nations in just the last week. Stephen Cook of the Council on Foreign Relations writing, we should be prepared for messy endings. Iran's fractious opposition politics produces instability. Stephen joins us now for more. Stephen, welcome to the program. You've heard this line many times. Wars are easy to start. They're difficult to win. To what extent is the end of this war in the president's hands?
Well, I think that the president was accurate in saying that the United States has been successful tactically. Clearly, the Iranians are no match for the combined military power, I should say, of the United States and Israel. But they have demonstrated that they still have considerable fight left in them, attacking GCC states and beyond. I think the big mystery for analysts like myself is why the United States hasn't taken more proactive military measures to ensure the Strait of Hormuz is open. For as long as I've been working on the Middle East, which is now a long time, I've heard that any effort to close the Strait of Hormuz was going to be met with overwhelming American force. We've used overwhelming American force throughout Iran, but not necessarily to keep the strait open.
There has been also a question about the SPR in the U.S. and why it hasn't been filled. John was mentioning that yesterday. I'm just wondering how you assess the conflict. We've heard things from President Trump about where we stand. Does it feel like it's wrapping up, like it's culminating, like it's past its peak violence?
It does not. Clearly, the United States and Israel still have target lists. The Israelis certainly would like another few weeks to try to crack open this regime. And as I said before, the IRGC continues to have fight in it. But none of those things matter as much as President Trump's gut. And I think in true fashion to the president, he's keeping all of his options open. And I think that's what we heard in the news conference and statements coming out of Florida yesterday. He could call it a tremendous success and end it now, but we're going to have more victory. Is it ending soon? Well, not this week. I think he's going to decide, and the inputs that help him decide are gasoline prices, how his base is responding, what the stock market is doing. So it doesn't feel like it's over. We're past peak violence if you look at the battlefield, but we could wake up tomorrow morning and the president could declare victory.
Would that be enough? Can he turn the tap off?
Well, what would happen was we'd go back to some ugly form of the status quo ante in which the regime has suffered a significant amount of damage, but continues to threaten its neighbors and hold a veto over the free flow of energy resources out of the Middle East, which is a core national security interest of the United States. So we would have weakened the regime, but we would not have solved the problem that Iran presents to both the United States as well as America's partners in the region.
Stephen, as the war continues, one notable feature of the retaliation from Iran has been all the projectiles and missiles that have been heading to other Gulf nations. Over the last week, we've continued to ask the question, how will they react? What's your read on things as to whether they will step in and engage in the conflict, or whether they'll continue to put pressure on partners like the United States and maybe put pressure on Israel as well to step back?
Well, so far that hasn't happened. That's clearly been the Iranian strategy, is to do a lot of damage to its neighbors so that they put pressure on the United States, and the United States puts pressure on Israel to bring this thing to an end. But I think the Iranians miscalculated, and so far Gulf leaders are outraged at what the Iranians have done, particularly the massive waves of attacks on the UAE and the damage that's been done to Bahrain. So far, we haven't seen that pressure. We are hearing from oil executives in the region. You mentioned the Aramco CEO saying that this is catastrophic. There may be a turn, but so far the GCC states are hanging tough. And as long as the United States and Israel are making military progress, they are not going and don't seem to be inclined to ask the United States to call it off.
Stephen, when people say the United States, we know who they're talking about, the president. When they say Israel, we know who they're talking about. When we say the Iranians, who are we talking about anymore? Who's leading this?
Yeah, well, it's clearly now in the IRGC state. Mojtaba Khamenei, the son of the now late Ayatollah, is really a creature of the IRGC. And this, if the regime does not fall, this is what the United States and other partners in the region are going to have to contend with. There are questions about the command and control. Like, why would the Iranians hit Gulf states after the Iranian president apologizes to said Gulf states? But nevertheless, it seems that the chain of command within the IRGC remains somewhat intact, and they are able to fire. So this is very much the regime that the United States, at the initial outset of this conflict, a little more than a week ago, called for the end of.
Stephen, it's good to see you. Stephen Cook there of the Council on Foreign Relations. That was one of the contradictions of the weekend, I think, for me, that the president was saying one thing and the military was doing something completely different, which speaks to why when we talk about the Iranians, we have to be very specific about who we're talking about right now and who's leading the response, because it's not the president. It seems to be coming from elsewhere.
And do we have maybe this idea of who's in charge right now in Iran? There are all sorts of rumors and reports. I found it very noisy out there when I try to get information. We also should take a look at if there is resolve in the Middle East to try to stave off the regime from coming back in the same way. What could the potential future be on the bright side in terms of oil supplies and in terms of stability for the region? I mean, this is what people are trying to hope for as well.
So on the bright side, when it comes to oil prices, they are declining this morning. We're down by 7% on Brent, 91.50. On WTI, we're down about 6 to 7% at 88.30. Up next on the program, we'll catch up with Stephen Schork of the Schork Group on the massive swings in crude. Plus, Lizzie drops by. She's got your morning movers. Energy producers falling alongside the cost of crude.
case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto, live Tuesdays.
Welcome to Bloomberg This Weekend. I'm David Gurr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Truly a historic day in financial markets in the last 24 hours. This trading range right here on crude, 119.50 at the high, 83.66 at the low, a $26 trading range. Shout out to Alex Longley of Bloomberg News for this one. From intraday high to closing price, the largest drop on record for crude.
I love some of the commentary from traders who are in the market. What markets are experiencing right now is not just volatility, but a sense of helplessness. How do you understand a market when it's swinging as though it were just sort of swinging in the wind? It's penny stock kind of behavior, and yet it's a massive market with a lot of seasoned traders who are not really trading on fundamentals.
At the mercy of the price of crude. Crude this morning down by 7%. Equity futures positive by 0.25% on the S&P 500, up by 1/3 on the Nasdaq. On the Russell, up by about 0.2%. Avoiding a third day of losses on the S&P 500 in yesterday's session. Consumer-facing names getting some relief given the turnaround in the price of oil. Airlines snapping a 6-day losing streak, and airlines have had a tough run of it.
They have a double whammy of both people who are worried about traveling during a time of conflict and uncertainty, and then also oil prices surging, the idea of how much this would really crimp their profit margins, getting a bit of a reprieve. They are the template, sort of the harbinger of the macroeconomy. So when the macroeconomy is swinging the way it has been, so too are their stocks.
Jet fuel and delays. The delay's pretty brutal as well over the last couple of days. It's not a good time to be flying at all, is it?
I mean, honestly,
really not.
Whether it's weather, whether it's the snowstorms, whether it's the Middle East, it's been a rough go of it.
The never-ending first quarter continues as we count you down to the opening bell about 3 hours away. Let's get you some single names, some morning movers. Lizzie has more. Hey, Lizzie.
Hey, John, we have to start with energy. It's the opposite story to yesterday. As you say, today we've got oil down off the back of President Trump's commentary on the Middle East, and the energy names are suffering today. But the oil price drop really is the reason for the relief rally elsewhere, and that is a better backdrop for the earnings that Oracle will be dropping after the bell later. So flip the board over. Oracle is up in the pre-market ahead of these numbers, up by nearly 2%. At this point. Of course, it's hard to find many stocks that have been more battered by the AI scare trade than Oracle. And so the question becomes, with these earnings, no matter how good they are, how much will the stock be punished if traders deem their capex plans too aggressive? But we've already heard from Oracle posting on X earlier this morning saying that any worries about their AI data center build out are for the birds, and that their flagship Abilene site is going to run on schedule. Speaking of data centers, though, finally, TSMC, of course, the go-to chip maker for NVIDIA and AMD, Broadcom, it is up in the pre-market. We've already had sales numbers from this company up 30% in the first 2 months of the year, lifted by the robust pace of AI infrastructure construction before the war in the Middle East broke out. The question now is, can it continue apace, given that data centers have been targeted as part of critical infrastructure? John.
Lizzie, thank you. Thank you for the update. Lizzie Burden out of London this morning. On our radar this morning, crude falling as President Trump vows to keep the Strait of Hormuz wide open.
I will not allow a terrorist regime to hold the world hostage and attempt to stop the globe's oil supply. The Strait of Hormuz is going to remain safe.
Well, it doesn't seem to be safe right now. The president later posting on social media, quote, "Death, fire and fury will rain down on Iran if it continues to block tanker traffic." Elsewhere, Gulf oil states deepening production cuts as the Strait of Hormuz remains all but shut down. Saudi Arabia, Iraq, Kuwait and the UAE cutting output by nearly 7 million barrels a day, amounting to 6% of global supply. And G7 energy ministers meeting today to discuss the possible release of oil reserves. The summit coming a day after finance ministers considered a coordinated release, determining it was not yet necessary.
Yeah, so what would trigger them? And they are meeting yet again, 1:45 p.m. local time at the International Energy Agency in Paris. The commentary from the French finance ministry saying we are going through the process, but obviously all options are on the table. Even if they don't come to some determination, the fact that they are meeting and discussing this is enough to at least provide a little bit of a buffer against some of the swings. Even if it's unclear exactly what they would do, it indicates psychology. It goes back to what you were talking about, the psyche of leaders and the response function to some of the oil price surges. Clearly it's an issue, clearly it's a political issue, and clearly they are preparing for some sort of response.
Yeah, the signal, not the substance. I thought the signal coming from the Reuters report was interesting. I'll read it to you if you missed it. Options include restricting US exports, intervening in the futures market, we've heard that before, waiving some federal taxes and lifting requirements under a US law called the Jones Act, the domestic fuel move only on US flagged ships. That was the Reuters reporting just yesterday.
Yeah, and of course the Jones Act got a lot of memes on X or Twitter or whatever you want to say. I am also very curious about restricting exports to other allies, because that is something that really plays into the hands of what does Europe do, not only with gasoline, but liquefied natural gas, given that the U.S. has really supported some of the oil supplies, natural gas supplies that had previously been coming from Russia.
There are some options on the table. Those options on the table are moving the oil price around, but no one's chosen an option just yet. Crude is lower by about 6% this morning, $92.50 on Brent crude. The president pledging to keep the price of crude lower.
I knew oil prices would go up if I did this, and they've gone up probably less than I thought they'd go up. We're also waiving certain oil-related sanctions to reduce prices. When the time comes, the U.S. Navy and its partners will escort tankers through the strait if needed.
Crude coming off its biggest intraday swing on record. Stephen Schork of the Short Group writing, if Hormuz remains functionally closed, the base case absent a ceasefire, the upper tails for Brent and WTI come into focus. Stephen joins us now for more. Stephen, what is your sense, your read? How much visibility do you have on what is actually going through the strait right now?
Yeah, absolutely. I mean, we can talk about keeping the Strait of Hormuz open. We can talk about raining hell and fire down in Iran if they decide to close it. But effectively, if you can assure a tanker going through Hormuz, you're not moving oil through the Strait of Hormuz. So effectively, we've had our blockade. We're about, day 9, day 10 into an effective blockade. So that's 20 million barrels of oil that is not making it to the seaborne market. So we're looking at a significant shortage of oil, regardless of the rhetoric coming out of both Tehran and Washington, D.C. Effectively, we are looking at 2, at best case, 3 weeks, and I'm being optimistic there, of a significant global shortage of oil. If we do not get that strait flowing with a significant amount of restoring the oil, that typically flows there on a daily basis.
Stephen, where and in what do you expect to see that show up first? In Asia, in oil product? Where are you looking for?
Yeah, absolutely. We're looking for it, and we're seeing it now in Asia. Now, of course, there's the talk about release of the SPR. We are at about, between the United States and Western European countries, we have about 1.4 billion barrels sitting in reserves. If you release that oil, realistically, you can get about 5 million barrels a day onto the market. That would supplant a quarter of what has been lost through Hormuz. But the bottom line is its location. That oil, if it were to be released, gets released in the Atlantic Basin. The oil that comes out of the strait mainly goes to Asia. So look at the Asia markets. And we're looking at that. We're looking at the Dubai market, which is a marker for the Asian market. It's a sour oil, trades at a discount to Brent. Typically, because it's an inferior oil, but it's trading now at a $10 premium in the spot market relative to Brent. So that is clearly a telltale that Asian refiners are scrambling to get heavy barrels to replace the Arab heavy that has been lost through the strait. So we're clearly seeing it now in Asia with that inversion of the Brent-Dubai spread. However, when you start to look at further out, when we get to the month of June, Brent is now trading at a $10 premium to Dubai out going this summer. So that's the market's way of telling you they expect to see some sort of resolution with the Strait of Hormuz and ease into Asian refiners between now and the month of June.
Stephen, how difficult is it to trade in this kind of market?
Oh, it is. Well, it looks. I mean, it makes Bitcoin look like a, just buying IBM stock and just holding it. It just makes Bitcoin look stable. So no, this is a market where you just really have to keep it very, very tight stops. At this point, you cannot go take any major position when you have a market that's literally moving yesterday $30,000 per contract. That's going to make or break people significantly. So that's what we're seeing now. And there's the rumors of as the U.S. Treasury interfering and coming into the market and trying to short the futures. All sorts of speculation out there. We have no roadmap. We have no resolution to what's going on in Iran. We have the President of the United States saying, oh, this could end soon. But then again, we still have Iranian generals out there as if they're auditioning for the role of the Black Knight in the reboot of Monty Python and the Holy Grail. So there is still a lot of chaos out there. So you have to keep your stops extremely short, your positions extremely small to get in and to get out. The opportunities are there when you have a market that's swinging $20, $25, $30 a barrel, a tremendous amount of opportunity to get in and out, but it's a tremendous opportunity to get burned. So we've never seen a market like this. And we're talking about June 2025 with the 12-day war. We're talking about 1991 with the invasion and kicking Iraq out of Kuwait. So we've had a lot of upheaval in these markets over the last 2 generations. We've never seen anything like this. So to take large positions out there is akin to a death warrant.
Stephen, I just wonder, looking forward, once, let's say, there is a resolution and supplies have been restarted, we keep going back to the point that Jeff Curry over at Carlyle Group made, that there's going to be a risk premium sort of baked into physical commodities that have to transport on the seas, not to mention oil in particularly. Do you agree? Do you think that we're going to set at a higher price just simply because there is this risk of disruption that was just thrown into cold relief?
Yeah, absolutely. Well, we do see a resolution. If we look at what the risk premium currently is, we look at the spread between implied and historical volatility. Historical is where the variance in price has been. Implied is where options traders think that the premium is going to be. And that spread premium is now, that risk premium is now well over $7 a barrel. It's increased $5 a barrel above where we were at the start of this. So there's already significant risk premium priced into the market. We're seeing it now also in the formation with the steep backwardation. That is to say, prices have spiked in the nearby months relative to the outer months. So therein lies that premium of securing, and this is the market's a way of going in and securing those barrels and hence bidding up the prompt market. So when we do look at the forward curve, when we do look at the spread between implied and historical volatility, we're looking at between well, if we look at the term structure, a $5 risk premium baked in, and that is the increase we've seen in the options market from about a $2 premium to $7 premium. That is where it is now. But if we get the kind of resolution we're hoping to see, i.e. a regime change to a positive government, which is a long ways off, well, clearly, I think that is a signal that peace is at hand, and I would expect to see that price premium exercised out of the market in the blink of an eye. But that remains to be seen. We have a long way to go before we get from there to a peaceful regime in Iran.
Well, Stephen, before you go, as this conflict continues, let me pick up on that Reuters piece once again, and some of the options available to intervene to reduce crude prices. They include restricting U.S. exports, intervening in the futures market, waiving some federal taxes and lifting requirements under a U.S. law called the Jones Act, that domestic fuel move only on U.S. flagged ships. That verbatim coming from Reuters just yesterday. What do you think is the realistic option there on the table?
Well, the first one, of restricting exports, is idiotic because we simply don't consume the type of oil that we export. We have no use for it because our refineries aren't engineered to use that oil. So if we don't put that oil, we keep it for ourselves. We're keeping it for ourselves, but we can't use it. With regard to intervening in the futures market, try and sell it. Well, you're trying to tell me that the United States, the U.S. Treasury is bigger than the global market for oil. quite skeptical on that as well. So if we want to reduce some taxes and other sort of gimmicks, at the end of the day, John, they're gimmicks, and none of them are any sort of resolution to getting oil flowing through the Strait, which is where we need it. So no, I don't see any of these gimmicks having any sort of positive impact on prices at this point.
Well, Stephen, given the extreme backwardation in the curve that you explained, why wouldn't a lot of these authorities just sell the reserves into the market and buy further out along the curve? Why wouldn't they do that?
Well, absolutely, and that is what's being talked about, that 1.4 million barrels. But again, so we're talking about that oil. Where is it getting released? Essentially into the Atlantic Basin, where we do have the Atlantic Basin is not short of oil, and this is what's being priced off of the ICE Brent crude oil market or the NYMEX WTI market. So where we need that oil released would be in Asia, and getting oil from the Atlantic Basin over Asia is an arduous process at this point. So it makes for a great sound bite, and we probably will, seeing at the given spreads, but it will have a limited impact on the markets where we really need to see that oil.
It's a good point, Stephen. Thank you, sir. Stephen Schulk there of the Short Group. Crude this morning down by 6%, Brent at 92.50. Lisa mentioned Jeff Curry. Jeff's going to join us tomorrow, so looking forward to that conversation. His recent note, every major importer is securing supply simultaneously. We estimate that precautionary demand could be 2 to 3 million barrels per day over the next 3 to 6 months. The physical disruption is the trigger. The behavioral response is the multiplier. And I think it's the behavioral response that you're really thinking about.
Yeah, we're back to storing oil barrels in our living rooms. There's an issue, though, not just with oil, but more broadly. If you could see disruptions to the supply chain, as we've seen time and time again, why wouldn't you carry more inventory if you can, especially if it is a commodity and not necessarily an item of clothing that's going to go out of style? And that, I think, is the behavioral multiplier that he's talking about.
Let's keep it on the markets. Futures this morning, positive by 0.2%. Up next, calming the bond market.
Global bond yields are moving quite dramatically higher. This global bond yields moving higher is going to keep treasuries higher as well. But I just don't see treasuries really breaking out of the range on either direction.
Up next on the program, Shin Kadota of Barclays from New York City. You're watching Bloomberg TV.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
The trading day is
is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslada Amin in Davos, Switzerland, and this is Bloomberg.
Following something like a $26 trading range on the crude price in the last 24 hours, at the high 119.50, at the low 80s. Crude looks like this right now. Brent and WTI down by 7% and 6% respectively. Brent crude at 91.84, WTI at 88.89. In the equity market, futures shaping up as follows going into the opening bow later this morning. Futures positive by 0.1% on the S&P, on the Nasdaq by 0.25%. Things were pretty unsettling Sunday evening. Ed Yardeni of Yardeni Research writing, if investors start expecting stagflation, a bear market is more likely.
Yeah, and he increased his chance of that, turning to 35% from 25% just a day earlier. It was moving quickly, he said, because the price of crude was moving so quickly. How have we taken that off the table? And I think that's a key question as we parse through different Truth Social posts as well as different rhetoric.
The bond market stuck between a rock and a hard place. Under surveillance this morning, calming fixed income.
Global bond yields are moving quite dramatically higher. This global bond yields moving higher is going to keep treasuries higher as well. But I just don't see treasuries really breaking out of the range on either direction. So yes, it's not a good flight to quality hedge in this environment, but I also don't see treasuries really moving out of the ranges that we've been in the last few months.
So here's the latest this morning. Global bonds rebounding on signals the Iran war might be coming to an end. Shin Kadota of Barclays writing, with a channel for upward pressure on yields led by inflation risk premia in place, geopolitical headlines remain in focus. Shin joins us now for more. Shin, welcome to New York.
Thank you.
It's good to see you. Thanks for being here. Let's talk about Japan and Japanese bonds. Typically, yen assets are a haven asset, but then you've got the fact that we've got a term to trade shock for Japan as well. How are they behaving given this shock right here?
Yeah, sure. So in the reaction to the earlier this week on the rise of oil towards 120, Japan's market was basically seeing yen selling off. As you say, the terms of trade shock was overweight on the safe haven demand for the yen, and then the rate was twist steepening on the expectation that the BOJ's hike might be delayed.
What do you think about the BOJ's monetary policy at the moment, and what are you expecting from them in the next several months?
Yeah, so we continue to expect the BOJ to hike in April, and followed by 2 more hikes in October and next April, taking the rates to 1.5%. And of course, there's the risk of delay in the BOJ hike, maybe towards say June or July. But I think there's also a discussion about the effects, because if the BOJ does decide to delay effects, I think it does add another pressure on the effects side. Dollar could go even higher, and that could worsen the negative terms of trade shock because the multiply by the oil and the higher dollar yen. So I think the BOJ will continue to take relatively hawkish stance, as to avoid the excessive yen weakness.
What's fascinating is how different central banks are being treated in terms of their response to an oil price shock. In the ECB, yesterday, there were 2 rate hikes being priced in. The Bank of England, there was 1 rate hike potentially priced in at one point. It has faded. For the Bank of Japan, it was kind of the opposite. They said maybe they would delay it. Is there a feeling that the Bank of Japan's mandate is more on the growth side now and very much still not on inflation, even if those come into conflict?
Yeah, so I think, the BOJ is in a very different game in the sense that, yes, they're trying to contain inflation, but their bigger fear is to go back to deflation. So that's why they're only moving slowly to make sure that growth doesn't get hurt too much by, excessive rate hike or the oil price negative shocks. So they want to continue to be on the hiking path, but not to hurt the growth, that to avoid going back to deflation that we experienced over the last 30 years.
You know, there was a period of time where we would talk about who's out there trading Japanese bonds. Oh, it's not one government guy sitting on a desk who owns all of them, and it's not actually trading. There were days when the Japanese bond market wouldn't trade at all. How much has the nature of who's involved in this market changed? And people actually coming back who are Japanese investors who now see value?
Yeah, so actually, you're right that the BOJ was the only trader in the market for a while. But now, actually, it's not so much the Japanese investors that's coming back in. It's actually the foreign international investors are actually coming back into the Japanese markets. And that's partly because, so for example, in the super long sector, life insurance companies are actually reducing the holding of JGB. That's partly due to, regulation, but also due to some demographics that demand for JGB is actually limited in the domestic market. But the international investors now see value in the JGB because it's, now more comparable to, say, European bond markets, so in terms of the yield and so forth. So it's actually the international community that's have come back to JGB market rather than the domestics increasing the presence.
I remember those headlines crossing the Bloomberg terminal, the 10-year didn't trade today, which is kind of crazy, right? And we saw that quite a few times over a number of years.
It's what happens when you have 60% of the market locked up in the government balance sheet.
We've witnessed the enthusiasm for Japanese equities from various US-based investors around this table. It is the great repatriation trade that we're all thinking about, though, and Lisa gave a nod to it. Do you think the money eventually will come home, the money that has been invested in European fixed income into US equities back into Japan?
So I don't think there's going to be a major repatriation in the sense that their holding of the foreign bonds have also dropped in the recent years. So the largest sell-off of the foreign bonds by Japanese happened in 2020 to 2023 when the global duration was selling off and FX hedging costs were rising. So at that point, they already reduced the foreign bond holdings. And I think additional money will probably be invested more in Japan, but they're also waiting to see, how high the BOJ hikes, and because they don't want to be, basically picking up the falling knife at this moment.
Just a final question before you go. Obviously, the focus at the moment is on the Middle East and the supply of energy. As we started the conversation, Japan massively exposed, and Asian refiners across the board, India, Japan, and elsewhere, exposed as well. How much of a cushion do those refiners have right now? What's your read on the availability of energy at the moment?
Yeah, so Japan has this oil reserve, which is worth about 250 days of the supplies in the daily consumption in Japan. So it could actually withstand a very long period compared to other countries. But of course, that's a quantity issue, but there's also a price issue, which, Japan faces the higher oil prices, that's multiplied by the yen depreciation as well. And also LNG import prices often linked to oil prices as well, so that also gets hit. So there could be quite a bit of a price shock on the economy, which, if extended, could be a negative factor for the Japanese growth outlook.
Shin, it's good to see you. Thanks for being here. Thanks for dropping by.
Thank you.
Thank you, sir. Shin Kadota there of Barclays, weighing in on the latest in Japan, fixed income and global markets. That's a massive buffer right there, but it's come at a pretty difficult time for a new prime minister who's got a vision of where she wants to take things.
Yeah, a little bit more stimulus, a little bit greater degree of fighting disinflation rather than concerned about inflation. The reason why this is so fascinating is because where the 30-year Japanese bond yield goes, so too goes the global bond market. That is the belief. So to the degree that they have a different policy than, say, the ECB in terms of their target, it has ramifications for the entire world.
As you suggested, there was a moment where we couldn't even really call it a market.
Yeah.
Because it wasn't much of a market. You need someone to buy and sell, to have a market.
Yeah,
and there wasn't much of one for quite a while.
Yeah, it was controlled pretty heavily. And there still is the glut of debt. And that's a real question here. And that's clearly what this administration is dealing with.
Crude this morning down 7%, about 92 on Brent. Up next, we'll catch up with Dan Green, House of Solace, Mark Short, the former Chief of Staff to the former Vice President Mike Pence, David Tinsley of Bank of America, Kathy Jones of Charles Schwab.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view. As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The surprise is that inflation is moving in the opposite direction.
Nothing good comes out of spiking oil prices this high.
The Fed is going to be very, very focused on what happens on the inflation side.
The big piece of this is how long this energy shock lasts.
I do think it's fair for people to take cuts off the table.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Futures just about positive on the S&P, attempting to build on yesterday's bounce, up by 0.2 on the S&P 500, on the NASDAQ, up by a third. In the commodity market, deep breath. The last 24 hours has been absolutely exhausting for anyone trading this stuff. 119.50 at the high, in the 80s at the low. Brent crude this morning, 91.90.
Yeah, a record move yesterday in the intraday price action. And what Stephen Schork said is he's never seen anything like this. Other traders have said things like, this isn't just volatility, but a sense of helplessness, because ultimately it is not being dictated by fundamentals. It's being dictated by comments that can change at any moment.
If the hostilities continue, we've seen that a million times. There is no sign of a diplomatic off-ramp, and the production cuts keep coming. They keep adding up. The UAE, Saudi Arabia, Kuwait, Iraq, we're talking about almost 7 million barrels of oil a day taken out of production in that region. That's going to have its own impact.
Yeah, it's about 6% of global supply. Together, those four nations produce about 19 to 20 million barrels per day, which accounts for about a fifth of the global supply. So if you think about what this means, it is a massive resource for the entire world, particularly with respect to Asia, which is the reason why people are gaming out which regions are going to get hit hardest and how much dispersion is there going to be.
We keep going back to this quote from Amin Nasser of Saudi Aramco, typically quite a reserved, conservative kind of guy, saying this overnight. This one by far is the biggest crisis the region's oil and gas industry has ever faced, calling it catastrophic. Jumana Basechi out of Dubai, leading our coverage out of the region over the last week or so, making the same point. that the way they're talking about what's happening on the ground with energy right now is very different to the hopium that came out of the administration just yesterday.
This is the 1-2 punch of both these shipments being prevented from going through the Strait of Hormuz, but also production being taken offline because of some of the storage facilities being filled up, but also because of refineries that have been taken offline in the region as a result of attacks. This is a toxic brew, if you will, of different events that has led to a lot of pessimism among the oil producers.
91.90 right now, Brent. We're down by 7%, and as you know, things can change very, very quickly. Coming up this hour, Dan Greenhouse of Solace Alternative Asset Management as crude prices whipsaw. The former Chief of Staff to the former VP Pence, Mark Short, as the White House signals a potential end to the war. And Kathy Jones of Schwab as bond market pressure continues to ease. We begin this hour with stocks pushing higher as crude pulls back. Dan Greenhouse of Solace Alternative Asset Management writing, if oil interference persists, the S&P 500 will probably be down 10%. Dan joins us now for more. Dan, good morning.
Thank you, sir. Good morning.
You're not typically the kind of guy that gets concerned easily. Are you concerned?
Yeah, I mean, I haven't been on in a little while, but last time I was on, we were talking about the weakness in the job market being something that was concerning to me. Obviously, there has not been any steep drop-off, but in the last jobs report, the private sector lost 86,000 jobs, which was, outside of COVID, the largest single job month loss since the GFC, basically. Now, obviously, some of that was skewed by the nurses' strike, and so we have to take it with a little bit of grain of salt, but clearly the job market slowdown has continued at best. I mean, it's probably not getting worse, but it's certainly not getting better. And so the backdrop coming into what's going on is an economy that's doing okay, but we're not creating a lot of jobs, which ultimately is the point of growth. Now you layer on top of that, obviously, the private credit software-related issues, which I don't think is, I don't know how many people are arguing that it's systemic per se. I don't think it is, but it is certainly affecting a corner of the market. The financials are down this year, led by the Ares and the Carlyles of the world. And that raises concerns about the prospect for additional lending going forward and how much growth that has spurred over the last couple of years. And now you have what potentially could be an oil price shock. So getting back to your question, am I concerned? Yeah, the backdrop's not great, and an oil price spike is never a good thing. But as a lot of people, I'm sure, are noting, it's not necessarily about the peak per se, so much as it is about how long this lasts. And right now, I'm not too concerned. If we end this pretty quickly, again, as you noted, oil prices are down considerably. If you can get them back down into the 80s even, let alone the 70s, then I think some of the worst case prognostications are going to prove to be incorrect.
Who is we when you say if we can end this pretty quickly? Who are we talking about?
No, I was going to make I was going to make a bad joke. But no, people in the financial markets that I talk to, I think are obviously acutely concerned about this. And when I say we, I mean the people that I talk to that represent the investor class, if you will.
Well, I'm talking about when you say, if we end this pretty fast, are we talking about the president ending this pretty fast in the Middle East? Are we talking about the Iranians getting on board and ending this pretty fast in the Middle East? Are we talking about the Israelis?
Yeah, it's everybody, of course. I mean, listen, we know the president yesterday said this is going to be over soon enough. As we were talking about before we came on air, the Iranians have a vote in this, and certainly to the extent that they don't want it to end, they can continue with the drone program, for instance. But from a market standpoint, I think I was just saying, so on the political side of things, there's this conversation about why are we there, the shifting rationales. And that's a perfectly fair political conversation to have. But from a market standpoint, whether it's missile capacity or nuclear capacity or the regime itself, the president and the Americans have a number of off-ramps to say, to declare victory, so to speak, and call it a day. Now, again, the Iranians have a vote in this, but from a market standpoint, that's a number of different positive outcomes in terms of this being, quote-unquote, over.
Which is the reason why, for the most part, markets are trading as though this is going to be limited in time. And frankly, Jason Thomas of Carlyle just put out a note saying the risk is time. Right now, people are assessing that risk is contained. Has there been anything that has shifted based on the non-farm payrolls report, plus the fact that oil prices are probably going to be somewhat higher, at least in the next 3 months, as a result of this?
Yeah, I think we should certainly get comfortable with the idea that oil prices will be higher. And this is something that we've talked about for a while. A number of times I've come on here, I've noted we've been interested in the energy space and invested in the energy space, partially on the idea that the longstanding geopolitical risk premium has effectively ground to zero. That's now, presumably for the immediate future, not going to be zero anymore. So are we going back to oil in the potentially 50s? I mean, coming into this was the oversupply issue. We're working through that very, very quickly. We're probably talking about a more normalized environment, excuse me, in the 60s or 70s. However, to shift back into the political realm for a second, 5 years from now, 7 years from now, 10 years from now, perhaps the geopolitical risk premium should be flat or negative on the idea that, well, now, I mean, in the best case scenario, you've got a more accommodative Iranian regime. The Lebanese are now reaching out to the Israelis. You've got the Abraham Accords. Perhaps this is step, I don't know, 1, 2, or 3 in terms of reshaping the region and creating an environment where geopolitics is perhaps less of a concern. Maybe that's a little Pollyannish, but that is one possible longer-term outcome.
These soothing headlines keep coming. The president has done a series of interviews with a range of media outlets in the last few days. This one is with Fox News, releasing this comment right here, that the president says it's possible to speak to the Iranians. Off the back of that headline, crude rolling over just a touch. We're now down by more than 8% on Brent to $90 and about 70 cents. More the same from the president.
Yeah, communication, and it's the signal, perhaps more than the details, since we don't really have a lot of details, but the signal is there is a desire to talk. There is a desire to find that off-ramp, which is the reason why people are leading to the idea that it will be contained. What is the new normal once this is contained? And I think that you've got both what Dan was talking about in terms of the really bullish scenario for oil prices coming down and a more greater and durable piece, and then you have a more negative idea with a more protracted, higher oil price.
Dan, what is the price of the volatility, given the fragile backdrop that you described at the start of this conversation?
Well, I mean, you see it in the VIX, and the VVIX, and the OVX. I mean, volatility is up everywhere, and deservedly so. I would just, to dodge that question for a second and go back to what you just said about the president talk. We shouldn't be surprised. I mean, this is a guy who flew to North Korea and was willing to talk to the North Korean president, something that the entire political class thought was nothing short of insane. So, and he's said repeatedly that he doesn't, you know, I know some people will find this offensive, so to speak, to say, but this is a guy who's repeatedly said he doesn't want to go to war, he doesn't want to have war. So I entirely am not surprised by the idea that he would talk to the Iranians.
So let's say there is an off-ramp, and let's say it is contained the next couple of weeks, right? And I understand that's a huge if. Has there been, I mean, just as sort of what people are trying to get to, has this alone put a damper on the forward-looking growth trajectory, especially paired with non-farm payrolls? And we just got small business optimism that did fall below expectations earlier this morning. I mean, or are we looking at everything in a negative light right now simply because people are feeling jittery and will once again go back to potentially things surprising to the upside?
The first thing I would say is I think a lot of people have been looking at things in a negative light, not just right now, but for 20 years. We've talked about this in the past, that post-GFC...
Been scarred by it.
Yeah, everyone's trying to be Nouriel Roubini. I've made this comment a couple of times.
Who's, by the way, bullish right now, but carry on.
Fine.
Yes.
Free right now. So yeah, I think there's a lot of pessimism. However, again, getting back to the peak versus the duration conversation, if oil prices come back down and this is wrapped up in a week or two and we get ships going back through the Strait of Hormuz, et cetera, then I don't think there's going to be too much lasting damage or scarring, so to speak, in the economy. Obviously, there'll be some short-term issues. Gasoline prices at the pump, which is ultimately what matters for consumers, are already higher. I have friends talking about seeing $4 gasoline, but that will pass quickly if we start getting oil back, and eventually we will return somewhat closer to the oversupply story, the 2 million barrel oversupply story that persisted before this moment. I don't know how quickly we're going to get there, but again, oil price spikes tend to be temporary in nature. That's why we call them spikes instead of oil price plateaus.
How much have you been getting involved then as a result of this, if you actually do see a more positive outcome and you see price dislocations?
Well, listen, we're all, to repeat, we've been in energy for a little bit of time now, so this is all working to our benefit. I don't know if I'm allowed to say this, and my compliance department will have talking to when I get back, but so this is to anyone who's exposed to energy, we'll say that.
Well done.
Is obviously benefiting positively, and for those people, the question becomes, do you lighten up into this, and if so, do you rotate? I mean, one thing I was talking to somebody last night about is, if you've been in energy, as some are, maybe you want to rotate out of energy, take some profits off the table, and go into something like the airlines that have been disproportionately hurt by this, or perhaps the cruise lines, because we can pretty much model out, obviously, the fuel costs for both of those industries. And if oil goes back down and jet fuel falls, and and cruises see a benefit, you might see a pop in those names on the other side of this. So there are things to do around this if you believe, as I do, that the economy is not, in the short term, going to be meaningfully impacted.
Well, it's the consumer piece of this that interests me. If we put it together, everything you've been talking about, the labour market is somewhat fragile. I don't think it's stable. I think it looks fragile. The financial conditions have been tightening. You can see that across the market. And then you layer this on top at a time we're about to get tax refunds. I don't think the average consumer, the consumer with a higher marginal propensity to spend right now, is going to take that tax refund after seeing these headlines and book the cruise or book the flight.
Well, and that's why it's important to get a headline on Sunday that said, victory declared, war over. In which case, we already have seen tax returns are up, call it 10% year over year, a couple bucks in people's pocket. That's very helpful. Obviously, gasoline's increase will eat into that somewhat. But the larger benefit from the no tax on tips, et cetera, really over time more than tips, is going to be beneficial to the economy. The consumer already, we know, in the United States is disproportionately inclined to consume, and they're going to start seeing some larger tax breaks, and that's going to be a positive going forward. I would just say the labor market has been fragile, so to speak, for some time now. And while I mentioned earlier the drop in private payroll growth, although again partially related to the strike, I haven't seen it get worse. Yeah, the unemployment rate's been drifting up, although there's some nuance to that, but I haven't seen it get worse. And so to the extent that it doesn't get worse, and we're just in this low growth, or no, what is it? No hiring, no firing.
Low hire, low fire.
I don't know.
Same thing.
LFLH, very close to LFLO from the 2000s for the Gen X and millennials out there. Yeah, as long as it's not getting worse, then I'm okay. And it's important, again, the core right now, to the earlier comment, fundamentals don't matter. Let's get oil prices back down, and then we can all take a breath.
They're down this morning. They're down by about 7 to 8% at $91 a barrel on Brent. Dan, it's good to see you. Thank you, sir.
My pleasure, sir.
Thank you. Dan Greenhouse there of Solos Alternative Asset Management. Up next on the program, betting on a short war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so.
Up next, Mark Short, the former Chief of Staff to the former VP Pence from New York City this morning. Good morning.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Live from New York City, welcome to the program. Equities just about turning negative just moments ago on the S&P 500, unchanged now on the S&P. On the Nasdaq 100, positive by close to 0.1%. The small caps, the Russell, negative by a third still, even as we pair some of the big gains we've seen in crude more recently. Brent is down by close to 8%, 91.20. WTI 87.90. The president speaking to Fox News a little bit earlier. They released some of those comments, open to speaking to the Iranians. More soothing headlines over the past few days.
Indicating a willingness to find an off-ramp at a time where it's not exactly something that he wants to see in terms of oil prices rising to this degree. You've raised the question multiple times. How much agency does he have to unilaterally end this conflict? And I think that's a question that we should give some more time to.
It's something I'm slightly uncomfortable with right now. The amount of people we're speaking to that are comfortable that the president has the ability to end this whenever he wants. This is not Liberation Day. This is not tariffs on, tariffs off. You've opened up something else now in Iran. And it's not clear to people who's actually running the show in Iran. Particularly the major contradiction over the weekend when the president comes out and apologizes to Gulf partners, Gulf neighbors. And then the strikes continue because he's not really running the country at the moment.
Yeah, there are a lot of questions also about Israel's goals, because Israel is also involved in this, and it doesn't seem like they're entirely aligned with U.S. goals. It also is a question about some of the Middle Eastern neighbors that are experiencing these missile incoming attacks and are going to respond. So there are a lot of questions as this does widen its umbrella.
Under surveillance this morning, betting on a short war.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion. We're winning very decisively. We're way ahead of schedule.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think so. We could call it a tremendous success right now as we leave here.
Here's the latest this morning. Crude prices pulling back as President Trump signals an early end to the Iran war, calling military objectives, quote, pretty well complete. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John, good morning. Well, President Trump maintains that the U.S. is ahead of schedule in achieving its military objectives, but that he doesn't think that the conflict will resolve this week. In fact, he says that the military operation will not resolve until he is satisfied that Iran's nuclear program will not be able to be obtained. Now, you mentioned we got new comments this morning with the president speaking to Fox News saying that he would be willing to speak to the Iranians, but then added that he, quote, sort of doesn't need to speak to them anymore. Pair that with comments that we got earlier this morning from Iran's parliament speaker saying that the country is, quote, absolutely not seeking a ceasefire, and a statement overnight from the IRGC maintaining that it will block oil exports from the region. Yesterday, President Trump threatened to widen the list of U.S. targets to electricity infrastructure if disruptions continue in the Strait of Hormuz. He reiterated that the U.S. Navy stands prepared to escort tankers through that critical waterway, which at the moment remains effectively shut. As Bloomberg News reports this morning, it appears electronic warfare is jamming signals in the Straits. Now, President Trump has said that there could be a few options on the table when it comes to curbing high prices. We heard him yesterday mention the idea of waiving certain oil-related sanctions, though he didn't specify that beyond saying he spoke with Russian President Vladimir Putin about it yesterday. John, people familiar with the matter tell us that the administration has been looking at several options, including a federal gas tax holiday, which would require congressional approval, or tapping strategic reserves amid questions about replenishing the SPR. I will quickly leave you with one domestic angle to this. New polling out from Ipsos this morning finds that 67% of U.S. adults are concerned that gas prices are going to get worse in the year ahead.
That is not surprising, Tyler. Thank you, Tyler Kendall, down in Washington. The signal from the president is important. So is the reality on the ground. Just as we're speaking, these headlines crossing, the UAE says it's currently responding to a missile threat. Qatar saying they intercepted a missile targeting the state of Qatar. And we've seen headline after headline like that and more still to come.
Yeah, and the IRCG coming out and saying this war isn't over until we say it's over, even though the president is saying, I can stop this at any point.
Joining us now to discuss is Mark Short, the former chief of staff to the former Vice President Mike Pence. Mark, good to see you.
Great to be here. Thank you.
This is not in the president's traditional playbook. This feels so different. Typically, he has something targeted, it's limited, it leads to a period of de-escalation. This feels so open-ended. How would you characterize what's evolving in the Middle East?
Well, I think there's some truth to that obviously, Venezuela, he wasn't looking for regime change. He left Maduro's number 2 in place. But at the same time, I think the president always likes optionality, which I think you've witnessed over the last 10 days, is that explanations as to how long this is going to be continue to vary a lot. And so I think you'll continue to see him want to keep that optionality as to whether he continues to prosecute this war or pull back.
How different is this time in terms of the support from other Republicans in Congress for the effort? I mean, it was sort of pretty unified around Venezuela. Is it the same here?
Well, I think that there's obviously been a growing threat of isolation inside the Republican Party. I think it's been notable that J.D. Vance has been pretty quiet and not as visible as far as advocating for these policies. And I don't think there was as much of an effort ahead of time to explain to the American people the priority and why we're doing this, which is why I think you see the polling down. Having said that, Lisa, if the president's successful here, and in many cases this military operation has been successful, but if he also is able to transform the Middle East for generations to come, I think you'll see a lot of Republicans be on board with this. I think the greater political concern in the short term is that affordability remains the #1 issue for Americans. And I think that even if best case scenario oil prices, now are in the $80 to $90 range a barrel, that's still a 33% premium over what they were. That's not going to help with the affordability issue heading into the midterms in November.
So what do you think is the most feasible counteraction to that by the president heading into the midterms?
I think the most feasible is to continue to explain why this is a necessary action, why for 47 years Iran has been at war with the West, why they've, going back to funding the Hamas and the Hezbollah and the Houthis, why they've killed Americans in Western Sahara, why we did this. I think that's what he can do best. As far as triggers, I think that one thing that would be helpful is if you relieve the Jones Act, but I think there's a lot of tension inside the administration because you have the protectionists, the Peter Navarro's for him, that is sacrosanct. They don't want to see that. I think it's disappointing to see actually providing relief for Russian oil at this point. I think that Russia's been partnering with Iran for quite some time. Iran's been funding and been providing them drones in their war in Ukraine, and our recourse to this is to actually relax the oil sanctions on Russia, I think shows the sensitivity they have politically to rising oil prices.
There's something very backwards about the whole thing. We're now asking help from the Ukrainians to help us intercept drones. At the same time, we're offering sanctions relief to the Russians who they're fighting with at the moment. Make sense of all of that.
No, thank you. I mean, that's basically, I mean, ultimately, you're sort of putting your thumb on the scale on both sides. Anyone who's saying this is going to create a sooner resolution to the Ukraine-Russia war, please explain to me exactly how.
I could just make the question how prepared they were for this. Why the Chinese were able to stockpile energy over the last 12 months and America didn't refill the SPR.
Well, look, I mean, I think that there was a lot of depletion of the Strategic Petroleum Reserve during the Biden administration.
Massive depletion, without a doubt.
And I think there were opportunities to continue to replenish it. I do think that there's obviously more oil production out of the United States today, and I think that the president deserves credit for having lowered energy prices as significantly as he did. But as we've talked about on your show, I think that the reduction in energy prices in many cases was masking the trade agenda and the extra costs. If all of a sudden you've taken that relief off the table, I think you're going to see the trade agenda, inflation, come to the voters even more sensitively.
How much control do you think he has over the fate of what's developing before our eyes?
Look, I think he has more control than anybody else, but as you said, I don't think he has total control over this. And you're saying, I mean, Qatar's still saying $150 before this is all said and done. They have facilities that are still offline. Bahrain has facilities offline. And so it seems to me there's a heck of a lot more volatility here, and it's just because the president signaled maybe this will be a shorter-term conflict, doesn't mean that that's guaranteed.
Marcus, good to see you.
Great to see you guys.
Thank you, buddy. Thank you. Mark Shaw there, the former Chief of Staff to the former Vice President Mike Pence. Successive presidencies have had reasons to do what the president is doing right now. But there is a reason why they didn't take the playbook off the shelf, because it can get messy very easily.
Yeah, in the Middle East, things are not typically clean, and we've seen that time and time again. There is a rationale for this and a potential best-case scenario that's really good, and I don't think that we should lose sight of that. The problem is the path there is so messy and uncertain and bringing in so many variables and changing on a dime, which is leaving people wondering, what is the playbook now, given that, as President Trump said himself, some of the people he was thinking about to lead Iran are no longer in existence. So how do you proceed with a path forward?
What happened to all the headlines, the stories, the policy effort around affordability? And then this, very quickly, the message gets murky. Now, if you come out the other side with more production, maybe you've got a better story to tell. But the runway, we've talked about the amount of time until the midterms, that runway is getting shorter and shorter as the months pass by. Up next on the program, David Tinsley of Bank of America Institute as the conflict in Iran hits the U.S. consumer.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Interesting setup this morning. You've got crude declining and the equity rally stalling. Check it out. Crude's down by about 8% at the moment. We're down by 8%, say, on Brent, and on WTI at the moment down by 7. 88 on WTI, 91 on Brent. That's the picture of crude. As the president, speaking to Fox News, says he's willing to speak to the Iranians as the strikes continue, make sense of that. But once again, the difference between the signal and the facts on the ground. And then the equity market rally just rolling over. No positive follow-through here off the vicious bounce from Monday's low in that trading session. We're just about unchanged on the S&P. On the NASDAQ, just about positive, by 1/10%.
Yeah, and ultimately, at a certain point, are we seeing enough calm where some of the stock traders can take a step back and say, why would I be incredibly invested in an incredibly volatile time, number one? Number two, what has changed, even if there is some sort of pause to this? Well, it's going to be higher oil prices, and it's going to be consumer that is still crimped, and possibly a Federal Reserve and other central banks that will refrain from cutting rates anytime soon. And it is a landscape potentially to crimp growth.
It's a triple threat. You've got a labour market that's fragile, an economic backdrop that's not convincing but has the potential to improve with all the stimulus behind it. Then you've got the tightening of financial conditions layered on top of that, and the energy shock that's exacerbating the problems for both the first point and the second point. Put that all together, it's not a great picture right now for risk assets, even if you believe the president's in a position to back away.
Even if he backs away, there are these production cuts that have already gone into place that will take potentially weeks to really work through.
Brent crude this morning down by close to 8%, 91.40 as we count you down to the open about 2 hours away with your morning movers. Danny has more. Hey, Danny.
Hey, John, looking at some of the stocks that are specifically moving on that oil move and did yesterday, too. Oxy, Chevron, Devron, again, all these turned around yesterday with the news coming from the president about a possible short-lived nature to this excursion, as he called it. Now, for the past week, Oxy is the only one of these stocks that's positive, and it's only positive by 1.5%. So today's move should erase that gain so far since the war broke out. On the flip side of things, you have the beaten-up stocks, and that were the airlines, the cruise ships, because of higher oil prices, higher fuel, and maybe concerns about sentiment. So these stocks turned it around yesterday. They are getting a slight pop, but John, much like the overall market, some of that convincingness of the gains of this morning is starting to wane, but they're up at least 0.5% in the case of Delta. Finally, some earnings news coming from Kohl's, and a big disappointment. Comparable sales fell 2.8%. It has been years of declining sales for Kohl's. They can't turn it around. They have a new CEO. That not helping them out. Shares dropping 7.4%, saying that the competition was tough for Black Friday. You're also seeing Macy's shares fall in sympathy this morning too, John.
Hey, Danny, thanks for the update. More from Danny in the next hour. Kohl's problem or consumer problem? We often play that game with the retailers.
So I'm trying to figure out what their commentary was, and they really came in incredibly weak on fourth quarter earnings. It's being treated as a consumer problem, which gives you a sense, I mean, ultimately I can't answer, right? But which gives you a sense of how the market's treating it, which is this is a broader issue, not just a Kohl's issue.
That's usually how the retailer wants to describe it in a moment like this, right?
Exactly. You know, our turnaround's on track, that's the commentary, and people are saying, okay, maybe.
It's never about execution.
Well, and people are sort of looking at them and saying, let's see.
It's a choiceful consumer, as they enjoy saying. On our radar this morning, crude prices easing as President Donald Trump signals the conflict in Iran is nearing an end.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay, and with respect
Very
to...
soon. Look, everything they have is gone, including their leadership. In fact, there are 2 levels of leadership, and even actually, as it turns out, more than that. But 2 levels of leadership are gone.
The president saying the Navy will escort tankers through the Strait of Hormuz. Elsewhere, Gulf oil giants deepening production cuts as the Strait of Hormuz remains all but shut down. Saudi Arabia, Iraq, Kuwait and the UAE cutting output by nearly 7 million barrels a day, amounting to 6% of global supply. And finally, the White House weighing several options to curb rising gas prices, including the release of emergency stockpiles and halting collection of the federal gas tax. The president saying he has a plan to address energy costs without providing the details.
And one person after another has come in and explained the limitations of each of these various proposals. Mark Short was just saying the most likely one would be relieving gas taxes and potentially ships that are built from foreign ships in U.S. harbors, which I believe is something covered by the Jones Act. But there is internal pushback because it sort of pushes against some of the nationalistic efforts by this administration. It is policy in conflict right now on a whole multiple slew of levels.
G7 finance minister surprised me yesterday. It felt like we were drifting towards release of emergency reserves, and somehow they backed away and said they weren't there yet.
Well, they're still talking, so there's still time.
Wouldn't it make sense to? Isn't that what they're there for?
You know, if they think that this is going to be short-lived, and I'd actually be very curious to see what the rhetoric is coming out of there, why would they use their resources now, given the fact that supply shocks have happened again and again and again? So what is President Trump, what is the U.S. administration telling them about the timeline? I know this feels a little bit like reading tea leaves and tarot cards, but that's where we're at.
If the president and the White House is relieving sanctions on Russian crude, I think that tells you that they're not in a good spot right now, no? Isn't that the obvious signal from that? If you're compromising your foreign policy objectives elsewhere, then things aren't going well, are they?
Well, I think a lot of people would agree with that.
Let's turn to the consumer. Feeling the pain at the pump, the average price for a gallon of gasoline jumping more than 50 cents since the war broke out. The Bank of America Institute reporting recent rises in the international price of oil and the knock-on effect on gasoline prices may put some upward pressure on household spending. David Tinsley of the Bank of America Institute joins us now for more. David, thank you. Enjoyed the read once again. The difference between now and 22. It appears to be many things, but including the household balance sheet and incomes. How much can this consumer offset? How much of a cushion is there to insulate themselves from this energy price shock?
Hi, John. Yeah, so I'm joining you actually from B of A's Consumer and Retail Conference in Miami. So all of this is, real top of mind stuff down here. What we see in our data is a very robust spending picture as of February. January, February together. The weather was messing around a little bit with the January data. But really, to your question about balance sheets, in our report today, we're pointing out a couple of things, really. One is that consumers have some space to borrow. When you look at the proportion of our customers that pay off their full credit card balance every month, it's actually higher than it was in 2019. So some people can borrow more. There's dry powder, if you like. And the good news really is that the refund checks from the stimulus are hitting people's bank accounts right now. Now, a few weeks ago, that probably would have been spent either saved or spent on discretionary goods, of course. Right now, maybe a little bit more of it will end up being spent on necessity goods, gasoline, for example.
David, have you got a read on the spending right now? What's the early read on where the money's going? Is that where it's heading?
For the tax refunds, what we're seeing right now, and it's really early days, so it's interesting actually that higher income households are getting bigger refund checks. They're up over 10%, up more than for lower income households and middle income households. But because lower and middle income households are under the pressure, they're spending more out of those refund checks. And so when we look at, for example, discretionary spending, 3 weeks before, 3 weeks after a refund check, lower income households, their spending's up about 20% plus, and it's less than that for the whole sample. So I think, it's a slight mixed bag. Early days, like I say, perhaps it'll end up more being skewed towards these affordability issues. But at the moment, it is being partly spent and partly paid. Debt's also being paid down on using the money, I think.
David, we've seen different retailers report very different results depending on which part of the K they cater to, whether it's very wealthy individuals or whether it's middle and lower class, lower income individuals. I'm just wondering, from your perspective, do you see that K widening or coming together?
Well, you know, in the very latest data, there's a small narrowing in the K between higher income households and lower income households. But I wouldn't make great play of that. I think it's the lowest it's been in our data for about 6 months, but it's still very wide. But I think last month we were talking about the middle income households and how increasingly it looks like there's a K opening up between higher income households and middle income households. And that's still very clear in our data. And just one other point, all of this is underpinned by wage dynamics. Higher income households in our data, their wages are growing at over 4%. For lower income and middle income households, their wage growth is moving lower. And so the gaps between higher and middle and lower income households, they're the widest in our data for wages that they've been for 10 years. So even though this tax refund story can kind of shift the data around over the next 6 months, when we come back to what's going to drive the consumer in the second half of this year, it's going to be wages. And that supports continuation of the K, I think.
Does it support continuation of strength in the economy, or does it point to a very different backdrop with less consumer resilience?
Yeah, that's a good question. So, I mean, higher income households, you know, they really punch above their weight in terms of overall consumption. And the growth in that cohort's pretty steady. So I think going into the second half, as long as those guys are still spending and still increasing their spending, the overall consumer picture can look quite healthy. Now, middle and lower, clearly a concern, particularly middle if it continues to cool. So, you know, we might come off a frothy period, partly related to tax refunds, but I think there should still be some momentum behind the consumer in the second half.
David, we hope you're right. It's good to see you, as always. David Tinty there of the Bank of America Institute. Tax refunds should help cushion this economy, but that was the bull case. And now it's like the as you were case. And that's a problem. And that's why the oil move is a shocker. You wanted these guys to go out and spend this money on discretionary goods and help fuel a bounce in the US economy. And now we're talking about the money going to necessities and the spread between high income and middle income getting wider and not narrower. All of that is adding up to a very different view of the future than where we were even just a month ago.
If people are looking for a sugar high from these tax refunds, that sugar high, to your point, is probably going to staples, not necessarily discretionary goods. I'm just thinking about the fact that the wage growth gap between higher income and lower income families is the widest that it has been since 2015. This really speaks to a question of at what point that gets rectified by some overarching economic trend, or whether this just gets expressed in the political venue, which is a reason why affordability is increasingly on the agenda time and time again.
A massive midterm issue. Equities, by the way, down by about 0.1% on the S&P 500 at the moment. In the commodity market, crude still negative by 7 to 8%. We're down to 91.20 on Brent crude, following a wild ride in the last 24 hours. Still tracking the headlines coming out of the Middle East. This, a report just moments ago, Iran beginning a new wave of missile strikes on northern Israel. There is little sign of de-escalation this morning on the ground, even if you're seeing signs of the president trying to put together an off-ramp for the crude market.
Yeah, and Iran has come out and said, we're not done with this. I mean, they've said this repeatedly at the same time that they elected someone, or they chose someone to be the next supreme leader who is a continuation play of the prior leader. So a real question here about what the off-ramp is for Iran, especially with the enriched uranium still on the table and questions about a land operation to go get it. So still a lot of questions around the story.
Up next on the program, protecting the flow of energy.
We're also focused on keeping energy and oil flowing to the world. And I will not allow a terrorist regime to stop the globe's oil supply. They better not play that game.
Up next, Kathy Jones of Charles Schwab, live from New York City. You're watching Bloomberg TV.
2026 for us is the year that everything just comes together, right? We're not just moving money. The last decade, literally, we've been the race for Africa's growth, right? And the future of Africa, in our opinion, is not hype, it's infrastructure-led. When Africa wins, the global economy wins. We're building the pipes, and those pipes are now of age. Now, as of right now, we are the biggest fintech in Africa, the most licensed non-bank entity. In the last 10 years, we built that muscle. Now we're putting that to the test, all right? Now we've covered the entire world. We have UK, US, UAE, Canada, Europe covered through our partnership with Global Open, for example, and moving on. And the point behind that really is, how do we ensure we use that infrastructure to drive the next phase of growth for StartupWave by empowering our customers across all our segments?
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
So we've got some things to get through. Let's start with this. The day ahead is shaping up as follows. In the next hour, you will get a briefing from the Pentagon. The Defense Secretary, Pete Hegseth, will be speaking. That's about 15 minutes away. In the next hour or so, we should get another call, this time from G7 energy ministers, with a release of reserves very much on the table. So look out for that. After the close, we talk about tech Oracle earnings coming up after the closing bell, as this headline crosses right here just moments ago, that Amazon is kicking off an 11-part U.S. investment-grade debt offering. We've seen this from a number of tech companies, including Alphabet, which offered a lot of debt across a lot of maturities and a lot of denominations, and a lot of demand came in. This feels like a different moment to issue some of this debt.
We've already seen a number of issuances pulled, more from the high yield side than the investment grade side. You have seen spreads widen out. Will there be the same demand? Because all of a sudden, this is the new haven, right? I mean, this could go one of two ways. We could see either people push back, concerned about the risk, or suddenly all the fears about AI have gone away, and now that's the ballast of any economic trajectory going forward, and people are going to want to buy it. It'll be a great barometer of sentiment.
It's an interesting test, so look out for further headlines on how that deal is going. Equity futures pulling back by some 0.2% on the S&P 500 as those headlines cross. A quick sneak peek at the price action across the Nasdaq, the Russell, the S&P 500. It's shaping up as follows right now. On the Nasdaq, we're down by about 1/10, so that rolls over, and the Russell's down by about 0.5. Even with this move in the commodity market, crude's still lower by more than 7%, 91.40. WTI at about 88. We're down 6% on the session there.
You had the NFIB small business optimism come in a little bit below expectations. You've just seen on the margins some of the economic data come in below expectations following what we saw with non-farm payrolls. This all adds to the feeling that maybe you can't get a Fed that's going to be easing quite as quickly. And either way, people are reassessing whether that should shift some of the risk appetite.
Payrolls was a shocker. Hardly talked about it.
Hardly talked.
We've had more redemption requests, and certain credit companies, certain private credit firms struggling to meet them. Shocker, hardly talking about it. Because at the moment, we're only talking about one thing, the energy shock. But the energy shock contributes to all of those things in negative ways. And that's the problem about this moment.
And even if you do end the conflict on some level, people are saying that the oil price will be reset at a higher premium and already has been. So that has to be factored in.
Under surveillance this morning, protecting the flow of energy.
We're also focused on keeping energy and oil flowing to the world, and I will not allow a terrorist regime to stop the globe's oil supply. They better not play that game. In the long run, oil supplies will be dramatically more secure without the threat of Iranian ships, drones, missiles, nuclear menace, or anything. So the Strait of Hormuz is going to remain safe.
So here's the latest this morning. Treasury yields reversing course as the president looks to calm oil markets. Kathy Jones of Charles Schwab writing this: if crude prices go up to 120 to 150 a barrel, then overall inflation could rise by 50 basis points or more. Kathy joins us now for more. Kathy, good morning. Good to see you.
Good morning.
What if we stay in the 90s, in the 80s? How much does that change the outlook for you and the team?
Not too much. I mean, I think one scenario, and the scenario that the market has favored, is this is a short-term shock. It will pass as others have passed. The Fed will look through the price implications, and, you know, we'll go back to normal, whatever normal is after this. But that risk appetite will come back, and Fed will be on hold for a while, and, you know, possibly cut in the second half of the year. But I think what's interesting is the cross-asset correlations that we're seeing, or the unwinding of some of those. So as crude went up, yields went up. And it shows you that the market is very attuned to the inflation end of things and not to the demand destruction that's possible. That might reverse if prices continue to go up. Even if inflation is going up, it may be that the market starts to focus on the recession risk and not the inflation risk.
This is the tipping point I think we're all interested in. Where is that tipping point where this actually becomes bond bullish and not bond bearish?
Yeah, I think it's hard to say, but it's where we see the potential for recession, right? At what point does the damage to the global economy and to the domestic economy, which has been pretty resilient, but at what point is that so much that we worry about recession, employment, et cetera? And, you know, if a sustained move to 120 and above, I think the market starts to price that in.
I've read a number of notes saying that on the margins, the chance of recession, which had been completely off the table earlier this year, has gone up just by virtue of a stagflationary shock. Do you think that that's accurately priced in the long end of the yield curve?
No, I think that if we were to actually get a recession, the long end would rally, that yields would come down further. The offset to that is we do have inflation and we do have rising deficits as far as the eye can see. And so how do you parse that out in the bond market? Higher term premium perhaps, but lower overall yields, because the Fed would probably be leaning towards a dovish stance.
I'm just wondering how much this curtails some of the other stories. As John was mentioning, we've been talking about credit shocks in the private markets. We've talked about concerns around software debt in particular. The leveraged loan space has gotten hit. I'm just wondering, if you have higher benchmark yields on the long end and you have risk aversion causing higher premia, at what point does this create fundamental stress in some of these corporate names that already are kind of on shaky ground?
Yeah, I would say in like the investment grade space, I don't think that they're really at risk in particular. Balance sheets are still pretty good. Management of the, the interest rate risk is still very solid. It's when you go down the credit spectrum, and even high yield, which is less junky than it used to be, still the balance sheets are in pretty good shape if the economy is growing. It is in the leveraged loan market and in private credit where you start to get concerned, because that's where the underwriting standards are weaker, the companies are smaller, the credit quality is lower. And I think the fundamental risk there is what's the exit strategy, right? If the economy doesn't do well, what's the exit strategy for those companies? And if they run to the door, if their investors run to the door, that's when you create the stress in the market.
For the bigger companies, we've seen a lot of supply met by tremendous demand. We saw two headlines cross just moments ago. Lisa and I were talking about that. Amazon kicking off an 11-part US investment-grade debt offering. An additional headline mandating banks for an 8-part Euro bond offering in euros as well. Can you talk us through whether you think that demand is going to be a feature of this year, or is this just a moment that we're in? Or do you think that this supply, it's going to keep on coming from these major players, that investors are willing to meet that with tremendous demand?
You know, I think the demand is there as long as the global economy holds up. But if I'm actually a little surprised at the timing of this offer, because there's so much going on, but clearly they must have an indication that the demand is there and they can get this done at yields that are attractive to them. But I do think the longer this conflict goes on, the longer the risk is to the global economy, not just the U.S. economy, the harder it is going to be to absorb this without a wider spread.
Lisa, are you surprised?
Yeah, I am.
That they've come to market right now.
Well, I'm looking right now at the all-in yield for investment-grade bonds, and it's 4.9%. Plus or minus a couple basis points. That's actually where it's been since the end of December. So it actually hasn't moved all that much. My question is, are they trying to get in before they see even more stress? Do they see an opening for something in terms of people looking for haven trades, and suddenly AI, which was a pariah, is suddenly thought of as a bastion? So people don't have enough space in their heads to think about AI as the real risk. So maybe they're going to go into this head over heels. There are a lot of questions here. I do think that it will set the tone for AI issuance for the year ahead if they can get in, clear this at a time of a lot of potential volatility.
Do you remember the Greenland crisis? Do you remember that one?
Nope, don't remember it.
But what a strange year.
Ridiculous.
And I know, look, I sound like a broken record, longest first quarter in the history of first quarters. But think about the different shocks that we've had to confront over the last 2 or 3 months.
When it is humdrum to say another record day on this, that, or the other, it gives you a sense of just how benumbed we have become to the incredible news flow.
There was the Greenland crisis that lasted a couple of days. We've had this, the energy shock, the AI disruption, a terrible payrolls report that hardly anyone is talking about because it's all been ignored, given what's happening elsewhere, redemptions of private credit firms, and taking out Maduro in Caracas feels like child's play for financial markets at the moment.
But the way that people talk about that is the clean one, the one that actually was executed cleanly without any consequences, even though there are some consequences which are continuing.
Kathy, good to see you. Thanks for being here. As always, Kathy Jones there, Charles Schwab. On the headlines in the bond market at the moment, the notable one happening just moments ago, crossing the Bloomberg, that Amazon is kicking off an 11-part U.S. investment-grade debt offering. In addition to that, mandating banks as well for an 8-part bond offering in euros.
Yeah, and at a time when potentially people are worried about the ECB hiking rates, maybe the Amazon is worried about the ECB hiking rates too, or they want to get in before that.
It's an odd moment, isn't it? It really is a strange moment. Up next, we'll catch up with Kevin Foley of JP Morgan, Tom Fitzgerald of TD Cowen, Abigail Watt of UBS, Jim Caron of Morgan Stanley. The third hour of Bloomberg Surveillance just around the corner.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1.
is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
There is spectacular amounts of volatility.
It feels like we should kind of sit on the sidelines for a moment here.
The market is looking for just what the off-ramp could be.
This doesn't feel like the beginning of a great year.
Eventually, that volatility will create great buying opportunities.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Just about avoiding a third day of losses on the S&P 500 yesterday with a major bounce off the low into the close. Futures right now negative again by 0.2%. No positive follow through here on the Nasdaq, just about rolling over, underperforming the Russell, negative 0.5. Following that wild ride in crude yesterday, 119.50 at the high, in the 80s at the low. We're down another 7% this morning. Brent at 91.94, WTI at 88. On the agenda, on the calendar later on this morning, moments away, there will be a briefing from the Pentagon. We'll track the headlines coming out of that and catch up with Tyler Kendall in just a moment. And later on this morning, there will be a meeting between energy ministers at the G7 level at a time when we've been waiting for some kind of reserve release from these countries.
Yeah, 1:45 p.m. local time in France. This meeting is taking place. Will they come to try to stave off some of the price increases that we've seen for consumers? Clearly, there is the will to do so. To answer your question, why haven't they done so far? And I think that's going to be a really key point today.
You look at the shape of the curve, some extreme backwardation right now. They could meet this, put out all that supply, issue those reserves, and then just buy further out along the curve, and that would make sense. I know things aren't as straightforward as that, but that would be the thinking, I think, at their level in this discussion.
Maybe. Let's hear what they have to say. Honestly, I've just been shocked by how idiosyncratic each type of oil is, where you're going to be getting it from, and how you can really do this in a way that effectively lowers prices for average consumers quickly. And I think that that's the challenge right now that they're trying to deal with.
There is nothing straightforward about any of this, and we've seen the cuts to output continue across the UAE, Kuwait, Iraq, Saudi Arabia, 6.7 million barrels a day now of output cuts that we're estimating here at Bloomberg.
Those four nations account for about a fifth of all oil supplies in this world. Those cuts alone account for about 6%. What I'm curious is how quickly they can get these supplies back online. In other words, even if this conflict were to end now, how long will it take? And I think that those are the questions that people are analyzing to understand what some of the scars could be.
Brent crude down by 6 to 7% so far this morning, 92.40. Coming up this hour, Kevin Foley of JP Morgan with stocks seeking to sustain momentum. Tom Fitzgerald of TD Cowen cutting his outlook on the airliners, and Abigail Watt of UBS looking ahead to tomorrow's CPI print. We begin this hour with stocks lower and crude falling on hopes the war in Iran may be nearing an end. Kevin Foley, the global head of capital markets of JP Morgan Securities, writing, despite the move in oil prices, most are taking an optimistic view of the situation. Kevin joins us now for more. Kevin, good morning.
Good morning, John.
Are capital markets still wide open?
They're very much open. You've seen a number of deals launched this morning. We continue to see good demand out there. There's been a rotation in terms of where the interest is, but deals are getting done. We're on the tape in both investment grade, leverage finance, and within equities, all with issuance today.
We were somewhat surprised by this headline coming from Amazon. I don't know if you can speak to it directly, but perhaps you can talk about it in general terms. Kicking off an 11-part US investment-grade debt offering, there's an issue in euros as well. The timing of this, what are your thoughts on things?
Well, let's look at investment-grade spreads since the announcement. We're actually tighter. On a spread basis, we're tighter since the announcement in Iran. We're only 14 basis points off the all-time tights. So you're sub 100 basis points on a spread basis for investment grade. That's as attractive as it can be. Give you some context. When the Ukraine happened in the start of February 22, spreads gapped out to 168 basis points in high grade. Again, we're sub 100 basis points right now.
You said there was a rotation going on. Are these AI giants considered havens more so now or less so now? Because I can't keep track of the narrative.
I think the giants are still viewed as havens. There's still a growth story there. There is what you're alluding to is that there's an AI disruption theme that's out there. And it's more looking at that second and third derivatives of who's going to be negatively impacted. So a lot of business is going to benefit from AI efficiencies, but the data centers are still key to this. The hyperscalers still are key. The growth is assumed to be there, and the CapEx spend is happening.
You talk to a lot of issuers, and it's fascinating. If you talk to market participants, we've all seen the sky fall about 15 times so far this year, and it's just March. And I'm just wondering why they've been so resilient to some of the things that market participants are worried about, whether it's higher inflation, whether it's a labor market that's cracking, whether it's some of the disruption tied to AI that could potentially lead to defaults.
Well, I guess the old adage, market climbed a wall of worry, but I think it comes down to liquidity, right? Particularly when you look at the debt markets, you look at the issuance that we've had over the past couple of years, we've very much been recycling capital. 75–80% of the activity that we've had over the past couple of years in the debt markets has been refinancing driven. We haven't had the M&A boom in terms of needing financing to fund all of that, sopping up that liquidity. I think you still continue to have a lot of cash in the system. You look at the equity markets, you've had a shrinking base of public companies. So that also helps, shorten the supply in terms of just keeping demand strong.
That might change this year. OpenAI, Anthropic, SpaceX. What's your view of the next 12 months?
We're continuing to forecast $200 billion of IPO issuance globally, which is up over 30%. In the U.S., we think it's 60 to 70 billion. There could be upside. There are as much, as you mentioned, there's rumors about some other bigger sized ones that could be in there that can move that number higher. Obviously, if the situation in Iran continues or escalates, that could change that outlook right now. But right now, we continue to feel good about the rest of the year.
Kevin, what is it about the situation in the Middle East that could upend that? What is it about it specifically?
Oil, right? The pressure, it's, I think your prior guest mentioned about balance sheets being healthy at a corporate level. We continue to see the same thing.
You mentioned that we haven't seen over the past couple of years the level of M&A as well as IPOs that we have been accustomed to. This was supposed to be the year that we were going to get all of these things, as John was alluding to. Do you still think that that's plausible, particularly on the M&A side? We touched on IPOs. Or do you think that that's going to have to get pushed back due to the sort of rolling cycle of crises?
Well, clarify my points on M&A. M&A has been up, but it's been much more with elevated stock prices and healthy balance sheets. A lot of it has not needed financing from the debt markets. So activity has been more muted in the financing markets. Yeah, the M&A story still, everything's in place for it. But we've got to see how things play out. We haven't written that, hey, or this isn't the year. But you're right, 2026 was supposed to be the year we were going to go gangbusters in M&A and a lot of pent-up demand. We still see activity levels. We underwrote a deal last week that got announced. We're continuing to commit capital to things. We're not throwing in the towel about that still being a good year for M&A. But obviously, if things persist or escalate, that could derail it. We saw after Liberation Day, we saw a bit of pause in activity, and things really then picked up in late July through the rest of the year. So we could see same dynamics here.
Just getting an important headline I want to bring you. It comes from the UAE, and I'm just to jump in and break this. This is the largest refinery in the UAE. It has stopped as a precaution following drone attacks. That refinery has the capacity to process about 900,000 barrels a day of oil. So that's serious business there. It stopped as a precaution following a drone attack. This goes back to a theme we've discussed throughout this morning so far. The hope that we can end this war quickly, encouraged by the words of the president in the last 24 hours and the facts on the ground. And we keep tracking the facts on the ground right now. And they're the kind of things that speak to the kind of issues we've been talking about for the last week. The problem supplying this market right now with crude and oil product.
And the problem being in the United Arab Emirates right now, the fact that this is again spreading throughout the region also raises a specter of uncertainty of what type of response there could be. Is it going to come on the part of people in the Middle East withdrawing investments to try to pressure an end to this? Or is it going to come from pressuring Iran to really throw in the towel as well? I mean, honestly, there's so many variables here.
Kevin, can we get your thoughts just to wrap things up on the Middle Eastern sovereign wealth funds as a pool and a source of capital for some of the deals we've seen over the last few years, and the prospect of that being threatened by these developments?
Well, there's two ways of looking at it. And with a higher oil price, that means going to be more profits coming out of the Middle East. So there actually can be an argument that there's going to be more capital flowing into some of the... Now, of course, it depends on what your production levels are. If you're getting shut down from some of that stuff, that's going to change the picture. But I go back to my earlier point about liquidity in the overall markets. We look across the entire system and there's lots of liquidity. So we're not worried about capital disappearing and certainly capital for investing. But yeah, I think that I look at a broader economic concern with oil, right? What does it do to the consumer? What does it do to inflation pressure that gives the flexibility to the Fed to support what they want, what the market is expecting?
Kevin, we're lucky to have you with us this morning. Thank you, sir.
Great,
thank you very much. Kevin Foley there of JP Morgan, tracking a number of things, including that headline that just crossed, also tracking a briefing at the Pentagon. Bloomberg's Tyler Kendall's been following that. Tyler joins us for more. Hey, Tyler.
Hey, John, good morning. Well, the Pentagon briefing is ongoing, but we've heard so far from the Defense Secretary Pete Hegseth saying that the U.S. will, quote, not relent in its operations against Iran until full U.S. military objectives are achieved. He reiterated that those include the U.S. dismantling Iran's ballistic missile program, as well as the industrial base that creates those missiles, destroying Iran's navy, and making sure that Iran will never be able to achieve a nuclear weapon. He then added that the mission would, quote, happen on the U.S.'s timeline, adding today that we will see more intense bombardment. Pair this with recent comments this morning that we've been discussing on the program coming from Iran, including Iran's parliament speaker saying that the country is, quote, absolutely not seeking a ceasefire. We'll continue to monitor these developments, John, but I will quickly mention we're also looking to see whether or not the Pentagon outlines any additional details about it seeking a supplemental funding package from the U.S. Congress amid reports coming from the Washington Post this morning that the U.S. spent $5.6 billion in weapon stockpiles in the first 2 days of this conflict.
Tyler, it's good to see you. Keep tracking that for us when you stay close. Tyler Kendall there of Bloomberg, tracking a briefing from the Pentagon ongoing. We'll keep bringing you the headlines from that. We'll bring you the headlines as well from what's happening on the ground in the Middle East. So as the Defense Secretary Pete Hegseth says that today will be the most intense day of strikes, and we're seeing headlines that back that up. We're also seeing this headline coming out of the UAE from the country's largest refiner that they've had to stop as a precaution following a drone attack. We'll wait to see how quickly they can restart, but ultimately that's a unit that can process 900,000 barrels of oil every single day. This is real output being taken out.
Yeah, and from the Abu Dhabi authorities, the post that they put on X, I thought was really telling. They said that they were responding to this fire. No injuries have been reported at this time. And then they added this: the public was reminded to obtain information from official sources only and to avoid spreading rumors. To me, this indicates just how much people feel in the dark and how difficult a very quickly moving story.
Futures this morning just backing off. We're down by about 1/3% on the S&P 500. Up next on the program, the Morning Calls Plus, Tom Fitzgerald of TD Cowen cutting his outlook on the airliners, a sector that has been beaten up big time over the last week. That conversation up next, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The opportunities are there when you have a market that's swinging $20, $25, $30 a barrel. You have to keep your stops extremely short, your positions extremely small to get in and to get out. We've had a lot of upheaval in these markets over the last 2 generations. We've never seen anything like this.
That was Stephen Schork of the Schork Group weighing in on the energy crisis developing in the Middle East, and another headline reinforcing just how brutal things are on the ground right now. This from the UAE, the largest refinery stopping as a precaution following a drone attack. That refinery with the capacity to process 900,000 barrels of crude a day. That's an important development. We'll keep tracking that. Also, this came a little bit earlier, came from Amazon. The timing's interesting. They're kicking off an 11-part U.S. investment-grade debt offering. We understand they're targeting 25 to 30 billion in dollar bonds and also 10 billion euros in the euro offering at the same time. That headline just crossing moments ago.
Listen, Kevin Foley, the head of capital markets at JP Morgan, just said that capital markets are very much open and that tech giants are still havens. So at a time when you haven't seen spreads materially widen out and people are looking for havens, the promise of all of the AI bots that are going to fill your rooms with all sorts of new information and purpose it clearly seems like something people want to get behind.
We'll keep tracking that. The issues have come over the last number of months, including from Alphabet, and they've been met with tremendous demand. The number, $25 to $30 billion in dollar bonds from Amazon, 10 billion euros in euro bonds, in euros. That offering coming a little bit later. That's the price action and some of the headlines. Let's get to your morning calls. First up, Bank of America reinstating Qualcomm at underperform, citing lukewarm growth prospects. Elsewhere, Baird lowering its price target on Oracle ahead of earnings this afternoon. The analysts looking for details on AI infrastructure. And finally, Morgan Stanley upgrading CrowdStrike to overweight, saying the firm is well positioned to outperform in the coming years. That stock is up in the pre-market by about 2%. Elsewhere, airline stocks have been falling as oil prices rise due to the war in Iran. Tom Fitzgerald of TD Cowen cutting his price target on the major carriers, writing, "We assume the airlines are able to recapture a portion of the spike in fuel prices, but it's hard to envision margin expansion this year, barring a rapid decline in energy prices." Tom joins us now for more. Tom, welcome to the show. Which airline right now do you think is most exposed?
I would say probably either American Airlines or JetBlue or an Alaska. All three of those airlines have a little bit more sensitivity in their model to fuel prices for various reasons.
And Delta, where do they fit in here?
They have the most buffer because they own the refinery in Pennsylvania, so that provides an operational hedge. You look back in 2022 when there was the fuel spike around Russia, Ukraine. Over the full year, the refinery provided about almost a quarter of a cent of a reduction on their average price paid per gallon of fuel for the year. So it doesn't bail them out, but it certainly helps in an environment like this.
We've had this conversation 50,000 different times. Why is Delta so much better at this than everybody else?
They play the long game. They're not afraid to buck consensus. When they bought the refinery, they bought kind of, I want to say late 2012, so it was viewed as kind of missing the market at that point in time. But you hang around. It's like fashion. You hang around long enough, eventually it comes back into style. 2022, it was good to have the refinery. This year, it was good to have the refinery. They're very focused on building durability into the model in every which way, so not surprising for them.
Having a refinery seems to be the hedge of choice for Delta. How many of the other airlines are actually hedged against oil price fluctuations?
None of the U.S. airlines are. Air Canada hedged about just a little under 20% of their first half consumption. The thing U.S. carriers found was the hedges. It was great during the fuel spike year, but they often ended up losing money when fuel prices declined, and it was advantageous to have everybody pricing on the same cost curve and just trying to manage, not just sitting idly back and actually working to pass on their input costs to the end markets.
When we talk about the airline industry, Tom, we're talking about a twofold hit here. On one hand, appetite to travel amid uncertainty. On the other hand, a question about how much higher oil prices are going to eat into margins. Which do you think is the main driver right now of the price action?
Right now, it's fuel. I mean, I think if there was any signs of demand destruction on top of elevated fuel, you'd see much more. I think you'd see much more weakness in the share. But just at a high level, if you think about when airlines were issuing guidance back in mid-January, the fuel prices in the forward curves were around, call it $2.30, $2.40 a gallon, depending on your estimates on which curve you looked at. Today, those curves are all about, above $3 for the rest of the year, maybe a little bit under $3 now with the easing we've seen overnight, but still a pretty meaningful delta if you have that type of going from, $2.30 to $2.40 to closer to $3 per gallon for a line item that's about 20 points of margin. You can't sweep that under the rug.
And Tom, it's a big market. There's space for different views. Here's a different view. It comes from Barclays. While the focus is on fuel prices in the near term, we know U.S. travel demand appears favorable as the industry heads into the peak spring break travel period and set against lower industry capacity growth. What's the counterpoint, Tom, to that this morning?
I don't know if I necessarily disagree. I mean, I kept my buy ratings on these names, especially the big airlines. I still think you'd want to own them, and that a lot of investors are under-owned overall. If you think about how much improvement has happened in this industry on a fundamental basis versus today and versus pre-COVID, I just think I don't know. The issue I grapple with is numbers are probably still a little bit too high, especially 1Q, possibly 2Q. So I don't disagree. We're seeing the same strength in demand, but there's a lot more uncertainty now in where margins settle out, just given we don't know where fuel is going to settle out. We don't know if there's any impact from higher gasoline prices. So it seemed prudent to take down numbers a little bit, even though I don't disagree that it's probably a good entry point for the stocks longer term.
Well, as you indicate, Tom, that's a massively important variable. The thing we're wrestling with, the thing we're grappling with on a daily basis right now is that anxiety around the labor market seems pretty high at the moment. At the same time, you're going to get tax refunds, and we're trying to figure out where the refunds are actually going to go. Will they buy that flight? Will they take that trip? Or will they just save that money?
I think, prior to the last week, we were going in expecting that they'd be, booking the flight, booking the cruise, spending it on discretionary services. This kind of raises a new wild card. We'll see. I think, and maybe we have more of a keeping up appearances, some spending surge this summer, and it pays off more later on in the year. But I think, all the signs on demand have been pretty encouraging thus far, and travel demand's been resilient. So knock on wood, I think.
And part of that is because it's the upper part of the K. One of the things that's driven the margins at the likes of United and Delta has been international travel. I mean, this is something we haven't talked about yet. The international travel could get disrupted based on the Middle East hubs that have been seriously impacted. Are you seeing any fallout from that you think has longer legs?
At least not for the U.S. airlines. In fact, United noted that they've seen a huge uptick in passengers from Australia, New Zealand, flying to Europe and connecting to the U.S. now instead of connecting through the Gulf. So that's an interesting positive incremental. I think it's too soon to say on bookings. Our early checks have been that they haven't seen any fall off in U.S. outbound demand, but obviously, if the situation worsened or there was, consumer discomfort or on traveling into that part of the world, into the Mediterranean, maybe you'd see a little bit of fall off, but I don't think anything to worry about thus far.
It feels like this group is at the epicenter of crisis after crisis, whether it's what we saw in 2020 with the pandemic, whether it was 2022 in Europe, or whether it's what's happening right now. How much more resilient are the balance sheets now than, say, 2019?
It varies carrier to carrier. Delta, United, and Southwest have the best balance sheets among the group. American and JetBlue are the most levered. That's also partly why they take a little bit more of a hit on these spikes of fuel because they don't have as much cushion. So it varies carrier to carrier, and that's been part of the bull thesis, especially for Delta and United, is that the balance sheet resilience should give equity investors more comfort that they can withstand a downturn, that they don't have to dilute shareholders whenever the next crisis hits.
Tom, it's good to see you. Thanks for jumping on. Tom Fitzgerald there of TD Cowen. Out of all the airlines, it would be Delta with the Trainer Refinery over in over in Pennsylvania.
That's a very pure play in terms of a hedge rather than just buying hedges.
It's just absolutely ridiculous. They just keep executing so well compared to everybody else. The facts on the ground, we keep talking about the facts on the ground right now. Chancellor Merz of Germany saying they're concerned at the apparent lack of a plan on how to end the war with Iran. Just compare that reality check to the hope that this market has, given the encouragement they've had from the President of the United States on the US's ability to end this soon. It's a very different take coming out of Europe this morning.
Out of Europe, as well as on the ground in the UAE, where there's discussion of a fire near a refinery that accounts for a significant point of their oil.
Coming up on the program, Abigail Watt of UBS looking ahead to tomorrow's must-watch CPI print.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Some notable headlines in financial markets. The number one in the Middle East, the UAE, was dealing with a fire earlier on this morning following a drone strike. And we saw this headline cross just moments ago that the largest refinery has stopped as a precaution following that drone attack. That refinery has the ability, the capacity to process some 900,000 barrels of oil per day. And as for oil production, we've seen those cuts across the UAE, Kuwait, Iraq, Saudi Arabia total close to 7 million barrels of oil per day. That's a problem right now. It's a problem for access to energy and ultimately a problem for the price of energy as well, even with the encouragement from the President of the United States more recently that they can end this war and end this war quickly. The price action looks like this. Brent crude is down by about 5%, so off session lows. Brent at the moment at about 93.80, WTI around 91. That's the commodity market. In the equity market, equity futures negative by 0.4% on the S&P 500. And if you want a headline from the credit market, corporate credit, it's this one right here. Even in this moment, as we've heard a few times, and Lisa said it herself, investment grade credit spreads right now are still pretty tight. And Amazon is kicking off an 11-part US investment grade debt offering this morning. Also, an 8-part offering in euros. And those numbers sound like this: $25 to $30 billion in dollar bonds and 10 billion euros in the euro offering.
Yeah, last time around, their bond issuance was oversubscribed many, many times. A lot of people seem to think, based on the notes that I've been getting, that this will be similar because this is ultimately a haven play. If you take a look at all-in yields for investment-grade bonds, it's 4.87%. That's the all-in yield. That's down from a recent high in April during the whole question of Liberation Day of 5.5%. So you are seeing pretty suppressed benchmark borrowing costs, even amid this crisis.
Someone we both follow and follow closely, Robert Schiffman of Bloomberg Intelligence, leads our credit team here at Bloomberg. Just the headline of his piece he just published: Amazon, huge bond deal to draw massive demand. And that really sums things up, and we've seen that a few times, including from Alphabet and others. As we count you down to the opening bell about 60 minutes away, let's get you some morning movers, some single names. Danny Berger has more. Hey, Danny.
Hey, John. Starting you off with some sell-side action. Bank of America reinstating Qualcomm at an underperform, pointing to the tepid growth of the smartphone market plus high memory costs. All of that adding to what they say is some lackluster performance coming from the company. Shares are down 2.9%, or 2.8% rather, following that downgrade. And then we had an upgrade from TD Cowen on Rivian. Shares moving higher in the pre-market by 4.6%. After that, TD Cowen saying that their new SUV, the R2, is surely going to have a lot of demand. They're optimistic about that. And the level of demand they're already seeing out there means that there is an upside to the 2027 assumption for Rivian. Finally, I want to get a check on some of the oil companies that have been whipsawed with the oil action. They have been moving down steadily. Now it's picking up some steam, especially for Occidental Petroleum. Those shares are down 2.9% with a decline in oil prices, a little bit more tepid for Chevron and Devon, but still all of them falling in sympathy with oil prices this morning, John.
Danny, thank you. Thanks for the update. Looking forward to the program. Danny Berger, Matt Miller taking over in about 27 minutes' time to guide you into the opening bell. For this market, some optimism building in the last 24 hours. I'm going to end to the war.
On Iran, you called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
You're talking
but soon.
about days?
I think soon.
Okay, and with respect
Very soon. Look, everything they have is gone, including their leadership. In fact, there are two levels of leadership, and even actually, as it turns out, more than that. But two levels of leadership are gone.
The president's comments whipsawing crude. Oil seeing its biggest intraday swing on record in yesterday's trade. Bloomberg's Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, it's very difficult to figure out where the economy is going to end up because we don't know actually when this war is going to end, despite what the president says. And we don't know when oil prices will come down. If they do, they are still high compared to where we were back in February. And that's going to cause a lot of confusion. And much is going to depend on the timing of this all. Now, the impact on the economy, you can sort of quantify if you leave out the time piece. We have gotten a lot more efficient with energy, so the impact on GDP is a lot smaller. You've heard the stagflation talk, but instead of the kind of impacts we had in the 1970s of 0.5% to 1% in terms of GDP, now it's only 0.1%, maybe 0.2% in a quarter. And remember, this war started in the third month of the first quarter, so there probably won't be much effect at all. We use a lot less energy to produce the amounts of electricity and power that we get, and we still are the world's largest petroleum producer, so we still have plenty of energy. It's just that it's a globally traded commodity, so the price goes that way. Who gets hurt? Now, this is not a stock prediction. That's Danny Berger's job, but in terms of how it filters into the economy, the airlines and trucking really going to feel it first because they've got to buy jet fuel and diesel, and those have gone up in price. And because trucking is more expensive, you're going to see some prices tacked on, raised at the retail level. Restaurants also, they get a lot of deliveries, and food prices that are going to go up because of imports. And then you get into the things like the chemical business. They use a lot of petroleum, plastics the same. And so down the road, a month or two, we could see an impact on all of those companies. The positives, despite what Danny said just a minute ago, oil producers and oil field service companies, because they get the direct benefits of the higher prices. And ordinarily you would say renewables, solar energy, wind energy, but the president is trying to kill those, so they're not going to gain as much. Sum it all up, and what do we think? Well, we just don't know, and that is demonstrated by the December Fed funds futures contract, because that's supposed to price in where we are at the end of the year, and it has been very volatile. As you can see, it was going up. We were looking at no moves at all. Then all of a sudden went down when the president said we might end the war soon, and now it's back up again today. People are still thinking that we might see some reason for at least holding the entire year.
Mike McKee, thank you, sir, with the update. And of course, the story far more important elsewhere to the Europeans and to the others. We've seen big moves to the front end of the UK curve, particularly in yesterday's session, erase some of that. But the sense is that they are way more sensitive to these moves than maybe the Federal Reserve is.
They're a lot more exposed in terms of the region to Middle East energy supplies, as well as, frankly, single mandate central banks that have a much more direct pass-through from some of the higher energy prices into what consumers pay and, frankly, into inflation.
Yields lower in the UK this morning. We're down by about 5 on 10s on 2s. We're down by close to 8. Abigail Watt of UBS writing this morning. Energy prices pose a near-term headwind to real consumer spending. The oil price shock is a more two-sided risk for monetary policy rather than is perhaps appreciated. Abigail joins us now for more. Abigail, good to see you, and good morning.
Good morning.
What did you mean by that last slide?
So I think if we think about the repricing we saw off the back of the increase in oil prices in bond markets and expectations around easing from the Fed this year, I think you saw obviously a clear focus on the inflationary impacts of the oil price increase. And I think perhaps what's underappreciated is that this is coming alongside a point where the labour market looks a little vulnerable at this juncture still. And it's also coming alongside potential growth hits, right? Like this is something that could hit real spending, which is 2/3 of the US economy. So I think perhaps the point around risk to rates being more two-sided is this idea that it could come at a juncture where the labour market's already looking relatively vulnerable, and the inflation shock, it will depend on the persistence of the increase in prices.
This is something we've been exploring all morning. We talked to Kathy Jones about it. At some point, there's a tipping point. This starts to become bullish for bonds because of the potential output hit that we could see from higher energy prices. How close do you think we are to that tipping point?
I think this is one element of the consumer story, right? I think one of the things you've got to think about is the kind of other drivers that we had for the kind of strength that we were expecting from the consumer this year, right? We're expecting that you see a strong tax refund season. Tax refunds are up 10% in the latest IRS data on an average basis. That's a little bit behind, I think, kind of some expectations of the fiscal stimulus, but that's another thing that should prove potentially supportive for household balance sheets. And if we think about kind of how this feeds through to household balance sheets as well, I think it's the kind of everyone outside the top 20% of the kind of income distribution potentially that's going to wear this kind of more. So I think you've got to weigh potential kind of positive headwinds, positive tailwinds for the consumer versus some of the kind of negative impacts potentially from higher oil prices. So I think it will depend on how those kind of play out in the next couple of weeks and months. And I think the key thing here with all of the kind of potential impacts for the economy from the oil price increase is really the extent and the persistence of that increase in oil prices. And I think that's what's going to be key in terms of how this feeds into kind of growth and also into inflation.
One of the tailwinds has also been the idea of rate cuts. How much is there momentum in the consumer, particularly at the lower end, should the Fed remain on hold?
Yeah, so I mean, in our expectations, we've got 50 basis points of cuts from the FOMC this year. And in terms of the timing of that, we think it's potentially kind of second half, so July, October. I think at the margin, that easing in interest rates is something that is supportive and helpful for the consumer. But that would, in theory, bring interest rates back round to around neutral. It doesn't necessarily outright stimulate the economy at this point. I think for us, when we're thinking about the kind of resilience and the potential strength of the consumer, I think that fiscal story is actually potentially the more important part of the kind of outlook this year for the consumer, rather than necessarily the kind of tailwind from monetary policy easing.
We've been talking about how that fiscal tailwind could potentially be absorbed by higher oil prices. How do you sort of weigh where oil prices are versus that fiscal boost that people were expecting?
Yeah, so I think it's probably one of the key things to be thinking about at this juncture. I think, as I said, I think the kind of persistence and the increase in kind of oil prices will be important. We've obviously already seen gasoline prices rising, and the consumer in the US is incredibly sensitive to higher gasoline prices. So I do think, there is a potential that some of the positive kind of tailwinds we were expecting from fiscal policy could be offset, in particular for those lower income consumers where, you are seeing the fact that savings are running kind of below average. They've kind of spent down any excess savings that had been built up. And I think, that's the area where I would think that you would feel that kind of gas price increase most acutely in the consumer.
Mike McKee was talking about where Fed fund futures were trading right now. What's your Fed bet for you and the team?
So we're expecting that the Fed deliver 50 basis points of cuts this year, right? Okay. I think the risk, if we're thinking about the distribution around that, I think, potentially if you see kind of more of a growth hit, if you see this kind of labor market vulnerability persisting, I think that you could potentially see the risk that rate cuts come sooner than we're expecting. And then I think, if we think about the kind of risks on the opposite side, the potential for rates coming later and them holding longer, I think that's really going to depend on what we see in the inflation data. Obviously, we'll get the February CPI this week. We're expecting that you see a slowing in terms of the monthly prints there, but we do think that will be the low point for the CPI this year. So, we're expecting that pushes higher and we see inflation peaking in the second quarter.
Independent of what happens in the Middle East, that's the low for this year?
Yeah, so that was our profile previously as well, because we're still seeing that tariff pass-through coming through. You are seeing kind of elevated core goods price increases, even if you are seeing a little bit better inflation on the services side.
So the call for 50 basis points, is that a call based on the economy or the man who's going to be the Fed chair?
So it's based on the idea that, if we think about when we're thinking we see inflation peaking, we do think that the run rates of inflation will begin to peak in the second quarter. And I think at that point as well, we're expecting that the labor market still looks vulnerable. We have the unemployment rate pushing higher from here to 4.5, 4.6 by the summer. So I think with that dynamic, I think that's a point at which in July, you should see kind of enough inflation progress for them to think, okay, we should remove a little bit of that excess restrictiveness.
Got it. Abigail, good to see you. Thanks for breaking it down. Thank you. Abigail Watt there of UBS. So we see unemployment climbing through the summer potentially and into the midterms. Ultimately, it's going to be the political framework there. That's not great reading. Won't be great for the administration to hear, and won't be great to see if that's how it plays out.
Especially after what we got with the job report that we got on Friday, which seemed to confirm that. I do wonder how important CPI and core PCE are going to be this week, given you need to see that progress in inflation to allow this to happen.
Brent crude this morning is down by 6%. We're at 93. WTI is down by about 5. We're at 90 so far this morning. Up next, we'll set you up for the day ahead. Plus, Jim Caron of Morgan Stanley joins us, remaining confident that markets can get back on the right track. That conversation just around the corner from New York City. You're watching Bloomberg TV.
in case you missed it, on Bloomberg Crypto.
There's a debate going on right now in DC that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Today will be, yet again, our most intense day of strikes inside Iran. The last 24 hours have seen Iran fire the lowest number of missiles they've been capable of firing. We will not relent until the enemy is totally and decisively defeated.
That was the Defense Secretary in a briefing at the Pentagon just moments ago, weighing in on the facts on the ground and where the operation currently stands, as many of you would call it, and where the war currently stands. In the commodity market, this is how the price of things is shaping up right now. Brent crude is down by 7%, WTI is down by 6%. The facts on the ground, drones, projectiles still being thrown into Gulf nations from Iran, and it's doing damage. And we see that in the UAE, intercepting, at least attempting to, a series of drones and missiles once again today. One hitting the biggest refinery in the country. They've had to stop as a precaution. We've talked about the size of that, the capacity to process 900,000 barrels of oil per day. A lot of energy production and output is being taken out in this region.
Yeah, we've gotten already 6% of the output taken off, the 6% of the output in the world, right? I mean, this is 6.7 million barrels from 4 nations of 20 million barrels per day that is produced. This is a crucial area of oil production for the world. When do we start talking about the fundamentals of what's being taken offline and how long it's going to take to put it back on? Until we get a timeline, we can't even go there. And I think that that is the level of uncertainty we have.
Some vicious, volatile moves in global markets in the last 24 hours as we count you down to the up and about, the start of another one. It's about 42 minutes away. Here's the trading diary for the week ahead. After the market close, earnings from Oracle, look out for that tomorrow. CPI data, plus we'll hear from the Fed Vice Chair of Supervision, Mickey Bowman. On Thursday, Dollar General earnings, the U.S. trade balance, and another round of jobless claims on Friday. Core PCE and UMich consumer sentiment. For stocks, they're searching for direction as President Trump signals the war in Iran might be nearing its end. Jim Carrot of Morgan Stanley writing, our base case remains that strong fundamental underpinnings in the economy plus easier fiscal policies will allow for prices to resume higher. Jim joins us now for more. Jim, good morning.
Good morning.
Still constructive?
I am still constructive. It's not going to be as easy as it sounds, though. I don't think it's going to be a straight line. I think that we do have to recognize what the initial conditions in the markets were prior to the event of the war and what they might be coming out of it. Look, in my career, I've experienced 3 of these. This is my 3rd one. The first one in the early 1990s, Gulf War I, Gulf War II, early 2000s, and here we are again. Each one of these events absolutely caused volatility. But the difference between this one and the last two was that the initial conditions coming into the markets today with a lot of fiscal stimulus, we have a lot of tax refunds coming in, we have relatively low interest rates. I think inflation obviously is under pressure right now, but it was headed down. Jobs data, confidence data, a lot of things were going right. And I do think that we will be able to put this behind us at some point. The question is, how long will this all last? Because I think the duration's a big point. What, if anything, breaks, and how long will it take to repair? And that's really what the risk is.
You seeing anything break?
Well, I mean, I think we're seeing signs, right? So the way that I look at this is that there are three basic risks that are out there. The first one is correlation risk. So first of all, and the second one's liquidity, and the third is contagion. So the correlation risk right now is that you're having equity prices come down and you're having bond prices come down. So there's no place to really hedge yourself, and that creates a scary situation in markets. But liquidity is still functioning relatively well in markets. Markets are functioning well based on repo markets and things like that. And contagion, we're not really seeing this become a broad-based wave of defaults coming through the markets because of this energy shock. So I think there are two out of these three reasons. The liquidity and the contagion component are okay for right now. The correlation risk, though, is relatively high.
And we've seen some pretty big losses being reported, at least by Bloomberg, in terms of certain hedge funds in particular. Bloomberg reporting Millennium, Balyasny, and Point72 among them. Are you seeing forced sales that are opportunities to really get in there?
Well, see, that's what we're looking at, right? So we came into this relatively well balanced in our portfolio, somewhat high quality and defensive. So for us, this has actually not been as big of a shock to our particular management and our portfolios. So we are looking, from my perspective, we are looking at opportunities to find dislocations in the markets to add to some of the themes that we really like. Cyclical broadening in the market's one of those. So, and that's what we're doing.
So at what point does cyclical broadening get challenged by higher oil prices and a potentially weaker growth outlook?
Listen, that's a great question. So what we see right now is that there's an inflation shock hitting the marketplace, right? That's why bond yields are moving higher and equity prices are going down. The risk is when does this inflation shock translate into a growth scare, and when does it start to really impact growth? That's when the cyclical broadening trade will start to get challenged, because cyclical broadening really means small caps and mid caps relative to large caps. That's usually what does well. That's what was working prior to this event. So do we get back into that right now? And that's what we have to ask.
Why do you think it hasn't already been challenged by the fact that we've reset oil prices higher and potentially put the Fed on hold for a longer period of time?
Yeah, so the reason I think that is when we look at oil prices, I don't think they're going back down to where they were. I think that they're going to settle at a higher level than where they were. So if you're looking at Brent, we're not looking at $70 Brent going forward. We're probably looking at best case scenario somewhere around like 80, I think, for this year. So I don't think that this shock just goes away, right? I think that we're taking the growth hit. We are going to get that. We are taking probably higher inflation right now. The market's repricing for this. So the question is where is the market repricing? Where is that overshooting? And does it actually give us an opportunity to enter? And we think that there are some selective opportunities where we can get involved. And I don't think that we tip ourselves into a recession necessarily. Now, clearly anything can happen and we'll react to it. But for right now, we think that this is still volatility in markets that we can take advantage of.
What are the openings right now? You call them dislocations. We're single digits away from all-time highs.
Yeah,
on the S&P. Where are the openings?
Yeah, exactly, and that's what we debate, right? Is we're sitting here saying, well, we do want to buy something relatively cheap, but nothing's really cheap in a whole lot. But you know what, John? That's actually a relatively strong sign for the markets, that the markets aren't willing to really take this down. Now, some people will say, oh, the markets are completely missing this. I don't believe the markets are that dumb. I think the markets are pretty smart. I think it really depends where you are. So the cyclical broadening theme, I still think, is a very strong theme. I think a lot of the technology sector has already come in relatively weak and relatively well discounted going into this. So it's not like we came in to this event where everybody was way overbought, way overlong at the moment. So I think we have to be a little bit less emotional, and we have to think through the valuations and where the opportunities are. And to your point, we're not seeing screaming buys at this point. So we're being slow, but we are starting to add.
Jim, it's good to see you. Jim Caron of Morgan Stanley Investment Management, still constructive on this market and seeing the ability to add as we get these dips, and they are small dips to the grand scheme of things.
They are small dips, but he's not alone. A lot of people saying this is a good opportunity, especially as it does seem like people are looking for off-ramps.
Equities right now on the S&P negative by about 1/10% going into the opening bell. The president seemingly sending the signal that maybe he's looking for an off-ramp and capping the advance on crude. Crude this morning down by 7%, 92.30, 89.40 on WTI. We've talked continuously this morning about the hope that we can take that off-ramp, establish one, and go down it. And the reality on the ground and the facts on the ground are still deeply concerning.
This morning, the reports of a fire at a UAE or near a UAE refinery, very much concerning. We'll continue to monitor this and figure out whether people come to more of an off-ramp.
Coming up tomorrow, Francis Donald of RBC, Lisa Shallard of Morgan Stanley, Jeff Curry of Carlyle, and the former St. Louis Fed President Jim Bullard from New York City this morning. Good morning. Stay safe. We'll see you tomorrow. This was Bloomberg Surveillance.
We're into the second week at Indian Wells. Five-time champion Novak Djokovic fought his way past American Alexandra Kovacevic in 3 sets to reach the 4th round for the first time since 2017. The victory for the 38-year-old makes him the second oldest man to reach the round of 16 at a Masters 1000 event.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. When I started to realize what was happening, it was 12 years, and we haven't done it.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
All right, we are risk off for the minute, but we've got 30 of those left until the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, the relief rally loses steam as airstrikes intensify in the Middle East, and Iranian officials say they are not seeking a truce.
Hedge funds take hits from the wild market moves, while Bill Ackman eyes a $10 billion IPO for Pershing Square.
Plus, Amazon kicks off what could be one of the largest corporate bond offerings ever, the latest blockbuster fundraising effort to finance the AI boom.
Robert Schiffman from Bloomberg Intelligence put it well. You know it's a ho-hum day when Amazon's willing to just offer all these bonds into the market. That's a good sign.
And pretty far out, too, right?
Yeah.
Some of them go until the 70s.
Yes, yeah. What a time to be alive. They wouldn't have done that were it last week when everything was war. Let's take a look at where the markets stand. Just looking at tech, NVIDIA having a significant announcement coming through, a new investment in thinking machines in the AI researcher, which has reportedly had some staffing issues itself. Also looking at TSMC ADRs, sales jumped 22% for the company in February compared to a year ago as AI demand persists. Also, Oracle, those shares are up 1% this morning. Matt, they're going to have earnings after the bell, spending risk, all of that in mind for Oracle, with Bob Sloan pointing out to us yesterday one of the most heavily shorted stocks.
Yeah, we'll be watching the free cash flow numbers for sure. I'm watching the S&P, I'm watching oil, I'm watching 10-year, all the macro indicators here. We're looking at stocks right now that are down. We had a revival in risk sentiment yesterday when President Trump said this war will be over very soon, but now we learn that attacks are intensifying. Brent crude still down right now about 7%, so we're looking at 92.25 for Brent and WTI that's trading in the 80s. And the 10-year yield rises, but we had come a long way down from the 417, 416 levels we were looking at 24 hours ago. So now adding 2 basis points brings us only back up to almost 4.12%, Danny.
A wild trip in these markets, with oil seeing the biggest intraday range yesterday since the futures contracts were first created. President Trump is doing damage control, saying the war in Iran should come to a close sooner rather than later.
We took a little excursion because we felt we had to do that to get rid of some evil. And I think you'll see it's going to be a short-term excursion.
We're winning very decisively. We're way ahead of schedule.
Are you thinking this week it will be over?
No,
You're talking
but soon.
about days?
I think so. We could call it a tremendous success right now as we leave here.
Today, Defense Secretary Pete Hegseth laid out the goal of the war without any timeline.
As President Trump declared yesterday, we're crushing the enemy in an overwhelming display of technical skill and military force. We will not relent until the enemy is totally and decisively defeated.
Let's get the latest with Bloomberg Washington correspondent Tyler Kendall. Tyler, the president's saying that the war could be over very soon. How do those mesh or contrast with the facts on the ground?
Well, Danny, at this point, we're really seeing an escalation. As you heard, the Defense Secretary Pete Hegseth maintaining that the U.S.'s will is endless, but the operation itself will not be. He says that this is going to happen on the U.S.'s timeline, and that later today we could see one of the largest bombardments of the military campaign so far. He maintains that the administration will, quote, not relent until all of its objectives are achieved, outlining and reiterating that that includes dismantling Iran's ballistic missile program and the industrial base that creates the weapons, destroying Iran's navy, and denying the country will ever have a nuclear weapon. But we have to pair this with comments that we got earlier today from Iran, including the Speaker of the Parliament saying that they are, quote, absolutely not interested in a ceasefire. Plus, we had a statement overnight from the IRGC maintaining that they will continue to block oil exports. President Trump yesterday said that the U.S. would widen its targets to electricity infrastructure if disruptions in the Strait of Hormuz do continue. Matt and Danny, I will point out that when asked directly about naval escorts in the critical waterway, a solution that has been floated by President Trump, we heard earlier from the chair of the Joint Chiefs of Staff, Dan Kane, saying that if tasked with this, the military will look at the range of options and conditions required, but it doesn't seem like that option has been deployed quite yet.
You know, President Trump has said this war could end very soon. In fact, he said it as we leave here today, talking yesterday, we would be victors. But can we really claim victory if the IRGC is still in control, if the Ayatollah's son some see him as more hardline than Khamenei himself, is the supreme leader, and if their nuclear capabilities haven't been obliterated for a second time.
Well, Matt, that goes to the main question of how is the administration actually measuring progress when it comes to the conflict. And President Trump says that they are ahead of schedule when it comes to achieving their objectives, but that they're not quite there yet. We did hear from the president, of course, yesterday saying that he doesn't think that the conflict is ultimately going to be resolved later this week, so signaling that it's going to continue, and then pair that with the facts on the ground as we continue to see drone strikes escalate, particularly from Iran. The defense secretary was just asked in this briefing if the U.S. has been surprised by how regional allies have been targeted in particular, and he says that the U.S. Was expecting this as one of those potential ramifications of this military conflict. I will point out that Bloomberg News reported a redhead on the terminal earlier today. A key production facility, refinery in the UAE, ended up closing due to a drone attack by Iran that set fire to the industrial site around it.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting from Washington, D.C. Now, some of the world's biggest hedge funds, known for their steady returns, suffered hundreds of millions of dollars in losses last week alone after the war against Iran triggered wild market moves. Bloomberg's Nishant Kumar reported on this and joins us now. And Nishant, it's interesting because this is multiple hedge funds. These are pod shops, and it looks like they have the same positioning risk.
You know, absolutely. Last week was basically this kind of perfect storm for hedge funds. You had this sudden geopolitical shock with Iran conflict that set off the broad risk of move, stocks down, bonds selling off, and then oil ripping through 120 and swinging back. So, you know, that kind of very violent cross asset move is tough for even the big multi-strats who have lots of money to maneuver, spread across lots of teams. They are diversified, but still, the diversification did not help them, at least in a very short period of time last week.
Yeah, and so some of the hedge funds you referred to in the story, Ballianzi, Millennium, and Point 72. Elsewhere this morning, Nishant, we're also monitoring a filing from Bill Ackman for a Pershing Square IPO. He's repeatedly pointed to, look, this is a shift to get it to a Berkshire-style long-term model. Is it that, or is it just a way to raise permanent capital, Nishant?
Well, having permanent long-duration capital really helps, and that's what we have seen the bigger hedge funds migrating to in this industry. It's the kind of capital that lets you hold on to your bets through volatility, through this kind of market, essentially, and make really concentrated long-term bets, which is the Berkshire link or aspiration, if I may say so here. You know, a closed-end fund structure supports that because you are not dealing with daily redemptions of investors the way you do it in open-end funds. So the clean takeaway from Pershing Square filing is that they are trying to lock in durable capital like Warren Buffett.
Hey, Nishant, thank you very much for your reporting. That's Bloomberg's Nishant Kumar. Amazon has kicked off a potentially record-setting corporate bond sale, tapping debt markets to fuel its AI ambitions. Let's get over to Bloomberg Tech co-host Ed Ludlow. Ed, it's remarkable that in the midst of volatile markets, Amazon is going for it, a potentially $40 billion plus offering across dollars and euros.
Yeah, we've seen a wave of AI-related offerings, particularly from the hyperscalers, but you know the Amazon one is size large. Basically, the offering targeting $37 to $42 billion in dollar terms, but in dollar-denominated and euro-denominated bonds. In the U.S. market, 11 tranches of high-grade bonds, raising between 25 to 30 billion. That doesn't seem set. Maturities 2 to 50 years. I think that includes a 2076 bond, about 1.55% above treasuries. And then in the European markets, where it's making a debut, it's targeting as much as 10 billion euros, 8-part debut, maturities 2 to 38 years. The point is, capital expenditures just this year alone, $650 billion across the hyperscalers. There is an insatiable appetite for it, it would appear, from the market. You know, Amazon, I think, tapped the debt markets in November at a smaller scale, but think about what we've seen from Alphabet most recently, Oracle as well, and how calm investors are about the idea that even an Amazon might swing into negative free cash flow at some point in the year because they want to see them fund the CapEx expansion and go after the AI game.
I want to ask about earnings that we had, earnings we're going to get. And TSMC was out yesterday, and that was good news, I guess, for NVIDIA. After the bell, we're going to get Oracle. What are the big numbers that stood out to you, Ed, and what are you going to be watching for?
So on TSMC, like, you know, the juggernaut continues. The demand for AI-related chips is quite clearly there. They continue to see growth of 30%. Where they are constrained is because there is a sort of suppression on the handset and PC market because memory prices are so high. So TSMC is doing really well, but just like every other name in the electronic supply chain, that consideration around memory is there. With Oracle, really simple story. Like, it relates to their credit profile, it relates to their growth. Just as with the other hyperscalers, people look to Oracle's infrastructure unit as it relates to the data center build out, and they want to see high bar passed when it comes to top line growth. We had our recent reporting, of course, which you would have noticed Oracle continues to post about on X, that they elected not to expand a site in Abilene, Texas, which had market ramifications. Maybe they'll get asked about that by the sell side too.
All right, Ed, looking forward to your program. Ed Ludlow hosts Bloomberg Tech with Caroline Hyde that kicks off at 11 a.m. They'll be covering all this and more. Quick check of what's going on in the markets right now. We are looking at losses on S&P futures, just about 1 or 0.2%. NASDAQ futures relatively unchanged here. But Brent crude continues to drop 7% from the massive gains that we saw yesterday and swings, really, because of the kickoff of the Asian session. Brent came down. Right now, $91.70 a barrel. Obviously, WTI a little bit lower than that right now. And the 10-year yield up about 2 basis points at 4.1170.
Yields being driven by that big digestion of Amazon bonds to come. A look at some of the other movers on our radar this morning. AT&T says that it will spend more than $250 billion in the next 5 years to build out its infrastructure in the U.S. Shares down about 1/3%.
Meta is hiking fees for advertisers to help cover the costs from digital services taxes in Europe, and those shares up about 0.8% right now.
And a big drop from Kohl's, reporting worse than expected sales for the last quarter, down 2.8%. It's been years of declining results, struggling to recover from that, down 2.8% this morning.
Coming up, we'll discuss mounting risks for supply chains and the dozens of ships stuck around the Strait of Hormuz, more than 150 by some accounts. We have the CEO of V Group, and they run a lot of ships and thousands of crew members transporting or attempting to do that, goods through the Strait of Hormuz. Renee Kofod-Olsen is with us next. This is Bloomberg Open Interest.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
2026 for us is the year that everything just comes together, right? We're not just moving money. The last decade, literally, we've immune the race for Africa's growth, right? And the future of Africa, in our opinion, is not hype, it's infrastructure-led. When Africa wins, the global economy wins. We're building the pipes, and those pipes are now of age. Now, as of right now, we are the biggest fintech in Africa, the most licensed non-bank entity. In the last 10 years, we built that muscle. Now we're putting that to the test, all right? Now we've covered the entire world. We have UK, US, UAE, Canada, Europe covered through our partnership with Global Open, for example, and moving on. And the point behind that really is, how do we ensure we use that infrastructure to drive the next phase of growth for StartupWave by empowering our customers across all our segments?
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Let's get now to high interest. Look what's making headlines around the world. The Pentagon says talks with Anthropic are over after the AI firm sued the government for labeling it a supply chain risk. Defense officials rejected Anthropic's demands to ban its AI from mass surveillance or autonomous weapons use. A $200 million contract is now in jeopardy as the military shifts to other AI providers, including OpenAI. Private equity's cash crunch is getting creative. Carlyle is planning a multi-billion-dollar structured financing dubbed Project Potomac to seed its next flagship buyout fund and return cash to investors who are stuck in older funds. The vehicle blends senior debt, preferred shares, and equities. It resembles a collateralized fund obligation, but without a credit rating and with large preferred stock sales. And Saudi Aramco's CEO is warning of catastrophic fallout for global oil markets if Iran war disruptions drag on. The company is cutting output by up to 2.5 million barrels a day and rerouting crude away from the Strait of Hormuz as much as it can, but it can't fully replace lost capacity.
Meanwhile, Matt, Bloomberg is reporting that hundreds of ship clusters or ships have appeared near dozens of ship clusters and hundreds of ships have appeared near the Strait of Hormuz as the war upends oil flows and shipping. Let's discuss with the group CEO, the CEO of V Group, Rene Kofod-Olsen. His firm provides cruise and management services to the global shipping industry. Rene, thank you so much for joining us this morning.
Thank you for having me.
What do things actually look like in the Strait of Hormuz right now? Because there's this confusion, our signals being jammed, where our ships actually, how do things look on the ground?
So, first of all, shipping is not really quite used to these dislocations. So we have ships stations inside the cul-de-sac of the Gulf, and we have ship stations outside. If you think about the daily sort of transit on a normal day, it would be 140 ships. So obviously, with a variety of ships, both the energy ships, but also normal bulk carriers, container ships, and so on and so forth. About 20,000 seafarers stuck.
So you're perfectly placed because of what you do to tell us what this looks like. Is it an actual closure? Is it a trickle? Are you seeing 3 or 4 ships going through every day? Are we seeing 10 or 20 ships going through every day? How does it look right now?
Right now, as a snapshot, it's closed. I mean, you have a trickle effect of ships going through, but not in any material way. So definitely you should consider it as a dislocated bottleneck.
It's a president, and to be fair, it's not just President Trump. It was Macron yesterday, too, talking about, do we get naval escorts? Trump saying that he wants to reopen the Strait of Hormuz. What would it actually take to allow the confidence to have ships be able to go through, and I guess to get the insurance to allow them to do so as well?
So if you take a step back, I think shipping is not adverse to these dislocations. We have had it in many, many ways throughout decades or even centuries. 90% of global trade is actually seaborne. It's the most efficient way of traveling goods and services on the water. But when you find bottlenecks like this, it's not that we're not resilient, it's not that we don't find solutions. The first point is the seafarers, because we don't have autonomous ships. So we need to ensure that we have a safe passage, however that is, regardless of the dislocation. So that's alpha omega. Secondarily, obviously, we need to ensure that then the assets can come all the way into their destination. And do remember, as I mentioned before, it's a cul-de-sac. And all the residents in that cul-de-sac obviously benefits from being able to have the trade flow. So there has to be found a solution for safe passage. There has to be found a solution for security going through. The strait is narrow. You have 2 lanes in and 2 lanes out. So we are waiting for a solution. In the meantime, we are ensuring that all seafarers, all ships are being looked after, waiting for what can be done. But there is not a direct replacement.
But you have, what, dozens of ships, thousands of seafarers that you're managing here. When you hear President Trump say, our Navy will escort you through, do you call the administration and say, okay, we've got a couple candidates here, send us the naval ships and escort us through? Or do you say, not right now, because these lives are on my hands?
So we discuss with all authorities, and we advise our clients at a minute's notice.
But it's not happening, to be clear. It's not happening right now. You're not teaming up with naval ships to go through the strait.
There is no defined structure for doing that. But historically, we have seen that in other bottlenecks, in other dislocating places, like the Red Sea. We have historically seen a very good collaboration between Navy assets and commercial shipping. But the alpha omega for shipping right now is that there is safe passage, secure passage, and the seafarers, as we have talked about, is obviously safe.
And you probably have to know where your ships are, too. There's been reports of those clusters. They look like they're forming on the map. We had it up just a moment ago, and it might just be jam signals showing false areas of where these ships actually are. How are you keeping track of your seafarers right now?
So obviously we are in minute-to-minute contact with our seafarers. I must say, as I just mentioned earlier, they are the most resilient parts of our industry. The craftsmanship on those ships to be able to navigate, even as you allude to, the AIS system is jammed or having a challenge coming into it. So those kind of things are obviously very, very important for all of us. But the point of the matter is that it has to be safe. And then we are, of course, in a very inflationary environment for everybody. So you are having a challenge with insurance, even though it's also a resilient industry. They are trying to find solutions for this. I think all shipping companies want to find solutions to this, to your question about Navy escorts. But right now, it's not there.
Renee, if you were to guess in a matter of days or weeks for you to start getting your ships through, could you give us a forecast?
No, I cannot give you a forecast, but I can tell you that from a supply chain disruption and from the trade flows where this is obviously omni-important for the entire world and for all the residents in that cul-de-sac, we want it to be in near term. Shipping waits for it to be in the near term. I think the shipping industry as a whole is resilient, is innovative, is creative, but that part of it is out of our hands.
Right. Force majeure, so to speak. All right, Renee, great to get your intel. Thank you so much for joining us. Group CEO, V Group, Renee Kofod-Olsen. Coming up, we'll discuss the market outlook amid geopolitical uncertainty with Citi's Stuart Kaiser. And as we see futures swing from gains to losses, this is Open Interest.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And
I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Quick look at futures as we approach the opening bell. As I said, we've been swinging between gains and losses. Right now, it's red on the S&P. The NASDAQ futures are green, but Brent crude is what to watch, down 7% at 91.97. We'll be back with the opening bell in just 2 minutes' time.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that have been swinging back and forth. They're relatively little changed as we head to the open of the trade. S&P futures down 0.1%. NASDAQ futures completely unched here, and the small caps are down. Telephone is ringing the opening bell at the New York Stock Exchange. It's got to be one of the oldest traded issues there. 150 years, you can see, of connecting. I guess that's part of the reason that they're listing, and their ticker is simply T. Down at the NASDAQ, it's a BDC ringing the opening bell. And I was looking at the 5-year, as I tend to do, performance over the last 5 years. Telephone is up 65%, which obviously underperforms the S&P, and SSSS is down by a fifth.
That's like the thing I get on my ticket when I have to get extra searched by security.
Oh, yeah.
With all those S's on there, it's not the greatest of tickers.
But you don't get busted.
No, never.
Right? You're good at hiding things.
You say that like there's a reason for me to be busted. There is absolutely no reason for me to be busted. Let me show you what these markets are doing. We have some very tepid moves on our hands. Amazon, a monster bond offering, $40 billion plus, perhaps, of a high-grade bond offering. It's going to be in 11 parts, and it's going to help fund its AI work. That's why you see some weakness coming from the Treasury market this morning. TSMC, those shares turned weaker at the open, even though sales jumped 22% in February with strong AI demand. After the bell, it's going to all be about Oracle. Shares are up 1.1%. Again, they have their earnings. A lot of the focus is going to be on spending risks, Matt.
All right, I'm watching the big numbers as we head into the trade right now. The S&P 500 unchanged, really, but Brent is where I've got my eye trained, down 8%. And if you look at WTI, you're looking at a similar number here. It's down 7% at 87.86. So the oils come down bigly after President Trump says this war will be over very soon. The market buys it. And the 10-year yield unchanged at 4.11. So it's come down substantially, even though it's up 1 or 2 basis points right now. Joining us now is Citi's head of U.S. equity trading, Stuart Kaiser. And Citi, I got to ask why? Why does the market believe it? President Trump says one time, this is going to be over very soon. We just got into a war with Iran. I mean, the Strait of Hormuz is closed right now. Refineries are shutting down all over the Middle East because they're getting hit by missile launches and drone attacks. Is this really something we can back out of very soon as the IRGC remains in control and the Ayatollah's son is appointed supreme leader?
It doesn't look like something we can get out of that quickly, but the market remembers back in last April, and when Trump said it was time to buy stocks, it was time to buy stocks. So I think you probably saw some people just with that gut reaction. And the second thing is, if you believe this is a 2 to 4 week event and the G7 is releasing reserves, et cetera, you sort of can maybe smooth out the impact on oil for that short period of time until which you get kind of some resolution and things to reopen, as your previous guest was discussing.
Even though we're saying, okay, markets are reacting, I'm looking at an unched S&P 500. Yesterday it was only up 0.8%. The biggest
was up. Yesterday was up.
Yeah, but not even 1%. The biggest decline.
It's just insane. I mean, we had oil going to $120 a barrel.
I get what you're saying, but my point is that the moves are small. Come on, Matt. Even you have to admit, directionally, it's interesting. But the moves themselves have been extremely contained. What do you make of that?
Well, I think that's right. Well, and look, when oil was at 120, the S&P futures were down about 2.5%. So you did see a bigger reaction when that happened. But I think exactly what you're talking about is the key here. You have the magnitude of the moves, but then you have the relative performance, right? So the moves have been relatively small. But if you look at what the market's done, it's punished positioning and it's punished the parts of the market that it thinks are most negatively exposed to higher shipping and higher energy input costs. On the positioning side, you've seen gold down. You've seen Korea and those AI bottleneck and memory stocks down. You've seen software getting short covered, right? On the relative impact, what do you have? You have Japan underperforming. You have Europe underperforming. You have EM underperforming. You have banks, materials, consumer durables underperforming. So the market, you could argue about the magnitude, but the market is clearly focusing in on the parts of the market it sees most negatively exposed to these impacts and is punishing them on a relative basis.
Yeah, hyper-focused. I mean, just a day after we got the biggest swings we've ever had in crude oil, which I think we'd all agree is relatively important to the functioning of the economy. Amazon is announcing a $40 billion bond sale. I mean, outside of, I guess, the crude patch, everything's cool, right?
You know, it seems to be, that payrolls number on Friday, I think we were kind of lucky that got reported at a time when people are focused on Iran, because to your point, the underlying fundamentals of the market have been pretty good. You know, GDP was tracking in the 3s, it's now down to 2, unemployment rate 4.3%, earnings, albeit very volatile, were actually quite strong. So fundamentally, people wanted to be in this market, and I think that that's why it's been kind of resilient. Obviously, now you have this kind of huge event risk pricing that the market needs to deal with, and I think if you're an equity investor, you've had a short-term risk shock from the front of the oil curve rising. And the question now is, does this persist long enough that I need to start pricing higher inflation or even negative growth shock into the market? And if the G7 releasing reserves can flatten that out a bit, it actually does trim off some tail risks.
By the way, so I was talking with Bruce Richards last week at Bloomberg Invest, and he said he sees 3+% GDP growth at $60 a barrel, at 82, at 101, you know, at 120, no more growth. So it moves in increments, right? Do you have a similar formula when you look at an equities target? Like, if oil stays at 90, then we're only going to be at 6,900 by the year end. If oil drops to 80, we could be over 7,000. If it goes to 120, we're going to be at 6,500. Do you?
I mean, I don't know if it's that linear, but I think the key word you said there was stays,
yes.
Right? So having 1 month crude at $100, I mean, front month crude is called up 25, 30%. The 2-year oil future is up 5%. And equities are going to respond much more to that 2 to 5 year oil price than they are to the front month. And think of it through like a fracking perspective. These frackers don't start increasing production unless they can lock in an oil price that's sufficient for them to make money. So the key, I think, to your point, is stay. If we get to these levels and stay at these levels, which means the oil futures curve rises, then it becomes a bit of a recessionary risk, and that's what the markets, I think equity markets are more.
Well, does it feed through into earnings meaningfully, or are the only earnings you care about driven by like OpenAI getting a $100 billion investment from NVIDIA to use that money to buy NVIDIA chips, like has nothing to do with oil?
I mean, it can feed into earnings, and I think that's why you're seeing retailing and consumer durables and stuff like that under pressure. Airlines obviously under pressure, but again, even an airline is hedging its fuel exposure, you know, months
and
if not quarters
prices
out.
One of the things, though, I didn't understand about the sell-off we saw last week, though, was what underperformed. Everything did poorly, every sector except energy, but one of the worst performing sectors was staples, second worst, down 5%. Healthcare, down 4.6%. I thought these were supposed to be the corners of the market where we could hide and feel safe when war was unfolding before our eyes.
I agree with you 100%. Those two defensive did underperform. Staples in particular, that had been an area that was heavily bought to start the year. So I think you had some people backing out of that. Within staples specifically, I think you want to gravitate towards kind of the grocers and that area. You know, the other areas of staples could be a little bit negatively impacted by both shipping costs and energy costs. What's actually kind of interesting is this, you know, higher energy, higher shipping cost trade has actually behaved a lot like tariffs did. Like the stuff that got hurt during tariffs is the stuff that's getting hurt now. You know, good news, bad news. Good news, we have a playbook. The bad news is it's happening again, unfortunately.
Oh boy, Stuart, thank you so much for joining us. Dusting off that playbook at City Head of U.S. Equity Trading, Stuart Kaiser. Let's get a check on your equity markets about 8 minutes into your trading day, and we are lower, only 0.2%. About 400 stocks are down, 100 of them are up. If you look at the gainers this morning, Meta having a pretty good day. Axios reporting that they're buying Moltbook. Producer Will tells me, you know, that AI, the chat forum for AI bots. Make sense of that, what you will. So Micron also doing well, up 4%. Broadcom also about 1% this morning too. Looking to the downside, Microsoft, Eli Lilly, another rough day for healthcare. And then it's a lot of the energy names. They are falling alongside the price of oil. Exxon down 1.3%. Chevron also down there in the top losers too. Let's look at what your sectors are doing. I'm going to guess energy is going to be near the bottom, and it is the utmost bottom sector. That is down 1.1%. Everything is down except communications. That's going to be Meta. That's adding to that. Infotech barely changed this morning too. Consumer staples and healthcare again getting beat up. The safety sectors, as Stuart was pointing to, maybe has to do with positioning to start the year, just not a place to hide out at this moment.
All right, interesting interesting market reaction to what's going on. Coming up, we'll talk more about how the war is impacting one specific industry, and that is airlines. We have at least one already hiking prices on higher fuel costs. Hedging be damned. This is Bloomberg Open Interest.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, you know, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, you know, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, you know, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, you know, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Minutes into your trading day, we are marginally negative, down 1/3 of 1%. NASDAQ, which was trying to push positive, now falls, still basically unchanged, but a little bit weaker. Russell 2000, that's also moving weaker as bond yields rise. Let's get you some top calls this morning. The sell-side action that we're following. First up, Hims & Hers, that gets upgraded at Citi and Bank of America after its obesity drug partnership with Novo Nordisk and the dismissal of Novo's lawsuit. The analysts at both firms saying that the deal significantly reduces legal and credit risk. Shares up another 12.4% after a good day yesterday, too. Up next, Morgan Stanley, they upgrade CrowdStrike, saying that it's built to win in AI as more customers adopt its products. The firm says CrowdStrike can grow revenue over 20%. Shares a little bit weaker, though, down about 3/4. Finally, Scotiabank is upgrading Air Canada, citing elevated uncertainty as fuel prices rise. The firm also notes that it is at risk of softening air travel demand. Matt.
You know, when you say CrowdStrike, I think of the CEO, George Kurtz, because he's a race car driver. And when I think about racing, it makes me think about that other story that we haven't talked about yet.
We have to talk about it.
F1.
Yes.
BYD.
Yes.
The Chinese electric car company.
I just don't get it. It's not a car with a racing history or much of a history at all. It feels weird to put that on the grid. You might have other opinions, Matt. I find that strange.
I feel like F1 isn't as much about racing anymore. It's about preserving your battery. But we can talk about it throughout the program. Right now, I want to stick with the airline woes. They have products that still use gas engines. Qantas is hiking international fares about 5% as jet fuel prices spike amid the Middle East tensions. And I'm talking about some serious spikes. Here you see 88% on this contract. I've heard of 150% jumps in the price of jet fuel. Let's break it down now with Savanthi Sith, Airlines Managing Director at Raymond James. And Savanthi, I wanted to highlight that number specifically because initially Danny and I were both like, wait, don't they hedge? You know, how does 1 week make a difference? But if you have a 150% spike in 1 week, I could imagine that overrides any hedges that you've got in place.
Hey, Matt. Good morning. You know, each airline is different. A lot of U.S. airlines actually do not hedge. Hedging is a very expensive insurance policy. And there are other tools that airlines have, kind of good balance sheets, margins to try and kind of work around it. And the best kind of tool that they have is capacity and fare increases. In Europe, you have a lot of airlines that are hedged because it is very hyper seasonal. But you're right, the airlines sell, you know, 2, 3, 6 months ahead of time. And sometimes it helps to kind of hedge what you're going to be flying. But a lot of airlines are kind of open to the fuel price increase. And this level of increase is really tough to overnight pass through. So airlines have to start right now.
It might be worse in Asia. Matt and I were looking at a story this morning that Qantas is looking at raising their ticket prices in reaction to what's happening with fuel prices, that Air New Zealand might be shortly behind. Is this something the American air operators can do too? Do they have the room to raise prices in reaction to what we've seen over the past week?
Yeah, we're hearing that some U.S. airlines are already trying to increase prices. I mean, definitely, if you think about the Strait of Hormuz and which regions are more impacted, it's definitely a bigger impact on Asia. But it is raising prices. You know, jet fuel is a global product. It is raising prices for everybody. And you have U.S. airlines that are already trying to raise prices as well. And to your point, it's such a big move that they have to raise prices.
For some reason, Savi, I'm interested in incremental moves in oil and how that affects other outputs. So do you look at that, like if jet fuel moves in a $10 band, how that affects earnings at a specific company?
Yeah, I guess the easiest way to kind of think about it is, look, fuel is going to be anywhere between a fifth to, you know, for some airlines, it's 40% of costs. And so that is a significant hit. Now, you're looking at, you know, the type of moves that we've had right now, you're looking as much as 10 points of margin that has been wiped out once all of this flows in through the P&L. So you really have to kind of raise fares by, you know, 10% or more to at least kind of start making a dent in all of this.
And the fuel prices, to be clear, Savi, they move on an amplified scale compared to Brent, right? If we see Brent go up $10 and that's a 15% move, you could see jet fuel rise 40, 50, 80%.
Sometimes. It really depends on the refining, you know, if the refiners are down or not. And that's definitely what we've seen. So the move in jet fuel has been greater than the move in Brent in a lot of cases as some of the refiners are getting shut down as well. So this is, you're exactly right. It's been a much bigger move in terms of the impact to jet fuel.
Savi, I know Delta owns a refinery itself. Does that airline emerge much less scathed, much more unscathed than its peers?
Yeah, so hedging is one method to kind of get, you know, just doing swaps or caps, contracts like that. Delta does own a refinery. You're exactly right, Danny. You know, that should help them, at least on the refining margin. They are exposed to crude price increases, but on the refining margin, they should be able to offset some of that increase. It's still a negative impact overall, but it should be less at Delta.
You know, I think one of the biggest concerns for economists is if we see this persist, and I know that, you know, higher price sustainability is key, you could see airlines reduce their aircraft purchases, right? I mean, would be, for an economist looking at GDP, the biggest fear. Do you see that as a possibility?
Like, it really depends, Matt, on how long this lasts. If this is a short-term spike, then I don't think you're going to see any kind of change in CapEx. It is not as easy to work with the OEMs, especially for aircraft that's being delivered this year and maybe even to next year. But the longer dated aircraft can get pushed out. What happens immediately is you start parking the aircraft that you have. You start flying them less, and you take seats out of the market, and that pushes kind of pressure on the fares immediately. So that's what I think what you see first. First, you start to see kind of the maintenance providers getting hit. And then, like longer term, if this fuel price persists, then you will see kind of order books getting narrowed.
Hey, Savi, real quickly here, because we're almost out of time. The DHS and the partial government shutdown has now entered its 4th week. TSA agents are now starting to miss their full paycheck. Is that having any impact on these airlines with these long lines at TSA with demand?
So far, we haven't seen an impact on bookings, but it is definitely a concern. I mean, this is a kind of bipartisan political failure that we're seeing here, and hopefully this gets resolved. But it's happening at a time that this is peak spring break period, and so hopefully this will get resolved soon. Right now, we're not seeing it as an impact on demand, but clearly the longer this goes, it is a big concern.
Savi, thanks so much for joining us this morning. That's Raymond James Airlines Managing Director, Savi Synth. Coming up, Oracle set to report results after the closing bell. Cloud acceleration in focus, and we'll take a look at that just ahead. This is Bloomberg Open Interest.
And I'm Tom McKenzie. This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks as oil comes down. We're seeing actually a fairly negative reaction on the S&P 500, still down 0.25%, even though the tech stocks are up about 0.1%. I think one point you could make is that these are extremely small moves, considering the huge swings that we've seen in oil. And we still are seeing that right now. We've got Brent crude down almost 8% right now at 91.41, reversing most of what we saw yesterday. And the same is true when you look at WTI. NVIDIA is up right now after an investment into thinking machines, after TSMC earnings, which should be, I think, a positive for NVIDIA, but TSMC itself is down 0.1% in, these are the ADRs. Occidental Petroleum down with the price of oil, as is ExxonMobil. Amazon up only at 0.2%, but after a massive bond offering announcement, I think it's $37 to $41 billion, so huge. And then Oracle ahead of earnings, which are expected after the bell, down 0.9%, Annie.
Let's get more on what to expect with Oracle's earnings. Bloomberg tech reporter Ryan Vostelica joins us now. And this is a stock that's already down 53% since its high last September. Ryan, what are we going to be concentrating on when they report?
Hey, good morning. So like a lot of the other major cloud companies, there's going to be a lot of attention being paid to Oracle's CapEx plans. There's been a lot more criticism and a lot more scrutiny of elevated spending by all these big cloud companies. At the same time, we are continuing to see pretty strong growth in cloud services as a result of AI demand. So it's going to be really a push and pull between those two ideas. How much are they spending, and then how much are they getting out of it in return?
In terms of the concern here, it's negative free cash flow. Free cash flow that's turned negative at a time when debt is just massive compared to equity. Are you seeing this turn from a growth story into a credit story, Ryan?
That's a great question right now. I know a lot of people are really closely monitoring the CDS spreads here at Oracle. It certainly is a great question. They are investing very aggressively in order to capture what they see as a pretty big AI opportunity. Now, their biggest customer when it comes to AI stuff is OpenAI, but there's been some reports about what is this relationship looking like. Maybe their data center in Texas looks like they pulled back on that. So a lot of questions about how reliant they are on this one customer. How much is this going to pay off? And then are all the investments that they're making into this, like you said, there's been some debt issuances, really a wide blowout in the credit spread spreads, free cash flow has turned negative. There's a lot of question on, is all this going to be worth it and over what time frame?
All right, Ryan, thanks very much for joining us. Ryan Vlastelica wrote the TechWatch story on Oracle. Highly recommend you check that out and subscribe to TechWatch if you're a Bloomberg client as well. Coming up in the next hour, Ed Yardeni raises the odds for a market meltdown. We'll ask him why and what he thinks now that President Trump said the war will be over very soon. Then we have Nancy Tangler. She shares her top picks with us, and she owns Oracle. So we'll ask her about the credit story that it has become. She owns the equity, to be clear. A lot of guests coming up, including Sukhinder Singh Cassidy on small business. This is Bloomberg Open Interest.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals, and the Bloomberg Business app.
Good turnaround Tuesday morning. We have markets in flux. I think that's the safest way to characterize the kinds of moves that we're seeing this morning. This is Bloomberg Intelligence, Paul Sweeney and Scarlett Fu. Paul Sweeney's off for the week, but we have a special start to our Bloomberg Intelligence program today because we're going to head over to the FIA Global Cleared Market Conference in Boca Raton, Florida. This is the Futures Industry Association, their annual conference. They represent clearing firms, exchanges, clearinghouses and trading firms, where our Tim Stanovic is sitting down with Thomas Book of Deutsche Börse, CME Group's Terry Duffy, Adina Friedman of the NASDAQ, Boon Chai Lo of SGX, and Kalshi's CEO Tariq Mansour. Let's join them now in Boca Raton, Florida.
Early this morning, $43 million of volume. Duke is favored, by the way. We know Walt likes Indiana. I want to see a show of hands. Raise your hand if you think that's gambling. Ooh. Okay, so one person up here, Terry, thinks it's gambling, and I'd say 30% of you guys.
We were supposed to raise our hand too.
Oh yeah, you can raise your hands too, yeah. All right, great. This is off to a good start. So Tarek, put it just to everybody right now. Why is this not gambling?
Can we ask the same question about zero-day to expiry options?
No, no, because I could do the same thing on FanDuel or on another gambling app, and I have to be 21 and I have to do it in a state where the regulators say it's okay.
I think the way that it's sort of we can sort of sit down here and debate this all along. I think there's this is going to sort of be debated in the courts and let the courts decide on the legal merits, and we feel very strongly about where we stand. I think the more important thing is to sort of take a step back and think about sort of why the consumers are adopting this at the scale and the pace that they're adopting it with. And as you said, there are other alternatives, for similar type of speculative activity, but they seemingly are engaging with Kalshi and some other prediction markets at this rate. And maybe just to sort of talk about the rate, prediction markets are the fastest growing company in America today, comparably to AI. And there's which one is growing faster, I'm not exactly sure, but they're both growing at a similar pace. And the most important thing, at least for us, is like the basic mechanics and how the activity is basically happening. It's like, are you walking to a house where the house is setting the odds and where the business model of that house is essentially customer losses. Like the revenue of the house is equal to customer losses, and that's the key KPI that they track on any given quarter, which I sort of bucket squarely under the gambling casino, betting model. Or is it an open, free, fair, and transparent marketplace where market participants are engaging with each other, whether they're hedging, they're speculating, they're using the forecast to get informed about the future, or other utilities, all of which exist in our grain futures.
So even if they're doing the same thing on FanDuel or DraftKings, the way they're doing it is different, so it's not gambling.
I think speculating in any financial instruments, people have historically called it gambling. Like, grain futures in 1905 got legalized in the Supreme Court, and, half of America thought that was gambling. Because what is gambling? You're putting some money to make more money on something you don't control. That is the definition of gambling in something like 20 states. Everyone sitting on this panel has gambling products under that definition. To me, what's important is I believe that a lot of people have opinions about politics. They have opinions about the economy. They have opinions about sports. They have opinions about culture. I actually believe these people have more opinions about these topics than they do about, where is the sort of S&P going to land at the end of the day.
Right.
And from that perspective, I think, the mechanics of whether you're trading against somebody else or whether you're being extorted by a house is very, very critical to that definition.
Terry, he mentioned grain, so.
Yeah, I just want to say a few things. I raised my hand only because I think it's, when you look at what the Commodity Futures Trading Commission has done, they have defined these as swaps. And when you define them as swaps, how do you define them as gambling? Even though if the Bears are playing the Packers and it's an outcome based and the same payout is done on a prediction market or at an online registered affiliate of any state, how do you say it's not the same? So, but our federal government has seen it differently. So I want to be in defense of Tarek to some degree here, because it's not like he's listing illegal contracts. It's not like CME is listing illegal contracts with FanDuel. But I am hard pressed, and I think it's up to the government to make this determination so we don't have to raise our hands so we all know what it is. are these swaps. And because of the word, if you look at the definition of a swap, there's the word occurrence in there. And occurrence means if you exchange a cash for a treasury, that would be deemed a swap on a treasury. There's also the word outcome in the language under the definition of a swap. So you can pull the word outcome up, and then you can say, well, an outcome is based on an event, and an event can be a sporting event, to Tarek's point. So I'm not disagreeing with that, but I think it's a very, very difficult situation we're in right now, and there needs to be some clarity. One of the things I told Tarek, I met with him earlier, is the best way for prediction markets, crypto, or anything to grow is to start to get some good, solid regulation around them that's sustainable through multiple administrations, not subject to administrations that are just going to take things up and take things down because of a lack of an understanding. I think that's the biggest problem we have, especially with crypto and especially with prediction. So I'd like to see new applications, new ways of doing business work, but let's do it where we all understand it, where we don't have to raise our hands.
Adina, you were also raised your hand when you said it was gambling, but at the same time, you're making your first foray at NASDAQ into prediction markets with outcome-related options, pretty limited in scope. What would it expand to, or does the regulatory environment, how you view it, not allow you to expand it much beyond those indices?
Well, I think the first thing is I agree very much with Terry that we need very clear rules of the road. You know, the markets thrive when we have consistent regulation. And it allows investors, first of all, to be protected and to try to drive fairness into the market infrastructure. I think the second thing is that it allows us all to figure out how we can construct products that can be made available to investors in different forms to allow for them to express themselves in their views about market outcomes. With the event options that we've requested approval from the SEC to launch, first, we are going to the SEC because the options markets are governed by the SEC, and we want to make sure that within the confines of the rule base that we operate within, we can create a construct that will work for investors. And the idea of an event option, we're asking to launch the event options on the NASDAQ 100, so it's not on an individual stock, it's on a basket of stocks, it's a product that we control. And we are making it so that it's in a way kind of an entry point for investors to come in and try to engage in options with a very simple contract, up, down, in terms of how they think about what's going to happen in the NASDAQ 100 the following day at certain price points. And so it's a very simple way for them to engage in the markets, but with all of the protections that our options markets provide to investors. And, Tarek also brought up zero DTE, which are short-dated options. And I think that's a different construct. Those are options that allow for investors to hedge risk. They are at scale. They're centrally cleared. There's a way for them to have open interest and allow for investors both to express themselves in terms of how they see the outcome of a stock or an index over the coming days. But it also allows institutional investors to hedge risk in an environment where there's a lot of fast-moving markets, a lot of change that's happening in the markets around them, and they can therefore manage risk in a shorter dated construct in a regulated environment that is governed by the SEC.
Yeah, Thomas, come on in. I saw you nodding along there.
Yeah, but I think in all fairness, Tarek has a point. Event-driven contracts are not really new, right? They have been discussed for many decades. For instance, we at Eurex, we have dividend futures which have the same features. You are trading company earnings based on outcomes. So I think what you see is it is really a spectrum that you have there, which ranges from you make macroeconomic events tradable with probably also real genuine hedging needs, but then of course the spectrum ranges into sports and into other underlyings which are more in the category of entertainment. So I think there is still the jury out, and the US has now taken, I think, a very proactive stance, at least the chairman that we heard yesterday, on these markets, in contrast to Europe, right? Europe is much more conservative. There is a question on consumer protection. So where does it start? Where does addiction start? Where do you need to really protect consumers, where some of the jurisdictions are much more conservative? And there is, of course, a question around market manipulation, around market integrity, which I think is really crucial for also these markets to grow. But I think there is no question that there is a price discovery function, like this wisdom of the crowd, which has a certain value. It might be that the data side is even more valuable than in the end the trading turnover of those contracts.
Unchai, in Singapore, regulators have not given approval to prediction markets, and they're taking a different approach. But I'm just curious how you're watching this play out in the United States right now from Singapore. What does it tell you?
Well, while there may be a legal and regulatory determination here, in many parts of Asia, I think the legal view is clear on where this stands. But I think what is important is whether there's probability, events, or prediction is a very interesting signal and engagement format. And it's what Thomas said. I think it fits in the spectrum of risk management. The question then is, how do we set the bar high that allows institutional investors to participate in this? Because even in our business, like in the Baltic Exchange, the sea level and the weather will determine whether the ship will sail, and that will determine what index level does it come out. Is that an event? Clearly it is. Is it meaningful in the overall tools for risk management to allow people to stay invested, but yet managing a portfolio? So it's a spectrum.
Tarek, I'm going to come back to you in a second. I want you to respond to something that I'm going to ask Terry, because Terry, you told my colleagues, Joe Weisenthal and Tracy Alloway on Oddlots a few months ago, that you don't believe right now event markets on politics are a good thing. You also acknowledge that you've changed your mind on things in the past, mail-in voting, Bitcoin, and the like. Have you changed your mind on this, or do you still think they're not a good thing?
Just for clarification, I said I didn't believe event contracts on politics of all different elections was appropriate.
Meaning the scale of like a presidential election would be appropriate.
If you have an electorate of 100 million people on a $350 million people in the United States, then I don't really have a problem with two of them running and we make a decision on that. So but I do believe that the people of the United States make that by voting, not so much on a prediction. What I don't like is some of these other predictions. Politics is okay. But when you take it down to a lower election where you have, say, a small community of people that's got a 500-person electorate, and all of a sudden there's millions of dollars being bet on one guy versus another, I'd kind of say that it's under core principle 3 that would be deemed readily manipulable and against the law. So those are my concerns with certain political event contracts.
Tarek, do you share that view that if they get smaller, it's more manipulable?
I'll give me a little bit of time, given that, this is purely about my business model.
Of course.
So let me just address a few things. So Kashi today owns, I forgot, either, 94, 96% of the regulated prediction market business today. So we have seen why these customers are using these products. We have seen what kind of customers are coming to these products. And we have seen why these products are important. So 2 weeks ago, the Fed put out a paper called Kashi and the Rise of Macro Markets, which we're not talking about here. But I encourage you all to go and read it. And it was very simple. You read it, Thomas, it seems like, which is why you had the opinion you had, I guess. But the TLDR of the paper is that this is the most accurate gauge we have as the highest economic authority on the planet to what's going to happen with the economy on GDP, unemployment, Fed interest rates, inflation. And this is the Fed paper on the economy, but there's abundance of papers on politics, macro, climate, and a variety of other questions on the importance of prediction markets as this sort of source of signal that is differentiated and actually more accurate than any alternative we have. And to me, that's one of the most important things, at least in 2018 when I decided to start a company, that I believe I could work on. The debate between speculation and hedging and price spacing is an age-old debate in the futures industry. It's always been existent. And there's always been the case, well, some people are speculating and it looks like gambling. It feels like gambling. It squawks like, everybody's kind of talking about ducks these days. But the law is not ducks. The economy is not ducks, right? There is sort of some ground truth, which is you need speculation. You need liquidity for these markets to achieve their purpose. Without liquidity, without speculation, my markets wouldn't work. And I will make the claims that none of your markets would work. Zero DT, zero day to expiry options will not work without liquidity. And so to me, yes, there's a question of difference in the underlying. The underlying is different. Some of it is sports, and maybe you don't like it, and you don't have to participate in that. But some of it is economics, some of it is politics, some of it is weather. But that difference in the underlying doesn't make the activity more gambling, right? It doesn't. When you're participating in a stock option and your counterparty is Citadel and is paying your broker PFOF because they know you're doing something dumb, that to me is more gambling. And that to my customers, when you ask them, why are you trading on the weather and politics and not S&P? Unequivocally, the surveys give us 95% response rate. Well, I don't trade in traditional financial markets because I don't have an edge. It's rigged against me. I cannot gain information about these markets, whereas some of these people believe, and they do, gain information about inflation, about politics, about sports, and so on and so forth. And the numbers show it. The super forecasters that are on Kalshi seemingly are outperforming Wall Street at predicting all these events, which is amazing. That's the whole premise of these markets. On politics, look, Kalshi spent 4 years getting regulated up front. I think there's been a lot of commingling in this industry that is important. I will uncommingle it for all of you. There is Kalshi, which is regulated, US-based, committed to the rule of law, under Biden, under Trump, under any administration. We will always be committed to this, and we'll be working with regulators for rulemaking. But there are others in this space that are based offshore in Panama that are doing, I honestly don't know what they're doing, but like anything and everything under the sun. So there are things that some would argue that are more, I actually agree with Terry. Some things are more readily susceptible to manipulation than others. I don't agree that local elections are more readily susceptible to manipulation than global elections, and there's a lot of ways to police that. But the way that we approach this is we are focused on building a fair and transparent marketplace. And the beauty, the blessing and the curse of prediction markets is that when there is a suspicious activity, you all see it. Tim, you report on it. It's right there in the chart, out there in the open. All the trading activity is public. It's also reported to the CFTC. And you see the weird patterns that our community can flag for us, that can go into investigation like we did. We released 2 investigations recently around, somebody who worked for Mr. Beast and a governor candidate around committing fraud. A lot of you release investigations pretty commonly. But, we are committed to building a marketplace that is safe, responsible, and where we police bad actors. I'll stop there.
You've been listening to Kalshi CEO Tariq Mansour. He's speaking on a panel with Bloomberg Businessweek's Tim Stenovic, along with the Deutsche Börse Group Executive Member Thomas Book, CME's Chairman and CEO Terry Duffy, and Adina Friedman, the NASDAQ Chair and CEO, along with the SGX Group CEO Boon Chai Lo from Singapore. Let's go back to Boca Raton, Florida.
Addicted by betting on certain sports events or other things. Right, I see non-farm payrolls or so. These are hedging events that really have a meaning. But then there's also a part where people would argue there has to be consumer protection because people get broke if they continue to gamble and bet with these.
Let me give some also high-level principle. Like I hope that Europe follows America in terms of innovation and regulation, and not the other way around. I really hope that that's where we land in 10 years, because I think we'll be in trouble if you follow Europe. I think we'd be much better off if the other way around happens. When it comes to customer protection, there is a very robust customer protection regime in traditional financial markets under federal government.
Yeah, the question is, what are financial products?
Well, I believe that anything that's openly traded in a fair and transparent marketplace is a swap. It seems like, Terry, at least you kind of see similarities in that definition, or at least similar views in that definition. I think that swap could be on a politic event, it could be on a sporting event, it could be on an economic event, or it can be on, whether S&P 500 will land 2 points up in 5 minutes, right? Now, if you're walking into a casino and they are giving you a fixed line, that is a gambling product. What is the difference between state-regulated insurance and on-exchange hedging? One of it is open, competitive marketplace that needs global, nationwide liquidity, and the other one is you're walking into a house that's giving you fixed odds for that insurance, and it's a bilateral trade.
What about variable odds betting, like parlay bets, things like that?
What about multi-legged options? Should we stop those?
I'm only asking whether or not you consider.
I mean, the only difference between combos and buying it is like if you buy contract X and contract Y standalone versus you buy them combined, you may get a little bit of pricing improvement. Isn't that the point of options, Terry? Like, that's the whole point of multi-legged options. So we can all sit here and sit down and be like, as long as retail is participating in 0-day to expiry S&P options, where they have no clue what the hell is going on about, and Citadel is paying us hundreds of millions of dollars to get that retail flow, that's okay. But if they are trading on something they actually care about or know about, that's the hard line we're taking, guys. That doesn't make any sense.
We could do this whole panel on prediction markets, and, and I know there's a lot of interest. In about 20 minutes, I'm going to go to you guys for questions. We're going to have to move on. I do have one more prediction markets question for Adina about the data that you will be getting from contracts or could get from contract probabilities. Could you just explain to the audience and explain to investors how that data could fit into existing products? In other words, will this data become inputs for any other products that you have, and are you seeing demand for that from clients?
Yeah. I mean, first of all, I think Tariq is, it's a little unfair in terms of the construct of this panel. But I also would say that there is utility to elements of the prediction markets in terms of being inputs into financial decisions. And I think that we have to recognize that, as you said, the power of the crowd is actually relevant as we're thinking about how we're making decisions in other financial instruments. So as we've been thinking about how to make sure that we have data that's available to people to drive inputs, we've talked about, actually did a speech a long time ago about markets everywhere. So how do we think about the opportunity for there to be two-sided marketplaces? That's why I was asking Tarek about, variable odds betting versus fixed betting. I don't think that that's the distinction, but the ability to have essentially two-sided marketplaces to make to drive price discovery, to make it so that we can understand the true supply and demand in that moment of any sort of instrument. I think the key is, from a regulatory perspective, to define financial instrument, and so to understand what's subject to federal law versus something else. And but in any event, the data that underpins what is ultimately driving trades across the prediction markets, particularly when it comes to economic signals, when it comes to drivers of underlying equity performance, those things are relevant for people to understand as they're making financial decisions and potentially investing across the securities that they might invest in. So we do see that as a relevant part of the data stream that we should be able to provide, and we would partner with firms like Kalshi and others to make it so that's available.
You said partner with firms like Kalshi. ICE made a big bet on Polymarket. Tarek's sitting right here. Would you make an investment in Kalshi?
So I'm certainly not going to answer that question. But we
Jeff is right there, by the way.
You were saying everybody's beating up on him, so now's a chance to.
Well, I only want to say, I think that there's obviously, we all are here to try to innovate in a space that allows for and drives investor outcomes that drive the economy forward. That's really kind of our job. And also to make sure, though, as we are doing that, we're thinking very hard about how we're managing the fairness of the markets, the oversight of the markets, the surveillance of the markets, all of those things to create a fair experience for investors. And we're going to continue to innovate in our space, and we operate in regulated markets. We believe that regulation matters in these spaces, and so that's, all of our decisions are driven that way.
Terry, I'm going to give you the last word on this, and then we're going to go to macro.
Yeah, I just want to just say one thing, because I think we talk about peer-to-peer markets, and Thomas made a reference to it, and I know Tarek has as well. We have peer-to-peer markets, and it's called technology. Technology has never been better in the history of the world to allow every single participant the ability to have the same information as the biggest players in the world. They may not deploy it the same, but they have access to it today. That is peer-to-peer. That's much better than any prediction market ever could be, is the proliferation of technology to allow people to be in charge of whatever venue of choice they want to go forward. So to say that we only have peer-to-peer, which makes predictions better than traditional markets, is really malfeasance, because we have that today with technology and the ability of that technology to be accessible at a cost way for people to access it every single day. So I think that's really an important factor.
I think we'll come back to prediction markets in the Q&A, and there will be some stuff sprinkled in later. I do want to get to geopolitics and macro, because no question sitting here is a war, several wars rage across the world right now, most recently in Iran. Boonsha, I'm wondering about a more fragmented world, and a world where increasingly countries are looking inward, where trade routes are changing, where tariff barriers are rising. Does that more fragmented world benefit a hub like Singapore?
Well, first, I would say our thoughts are with those that are affected. And is what's happening in the Middle East clearly complex and evolving. But in a more fragmented world, even if I look through the lens of Asia, that has started a while back, trade flows were being reimagined, supply chain were changing. And if you look through the lens in Asia, you have the core engines of China and India, a Southeast Asia that is growing, and then a price signal that could come out from Japan through rates and FX. So I think in a fragmented world, hubs are still important, but I think nodes that are being connected together will be even more powerful. So I think more importantly, at least for us, for market infrastructure, even with events market driven AI, I think the premium being put on trusted market infrastructure for investors become even ever more important.
What have just for you, the last few days looked like in terms of flows in terms of volatility, in terms of what you're seeing, especially with regard to what we've seen with energy around the world?
Well, obviously, volumes have grown tremendously, but I think what's important is markets are still orderly, margin calls are being fulfilled, and trades are being settled. We've seen the spike, 5 sigma moves across many different markets, but I think what's important is also it's no longer a most likely view, most likely scenario. Dynamic and nimble portfolio risk management become ever even more important. So I know we'll come back to prediction markets again, but I think there is some value on probabilistic events that if we raise the bar high enough, and obviously we're not going to venture into a non-financial metric, but I think that could be in some way beneficial for investors to read signals.
It always goes back to prediction markets, no matter how hard I try. Thomas, this more fragmented world that we're seeing, does it increase the need for consolidation of exchanges in Germany? Does it increase the need for consolidation of exchanges in Europe? And Dina, you run exchanges in Europe, but Thomas, I mean, there's been a lot of talk in Germany about consolidation. Would you be open to it?
I mean, I think, first of all, it creates the urgent need for Europe to work on its strategic autonomy. I think over the past weeks and months, this is an ongoing theme, and sort of the irony is that a lot of the pressure that is now on Europe to create sort of autonomy in energy, in technology, in defense, but also in capital markets is actually a positive thing for Europe to get its act together. Capital markets is a crucial thing of that, and the savings and investment union, but really the focus that has to be there is on activating private capital in these markets, right? So the market infrastructure, Selina operates a large exchange in Europe. We are operating a large exchange there. The market infrastructure is there. The question is really how can we activate capital? We see positive, really positive signals in Europe. We see more international investors returning to the markets, also more IPOs, and in particular we see more retail activity that's coming, but still there is, whatever the studies say, 30 or 35 trillion of savings on bank accounts that are sort of to be activated for investment in capital markets.
Yeah, Dina, how are you looking at the macro environment? Because interestingly enough, you're sitting between, you work with SGX. We do. Have a partnership with them that you announced in the fall. And then also you have the NASDAQ Nordics, so you're big in the Nordics as well. What's your view?
Yeah, so I think that when it comes to the European Union, first of all, it's an enormous economy that is really kind of untapped, I would say, in terms of the potential to grow, to engage the citizens in the markets and capital formation, everything you just said. And there have been a lot of studies as to what is the path for that, to unlock that potential. When you really peel back the onion on that, I think you need to start with public-private partnerships and the government policies around equity ownership, around, there can be tax reform, there can be the pension plans and how they deploy their capital across the markets. We have something in Sweden, which are called the ISK accounts, that are extremely tax-efficient accounts for investors to be able to invest their money into the markets, any of the public markets, but they have a very, very preferential tax rate of 1% on their holdings and no cap gains tax. If you look at the launch of that program back in 2012 in Sweden to today, the amount of equity ownership in Sweden has gone up to now 56%, which is almost equivalent to the United States, whereas the average across Europe is like 19%.
Germany is 17%. So.
Right, and so there is a huge opportunity to really tap into the ability for everyday citizens across Europe to engage in the capital markets to drive wealth creation. That's also allowed us to have more than 500 net new issuers come onto the Nordic markets over that same period of time. So you have this incredible opportunity to really drive capital formation, have innovators come, small to medium enterprises, larger companies, and really fuel that innovation ecosystem across Europe. That is not up to us to do. That's up to the governments to do with the private sector. And then for us then to create really robust markets. The one area within the studies that have been done that I do think can be made much more efficient is post-trade infrastructure. There's a lot of fragmentation of post-trade infrastructure. There's also the lack of harmonization of basic listing rules and things like that could be more harmonized and brought together. But having markets across Europe is not the problem. It is, kind of different markets. It's really kind of all the policies and then obviously the post-trade infrastructure that could be harmonized.
Terry, come on in on the macro here. Going to you on oil, because, we did hear yesterday that CME Group and its energy complex reached a new single-day volume record of 8.3 million contracts on March 6th. It surpassed the previous daily record of 7.9 million contracts. That was just set on March 3rd. Can you talk a little bit about what's happening at CME when it comes to energy just in the last few days?
I will, and I think when you look at my colleagues down in Atlanta, I think they traded over 11 million contracts in their energy complex, so they also had a very busy sessions over the last several days too. So the oil markets in general have been very active. You asked a question a moment ago about geopolitical risk, and oil has a lot to do with that, and I don't think too many people are talking about this, and it concerns me a lot. When you look at what we did by going into Iran, which I support what we did because of the way the rulership was going there, and I think that was detrimental for the people. After 47 years, something needed to be done. So I commend President Trump for going in there and doing it. The problem is, what does that mean as far as the derivative, since we're in this conference, for Russia finishing off in the Ukraine? What does that mean for President Xi going into Taiwan? I don't think anybody knows the answer to those questions. We just went into Iran, where they can now maybe potentially in their minds justify going into other countries just like we went into Iran. And we could say, no, we went after, a really bad guy. What are you guys doing? And they could say, well, we think they're really bad guys, so why are you yelling at us? So I think that's an issue. So if you think oil can go from 118 to 87, which was your question, like it did, I can see it going back to 150. If in fact some of those other things happen. So I don't think the geopolitical risks to marketplaces between oil, interest rates, every other asset class is out of the woods by any stretch of the imagination.
You can make predictions on
that was Terry Duffy, the CEO and chairman of the CME Group. He is in discussion with Tim Stenovec of Bloomberg Business Week at the FIA Global Cleared Market Conference. The panel also includes Deutsche Börse Group Executive Member Thomas Book, NASDAQ's Chair and CEO Adina Friedman, SGX Group CEO Boon Chai Lo, and Kalshi's CEO Tarek Mansour. Let's go back to the conference taking place in Boca Raton, Florida.
Considering intervening in oil futures markets. The idea is the government would use its huge balance sheet to trade futures contracts to push down the price of oil. He's already laughing, and I haven't even finished the question.
Oh, it's to me?
Yeah, it's to you.
Are you going to ask Tarek again? Prediction markets are saying about this.
The U.S. Treasury has traditionally stayed away from commodities markets. Is this a good idea? And look, it's still considering this, but I saw this.
So what's important about this, Tim, is that the U.S. Treasury Department, in the rumor that you're suggesting, and it's a rumor, I have not heard it substantiated by the administration, there's two ways they could go about this. Would they be buying calls on oil because they're concerned that this is not a short-term deal and the price could go up exponentially, and they want to make sure that the American people are protected? So nobody says that part of the equation. Are they going to buy just futures and be long the oil market so they can do that? Or are they going to just kind of come in and try to sell the hell out of it to push the price down, which might be, a biblical disaster to do so. So I don't see the U.S. government coming in using the futures markets in order to move the price in order to benefit the people. Because when you look at today, look at the biggest market in the world. Biggest market in the world is not oil. It's called the U.S. Treasury market. And the Fed's balance sheet today between $7 and $9 trillion. You know how much of that they hedge or use it to move the price? Zero. They don't use any marketplace for hedging or that. So I don't know why we would do it with oil. I think that was a suggestion by many of people about what you could do with the price of oil. But markets do not like when governments intervene in order for pricing. What he can certainly do is use the U.S. stockpiles, take them down, then replenish them at a later date. But to say that he's going to use a market in order to facilitate the price one way or another, I think is wrong.
Okay, Tarek, speaking of the macro, you said last year that Kalshi is expanding to 140 different countries. Yesterday, you announced you're expanding to Brazil, outside the U.S. for the first time. You're partnering with Brazil's XP to list event contracts. Where else will you launch this year?
So I'm offended you didn't ask me about my views on macro.
This is kind of a macro question, though, because it gets into account what people are thinking.
I'm kidding. I wouldn't have any insight, actually. If you really want real insights, you should go to Kalshi.com, www.kalshi.com. then you get real insight with people with skin in the game. But we are going to take a pretty aggressive international expansion strategy. Our approach is very consistent with the U.S., so regulatory first. And it's also consistent with some of our kind of core beliefs. We like traditional financial market structure. We like intermediation. We like this idea that there's sort of an exchange, there's a market maker, and there's a broker, and they have different functions, all of which are key. Obviously the U.S., that's sort of a question around market structure that's been going on, and we'll participate either way. But when it comes to international expansion, we like the partnership strategy, where we partner with local brokers. They have distribution, they have a brand, they have credibility with the regulator, and obviously the regulatory infrastructure. We're very excited about the partnership we announced with XP in Brazil. The early signs are very strong. We're looking at basically all the other jurisdictions. So Canada, obviously Europe, the UAE and Middle East, and then Asia, including Southeast Asia.
Okay. Boonchai, one to you about the market in Singapore right now. As I mentioned, you are working with NASDAQ on a dual listing mechanism. It's set to go live mid this year. Since announcing it, what have you heard in terms of interest from companies? Who's your target for these companies? Does this prevent the next C or the next Grab from not listing in Singapore?
Well, first, partnership between SGX and NASDAQ is very strong. Our interests are aligned to work with companies to raise capital, providing investors with more choices. Yes, we're looking to make this operational by the middle of the year. Our teams are working together. The pipeline is building, and we think a few companies will use this global listing board to raise capital in the US via NASDAQ and in Asia via Singapore. And part of that is this will facilitate companies, whether in Singapore or Asia, and global companies or Asia Nexus, to tap the global pool capital. So some of the companies that you mentioned we missed, I think we're seeing these companies, new companies, and there are many more of these in Southeast Asia that I think will use this platform.
Well, how is the IPO pipeline in Southeast Asia right now? Well, I know you had a really good few months, but what's it looking like? What's the outlook?
We have over 45 in the pipeline as of now, and that's grown from 36 months ago. So it's looking strong.
Yeah, I mean, we have, so NASDAQ and Singapore have been partners for decades, actually, on technology and other market innovations. We've been working together to create more connectivity across the post-trade infrastructure and other things. And I think this new dual listing program, there's a very healthy pipeline of companies looking to go public in general. But across Southeast Asia, because it doesn't necessarily even have to be a Southeast Asian company. It could be a U.S. company that has a lot of business in Southeast Asia where they want to tap into investors across Asia in addition to the United States. What is really unique about the partnership that we've developed with SGX is how much we've also had the regulator in Singapore, MAS, work directly with the regulator in the United States, SEC, to come up with a common listing framework that allows for the companies to be subject to one listing jurisdiction, not two. So that if they are eligible to list in the United States and they've gone through the SEC process, MAS will accept that as the regulatory oversight for that listing. They still obviously oversee all the trading and other things that are happening in the markets. But it's really an interesting construct of two regulators actually working together in a way that you don't normally see to kind of create that combination, along with the exchanges, along with other key participants in Singapore to really drive liquidity and drive investment. So it's a really unique and exciting partnership.
And we talked about geopolitics earlier on, single set of documents. I think gives the issuer a greater certainty on time to market. Right. And that's important in the world that we're faced today.
Mm-hmm. So Tarek mentioned trading on the weekends, so I think this is a good place to get to 24/7 trading and maybe tokenization as a way to do that. Digital assets too. We're going to try to fit quite a bit in the next few minutes. Thomas, you have a partnership with Kraken. You announced this back in December to create unified access across traditional and digital asset markets. What have you been able to offer as a result of that partnership? And just update us on how it's going so far.
First of all, we are really proud. It's a great team around Kraken. Our view really is that the tokenization does allow a completely new use case. Currently, the industry is really very message-based, right? And tokenization allows for a shared state. approach to our industry. So it will allow a new market model. It does allow 24/7 fractionalization, instant settlement, and other things. So there will be use cases. Cryptocurrency is one. Tokenization of securities, of equities is one, but also, of course, payment and collateral coins. So we are looking with Kraken to really create a fully hybrid model so that you are both able to, for instance, have a stock that you can trade in the conventional, traditional finance approach, but also in a digital form with the same execution, with the same post-trade layer. So we are excited, and we are starting on that. I think if we sit here, I mean, the journey of the past 30 years of the industry has been from sort of floor pit trading to electronic trading. So you can all trade here, as Terry has said. Basically, everybody has seamless access. And I'm sure there will be a further transformation, a disruptive transformation with tokenization of assets. So we, as Deutsche Börse, we really want to lead that transformation in the use cases. And therefore, with Kraken, we are building various use cases. And we're really starting with cryptocurrencies. So we have crypto custody now in our CSD. In Europe, we are the first one to offer, for instance, these cases.
Yeah, Adina, yesterday you said you're planning a new design for tokenized equities. Speaking of Kraken, you're working with Hayward, the parent company of Kraken. Is the whole point of this, at the end of the day, to get to 24/7 trading?
Well, we do talk about how do we get to, what we would call an always-on markets, but we're starting with 23/5 trading. So even before we announced the partnership with Kraken yesterday and how we're looking at the NASDAQ equity token design, I think that we've been really focused on driving towards 23/5 trading in U.S. markets, and which really, frankly, is aligning ourselves a little bit more with the futures markets because they've been in a 24/5 market environment for a long time. So you've got the NASDAQ 100 future that trades all night and all the time, but you don't have the underlying stocks of the NASDAQ 100 that trade in the same hours. You don't have the option that trades in the same hours. So how do we try to create a more unified market environment where investors all over the world have the same experience? They have a consolidated tape. They have market protections. They have guardrails around their trading activity throughout the day, throughout their trading hours, in addition to the U.S. hours. This will not change the open and the closing times for the U.S. markets. This allows for us to have the same market infrastructure available all night. We are starting 23/5 because we also are working with DTCC, and there's some need to have some downtime every day. And we're not going into the weekends. We have not yet seen significant demand in that environment. So that's where we're starting. When it comes to the tokenization of equities, I think that is the next leg of innovation for securities markets. So we are first and foremost working with DTCC to tokenize equities at the CUSIP, to actually represent equities in a tokenized form, to allow those to trade and settle on our markets through DTCC known infrastructure in a tokenized form. But we also are working with Kraken because there's the permissioned world, and then there's the permissionless world, as you said, and to create the right bridge between the permissioned world, which is the world we operate in, to the permissionless world that does have instant settlement, that does have different market structures, that does extend it, but give the issuers, number one, the choice. Do they want their securities to be tokenized? Secondly, control in terms of understanding who their investors are, modernizing their experience in connecting with those investors, hopefully modernizing the proxy process, hopefully making some really big changes to their experience in both a permissioned and a permissionless world, we think is the future of markets. So we're very excited about that.
Terry,
You've been listening to Adina Friedman. She is the chair and CEO of NASDAQ, and she's part of a panel discussion taking place at the FIA Global Cleared Markets Conference. Bloomberg Businessweek's Tim Stenovic is moderating the discussion, along with Deutsche Börse Group Executive Member Thomas Book speaking, CME Group Chairman and CEO Terry Duffy, the SGX Group CEO Bunchai Lo, and Kalshi's CEO Tarek Mansour. Let's go back to the conference right now.
What you're doing when it comes to reliability and how to keep them.
And again, we don't hide behind anything. I'm a very transparent person. When the deal happened over Thanksgiving, that was a data center issue that we don't own. That was human error on their part, and so we know what happened there. On the other issue, it was some technology as it relates to velocity logic, which is there to protect the clients, and sometimes things happen in the most inopportune times. So that is basically what happens. And there's nobody sitting up here or anybody in this room that doesn't work with technology or hasn't broke at a time where you wish it wouldn't have. So things happen. So, I'm very upfront about it, but I think our track record, when you look at our technology platforms, have been very resilient. We spend a tremendous amount of money doing them. I'd like to talk a little bit for a second, if you don't mind, on tokenization as well.
Please.
Because not only do I will talk about the bad stuff, what happened when it's going down, but when you look at tokenization, you know, I said on my earnings call that I'm going to be looking at my own stable coin as well. So what I think is important...
CME coin.
CME coin.
Yeah,
absolutely.
working with Google, right?
Right. Well, no, that's different. That's tokenized cash. So tokenized cash will be on a single Google ledger. A CME coin will be on a distributed ledger that you could use within our own ecosystem. And I am working with the OCC, the Office of Controller, not the clearinghouse, the OCC, to potentially move forward with our own coin. And I think it's really important, especially when you look at the Clarity Act going on right now in Washington, about how much of these coins do you want to take or not take, because the same argument the banks have about why they don't want to be able to pay a yield on a stable coin would be the same reason a risk manager like myself would want to have, is I don't want to be sitting there with a bunch of coins and no cash. So you have to have a plethora of capital that you can offer to your clients, and we think a stable coin on a small amount makes sense. We think tokenized cash makes a tremendous amount of sense. We think cash makes a lot of sense, and other forms of securities that we take for our margin to risk, manage our products. I think just going down the path of stable coins is probably not the best thing, but on tokenization, I know people are talking a lot about that with products. There is a legal framework here in the United States that none of these meet today, or they don't meet at Reg NMS. They don't meet a whole host of other things as it relates to. So even if you look at the way Robinhood and others are trying, and Kraken, who are trying to digitize stock trading, they have to do it within their own ecosystem of Robinhood, where you wouldn't be able to have access to it unless you had a Robinhood account. So what is it really gaining you? So I think this whole tokenization thing is interesting, but it doesn't fit within the legal framework of the United States of America.
Yeah, so I think that's where interoperability is really, really important, that we build interoperability across chains, but also across markets. You create a token standard that allows for these things to actually manifest themselves as equity as opposed to a securities-based swap, which is what Terry's referring to, and conveys the rights that an issuer should have. I mean, the one thing that we feel like for the entire process of tokenization is the issuers need to be a part of it. So we are building that token standard around that. But I agree with Terry that this is an opportunity for us to mature markets and to drive collateral efficiency. We've also announced a partnership with Baton Systems through Calypso to drive collateral mobility in a tokenized form using DLTs so that we can really start to leverage the advantages that blockchain technology can offer.
So Boonchai, if this world that we get to ultimately is an always-on world, does it help Singapore, or does it make the time zone advantage that Singapore has and Singapore's markets have increasingly irrelevant?
I think it would be more relevant, would be useful. I think Terry talked about the CME coin. I think for clearing infrastructure, to give customer choices and efficiency, stable coins, tokenized cash, I think could be a direction of travel in future. And today, many exchanges, including SGX, we take multi-currency, we take cash, we take securities, and that could be just another way to enhance the ecosystem.
Tarek, I want to give, sorry, Thomas.
No, Tim, I just don't, I don't think that all markets will eventually be always on. Right? I think there is very different demands that you have across different constituents. I don't think that many institutionals really need to trade 24/7 on the weekend. That might be for use cases on the retail side. And you have markets, if I look at us, power markets are 24/7 all along, right? Or foreign exchange markets, and we also can do 24/7 clearing now with nodal clearing. So I think it will really be driven by where's the need. I mean, there Europe, probably a little bit like Singapore, is in a good position because we are between the time zones of the US and of America. But currently the drive and the discussion really stems from retail access, from digital apps, and it really comes around equities, right? And then sort of Asian flow getting into US stocks.
Can I just say something about 24/7?
Yeah.
What's really important is, you need to pre-fund no matter what you're doing, whether you're trading cryptocurrency or not. Because unless the banks are going to be open 7 days a week and the wires are going to have the same amount of flows that they have today, real-time payments is not going to facilitate enough outside of maybe a crypto asset class, but not the rest of them. So it's going to be really important that...
And I share that. You got to make a distinction between continuous trading, continuous liquidity, continuous settlement.
Okay, so I want to give Tarek the last word on this, and then I want to get to some questions. We're running out of time, unfortunately. We could do this for, I barely got through any questions. But Tarek, you've done always on, you've been always on. What are you seeing on weekends? What could you share with the people up here, the audience, about what you've noticed in terms of patterns and what people are interested in? Just, yeah.
I'll try to be fast. My mental model for this is prediction markets are basically a financial product, but they're also in some ways a news product. And so in some ways, the news is always on, right? Like this notion that like something could go crazy on Sunday and the news will be like, let's wait till Monday, 8 a.m. to cover it, you know, doesn't make much sense. And I think that applies to prediction markets as well. Like you have to have these things be covering all the holes that, you know, currently exist. And, you know, we saw this weekend, you know, a lot of you were freaking out about the price of oil on Sunday, and, you know, some of you may have looked at Kalshi because it was a gauge. And I think the interesting thing here is, like, I think there's like two dimensions. There's a dimension of time, filling up basically, you know, all the hours of the day so that we have as much price discovery information about the hours of the day. And then the other dimension for us is just being able to put markets up fast enough on the things that are going on. And there's a paper from Kevin Hassett, who's the chair of the NEC right now, dating a few years back about prediction markets, and where he kind of argued this idea that as the world gets increasingly more complicated, more dimensional, to be able to have accurate asset prices for our traditional assets, you know, whether it's indices or home prices and so on, we need infinite markets. You need to price all the different dimensions that feed into those asset prices, whether it's geopolitical risk, COVID, AI and how it's going to accelerate. Citrini report came out, for example, this week. It actually tanked some stocks. You know, we put out a market on this, and it shows that there's only less than 10% chance of this doomsday scenario happening. So that's kind of how we think about it. Is like, how can we cover all the different dimensions that matter to the economy so that people can get an accurate gauge on what's going to happen?
Okay, I want to go to questions in the last few minutes that we have. I know there's some mic runners in the audience right now, so if you have a question, please head there. I would ask another question, but I want to make sure we have time for some audience questions. Yeah, please.
Thank you. I just thought the conversation at the beginning of the panel was interesting about the word speculation, betting, gambling, hedging, etc. At the end of the day, futures markets began with hedging, right? So agricultural hedging, one person's hedge is in a person's speculative position. So people have always speculated, whether you call it betting or speculating or whatever. Yeah, no, hedgers don't hedge with hedgers, right? So there has to be someone else. It's about transfer of risk. So I found the argument at the beginning a little sort of strange. And with regard to betting, we'll call it that for a second, in Europe and in Southeast Asia, there's been betting for decades. There are loads of platforms where you can bet. I could bet now on my telephone on betting. To say, you know, Kalshi's way ahead of Europe and everything else, it's just not true. You can bet on anything. I find it a little distasteful when we start betting on assassinations and nuclear attacks. We don't have that on Kalshi. That's a very different thing.
Well, why don't you jump in?
We agree, and we
this
don't
has been
have
an issue, and distinguish between poly market.
To be clear, there's a few things. Like, one, I didn't say that, you know, we reinvented betting. Actually, I'm claiming the very opposite. We also had betting in the U.S. in the form of DraftKings and FanDuel and some other platforms. You know, I do believe that, you know, U.S. has done quite a good job at innovation in the last decade, and the results and numbers show. We don't do war, terrorism, assassination, death on Kalshi because those markets are illegal. They're also distasteful. I actually do agree with you. And there is, you know, we do face this issue as a company. There are, you know, there is two main players in the ecosystem. One that has been committed to regulatory first approach to this model. We spent 4 years getting regulated by the CFTC and have engaged with our regulator, federal regulator, at every step of the way to bring these markets to light. And it took us a while, right? A lot of you have actually heard of poly market before Kalshi. Now you're hearing about Kalshi, maybe a little bit more than poly market, but and we do, you know, poly has sort of taken a different approach, which is the offshore, unregulated approach. And they are coming to the U.S., and I'm very excited about their entry to the U.S. I think they will do a good job. They have a great team. But there's an important bifurcation here, which is the markets that you're reading in the headlines, or the insider trading and the Maduro trade, those are happening offshore on unregulated products, not on products under the CFTC's jurisdiction, because they wouldn't be allowed.
Any other questions here? Or am I going to do a lightning round with the folks? There's a question right back there.
just following up on that question, so specifically prediction market on sports, what is the tension between sports bookmakers versus prediction market? I know I've been speaking myself with a few bookmakers, and they say that prediction market of sport is temporarily with the current administration, as Terry says. What is your take? How do you see the split between prediction market and sports books competing on the same marketplace?
I think you should limit the number of questions on prediction markets so others can speak. But, look, I think, you know, the sports books are saying that, but they're entering prediction markets. Maybe that's my answer.
Is there anyone else who wants to weigh in on that? Terry?
Oh, what did you say?
The sports books are saying these are not going to last, but then they seemingly are entering prediction markets and are re-strategizing.
And Terry,
well, I don't know if I agree.
The strategy around prediction markets.
You said that, I don't know if traditional sports books don't think that, they think this is not going to last?
I thought that was the question. Right?
If that's what they're suggesting, I would suggest that you look at what the opinion is of the people who invest in the publicly traded online gaming companies think a little bit different at this moment in time. And I'm not trying, I'm a partner of FanDuel with Flutter, and I like this company a lot, but they have suffered dramatically, as has DraftKings, or the two US-based entities that are publicly traded. They've lost a tremendous amount of their value. So I don't think investors are suggesting this is a one and done type of operation. I think what's really important is, as we said earlier, the guardrails need to be determined. I think this is going to the Supreme Court ultimately to decide if in fact these are sporting contracts that should be under state law or these are swaps under federal law. I think that's where it's going. I think both prediction markets and online gaming can operate in the same environment going forward. They might have a different constituency of clients, they may not. They might have a crossover. But they are not. I don't believe Kalshi is going away, and I don't believe the online is going away either. But they have definitely suffered at the success of Kalshi. There's no doubt about that.
We only have a couple minutes left, so I want to do a lightning round, and I'm going to start with you, Thomas. I'm asking each of you the same question here. This is about innovation and exchanges. That's the theme here. What is the biggest area of innovation for you?
It's clearly tokenization. That's where the focus is in terms of technology that we'll have for the next 10, 20 years, and we will focus on that transformation. I'm sure it will open up completely new layers of efficiency, both in collateral mobility, but also in the way that intermediation layers can be removed. So that is a clear focus, and we are, of course, very technology-driven as a company.
Thomas says tokenization. Bunchai, what about you? Biggest area of innovation?
It can happen in isolation. It's about market need, market gap. We launched 3 months ago crypto perpetual futures. That's the fit into the market need. And looking at the geopolitics that we're in, I think rates is clearly one of the macro view that investors are looking for Asia. I share the point on tokenization, but I think it's also a matter of adoption. What's the point of inflection?
Adina, how are you thinking about innovation? Biggest area for you?
We're as equally focused on tokenization as we are on AI, and I think AI is an incredible technology that's coming across every industry, but certainly is going to have a huge role to play in the capital markets. There's so many things we could go into there. I'm gonna that would be another panel. But we have an AI-driven order type. We have more order types that are driven by AI. We have market protections that we are really leveraging AI to the utmost of its ability to protect the markets. Obviously, there's a lot of automation that can be done in terms of the inefficiencies of workflow across the system. But there's also the opportunity to really leverage AI in new ways to drive trading and investment strategies. And so there's a whole new way of thinking about AI across markets that I think is a really important part of the future of markets in addition to tokenization.
Terry?
A couple of things I would say. One is distribution. The other, I would say, education. And the third thing, which I think is the most important thing going forward, and that's capital efficiencies. We've been able to create capital efficiencies going from 20 billion a day to 80 billion a day today. And when you can continue to see that going probably to 100 billion a day in the near term, that's what continues to help markets grow. Because when you can take people, give them back their money to deploy to do other things in what they want to do, but yet still do their risk management without putting any risk to the system. That's what I think innovation is all about.
Tarek, last word to you.
So I think that we are seeing a shift in consumer behavior that is very rare in consumer when it comes to prediction markets. And I think maybe in the last 2 decades, I think we saw it in social media, I think rideshare and home share, then AI. And I think prediction markets is following that similar trajectory where it is touching the masses. It's really mainstream consumer adoption. And I think over the next few years, we're going to see hundreds of millions of people engaging with these products, whether they're trading actively or they're using it as an alternative news feed. I think that this bodes very well, and it's very exciting for the industry because, going back to Terry's point, I think it's going to help with distribution, it's going to help with education when it comes to prediction market, but also traditional derivatives, and that's something I'm very, very excited about.
I want to thank all of you guys for being such a great panel and having a great conversation, and thank all of you for hanging out with us for the last hour.
All right, you have been listening to Bloomberg Businessweek's Tim Stenovic moderating a discussion panel at the FIA Global Cleared Market Conference. He was speaking with Deutsche Börse Group Executive Member Thomas Book, CME Group Chairman and CEO Terry Duffy, Adina Friedman, the Chair and CEO of NASDAQ, Boon Chai Lo, this SGX Group CEO, and Tarek Mansour, the CEO of Kalshi. They talked about prediction markets along with regulation and innovation in the exchange space. And of course, if you want to check out excerpts of that conversation, be sure to go to Bloomberg.com. Good morning, good Tuesday morning. This is Bloomberg Intelligence. We've got a lot coming up in this second hour of the program. Mike McGlone will give us his take on oil prices, which have been fluctuating all over the place. We're also going to check in with James Abadi. He is the Managing Director and Head of Fundamental Strategies at Horizon Investments. Bailey Lipschultz will give us the update on Bill Ackman's Pershing Square looking to IPO on the New York Stock Exchange, and Mary Ross Gilbert of Bloomberg Intelligence telling us why Kohl's shares are higher despite a worse than expected comparable sales number. First, though, let's go over to Charlie Pellet for our Bloomberg Business Flash.
Hi, thank you very much, Scarlett. You mentioned Kohl's stocks surging now by 8.5%. This is U.S. stocks advance. West Texas Intermediate crude down now by 11.6%. This Bloomberg Business Flash is brought to you by IBKR. In 2025, IBKR retail clients averaged a 19.2% return, beating the S&P 500 17.9%. The broker you choose matters. Visit ibkr.com/2025. The Pentagon says it is conducting the most intense day of attacks against Iran and will not give up until the Islamic Republic is defeated, striking a more aggressive tone after President Trump's suggestion that the war could end soon. Right now, we do have the S&P 500 index up 31, best level of the day right now at 68.26, gaining another 0.5% after yesterday's turnaround and advance. The Dow up 0.5, up 232 now. NASDAQ Composite Index up 0.7, up 159. The VIX at 22, the 10-year 4.11%. Spot gold up $75 the ounce, up 1.5%. Bitcoin up 3.6%. Oil, again, the big story. West Texas Intermediate crude down 10.9%. Brent down by 10.3%. Brent, of course, the global benchmark. Airline shares remain under pressure amid concerns about higher energy prices. Tom Fitzgerald is an analyst at TD Cowen, and on surveillance this morning, he said it is hard to envision margin expansion this year, barring a rapid decline in energy prices.
If you think about when airlines were issuing guidance back in mid-January, the fuel prices in the forward curves were around, call it $2.30, $2.40 a gallon, depending on your estimates on which curve you looked at. Today, those curves are all about, above $3 for the rest of the year, maybe a little bit under $3 now with the easing we've seen overnight, but still a pretty meaningful delta if you have that type of going from, $2.30 to $2.40 to closer to $3 per gallon.
TD Cowen's Tom Fitzgerald. Among U.S.-based carriers, shares of UAL down 1.6%, American down 1.5%, Delta down by 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks a lot. And stocks on the move. Nora Melinda joins us right now. I was looking at the Amazon story earlier today. Why are they raising debt? Because they can. And they can do it in a big way, too.
Yes, looking at shares of Amazon, ticker AMZN, we're seeing shares higher by about 0.8% right now as we speak. And this is after the company said it's targeting the equivalent of about $37 billion to $42 billion in a cross-Atlantic offering in both dollars and euros. So we do know that the sale is the latest in a series of jumbo note offerings by hyperscalers that are really looking to invest hundreds of billions of dollars in AI. We know that this has really been the charge that many companies have been fixated on. And the firm is marketing its U.S. high-grade debt in as many as 11 tranches, and it also targets raising as much as about 10 billion euros from a potential 8-part debt Eurobond sale. So a lot of action going on here as it really looks to pay for some of the things that it has in mind.
Because they can is such a great answer for so many questions of our time.
So many questions.
Yes.
I mean, as an investor, though, I don't think I'm going to get rich off this. You know, the yield is like, under 2%.
Yeah, I mean, I think that this is one of those things where it's so many companies in the tech space, they're just spending so much money. But we do know that what still remains underlying is that so many investors are concerned as to whether or not all the money that's being put on this effort to build out artificial intelligence is actually going to pay off.
Yeah. In the tech space, you've got another name for us.
Yes, looking at shares of CrowdStrike, ticker CRWD, also higher, up right now about 0.4%, pairing an earlier gain of about a 3.2% gain. This is after Morgan Stanley raised the company to overweight from equal weight. They're saying that the platform is a winner from the AI positioning and its growth outlook is promising. Looking on a year-to-date scope, this stock hasn't done particularly well. It's down about 7% so far for 2026, but Morgan Stanley essentially putting their weight behind it, saying that they think that this is a good name to look at. You're clearly seeing the street reacting to that.
All right, what else you got?
Lastly, I want to take a look at shares of Kohl's, ticker KSS. We're seeing a stock that's earlier surged as much as 14% for double-digit gains. Right now, it's up about 8%. And this is after the company said that it was pleased with its performance so far this year on a call with analysts. But in the back end,
what else are they going to say?
I mean, no, it's interesting that we're seeing this rebound. I mean, if you take a look at what some analysts are saying, we know Bloomberg Intelligence, they said that they believe that this is a short squeeze. We saw some data that came out of S3 Partners that are essentially saying that short interest is about 26% of the float. So we do know earlier the company did report that it was, kind of losing ground a bit. We did see that it reported a bigger sales drop than expected last quarter. So it's interesting to see this upside reaction after that report.
I appreciate the short squeeze explanation, at least for the short-term movement here on some fundamentally maybe disappointing news. All right, thank you so much. Nora Melinda is Bloomberg Television Markets correspondent, and for more conversations like that, subscribe to our Stock Movers Reports, where we offer 5-minute audio reports on the biggest winners and losers in the stock market. You can check it out on Apple Podcasts, Spotify, or anywhere you listen. Oil prices, they are the movers of the day, of the week so far, and what we're seeing is a retreat in WTI and the global benchmark Brent after yesterday topping $119, approaching $120 a barrel. They're both in the mid to high $80 range. Mike McGlone is our Bloomberg Intelligence senior commodity strategist, and he joins us now. And Mike, the president did make some remarks that kind of eased concerns about the war in Iran, that it should wrap up fairly quickly. It sounded like things are wrapping up, but we also get other indication that things are not returning to more normal. The Strait of Hormuz, for instance, is still very much effectively closed at the moment.
Scarlett, the Strait will be open. It'll be cleared up. Iran's offensive capability will be done. It's a question of time and duration. But the bottom line is we peaked around 120 yesterday in crude oil. It's very similar to the peak in 2008 at 147 and very similar to the peak in 2022 at 130. And I predict this pump up is going to produce lower crude oil prices by the end of the year. One good example of that is you look at the February future. Remember, in futures, we like to go where the puck's going. The February future right now is $67 a barrel. Last year, at the end of the year, crude oil ended at $57 a barrel. And because prices went up so much, it's going to incentivize that excess supply from America and Western Hemisphere and push prices lower. And the bottom line is, what does Mr. Trump want for the midterms? Lower prices.
So filling up this morning at the Wawa, $3.60 a gallon. It hurt this morning
compared to a week ago.
Mike, what are the price levels I have to watch right now?
Well, John, I'm glad you mentioned that. I bet you're going to see 260 by the time it comes to fill up before the election. So if the average price of gasoline in this country pumped to 350, it was around 3 before that. But that's on the back of U.S. and Canada has a big excess supply. What's the price pump going to do for more supply? It's going to accelerate that trend and bring prices back lower. But remember, this was a unprecedented event, and the strait is still closed. We have to look back from the future and say it will be open and prices are going lower. But the bottom line for this is a normal trajectory in energy and crude oil. Basically, it's its own worst enemy when it spikes, and if it stays high, it brings on a recession. But the bottom line is we're seeing pretty significant volatility in metals and gold and energy. That volatility may trickle up to the stock market, and that'll probably be your biggest pressure factor for prices as we head to the year end.
The price action that we saw in metals yesterday, Mike, was very much tied to what the dollar was doing. The dollar was higher, so we saw metals prices decline. Today, the dollar is giving back some of those gains. The Bloomberg Dollar Index off by 1/3%, and metals are higher. Does oil trade in relation to the dollar anymore, or have we moved on from that?
Well, we've moved on from that. In the macro big picture, there's the most highly negatively correlated commodities to the dollar. It starts with gold and then copper. Crude oil, it's part of the theme, but the bottom line is the dollar is pretty stable. It's versus a basket of other currencies. The key thing to remember about the metal, it's gold to gold. Gold, to me, has reached the status of a speculative risk asset. Its 180-day volatility is now 2.4 times the S&P 500. That's the highest on 100 years. That's not a store value. So it's switched over to speculation, which to me is probably a sign of a peak in gold. Copper might have even peaked around $6 a pound, partly because it's completely dependent on a higher stock market. And then you have to look over to China. China's in a decline. Their 10-year note yields are 1.8%. And I think that's the key thing we'll be looking at the end of the year. If that U.S. stock market just backs off a little bit, copper's going to drop. Even gold might drop, and crude oil might already be heading that way.
Mike, put on your farmer hat for a moment. What's the correlation to something like corn? Biofuels are still a thing, right?
Well, that's the key thing. I'm glad you went there, John, because I was at the all-day ag outlook in Covington, Indiana last week, and the key theme is we need demand because we have excess supply from here, the U.S., and Brazil. And where does that demand come? The only source is biofuels, but that problem is we already have an excess of fuel and crude oil production in this country. So that's a key thing. But the bottom line for corn and grains is the high in that December corn contract was right around $5 last week. Everybody in the crop wants to be able to sell. Corn Belt wants to be able to sell around 5 so they can bring on more supply because the cost of production is below 4. And unless we get a bad crop, prices are going to continue low. Remember, last year we had a very big bumper crop.
Good stuff. Thank you so much, Mike McClone, Bloomberg Intelligence Senior Commodity Strategist. We talked about oil, the metals, and the soft commodities as well, joining us from Miami. You know, when we look at all the volatility in the markets, it's kind of striking how much investors have to juggle in terms of the different factors out there and, you know, the narratives that they need to contend with.
What do we call it? The confluence.
Confluence, that's a great word. Matt Griffin knows the confluence very well. Matthew Griffin is our Bloomberg equities reporter, and he's one of the authors of today's big take story, which is about how market cracks are widening as war, AI, and credit fears are colliding all at once. Matthew, great to see you.
Scarlett, great to be on. Thanks for having me.
So the war in Iran just introduces a new shock into the global economy, one that already has investors feeling kind of nervous, kind of confused, certainly very uncertain about all the different things that are taking place, whether it's inflation, whether it is the jobs market, whether it's AI or private credit.
Yes, and what I would say about this is that it really means two things for markets right now. One is, even if the war ends tomorrow, even if oil prices go back down into the 60s per barrel, it's not all clear for investors in the way that maybe you think about last spring, Trump paused the tariffs. You have, you know, the best day for the S&P 500 since 2008 because a lot of the headwinds facing markets just vanish. That's not true now when you have private credit concerns, when you have fears of AI disruption. And then another thing is that the war also heightens some of those other risks. It makes it harder to refinance loans, private credit loans that aren't working. If central banks can't cut rates, it puts more pressure on consumers. So it all just adds up to a really tough spot for Wall Street right now.
So what's the playbook?
Well, what the head of U.S. rates at Amerivet told us is the playbook is out the door. And I know that maybe isn't a definite answer, but I think everyone is scrambling to figure out what to do here. One thing that I, heard from an investor myself is diversification is really important because there's just a lot that isn't working right now. So you want to make sure you have some exposure to things that do, but I don't think there is a right answer.
One of the final quotes you have in the story is pretty telling. It's from Matt Maley, who talks about how a lot of people are not so concerned because they say, yeah, okay, oil is spiking, but it's not as bad as it was in the 1970s. Okay, there might be a bit of some lofty valuations in tech, but it's nothing like 2000. All these comparisons to previous contexts kind of give us a false sense of complacency, doesn't it?
Yes, and it comes back to the idea of the story. So Matt Maley, he's a strategist at Miller Tabak. What he says is you can't look at each of these risks on its own because the problems together can add up to create, issues for risk assets, and also that the stock market is really expensive today. So that maybe creates more downside risk, even if the initial, issues are smaller.
So if a headline crossed and said the war is over, is it all back to normal?
I think that's what we've been hearing is not necessarily. I talked to investors and strategists for a different story last week that was about this question of will Trump and can Trump step in to rescue the markets in the way that he did last spring?
The
Trump put, yes. And what a lot of people told me is they really weren't holding their breath for two reasons. One, the market hasn't been shaken as badly as it has been last spring, so the administration may not be at that point yet. Although you did see Trump, making some comments yesterday, signaling the war will end. But the more profound issue is that a war is not as simple to change as a list of tariff rates on a poster board.
Well said, Matthew Griffin. Matthew is a Bloomberg equities reporter. He is one of the co-authors on the Bloomberg Big Take story on how market cracks are widening as war, AI, and credit fears collide all at once. And that's before you even get to, concerns about the job market or inflation, the more pedestrian concerns that we're used to detailing.
I'm not fixated right now on the VIX because it is lower, 22.75. I mean, it's
yeah,
coming
but
in
yesterday it
quite a
got to
bit.
like 30 something, right? So
But
it's all over the
moves
place.
like that, it's just, pretty remarkable.
Yeah, buckle up. There's a lot more to come. We are in day 11 of this war in Iran, and prices are on the move. This is Bloomberg Intelligence with John Tucker and Scarlett Fu. Paul Sweeney is off for this week. Stay with us on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:20 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks advancing as oil tumbles after the Group of Seven Nations asks their main energy agency to be ready to deploy oil reserves if needed. The Dow, the S&P, NASDAQ all advancing. S&P 500 index right now trading very close to morning highs. S&P up 29. That is a gain of 0.4%. Dow Industrials up 248, up 0.5. NASDAQ up 153. That is a gain of 0.7%. The VIX at 22 now with a 10-year, 4.10%. Gold up $88 the ounce, up 1.7%, 52.26 on the precious metal. And West Texas Intermediate crude now down 12%, 83.35 a barrel. Brent, the global benchmark, 87.39, down 11.7%. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. AT&T is pledging to spend more than $250 billion over the next 5 years to expand its telecom network infrastructure in the United States. The company will focus on building high-speed fiber and wireless networks to expand internet, wireless, and satellite services. AT&T up 0.7%. Among rivals, T-Mobile US up 0.6%. Verizon also up by 0.6%.
And you know what, today is the anniversary of the first phone call by Alexander Graham Bell.
Who did he call?
Watson. Watson, come here. I want you.
Watson, come
the
here.
First thing, said over a telephone.
Stocks higher right now. We have got the S&P up 0.4%. Watson, are you watching oil? West Texas Intermediate crude down 12%. And that is a Bloomberg Business Flash.
All right. Thank you so much, Charlie Pellet, with our Bloomberg Business Flash. Scarlett Fu and John Tucker here. This is Bloomberg Intelligence. Paul Sweeney is off for the week. Charlie mentioned that stocks are rising. Hard to believe that stocks ended yesterday higher, John, given where we were at the start of trading.
We're all over the map. And my question is it fundamentals or is it positioning at this point?
Right. You just look at oil prices. Yesterday, almost $120 in the morning. Then they fell below $90 in the afternoon after President Trump signaled the conflict in Iran is nearing an end. Let's bring in James Abadi. He is Managing Director and Head of Fundamental Strategies at Horizon Investments, joining us from New York. James, John asked a good question. Is this fundamentals or is this merely positioning because we don't know what fundamentals will look like going forward?
Well, the fundamentals are quite good. I mean, there's no doubt that the consumer remains relatively stable. We saw that with today's ADP private payrolls report. We're seeing the emergence of manufacturing recovery after a 4-year malaise, as demonstrated by the very strong ISM manufacturing index reading recently. And we've seen continued, very strong AI infrastructure build out. We saw today TSMC, the go-to chip maker for NVIDIA, reported a 30% jump in sales for the first 2 months of the year. So, we think that, 2026, should see a sharp recovery in nominal GDP. And our investment thesis has been that we'd see a year of very strong profit growth being partially offset by a potential derating in the market's valuation metrics. And we think that stays in place. Now, obviously, that hinges upon the conflict in Iran being over very soon, which we think it will be.
Okay, you're not worried about the stag part. What about the inflation part?
Well, again, that hinges on, whether or not we see a conflict resolution or simply the end of, combat operations in Iran occurring. And, to us, there's enormous political pressure in the United States as well as Israel to bring combat operations to a close after having used just air and naval forces. It's important for us in the U.S. to be aware, what the Israeli press and senior members of its own far-right political coalition are explicitly saying, especially around the current Jewish holiday of Purim. They've noted symbolic parallels between the modern conflict involving Iran and the Old Testament biblical story in the book of Esther. Obviously, clearly these parallels are symbolic interpretation and not literal historical parallels, but they resonate because the Esther story itself takes place in ancient Persia and has importantly given biblical justification for the preemptive attack on Iran in an effort to thwart an imminent attack by Iran. So whether that's true or not today, using that Esther analogy means the current confrontation will be brief and decisive, not months or years, and end once that threat is neutralized.
That might be the plan, but things have a way of not going according to plan. What is the risk to the U.S. economy, to financial markets, if the war does drag on, if things are not wrapped up fairly quickly?
Yeah, what could disrupt this is somewhat analogous to 2002, I would say. The key point is that the economy and the stock market often move on different timelines and amplitudes. Back in 2002, the U.S. economy began recovering, but the stock market continued to perform poorly for several reasons. The market was still unwinding from the dot-com bubble. Corporate accounting scandals like Enron and WorldCom crushed investor confidence. Maybe that's somewhat analogous to the troubles in private credit today. And most importantly, geopolitical uncertainty, the aftermath of September 11th, and then by mid-2002, the build-up to the Iraq war really tanked stock markets in the summer and fall. So, unlike our thesis today, where strong profit growth is an offset to a potential derating of the market's PE valuation, keeping the indices somewhat range-bound, but a good environment for active stock picking. If we get talk of regime change and boots on the ground in Iran, we see the derating risk of assets picking up steam and the economic recovery to be greatly diminished or pushed out like it was in 2002, which leads to a very difficult year for investors, maybe on par with what happened back in 2002 when the market was down double digits. So far for us, we're maintaining a pro-cyclical bias with a portfolio focused on economic growth, leading to very strong profit growth across industrial, cyclical technology, regional banks, but maintaining a protected put option hedge on underlying equity exposure, just in case we're wrong.
I mean, you brought it up just briefly, but the credit crunches, correct me if I'm wrong, they're the kinds of things that lead to recessions. Is the Fed really equipped at this point to play whack-a-mole and deal with these extraneous issues?
No, really, it's dominated by geopolitical events because once confidence is broken, the cost of money, that is whether or not the Fed lowers rates, is almost irrelevant, essentially. You start to have them talk about, pushing on a string in terms of liquidity. So with regard to credit and the Fed, I think, rates are where they, I think, should be given the inflationary environment. And it really is about confidence, both the consumer and the corporate level, that will dominate where we see credit and equity markets move forward.
All right, James, really appreciate your joining us today. James Abate is Managing Director and Head of Fundamental Strategies at Horizon Investments. I mean, one thing that we'll know that we can look at to return to normal is deal making, is fundraising. That'll be a sign that people feel comfortable, companies feel comfortable with the current market environment. And it looks like at least one person feels good about how things are shaping up. Bill Ackman has filed to take public his hedge fund firm, Pershing Square, and a new closed-end fund at the same time. Bailey Lipschultz is Bloomberg News' senior equities reporter. He's been covering IPOs for years, and this is something we had been anticipating, Bailey, because there was this effort to list the hedge fund Pershing Square back in 2024 that didn't get very far.
Well, so back in 24, the initial thought process, from our understanding from Pershing Square, was we're going to raise a lot of money in a closed-end fund. So that way we can have an even higher fee base. We want to raise more than $20 billion. Then that number became like 10, then it became 5, then it didn't actually get off the ground. So that was for the closed-end fund. Now we're seeing them come back with this, I'll call it novel pitch, that if you invest in the closed-end fund, we'll give you some shares to the actual management company as a way to entice people to buy. Their pitch was, we had a few $1 billion in demand last time. We now have $2.8 billion in private demand. As long as we can bridge the gap to more than $5 billion in this closed-end fund, ups our fees, and also gives us something else to give investors, and it ultimately takes the company public.
So it's fee? What's the motivator here? Is it fees?
it's creating a vehicle.
He's pausing.
No. It goes back to kind of the pitch that.
I'm just trying to assess whether or not like this is a sign of healthy markets and it's a good move.
It's something that they need to do. So, point blank, Pershing Square failed to raise a handful of billions of dollars in a closed-end fund 2 years ago.
He's not coming at this from a position of strength, or is he? I know I'm really pressing.
I mean, maybe. Okay, things that we know. They wanted to raise tens of billions of dollars before. They did not. They had discussed potentially taking the management company public. Now, with this process, both can happen potentially. Raising $5 to $10 billion increases the amount of fees that the company can generate, the management company, and it takes the management company public.
A lot of people know Bill Ackman as an activist investor. They think of Herbalife. They think of all these other companies that he kind of targeted, made his case against, or made his case for. He no longer really does that, does he?
No, it's pretty much holding a handful of companies. So whether it's Chipotle or Alphabet, Brookfield, like kind of buying a concentrated portfolio and holding it. He's also now even...
Like Warren Buffett, kind of using that playbook?
That's exactly what he's trying to lean into, though a bit more vocal on social media with his views, which, depending who you talk to, is bullish or bearish, but really trying to cater with this offering to retail investors, point blank, is kind of the view of this pitch.
So now he's going to listen to retail investors and, run his company.
He engages with them, though.
He does engage. He shares a lot of things on social media.
I'm just still trying to wrap my head around why he'd want to go public with anything and then be open to so much more scrutiny and regulation or whatever.
Well, I think that's kind of the discussion going back to 2024 when they sold a stake in the company, Pershing proper. That was viewed as a way to start the process to going public. So there was always a vision to IPOing or taking public the management company in some capacity. And it does benefit by, if you're a management company and you're collecting a 2% management fee, the more assets you have under management, the more fees you have, the more attractive the company does then.
So what's the timeline now?
So base case at a bare minimum, you need 15 days from this filing before you can launch an IPO process. It takes about a week or so. When you look at the calendar, 2.5 weeks from now, you get closer to some of the holidays. So maybe this is something that we see starts to hit the road after the Easter holiday when people are back in their seats. But at a minimum, this process cannot formally start for at least 15 days, and then we'll move from there. But we're expecting it probably, just looking at the calendar, call it right on the other side of April.
Okay, again, I mean, some sign of confidence from Bill Ackman that he's moving forward with this in a period where there's a lot of uncertainty about asset prices, about the global economy.
And that's something that they kind of call out in his 8-page letter, basically saying that, most of the time, companies who are looking at IPOing will not go when there's volatility in the market. Their pitch is, well, if you're giving us money to turn around and invest, well, we should be buying low and then ultimately profiting from there.
Very well said. Bailey Lipschultz, senior equities reporter for Bloomberg News, writing about Bill Ackman's Pershing Square, an IPO that includes a stake in the firm as well as its closed-end fund, a new one, in fact, on the NYSE. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got stocks pushing higher, a rebound, gaining further steam as oil tumbles on hopes that the world's largest economies will be ready to deploy stockpiles. With the war in Iran posing threats to global supplies, S&P up 28, now holding close to session highs, up 0.4%. Dow Industrials up 263, up 0.5. NASDAQ up 134. That is a gain of 0.6%. The VIX at 22, the 10-year 4.10%. Spot gold up $92 the ounce, up 1.8%. West Texas Intermediate crude now down 12%, 83.40 a barrel on WTI. Barrel of Brent 87.61, down now by 11.5%. Group of 7 nations have asked their main energy agency to prepare scenarios for the release of emergency oil stockpiles as the Mideast crisis roils markets. Oil certainly front and center this morning. James Abadi is Managing Director and Head of Fundamental Strategies at Horizon Investments, and he was a guest moments ago right here on Bloomberg Intelligence.
If we get talk of regime change and boots on the ground in Iran, we see the derating risk of assets picking up steam and the economic recovery to be greatly diminished or pushed out like it was in 2002, which leads to a very difficult year for investors. Maybe on par with what happened back in 2002 when the market was down double digits.
James Abadi of Horizon interviewed moments ago right here on Bloomberg Intelligence. Among oil names, USO, that is the oil ETF, trading lower now by 2.6% among oil majors. ExxonMobil down 0.4. We've got Chevron down 0.5. ConocoPhillips down by 1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thanks. And coal shares right now 6.6% higher. They had results. In fact, they reported worse than expected sales for the last quarter. They continue to struggle to revive years of declining sales. Let's figure out the coal story this morning. Mary Ross Gilbert, Senior Equity Analyst with BI covering retail. We actually, Mary, just did an informal survey in the studio. Charlie Pellet, the last time he was in a Kohl's was 10 years ago. Scarlett?
About 10, 12 years ago.
Yeah, okay. Me, actually, I do go there, but probably about 6 months ago. Who is Kohl's customer? I mean, clearly not us.
So, John, the Kohl's customer is largely a low to middle income consumer. And so I just went there yesterday just to see what the store looked like. And I did observe that their customers are definitely seeking value. You don't always see a lot of bags because they're in there carefully choosing, trying to find value. And so this is why the company has brought on deal bars. Those are $10 and under items. And now they've announced that they're also bringing in toy bars. So they want to also feature items, again, $10 and under, with different price points of like $4.99, $5.99, et cetera. So they're really trying to gain, traffic and conversion, but really they're also leaning into their private brands. So for example, I did observe that Elsie Lauren Conrad, which is their women's label, it's a really fun label, and they did a great presentation in the store yesterday. The problem is that the rest of the store is still not, it's not really cohesive. So we're really not there in terms of where we need to be, where you can see a real cohesive strategy. And so we saw a lot of clearance in the stores as well. So they still have a road ahead, as you highlighted, with the 4 years of stacked comparable sales declines.
Yeah, that's quite a track record to have to turn around. Mary, according to a company presentation at the earnings, Kohl's admitted that it lost competitive ground during high-traffic shopping windows, including Black Friday, Cyber Monday, and the week following Christmas. When I read that, I thought that was a fairly startling admission. How do you interpret that?
I wasn't surprised, candidly, because we were there on Black Friday, and I could see that shoppers were trying to spend, because you get sort of a free, the minute you walk in the door, you get a free Kohl's cash, and you scratch it to figure out how much cash you get. And trying to find a way to spend it was a challenge because there were a number of excluded items. And while they've increased the number of brands that are not excluded, there's still a fair amount. So there was some confusion and not a lot of customers were walking out with bags is what we observed. So we felt like, you know, it was hard pressed, let's say, to find a way to spend the money. So they really needed to do a better job, and that's what they admitted, on finding values. And that's why they say that their margins this year, you know, are going to be hard pressed because they need to get the sales lift, right? They've done such a great job on managing expenses, and they'll continue to do so. But until they get the sales moving in the right direction, they're not really going to see that margin improve because they do have to be more promotional, have sharper values, and so that's going to impact margin to a certain extent. But it's important so that they can be competitive because we saw strong results in off-price, as you note.
You could hear me early this morning going, ouch, as I filled up the car. It was, what did I say, $3.60 a gallon. Did that come up in the call with the executives?
Oh, good question.
I mean, it's probably the last thing they need for their customers to be paying lots more for other stuff.
John, you're absolutely right. And this customer is really going paycheck to paycheck. And so when you do have gas prices going up, that's going to impact their discretionary income, and thus the importance that they really have those sharp values in the stores. So that's what they're hoping to achieve. They're really leaning into their private brands, and they've got a campaign, Buy Kohl's, which features their brands like So for Juniors, and that actually did well because they really featured that heavily in the stores. We observed it yesterday. And so, you know, I think, and that also helps on the margin side to a certain extent. But again, you know, they really need overall sales to rise to really get margins to move in the right direction.
This is a company, as you pointed out, has been struggling for about 4 years with same-store sales, you know, not performing very well. You just look at the sales growth over the last couple of years, and it's a bunch of negative numbers starting from 2023 on. What is needed here to really change the trajectory of Kohl's? I mean, how much longer can it go in this same direction before it becomes a candidate for takeover by another company or by private equity? Or, I mean, something needs to change, perhaps.
Scarlett, yeah, you raise a valid point because when you think about it, they do have a juicy real estate portfolio, so that might be attractive to some strategic buyers potentially. So there could be some interest here. We also think that with over 1,100 stores, do they really need to be operating that many stores? They did say on the call that they have no plans to close or open any stores, really. They might have a replacement store here or there, but their objective is really to get this box more productive and also raise digital sales. They really want to take advantage and grow digital sales too. So it's really about reaching a point of stability on the top line. And so they're, like I said, leaning into private brands, and they have a number of initiatives, but it's going to take time. So they're already guiding toward comparable sales declines of about 1% to 3% in the first quarter. And when you look at the stacked 4-year comp decline they're going against or cycling, that's a 17% decline. So that shows you the magnitude of the decline, and that's even after gaining a $2 billion revenue business with Sephora. So that means that when you look at the declines in the rest of the business, it's much steeper than the 17%. And so that's a critical thing to note. And when you think about Sephora, their comp sales were flat in the quarter.
Yeah.
Previously, we were seeing increases. So that business has really matured at this point. And that's why they've got a number of initiatives there, bringing in more brands to really ignite and try to grow that business.
All right, sounds like there's a pretty long to-do list for the now permanent CEO and chairman Michael Bender. He was named interim CEO after the previous CEO was let go for directing business to someone he had a personal relationship with, so there's a lot of turbulence in the C-suite as well. Mary Ross Gilbert, our senior equity analyst covering retail, joining us for the latest on Kohl's, which, as you mentioned, John, is up 7.1% on the day right now, despite those disappointing same-store sales numbers.
Yeah, 7% higher. Did we mention short squeeze?
Yes,
Something
Norm
like
Melinda
that.
was telling us about that.
I was looking for some sort of explanation. You are listening to Bloomberg Intelligence. John Tucker and Scarlett Fu.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Neither one of whom are here right now. So you're left by default with me. I'm John Tucker. Hi, everybody. Well, later today, Oracle opens its books to investors. Cloud computing giants shares, they have fallen steeply since the September peak. It all has to do with worries over artificial intelligence. Investors are going to be looking to the earnings as a barometer for AI demand. And let's dive into it right now. Also, the tech space in general with Anurag Rana from Bloomberg Intelligence. Anurag, let me start. I'm sure they're going to get questions on the call at some point with the relationship with AWS and what happened there in terms of the data center investment and what's going on?
Yeah, so if you go back in history and see, Microsoft was the sole partner for OpenAI, and, they had most of their cloud needs going through Microsoft's cloud. But at one point, Microsoft said, we already have a whole lot of exposure, and allowed OpenAI to go work with other vendors. And Oracle was the big winner at that point. So they have a very big contract with OpenAI called Stargate, under which we have data center construction going on in Texas and the whole thing.
Abilene, Texas.
Yeah. It's a very big project. And that really led to OpenAI signing up a very big contract with Oracle north of, we think it's about $300 billion or so, which is most of their backlog, to be very frank, for Oracle. But just about a few, I would say a couple of weeks ago or so, Amazon signed a big contract with OpenAI to be one of their cloud partners. Amazon also invested about they're supposed to invest about, $30 billion in OpenAI. So now the big question on today's call is for Oracle management to come and explain that, they still have a sizable presence in this relationship and how that business is not going to get impacted. I think that to us is the number one question we would be asking.
Do they still have a relationship?
Yes. Yeah. I mean, I know Brody the other day reported that there is some delay in the expansion or some issues with that Abilene data center, but that the first phase of it is still going. They still have a lot of revenue to be recognized, because one of the things there is a big worry in the market is how is somebody like an Oracle going to fund some of this expansion? And again, a few weeks ago, they said they're going to raise up to $50 billion, both as a mix of debt and equity in the market to fulfill some of these obligations. So that's going to be the second thing you want to know and say, how are you funding this thing? Is it even profitable? What's the internal rate of return for some of these contracts? So there's a lot that I think is going to happen today on their call.
Oracle's free cash flow has actually gone negative, hasn't it?
Yes, but you would expect that. See, when you are investing that amount of money to expand the data center work, and you are betting on being, let's say, one of the bigger cloud providers out there, you are going to go through hiccups. But remember, Oracle is a very profitable database business. It has very good application software business. So I mean, they do generate a good amount of free cash flow if you were to not think about these investments.
More broadly, are chips design advancing at the same pace that the AI data center build-out is occurring?
Yeah, so what's happening on that end is these companies that are creating these data centers are creating with the idea of the next generation NVIDIA chips, for example. So whatever NVIDIA is selling right now, they're going to design a data center with that way. Now, down the road, if you get a brand new chip with new capabilities, you can make changes to that infrastructure and sell that. So they are made in a way that are fairly flexible to utilize whatever chips that are provided by the likes of NVIDIA or, to be honest, anybody else.
What do the AI-related backlogs look like for the company?
So for Oracle, that's the big one. Is it's very strong right now. It's north of 500 billion. But as I said, our calculations say that over 300 of that is just from OpenAI. We need to know whether OpenAI is still holding their promise to, take care of that 300 billion, or is there any changes to that particular agreement?
Okay. Let's move on to Apple for a second. A number of stories out today, but. How far, I want to ask you, how far behind are they in artificial intelligence with respect to everybody else?
Yeah, see, I think it's an apples and oranges situation, because to be very honest, they are licensing the products that are being built by somebody else. So in this particular case, Gemini's models will be used to take care of the next version of Siri. Why does Apple need to go out and create their own large language model when they can license the best technology in the world from somebody else? And they don't need to spend that much in capital expenditures that way.
Do I care where Apple's stuff is made? Who makes
That's
it?
exactly my point. I mean, that's what I'm saying. So, for example, let me give you a
shifting from China to India.
Well, that is important from an export point of view and duties point of view, because, when you are diversifying away from China, which I think they should be doing anyway, the reason for that is because, you don't want everything to be isolated in one area. You will, I think India is another one. I'm also thinking there's going to be other countries down the road, maybe Vietnam, where they're going to add more capacity to build, some of these products, going forward.
Real quick, before you go, like 20 seconds, the software stocks, what's going on today?
Well, I think it's a mix of the software semi-trade that we have been looking at for a while. Software's been going down because there's a massive depression in the way some of these fears about that AI is going to eat software. So that's one. I think the more recent depression is because of potential decline in tech spending because of the war in Middle East.
All right, Anurag, thanks a lot. Anurag Rana from Bloomberg Intelligence. And for our listeners in the U.S., reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121. presented by Golden Crest Metals. And stay tuned for the latest market news, industry research, your top stories, global business headlines are coming up. Right now, the S&P 500 up 29 points. This is Bloomberg Intelligence.
This is CBS News on the Hour, your home for original reporting.
I'm Steve Kathan. The Pentagon calls it the most intense day of U.S. strikes since the war in Iran began. And Joint Chiefs Chairman General Dan Kane says more than 5,000 targets have been hit since the war began.
We are watching what they're doing, and we are adapting faster than they are.
In Washington, we're hearing today from congressional Democrats.
There seems to be no end game.
That's Democratic Connecticut Senator Richard Blumenthal, who says conflicting messages from President Trump are making the war deeply unpopular.
Americans are sick and tired of forever wars.
Democratic Arizona Senator Mark Kelly is worried about how much the war is costing the nation on a daily basis.
We've seen estimates of, $1 to $2 billion a day.
Allison Keyes, CBS News, Washington.
Well, President Trump vowed today to hit Iran 20 times harder if it moves to block the Strait of Hormuz. Iran responded with its own salvos.
I'm Vicky Barker at the Foreign Desk. Iran's parliament speaker has vowed an eye for an eye, saying Tehran will respond in kind to U.S. and Israeli attacks on its infrastructure. This as Iran's military continues to fire drones and missiles at targets in Israel and Arab and Gulf states. And one top Iranian security official appeared to threaten Trump himself, writing on X that, quote, even those bigger than you couldn't eliminate Iran. Be careful not to get eliminated yourself.
Authorities in Toronto are investigating shots that were fired outside the U.S. consulate before dawn today.
2 individuals emerged from the vehicle, discharged what appears to be a handgun at the front of the building, and then got back into their vehicle and drove southbound.
Well, voters in Georgia are casting ballots today in a special election to fill the congressional seat vacated by Marjorie Taylor Greene. CBS's Skylar Henry.
12 Republicans, 3 Democrats, a Libertarian, and an Independent are all in this race. President Trump, through his support behind District Attorney Clay Fuller, who describes himself as a MAGA warrior and also an America First patriot.
On the Health Watch, CBS's Michael Wallace tells us the FDA indicates the maker of Ozempic failed to report all the suspected side effects of the weight loss drug.
In a warning letter to Novo Nordisk, the FDA cites 2 deaths and a suicide in patients who took semaglutide, the generic name for Ozempic and Wegovy. The agency says the drug maker should have reported the deaths within 15 days of learning about them, as required by federal law, even if it determined the deaths were not related to the drug. It's not clear if the drug or other side effects were to blame. One of the patients died of a stroke.
Wall Street, the Dow is up 232 points. This is CBS News. Some new information today on cancer risk and diet.
A study in the journal Cancer finds people who skip meat have a 21% lower risk of pancreatic cancer, a 12% lower risk of prostate cancer, and a 9% lower risk of breast cancer. Researchers also find a lower risk of less common types of cancer like kidney and multiple myeloma. A professor of epidemiology at the University of Texas Cancer Center tells Women's Health plant-based diets can support gut health and often replace processed or high-fat animal foods. A drawback, the study finds vegetarians have almost double the risk of squamous cell carcinoma, perhaps due to nutrient deficiencies. Deborah Rodriguez, CBS News.
Brain cancer was the cause of death for Tommy DiCarlo, lead singer of the group Boston. He was 60 years old and fronted the band for the last 2 decades. I'm Steve Kathan.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The most intense day yet. Welcome to the Tuesday edition as the U.S. and Israel conduct their strongest day of attacks against Iran so far in this conflict, just a day after President Trump declared the war very complete. Iran says it's not interested in a ceasefire, and so the strikes continue. We're going to get the latest in just a moment from Bloomberg Washington correspondent Tyler Kendall. And as crude oil keeps falling, we'll find out why when we talk to Mike McGlone at Bloomberg Intelligence. We'll have analysis from our political panel. Jeannie Shanzano and Rick Davis are with us for the hour. And we start, as always, on Wall Street. Let's get to it first with Charlie Pellet at World Headquarters in New York. How's it looking, Charlie?
Right now, we are holding close to session highs on the S&P 500 index, Joe Matthew. But as always, we are very much focused on crude. Let's begin with West Texas Intermediate, down now by 10.2%. Just above $85 a barrel. Brent, the global benchmark, 89.22, a drop there right now of 9.8% on Brent crude. The Dow, the S&P, NASDAQ all higher. Stocks are gaining. S&P up 15 to 68.10. That's a gain of 0.2%. The Dow up 148, up 0.3. NASDAQ up 94 now, higher by 0.4%. The VIX at 23 with a 10-year 4.10%, the 2-year 3.54%, spot gold up 1.7%, 52.25 the ounce, and again West Texas Intermediate crude oil down 10.2%, 85.09 a barrel. Group of 7 nations are asking their main energy agency to prepare scenarios for the release of emergency oil stockpiles. The G7 wants to be ready to deploy oil reserves if needed, and it has tasked the International Energy Agency with studying the volumes that could be released. Among some of the oil majors right now, ExxonMobil down 0.5%, Chevron also down 0.5%, while ConocoPhillips is down 1.3%. As for oil and the wider market, Ed Yardeni is chief investment strategist at Yardeni Research. He was a guest this morning on Bloomberg Surveillance.
In the short term, we clearly have an issue with the Strait of Hormuz. It's hard to get optimistic here unless we see some tankers actually going through there without any incident. I know the president sounds like he wants to declare victory here pretty shortly, but you know, I think Iran lost the war. They just don't really know it, and they're not acting like it.
Ed Yardeni of Yardeni Research will have a whole lot more on the energy markets coming up in just a moment with our Mike McGlone. Again, recapping here, S&P 500 index holding on to a gain of 0.2%. West Texas Intermediate crude down 9.9%, 85.35 a barrel. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you, my friend. He'll be back in about 15 minutes with more on the markets here. Welcome to the Tuesday edition of Balance of Power. It's nice to see you. We're live on Bloomberg Radio, streaming live on YouTube. Search Bloomberg Business News Live unless you're watching us on Bloomberg Originals. You know, I'll talk to you later about the podcast, curated daily by producer James. It's great to see you. The week that Mike McGlone became a household name, isn't that something? He will be up in about 5 minutes with the latest because oil prices keep falling. I mean, consider what Charlie Pellet just told us here and where we were at this time yesterday when I got to work with the VIX at 30. With crude oil just below $100 a barrel, and people at that point thought it was good news. Now here we are, ever lower, at $85 for West Texas Intermediate, down 10%, despite the rhetoric that seems to have sprung back to where we were 24 hours ago. And the president, of course, said that this was very complete. Market turned on a dime. But everything we've heard since then, including the president's own news conference last evening that we brought you here live on Bloomberg TV and radio, started talking about continued attacks, unconditional surrender. And he did speak directly to the price of oil. If we go back a day here, once again, knowing that crude oil is now in the mid-80s, President's surprised it didn't go higher, knowing that it touched $120 yesterday. Here's Donald Trump from last evening.
This was just an excursion into something that had to be done. During this brief disruption, we're way ahead of schedule, and it's going to be ended soon. And if it starts up again, they'll be hit even harder.
An excursion. Called it an excursion multiple times yesterday, and went on to say that I knew oil prices would go up if I did this. They've gone up probably less than I thought they'd go up. Enter Bob McNally at Rapidan. He doesn't think we're done. Out with a client note today that says yesterday's sell-off, the relief sell-off, was premature and is likely to reverse in the coming days. Let's find out what's happening now, because Pete Hegseth says we've got a doozy coming. This is the most intense day yet, and everyone's getting whiplash trying to follow the ball. Bloomberg Washington correspondent Tyler Kendall joins us here at the desk before she runs back over to the White House. President's back in town, right, from the trip to Miami. We've got a bunch of stops on the schedule here. Does he have any screen time, or is Pete Hegseth speaking for the administration?
Well, we could potentially hear from him later today. There is going to be a White House press briefing with Caroline Leavitt at 2 p.m. Eastern, so maybe we'll get a little bit more clarity, because as we just heard, President Trump did suggest yesterday that the U.S. is ahead of schedule when it comes to achieving its goals, though he did say he doesn't expect the conflict to end this week. But then you heard this robust rhetoric from Secretary Hegseth earlier saying that the U.S. will not relent in achieving its objectives. He says that the U.S.'s will is, quote, endless, though he went on to say that this operation will not be endless. Yeah. And you put this into context with what we're hearing from the Iranian side, Joe, which is a statement earlier this morning from their speaker of their parliament saying that there's no intentions here from the Iranian side to negotiate. And then there was this statement overnight from the IRGC maintaining that the military is going to continue to block oil exports from the region. It feels like we're heading towards escalation. Right. As Hegseth outlined, today's going to be one of the most robust days in terms of its bombardment campaign. So raises questions here about the timeline and how the administration is measuring that progress, though they do outline some tactical successes. We heard earlier today the U.S. has hit more than 5,000 targets in the region.
Yeah, big questions about what targets will follow. Let's hear from Pete Hegseth. He held a joint news conference with the chairman of the Joint Chiefs earlier today at the Pentagon.
Today will be yet again our most intense day of strikes inside Iran. The last 24 hours have seen Iran fire the lowest number of missiles they've been capable of firing. We will not relent until the enemy is totally and decisively defeated.
Well, that doesn't leave much to the imagination here. An Iranian official telling CNN, we hold the screw of the global oil price in our hands, and for a long time the U.S. will have to wait for our actions to control the price. This isn't cooling off. It's heating up, to your point.
Well, I'm glad that you had brought up right before we tossed to that bite. It's raising questions about what's going to be hit next, because remember, President Trump yesterday suggested that the U.S. could expand its list of targets to electricity infrastructure if we continue to see disruptions in the Strait of Hormuz. And we have. I mentioned the IRGC statement saying they're going to block oil exports. Bloomberg News, pretty incredible reporting this morning. They analyzed the data from the Strait, and it appears that electronic warfare right now is jamming the signals, which is throwing everything off in terms of tracking what's actually going in and out of the Strait. And we had a new headline on the Bloomberg terminal earlier today that the G7 is now asking the International Energy Agency to prepare potential scenarios for them to release stockpiles. So it is very clear that nations, the U.S., are looking for solutions amid these concerns that oil disruptions are going to continue. I'm sure you saw that earlier today. The largest oil refinery in the UAE ended up pausing, at least temporarily, as a precaution, its production because of an Iranian drone strike that didn't necessarily hit the refiner, but it hit the area around it and caused a pretty big fire. So these disruptions are continuing. I'll leave you with this. Pretty incredible reporting from Bloomberg News. People familiar with the matter saying that production cuts between the UAE, Saudi Arabia, Iraq, and Kuwait have lowered their collective crude output by 6.7 million barrels per day.
It's all about the barrels, of course, Tyler. Thank you so much. As we anticipate our conversation with Mike McGlone, let's hear from President Trump yesterday, as I mentioned, specifically to the price of oil. Here's what he said in that news conference about the jump to almost 120 and the swoon back down below 90.
I knew oil prices would go up if I did this, and they've gone up probably less than I thought they'd go up. We're also waiving certain oil-related sanctions to reduce prices. When the time comes, the U.S. Navy and its partners will escort tankers through the strait if needed.
Now, remembering, of course, nothing's really changed in the strait, and as Tyler just told us, UAE has halted its massive Ruwais oil refinery, one of the biggest in the world. That's more than 920,000 barrels a day, and Saudi Arabia, of course, shut its biggest refinery last week. So, Mike McGlone, back with us from Bloomberg Intelligence, our senior commodities strategist. Why then is oil continuing to go down?
Well, that's the key thing in futures, Joe. You have to skate to where the puck's going, and the puck and price went up way too much. You mentioned $120 a barrel earlier in the week. And if you look over at in the future, the February contract, which will be the end of the year contract, it's traded around $67 a barrel. And I think it's more likely to head below towards 47 than near the current price, near 87. The bottom line is 57 is where we ended last year. But the key way to really accelerate a bear market is what we did. We flushed out all the shorts. We gave the producers a great incentive to sell forward and bring on more supply if they waited to hedge. Now they can do that, and they'll pressure prices lower. And the bottom line is, what does the leader of the world's largest energy producer, next exporter, want by the time he gets to midterms? Lower energy prices, and all those trends are in his favor.
Well, okay, makes a lot of sense. I guess the narrative has not changed for you. Basically, in the last 12 to 24 hours, Mike, could that change in the next 24 hours if you see a massive uptick in the bombing campaign, if we get special forces on the ground to look for uranium or seize Karg Island?
There's little doubt in the ability of the U.S. military to repress offensive regimes. I fully expect that. But the bottom line for me is what you said earlier, Joe, is this accelerated my bearishness. For instance, we had that peak near 130 in 2022. That it brought on the deal and accelerated the switch to EVs. This just pump will accelerate that process. To me, it's going to accelerate what's happening, typically happens in commodities. You usually have to get to that low price cure, because the bottom line is there's a pretty excessive amount of supply versus demand in the U.S., Canada, Argentina, all the way down to South America. And the key question is what stops it. So let's look at the price of gasoline. It pumped up to near $3.50. That's going to accelerate, maybe curb a little demand, bring on supply, and typically it'll drop back towards $2.50 by the end of the year. That's my guesstimate, because that's what it usually does when it spikes too much. And again, the strait is still closed. That was an unprecedented event. I fully expect from the future we're going to look back, say all mopped up, strait's opening, prices go back down.
National average today, $3.53 a gallon. What do we see first, $3 or $4, Mike? $3. All right. So forget the predictions for $4 a gallon gas, says Mike McGlone. We can't go a day without talking to him at Bloomberg Intelligence. I'm Joe Matthew in Washington. Coming up, Ed Harrison and the Everything Risk newsletter, only on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Oil lower, stocks higher. The Dow, the S&P, NASDAQ, all very much in the green. Right now, West Texas Intermediate crude is down 10.2%, just above $85 a barrel. Brent, the global benchmark, 89.31. It is down by 9.7%. The Dow, the S&P, and NASDAQ, they're all in the red. S&P 500 index up 20 now to 68.15. That is a gain of 0.3%. The Dow up 194, up 0.4. While NASDAQ, the composite index, up 109. NASDAQ up by 0.5%. The 10-year 4.10%, with the 2-year 3.54%. The VIX at 23. Gold up $91 the ounce, 52.30, up by 1.8%. And again, crude down 10%. WTI at 85.33 a barrel. Amazon has kicked off what is likely to be one of the biggest corporate bond offerings ever in the latest blockbuster fundraising to pay for the AI boom. Now, sources tell Bloomberg the tech giant is targeting the equivalent of about 37 to 42 billion in a cross-Atlantic offering in dollars and euros. Amazon shares, they're gaining today by 0.5%. And Salesforce planning to sell as much as $25 billion of debt to fund a share buyback. Salesforce shares down now by 1.3%. Again, recapping, the Dow, the S&P, NASDAQ, all gaining. S&P up 0.3%. This is crude. West Texas Intermediate slumps now by just about 10.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Balance of Power continues. Once again, your host, here he is, Joe Matthew.
Hey, Charlie, thank you so much. We'll have more from Charlie Pellet, watching Wall Street, in about 20 minutes here. Big part of our program every day, live from Washington, as we connect the dots between Washington and Wall Street. And I'll throw one quick log on the fire here before we walk through the markets with Edward Harrison. He's joining us from the Everything Risk newsletter. And it's a conversation you're not going to want to miss here, because Edward is speaking truths that the markets may not be reflecting on this up day once again. Tom Tillis has something on the schedule for this afternoon to be a fly on the wall, meeting with Kevin Warsh. Yes, remember, this is the Senator Tillis, the Republican from North Carolina, who is blocking the confirmation process here until the DOJ investigation into Jay Powell is resolved one way or the other. He's going to be sitting down with Mr. Warsh this afternoon, according to Politico. I would expect some headlines to come from that conversation, and maybe we'll get some clarity on when exactly a hearing, or more importantly, a vote might take place. It was right around this time yesterday, a little bit later on, that the President of the United States changed the entire market. Remembering when I got here, as I mentioned, the VIX was at 30. Crude oil had just dipped below $100 a barrel. It was doom and gloom. Markets were deeply negative. And then the President held a couple of telephone calls, a couple of phone interviews with reporters, and changed the entire landscape. Still echoing today, the President's iconic wartime prose, channeling the likes of Winston Churchill. The war is, quote, very complete, pretty much. That's all it took. Turn on a dime. You were with us yesterday. By the time we got to the late edition of Balance of Power, oil was below 90. Markets were rallying. VIX was in the mid-20s, and it continues today. The question is it justified? Because not all that much has changed. Listen to the news conference from the President last night, still threatening a beatdown on Iran if they don't accept an unconditional surrender. And the Defense Secretary, Pete Hegseth, today saying it will be the most intense day of strikes so far in this campaign. Enter the Everything Risk newsletter with the headline, "Calming words from Trump can only help markets so much." Edward Harrison, the author, with us now, Bloomberg's senior strategist and the man behind the newsletter, with us at the desk. It's great to see you back. I've been really looking forward to walking through some of the corners of this market. But broadly here, you're not terribly convinced that this is over.
No, I'm not convinced it's over. I do think that we now have a sense that Trump does react. That is that regardless of whatever he might say, he did see the markets throwing a tizzy yesterday, and he decided to say a few calming words, see what kind of reaction he got, and he got a very positive reaction. It's almost like Pavlov's dog.
So it's Taco Tuesday.
Right. Not only one day, but 2 days in a row.
But if it's Taco Tuesday, then it's buy, isn't it?
Well, the problem is that these are just tests. There's still lots of options available. There are lots of options available for the Iranians as well.
Okay.
And so as a result of that, we don't know where this is going over the longer term. But at a minimum, we do know that the markets will react positively to a de-escalation. And so Trump can use that information. Iran can actually use that information. But what we see now is that it's not a foregone conclusion that we have $100 a barrel for oil going forward.
Check this headline now just to fulfill your concern. Qatar says it has detected and intercepted 5 ballistic missiles today. 5. We know earlier the UAE shutting down its biggest oil refinery. Who's buying? Are these retail investors buying the dip? Where's the bid coming from?
That's a good question. It's hard to say at this juncture, but the markets in general are conditioned to buy the dip.
We sure are.
We know since April, over and over again that when the markets fall out of bed, there are mollifying words, and therefore the markets can go back up. So we didn't even see that much of a dip. American assets actually outperformed the Europeans on the concept that even if it was terrible, it wouldn't be as bad for the United States in terms of the the stagflationary implications. But it was nothing like we saw in April 2025. So the markets have already conditioned themselves to A, not go down as much, and B, to rally on a relief from whatever Trump has to say.
Everything seems to be catching a bid. I mean, you've got a lot of energy up here, not the entire sector. Financials are looking pretty good. Mag 7 for the most part, with some exceptions like Microsoft. It's pretty broad-based here. Micron Technology, back above $400. We can't break these habits, can we?
No, and I was looking at the wide swath of things because we have gold, we have silver up. Yeah. The only thing that's down actually is treasuries. Treasury yields are up. So what I would say that the market is telling us is that we're not going back to where we were before. Okay. However, we're going back enough to where we were before that we can have most risk assets rally. However, the one asset where there's problems is treasuries because inflation is still a problem. We still have oil at almost $90 a barrel. Right. So what that tells you is that with the CPI coming out very shortly, with PCE inflation at 3%, core PCE, that the market's concerned that irrespective of what happens, inflation is going to be a problem going forward.
Yeah. Most important stock in the market, NVIDIA, is up 1.5% now, $2.50. So talk to me about oil specifically. What's the breaking point for you here? We were talking to Mike McGlone, who says $40 is more likely than $140 at this point. Is there a line where that number becomes inflationary in a world that can damage stocks, and what is that number?
I think we're already at that number to a certain degree because the way that I'm looking at it is if you look at swaps markets, they're discounting what the Fed's going to do going forward, and we're sort of in the September to October time frame for cuts. And we're doing that with 3% inflation. So what that says is that 3% will go down to 2.5% by that time, and the Fed will be able to cut. But if 3% remains at 3% or even goes higher, then those cuts will be wiped away. And potentially at some point, people will start putting in the risk of a Fed rate hike, which they've already done for the ECB. Right. So I think that we're, with oil at the levels that we're seeing now.
We're 85, 84 right now.
Right. Yeah. That's a level that is substantially higher than it was before.
You want to see a 6 handle? What makes you more comfortable?
70 certainly would do the trick, but 80, 85, 90.
Too high.
Already we're seeing an impulse to inflation that is going to add to inflation expectations in a negative way. Now, obviously, the Fed looks through food and energy prices because they're looking for the core, but the core is already at 3%. This only adds on top of that, and what it says to the market is the chances of a cut diminish.
It was only a couple of weeks ago I woke up to Tom Keene telling me about a 10-year below 4%. We're at 4.11 right now. How far does that need to climb before it starts to give stocks a run for the money?
I think 420. You know, before 420. We were in the 4 to 420 range at some point. When it started to get over 420, people started to think that it's starting to push up to levels that are negative in terms of growth. I mean, it's not a terrible negative. We're talking about gradations here.
Sure.
But, you know, there's a line. We've stayed within that range, 4 to 420, pretty much, except going below briefly since September. When we went above that line, then that was negative, and that's when we saw all of the market volatility earlier this year.
So you know you can make, as an investor, you're going to start making 4.2%. You're not buying Salesforce anymore. Is the point here? Right?
Exactly. Yeah. I mean, because we have the AI trade, we have software, we have private markets, and all those things are in the background. What I would say is, if you just look at the broad swath of risk or risk aversion, look at high yield, and you can see that high yield spreads are not really that far out. They were much further out in April as a result of the original tariff imbroglio. So what you have to think is that, broadly speaking, the markets are telling you we've got it. You know, everything's fine.
Right.
Everything's not entirely fine, but that's what markets are telling you.
Of course. Next week, Jay Powell, wouldn't want to be him. You've been talking about the possibility of even rate hikes. What's he going to tell the room when he holds the news conference? What's the statement going to look like?
I think he's going to say that we're on hold indefinitely. That he's not going to. He's going to say every meeting is live, and we care about the employment market, and we saw a loss of jobs, and we're looking at that carefully. But if you read between the lines, what he's basically going to say is, we feel like we're in a good position just to continue to hold until we get daylight on one or the other, that is employment or on inflation. And with regard to employment, remember, even though we lost jobs, a lot of that had to do with the fact that we had bad weather, and B, there were a lot of layoffs in January that fed into February. So if you look at the weekly jobless claims, they're all telling you that the Fed can hold for a considerable period of time.
How about that? So the next jobs report is going to look a little different, obviously.
I think so. I think it's going to be better than the previous one that we had.
Did the S&P 500 bake in a new floor with that bounce yesterday?
No.
I can put your technical hat. No, is that okay? If you're just saying, we're at 68.23 right now, up 27 points. What is the point of support that you've got your eyes on?
I'm not really at this point. It's all about what the president and what Iran does.
Okay.
It's all about where oil goes from here.
Got it.
I think anything above 100 is going to get you much further down than we are now.
Back to $100 a barrel, which is, of course, still within the realm. Someday when they kick me out of here, I'm going to have Edward Harrison run my retirement account so I can stop working. Edward, it's great to see you, and welcome back. The Everything Risk newsletter. Look for it on the terminal and online. His unique view only here on Balance of Power on Bloomberg Radio.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Oil lower, stocks higher. S&P 500 index holding close to session highs as the equity rebound continues for a second day. S&P 500 up now by 31 points, up 0.5%. This is crude tumbles on hopes that the world's largest economies will start to deploy their stockpiles. The Dow up 292, now up 0.6%. We do have the NASDAQ Composite Index up 156, up by about 0.7, with a VIX now at 22. The 10-year 4.10%. The price of gold up $93 the ounce to $52.32, up by 1.8%. And West Texas Intermediate crude now down 11.5%, $83.88 per barrel of WTI. So the S&P 500 wiped out losses as crude tumbled after the group of 7 nations tasked the International Energy Agency with studying the volumes that could be released. As for the oil volatility that we're seeing, Amanda Agati is Chief Investment Officer for Asset Management at PNC Bank, and she was the guest this morning on Bloomberg Daybreak.
You know, I'm not sure that we learned a whole lot between yesterday and today, other than, some calming, comments coming out of the president, certainly last night, that this isn't going to take as long as maybe what we think. I think the path forward just is going to continue to be pretty choppy.
Amanda Agati of PNC Bank. Meta Platforms is asking advertisers to cover the cost of digital services taxes, levies imposed by countries on local sales made by tech firms. Now the company has emailed advertisers to inform them of new so-called location fees. Meta Platforms taking part in the broader tech rally today. We've got Meta up now by 1.7%. After earnings, Kohl's stores up now by 0.4%. Oracle reports after the close of trading today. I'm Charlie Pellet. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, we thank you. We'll have more from Charlie Pellet and his view of the markets coming up at the top of the hour, 1 p.m. Eastern Time, as we welcome our global television audience to the program. Welcoming you already. Thanks for being here on Bloomberg Radio. It's the Tuesday edition on the early side for Balance of Power. 79 degrees and sunny right now in Miami as they build Bloomberg House for the upcoming F1. The Republican retreat is underway as well there at Doral. The president's back in Washington, but rank and file and even committee chairs are still in Florida. And they're talking about a lot of stuff there, including fighting a little tradition, as the president put it. That, of course, would be losing the House in the midterm elections. Big speech from the president last night, a bit of a pep rally before he held the news conference that you heard live here on Bloomberg. Interesting to hear from Lisa McClain, the House Republican Conference Chair, who you've heard on this program many times. History will tell us, she said, the party in the majority is supposed to lose seats. But I don't know about you. History's been wrong a lot this year. And maybe that is true. But of course, the currents that we're seeing here, the tide against Republicans has been quite real as they try to seize on the issue of affordability. At the big retreat, the president's talking about Iran. We're talking about the potential for $4 a gallon gas. We're back above $3.50 a gallon now. And of course, that's the feedstock for so many things when it comes to energy. And the Strait is the feedstock for other stuff like fertilizer that impact food prices, and the cycle goes on. Now, of course, we're talking about the potential for a lot more volatility. And the president's going to be asking for money to help pay for this war, even though he wants the SAVE Act to be taken care of first. Either way, members of the Republican conference might feel like they're watching from the sidelines right now. And that was the point that Jane Harman made when she joined us yesterday, the former Democratic Congresswoman who was ranking member on the House Intel Committee. Here's what she said.
The president is claiming free rein to do whatever he wants, including charging taxpayers $1 to $2 billion a day to support the effort we have underway. And that effort is leading to the highest gas prices in American history. So if I were the Congress, this is advice to both parties, I'd figure out a way to work together to stop this. And I'd also figure out a way, if you want to win your election, to show that you're doing anything. The president is trampling on the Article I branch of our government.
Surely you kid, Jane. But of course, she's not kidding. At some point, gosh, imagine, maybe Republicans and Democrats will need to work together to reestablish the credibility of the United States Congress. Let's assemble our political panel. Glad to say they're both back together. How about it? Rick Davis is with us, Bloomberg Politics contributor, Republican strategist, and partner at Stone Court Capital, alongside Bloomberg Politics contributor Jeannie Shanzano, democracy visiting fellow at Harvard Kennedy School's Ash Center, and of course, our Democratic analyst. The Save America Act. Rick, I'm curious your thoughts about this because he's given John Thune heartburn. The president says, I won't sign anything until SAVE is done. This is voter ID. And he's added a couple of transgender components to this that have nothing to do with elections, making it even less palatable for some lawmakers. But this has no path in the House, or in the Senate rather, and it's already passed the House. What's the president trying to do? And does DHS stay closed until this is addressed?
Well, according to the president, he's not going to entertain any new legislation crossing his desk until this is done.
Yeah.
So my sense is that's a message to Congress not to try and pass anything other than this first. Two, there's actually a good bit of support in Congress and amongst the Republicans for the concept of a voter ID kind of program. I think there are a lot of people who think we're well past the idea that somehow showing an ID is somehow a bad thing. That being said, it's more about the process. Cracking the filibuster is what the leadership under John Thune is not willing to do. And it's not the fear of being able to get this done under a talking filibuster, let's say, which is what the president's pushing for. It's the ramifications of turning over the floor of the United States Senate to the Democratic Party, where they can do a lot of damage. And they're in the minority. So it's almost, counterintuitive to think that somehow it's a good thing to let the Democrats run the floor for as long as they can stand and talk, and somehow that's going to be a good thing for Republicans.
Talking filibuster, we're still back around on this. The fact is, this would also significantly limit mail-in ballots, Jeannie. And as I mentioned, it introduces transgender politics to a matter that has nothing to do with that, keeping men out of women's sports and so forth. But some Republicans don't want this either. Tom Tillis said he's not going to be told what to do with mail-in ballots in his state. So is Congress just closed indefinitely?
It is. This to me is a sign of desperation on the part of President Trump. At first it was sell the big, beautiful bill. That'll win us the midterms. Then it was redistrict Texas, redistrict more of these GOP seats. That'll save us. And now he's jumped to the SAVE Act itself. None of that is going to save the Republicans in the midterm. It doesn't seem like President Trump cares all that much, because what did he say yesterday? I mean, it was amongst many stunning things he said yesterday was once again that he doesn't hear much about affordability anymore. It was something that was made up by the Dems. He doesn't hear about it. Maybe that's what happens when you spend your time with billionaires. And also he said he knew what he was doing driving up the price of oil when he attacked Iran. He is not going to do the one thing Americans elected him to do, which is to legislate on and address affordability. He will lose the House unless he changes course very quickly. And something we thought was unthinkable, potentially even the Senate. This is all a sign of desperation. And I think one other thing, so that he can blame John Thune and Mike Johnson. Should he lose the House in the midterms, he's going to say, told you so. You should have passed the SAVE Act because Dems stole the election.
Wow. Well, in the meantime, though, Rick, he does need some other stuff like this supplemental that we expect to get within days here on Iran, correct? And a lot of stuff could be attached to that bill. So how closed is Congress?
Yeah, as you say, there's more than just the SAVE Act to his agenda, and he's going to have to reconcile that. And there's nominations. Kevin Warsh's nomination is stalled again. That's right. We talk about Tom Tillis. He's been very clear that he's not moving anything forward. So right now, I'd say the Senate is pretty much in a gridlock. I mean, maybe the way to do this is to bring up the SAVE Act, let it fail based on the fact that you can't get enough votes to pass it, and then try and convince Trump that that part's over and we need to move forward. I'll be honest, the one thing I can't figure out as a Republican who's harvested a lot of votes over the last 40 years is we do really well with mail-in ballots. And I don't understand why any president with an R by his name is interested in cutting off the lifeline of a lot of Republicans who only vote through mail-in ballots.
Boy, you know, it just keeps coming back up. It's kind of amazing. And so elected Republican leaders are going to be huddling today at 4 p.m. to talk about paths forward here, Rick. And I suspect they're talking about strategies like you're suggesting. Bring it to the floor, let it fail, remind the president he needs the supplemental. And I guess I would then ask you, does all of this put reconciliation at risk? I mean, if you get the supplemental, you tie a bunch of stuff to it, and they somehow reopen DHS, what's the need for reconciliation, or would there even be votes for it?
Yeah, I think that you just mentioned the one key thing to even talking about a reconciliation bill, and that is opening DHS. There's no scenario that I can imagine in Congress where you have a government shut down in a critical agency at a time of war, right? I'm not making this up. Homeland Security. And we're going to then bypass the budget system to go to a 51 vote funding mechanism to do other things like fund the war. So we're not going to fund the defense of our country, but we're going to fund the war that's creating a risk to the defense of our country. I mean, I can't imagine a member saying yes to that scenario. So at the end of the day, I think, 25 days that the Department of DHS has been partially shut down, and everyone seems to be just kicking the can on this. And again, I think this just offers up Democrats opportunities to point out the obvious, which is how in the world can we say to our constituents that we are doing the right thing by them when this agency is shuttered?
Well, we're going to get into the situation, the conflict in Iran with our panel much more in depth in our second hour, but it does collide here, Jeannie, because there are a group of Democrats in the Senate who are locking arms here to try to test the limits of their powers in the minority. Enter Cory Booker, Tim Kaine, Tammy Duckworth, Tammy Baldwin, Chris Murphy, Adam Schiff, calling for more powers votes. Otherwise, they will disrupt the chamber, a la Senator Tillis, unless Republicans agree to hold public hearings. Pete Hegseth, Marco Rubio, on the justification for the war in Iran. Is that something that you could see actually seeing the light of day?
It's incredibly important that they do that, and they are doing the right thing. I mean, I think what was more stunning to me was your conversation, Joe, with Debbie Wasserman Schultz, when she volunteered that she may support a request for more funding for the war. Let's step back for a minute, and especially after what the president said yesterday, which was very difficult to discern because he was all over the map. This is a war a president has started unilaterally. He didn't think it was important to go to Congress for authorization. He started it unilaterally. This is to a Pentagon that is funded in this year at $1 trillion, the most in human history. And he has the audacity to say now, I'm going to go back for more funding for a war that I started, knowing the devastating loss of life, economic impact around the world. All to Jane Harman's points, members of Congress should stand up and say enough is enough. We are the first branch of government. You do not have this power, because let's not forget, in the last few hours, he and members of his administration have been talking about starting another war and taking over Cuba. So this is not the end of this with Donald Trump. And Congress does have to reassert itself. And that starts by saying, we didn't get a chance to vote for this war. We're not going to authorize more money for it. You need to come here for us to have a war authorization vote. Those Dems are right, and Democrats who are all over the map on this, who are saying they may fund this thing or they may consider it. Even Hakeem Jeffries said it was open to it over the weekend. That is something that is really shameful.
Well, in this great piece of reporting by Bloomberg's Matt Shirley that you can find on the terminal and online, we consider the tools that could be used here by the senators I just mentioned. It's a really interesting moment that we're in here as the minority tries to test the limits of its influence. Baldwin conceding Democrats have a limited number of tools to put meaningful checks on Trump, but vowed to use procedural obstacles to delay all other Senate business. Tom Tillis is setting the trend here until Trump officials agree to public briefings. Reports Matt Shirley here in Washington. We're going to reassemble our political panel in our next hour. Rick Davis and Jeannie Shanzano are with us for the duration as we seize on the rhetoric surrounding Iran and what is apparently now the most intense day of attacks so far, despite the president saying the war was very complete. I'm Joe Matthew. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
The U.S. promises the most intense day yet in Iran. Welcome to the Tuesday edition as the U.S. and Israel conduct their strongest attacks in Iran so far since the start of the conflict, just a day after President Trump declared the war very complete. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, the Speaker of Iran's parliament, says the country is absolutely not interested in a ceasefire right now. As we like to say sometimes, the enemy gets a vote.
Well, this is the thing. Even if the U.S. is ready to wrap things up, that is not to say that Iran is, or Israel, for that matter. Something else we have to consider is this is joint Israeli and U.S. action that is being taken, not the U.S. unilaterally. And certainly you're getting some mixed messages, not just from within the Trump administration itself, from the president itself, but also between the U.S. and Israel. We'll get into that this hour with Aaron David Miller of the Carnegie Endowment for Peace.
There's potentially some sunlight between our objectives here as these two countries work in tandem. But Kaylee, of course, we're watching the situation in the energy markets as well. Crude oil prices are ever lower once again today, despite the fact that nothing really has changed. You could actually argue that it's worse as the UAE shuts down its biggest refinery and nothing's passing through the Strait.
Yeah, the Strait is still effectively closed off, and yet you're seeing oil prices, both Brent and WTI, down 13%
Big move.
today. Yes, we're still higher than before the conflict started, but we're nowhere near the triple digits 120 level that we touched just yesterday. That was yesterday.
Far cry. It's really incredible, the reversal that we've seen. We're going to talk about this in a moment with Tyler Kendall, who's at the White House. She's got the latest on the administration's plans. We may or may not see the president today, but we do have a news briefing that's scheduled with the press secretary. And we'll talk to Republican Congressman Marlin Stutzman, who's at the GOP retreat still underway in Miami. That's where the president spoke last night.
Yep. Well, be interested to get the take from the congressman of what the feel was like in the room, if they have a clear idea of the president's timeline and objectives when it comes to Iran. So we'll get to all of that this hour, but for the check on oil prices that we were mentioning and the markets beyond that, we turn to Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee and Joe. Indeed, all eyes very much on energy, specifically crude. Right now, West Texas Intermediate crude dropping 13%, 82.60 for a barrel of WTI. Brent, the global benchmark at 86.50. Barrel of Brent down now by 12.6%. Bottom line here, oil lower, stocks higher. S&P up 31 now to 68.26. That is a gain of 0.5%. S&P 500 rising as crude moves lower on hopes that the world's largest economies will be deploying their oil stockpiles. The Dow up 292, up 0.6. NASDAQ up by 0.7%. The VIX at 22, the 10-year 4.11%. Spot gold up 1.7%, 52.28 a barrel. And again, West Texas Intermediate crude down 13.8%, 81.75. Bitcoin up 3.3%, 71,280 on Bitcoin. Keeping an eye on some of the oil names, specifically the oil ETF, the United States Oil Fund ETF, USO on the ticker. It is down 4.7% among oil majors. ExxonMobil down 1.1%, Chevron down 1.2%, and ConocoPhillips right now down by 1.9%. Again, looking at a 14% drop now for West Texas Intermediate crude, with the S&P up 0.5. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And back we go to Washington. Once again, your hosts, Joe and Kaylee.
All right, Charlie Pellet checking on the markets for us. Thank you so much. Clearly, markets have seized on the narrative that emerged from a phone call President Trump had with a CBS journalist yesterday, the idea that the war could be over very soon, that he thinks that the objectives are getting close to complete. Pretty much, and that's a quote. Of course, that doesn't necessarily match the rhetoric we got from President Trump when he spoke in Florida yesterday on the idea that, yes, the U.S. is winning, but there is more to be won, that they want to see some degree of completion of the mission here, though that may not still be clearly defined. And all the while, we hear from the Defense Department, or the Department of War, as Pete Hegseth likes to call it, that things are only intensifying in terms of our operations when it comes to Iran, not easing up. This was Secretary Hegseth at a briefing this morning.
Today will be yet again our most intense day of strikes inside Iran. The last 24 hours have seen Iran fire the lowest number of missiles they've been capable of firing. We will not relent until the enemy is totally and decisively defeated.
On to Truth Social, the President of the United States earlier today, if Iran does anything that stops the flow of oil within the Strait of Hormuz, they will be hit by the United States of America 20 times harder, in all caps, than they have been hit thus far. A far cry from the war being very complete. Bloomberg's Washington correspondent Tyler Kendall is on the North Lawn of the White House to begin our coverage this hour. Tyler, how do we rationalize the rhetoric coming from the Pentagon, the White House, and Iran, which now says it's not interested in a ceasefire right now?
Well, Joe, I think both of you really set it up perfectly that there seems to be a little bit of tension here when it comes to a potential timeline. Now, President Trump outlining yesterday that the U.S. is ahead of schedule, in his words, when it comes to achieving its objectives, but that he doesn't expect the conflict to be resolved this week. Then pair that with Secretary Pete Hegseth earlier today outlining that the U.S.'s will to achieve its goals are endless, but he said that this operation is not going to be endless. And we heard him reiterate how the U.S. is measuring progress, perhaps outlining those goals, including destroying Iran's ballistic missile program, but also the industrial base used to create those weapons, destroying Iran's naval and Navy capacity, and then making sure that Iran will not be able to ever deploy a nuclear weapon. So we're looking for some sort of update when it comes to how the U.S. is actually measuring how it is working towards these targets. As Pete Hegseth said earlier today, that the U.S. has so far hit more than 5,000 targets in Iran. But then, as you mentioned, we got this statement from the Speaker of Iran's parliament saying that they absolutely not are looking to negotiate and have a ceasefire. And then I'll also point you to a statement overnight from the IRGC saying that the military intends to continue to block oil flows and exports when it comes to the region. And you mentioned President Trump's post on Truth Social earlier today. Yesterday, we heard him say actually that we could see the list of U.S. targets widen to hit electricity infrastructure if disruptions in the Strait of Hormuz do continue. And by most metrics, they are. Traffic in the Strait has effectively come to a halt. As Joe and Kaylee, Bloomberg News reporting this morning that it appears that electronic warfare is now being deployed to jam the signals in the Straits, which is only complicating the matter more for those vessels that are supposed to be heading through.
Well, it's incredible, Tyler, as a red headline just crosses the Bloomberg terminal that oil is extending declines. We are now down 15% on the day, trading back near $80 a barrel on WTI. This is a far cry from where we were just at this time yesterday, certainly from the early trade Sunday into Monday, which speaks to the idea that President Trump clearly is cognizant of the market. If the Strait of Hormuz cannot be opened up in the near term, what other action domestically do we understand the administration may be prepared to take when it comes to gas prices, which are still higher than they were when this conflict started, even with the declines we are seeing?
Well, I'll actually give you first the international coordinated effort that we could see as the G7 did ask the International Energy Agency today to draw up scenarios about potentially drawing down those emergency stockpiles. And President Trump himself has said that the U.S. is looking at some other potential options, right? He had floated the idea that we could see the U.S. Navy escort tankers through the Strait. I'll point out that the chair of the Joint Chiefs of Staff, Dan Kane, was asked directly about this and said that the military was prepared to draw up scenarios if that option ended up being fulfilled or asked by the president, but it doesn't seem that that scenario has been built just quite yet. And then people familiar with the matter telling Bloomberg News just yesterday that there are these other tools in the toolkit that the administration is eyeing, including potentially a federal gas tax holiday. I'll point out that that would require congressional approval. We could also see potentially some intervention in the oil futures market. And then this idea that we could actually see a tapping of strategic reserves amid some questions about replenishing the SPR. I pulled the latest statistics earlier today. The SPR right now is at 60% capacity, so there could be some room here, of course, but the administration had been denying that that was really an option that they had ultimately wanted to tap. So we'll see as it goes from here, because Kaylee, you're exactly right. This is a White House that has been trying to message around affordability concerns, but as retail gas prices go up, it's going to be something that puts the administration on the defense.
All right, Bloomberg's Tyler Kendall live at the North Lawn of the White House. Thank you so much. And as we consider the White House messaging around affordability, around gasoline prices, around this conflict in Iran, we got many messages from President Trump yesterday, either via interviews like the one with CBS that really turned the markets around into the close in the Monday trade, or in statements that the president has given, both to Republicans at their retreat in Doral, at his facilities in Doral, or in the press conference that followed. Here's a taste of the words of President Trump yesterday.
This was just an excursion into something that had to be done. During this brief disruption, we're way ahead of schedule, and it's going to be ended soon. And if it starts up again, they'll be hit even harder.
So we want to speak now with someone who was there in the room where the president spoke yesterday. Congressman Marlin Stutzman is with us. He's a Republican representing Indiana's 3rd District, joining us live from Doral, and we appreciate it, sir. Welcome back to Balance of Power here on Bloomberg. When you heard the words of the president, both in the ones directly to you and your House colleagues and in the press conference after, do you have a sense of clarity as to when exactly this conflict is going to be wrapped up and what we will have achieved at the end of it, what we still may have yet to achieve?
Yeah, Kaylee, great to be with you. Yeah, you know, the president is taking the information day by day that comes in. You know, one of the things that we all know and are seeing is that our military is performing just incredibly. And the fact that, you know, the intelligence that was gathered on the front end gave our military the ability to go in and take out the Iranian assets at the pace that they did is truly remarkable. And, you know, I think for us as Americans, our attention span can be very short, and we want these things to happen quickly, just like, you know, with the Maduro case, where our military was in and out overnight was incredible. But, you know, we have to realize that these things do take some time, and that this is going to be a long-term situation that is going to have to be dealt with. And I think President Trump is handling it.
How long is long-term, Congressman?
Well, I think we're going to operate as quickly as possible. We want to destroy the assets, and we want to see that the Iranian regime is decimated. And, you know, as was said earlier on the program, that, you know, the other side has a vote in this. I think that they're going to continue to, you know, use their propaganda to try to drag this out as long as they can, like they always do. But in reality, I think we know that this is going to be a shorter situation. The mission is already mostly accomplished, but of course the transition and the changes over there still have to be made. My hope is the Iranian people really step up, and they're the ones that start to make the changes in the government that need to be made, with the support of a coalition that has really come together very strong in the Middle East and here at home.
Well, I guess to your point, Congressman, and it's good to have you back. Thanks for joining us. I know it's a gorgeous day in Miami right now. That research coming from Rapidan Energy would suggest that we could be in for a lot more of this. U.S. military operations, Rapidan writes, have not yet meaningfully degraded Iran's ability to disrupt Strait of Hormuz traffic and are likely to do so for several weeks. This updated disruption outlook indicates that barring a ceasefire and the resumption of Hormuz flows, crude oil could get back into the mid-100s, kind of like we saw in the panic that brought us to $120 almost yesterday morning. How worried are you that we actually have not seen the worst of this yet?
Well, I think there's definitely concern, and there's natural concern. I mean, who wants to take the risk of traveling through there right now? But it was just announced that President Trump just put together a $20 billion underwriting insurance program, and is telling these ship operators and these shipping companies to move and to continue to operate, and that, you know, we've taken care of the Navy, the Iranian Navy, that they're no longer a threat. Of course, China wants to see activity. Most, buyers and sellers of the, almost 20% of the oil and gas that comes out of the Persian Gulf area and through the Straits of Hormuz is able to move. And so I think that President Trump, who is a businessman, knows that while there is instability with the military attacking Iran, that it does create uncertainty, but by coming back on the backside with an insurance program and confidence, saying that they can move, hopefully will make a difference. So I think really, to Kaylee's question earlier, I think within a month from now, we're going to have a very different conversation.
Well, as we consider the Strait of Hormuz, it is worth noting that the Energy Secretary, Chris Wright, actually just posted on X that President Trump is, in his words, maintaining stability of global energy during these military operations against Iran. He says the U.S. Navy successfully escorted an oil tanker through the Strait of Hormuz to ensure oil remains flowing to the global market. So when we consider that escort, Congressman, and you mentioned also the insurance underwriting, that's billions of dollars as well. All of this comes at a cost via military resources or others, which raises the question, and given your seat on the Budget Committee, I'll pose it to you, how we're going to pay for this, if we need more funding to pay for this, and whether that's going to come through just a supplemental bill or maybe a second reconciliation package.
Well, it could probably come through either one of those. It depends on what the needs are. A reconciliation bill is going to move, but it's going to probably take time. Now, one thing that we have seen is that getting things through the Senate, sometimes you have to package them together like we did with the one big beautiful bill. There may have to be a second big beautiful bill to be able to move through. But if it's a supplemental, I think that there will also be strong Republican support. And I think that the fact is that President Trump he moves quickly. He wants to find solutions and get things moving without as little disruption as possible. But as we all know, that the markets get scared, people don't want to take the risks, and so there is going to be a price to pay for that. So I would answer that with stability there comes a price. It's much easier for terrorists to shoot a $2,000 rocket when we have to have a $200,000 rocket to respond to it, to knock it out of the sky. So safety and security does come with a price tag, and I think that that's why it's important to do this now before we ever gave Iran a chance to have a nuclear weapon, and they would be leveraging the West from here for eternity.
I'd love to ask you about the messaging conversations that you're having at the retreat, Congressman, but just quickly, do you expect that supplemental request from the White House this week, as some had reported?
I don't know if it'll be this week. I think they're probably still analyzing a bit, but you know what? They may have the numbers that come from the Department of War. They have a pretty good idea of what the daily costs are. But I think that, I would suspect maybe over the weekend or the request comes and then we'll have to take it up next week when we get back to Washington. But I think that there's a lot of positivity around the actions, the mission that has been accomplished in Iran. Just watching the Iranian people here in America, the Iranian Americans that are celebrating because this regime is being changed. I don't have any problem saying that there needs to be a change in regime in Iran, and the fact that we have taken out the military capabilities that they've had, the nuclear capabilities that they were working on, giving the Iranian people a chance. I think that the Iranian people are the real difference makers here that are going to really guide the direction of Iran. Just like I said, the same thing with Syria. And Syria is making a good move in the right direction. So having opportunity for the people will produce good results, I hope.
Well, we're covering the globe here, and I want to ask you about the Ayatollah's son now, Congressman, and that's the issue. We've now talked for about 10 minutes, and we haven't brought up the issue of affordability. In our remaining moment, are you having conversations there? Is there a plan for members like yourself in the Republican conference to message around this war when it comes to affordability in America?
Yeah, Noel, that's exactly right. Things here at home are getting better. Inflation is down. Of course, what we passed in the big, beautiful bill addresses the tax policy that is now going to benefit Americans. We're just coming into tax season, and the Treasury Secretary is doing a phenomenal job of communicating what is happening and that people are seeing more money being left in their pockets rather than going to pay the federal government's spending sprees over the last several years. When people have more money in their pockets, that's going to spur on the economy. And as I was just talking to some sales folks back home, they don't see the urgency yet, but they are starting to see that people are just kind of building up and ready to make moves here over the summer. So I think, again, this summer we'll see a much more active market.
Well, I guess we'll all be hoping for fat tax returns this year. Congressman, thank you so much for the insights. Again, redhead on the terminal, the Navy escorting an oil tanker through the Strait of Hormuz. It has happened. This is Bloomberg.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks trading at just about the best level of the day. Oil now taking another leg lower. This on word that the U.S. Navy has escorted an oil tanker through the Strait of Hormuz. That word from Energy Secretary Chris Wright in a post on X. Right now, West Texas Intermediate crude trading at $78 a barrel. WTI down now by almost 18%. Barrel of Brent 82.37, drop there of 16.7%. That word, though, moments ago from the Energy Secretary saying on X that the U.S. Navy has escorted an oil tanker through the Strait of Hormuz. We got a whole lot more for you coming up on Balance of Power. Equities higher with the Dow now up 400 points, up 0.8%. The S&P 500 index up 39, up 0.6. NASDAQ pushing higher by 0.8%. The VIX at 22 with a 10-year at 4.11%. Spot gold is up $88 the ounce, up 1.7%, 52.27 the ounce. And again, West Texas Intermediate crude moments ago with a $76 handle. Right now at $76.99. WTI down now by almost 19%. Briefly, earnings news. Among the names reporting this morning, we heard from the retailer Kohl's, shares up by 1.8%. Oracle reports after the close of trading. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. We'll continue to check in with Charlie later this hour as we track this remarkable move in oil. Yes, it was an outsized move to the upside yesterday before a complete reversal on the headlines from Trump's interview, a conversation with CBS suggesting the war could end soon. Now, even more downward pressure coming today, and the leg lower continuing after this headline from the Energy Secretary Chris Wright, who says the Navy has successfully escorted a tanker through the Strait of Hormuz, which, of course, President Trump suggested the U.S. Navy would be willing to do in order to combat higher oil prices, which when he launched these combat operations when it comes to Iran over a week ago, he said he anticipated. This was the president yesterday evening.
I knew oil prices would go up if I did this, and they've gone up probably less than I thought they'd go up. We're also waiving certain oil-related sanctions to reduce prices. When the time comes, the U.S. Navy and its partners will escort tankers through the strait if needed.
And here we are. It's actually happened, as Kaylee mentioned, the president adding some thoughts on Truth Social to write, if Iran does anything that stops the flow of oil within the Strait of Hormuz, they will be hit by the U.S. 20 times harder than they have been hit thus far. Additionally, we'll take out easily destroyable targets that will make it virtually impossible, he says, for Iran to ever be built back as a nation again. Death, fire, and fury will rain upon them. We assembled our political panel for their take. Bloomberg Politics contributors Rick Davis, Republican strategist, partner at Stone Court Capital, and Jeannie Shanzano, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center, with us for more on this. Rick, when you hear the rhetoric from the president and you see now that we're actually escorting tankers through the strait, this is essentially a no-fly zone that we're standing up here. Can we afford to do this for weeks?
Well, it's certainly within the capacity of the Fifth Fleet, our Navy presence in the Gulf, to be able to carry out these maneuvers. They train this, they do war games around it, they know what they're doing, and it's no easy task. The Gulf is a very shallow body of water. The pinch point at the Strait of Hormuz, you could throw rocks into Iran as you sift your way through there. So it's taking these tankers through a war zone, and it's great for the price of oil. Obviously, we see movement just off the announcement. That's important for the rest of the world. But I would worry that this is an escalation on the part of the military, a new phase of the war, where we're putting our service members and our military at risk in order to deliver oil to who? Mostly this oil goes to Asia, and half of it goes to China. And I think that's a real political risk for the president if anything happens.
Well, and the president was saying that out loud in his press conference yesterday, Jeannie. He actually said this really is standing to benefit China, that it's an honor to do it. How does that message ring here at home?
Not well. It was, on top of saying he knew oil prices were going to go up, he is saying that this is going to benefit China. He said so many things during that press conference that were really Orwellian, to the point that you couldn't really make sense of them. At one point, he said, we could do it the easy way or the hard way. And I think the hard way is the easy way. And you just stop and think, what is he talking about? And so none of this works for him politically. It is a risk. It is an escalation for the U.S. Navy to do this. And it is an escalation just hours after the president said this thing was near over. And oh, by the way, we're going to keep going. So it's hard to know what to make of it, except this is bad for the United States. It's bad for him politically. And I guess the winner here, thank you, Donald Trump, is China.
Well, you know the old don't take him literally, take him seriously line. Rick Davis is even challenged by what we've heard in the last 24 hours. The war was very complete, according to what he said yesterday. And now we're doubling down to what Pete Hegseth calls the most intense day of bombing yet. Assuming that the military is outperforming, and that has been the report from every quarter, what about the rhetoric and the way voters are supposed to interpret what they're hearing? The president did hold a news conference last evening, and it was a bit of a weave. Does the administration need to be more direct, more on point with the American people?
Sure. I would say that at best, the communication strategy around this entire thing has been stressed out. President never went to the American public at the beginning and said, this is why we are doing what we're doing. This is why I have asked to spell our blood and treasure in a place like Iran. This is why it's important to the American people. So that didn't get done. So since then, it's been pretty much backfilling. This is what happened today. And sometimes it's good news, sometimes it's bad news. Certainly the bad news the public tracks is how many American service personnel die in this effort, because that is the most sensitive political issue in America ever. And so, yeah, I don't think this administration is really on top of their game. Pretty clear last night, the president was saying things that were not echoed by the Secretary of War today. This is always the challenge with doing press briefings. You expose yourself to inconsistencies within the administration. So it's incumbent upon this administration to communicate clearly to the public, and it's on them if they don't. And in an election year like this is, it makes it even more important. So we'll see whether or not they sort of get their comms act together. But right now, they seem pretty spread thin on that.
Well, and to this point, there's new polling out from Ipsos around public sentiment around the war in Iran. Overall, just 33% of those polls say that President Trump has clearly explained the goals of U.S. military action in Iran. 64% said the administration has not adequately explained the objectives or haven't done so clearly. And to Rick's point, Jeannie, there was also overwhelmingly 54% or very, 31% somewhat concerned about risk to the lives of American military personnel. There's concern in here about the cost of military action and the economic impact here at home. The vast majority are concerned about that. But President Trump has suggested that he doesn't care about polling around this issue. So I wonder, when we think about the tone shifts we have gotten from the president, whether or not they're consistent, if you think that is more reflection of political reality or market reality, market forces that the president is considering.
Primarily to market forces. He does care an awful lot about his own image, his legacy, how he is viewed in the media and in polls. But of course, he discounts the polls that don't show him favorably, and he, holds up those that do. So I'm not surprised with these really bad numbers out of Ipsos, out of Quinnipiac. I mean, it is across the board. He is, of course, going to say, oh, these polls don't matter. And I think, just to step back and say, the president spoke for 90 minutes yesterday, Kaylee, and you and Joe listened to the entire thing. And what did we get out of that? We got completely mixed and muddled messages. None of this is normal. Over 1,500 people have been killed. We have an energy crisis. We have a president and administration who don't agree on why we're there. We have an Ayatollah's son who is now the supreme leader after having his wife, his children, and his father killed. He is more hardline than the previous. And we have 900 pounds of nuclear material sitting in Iran. And they are saying, job is almost done. This is looking great. None of this is normal. None of it makes sense. And the American people are right when they say, we do not support what is going on here. And they need a Congress to back them up in that.
You know, Rick, we're talking about the president's messaging to the American people. How about to members of Congress and specifically the Senate? There's great reporting today by Bloomberg's Matt Shirley that you can find on the terminal and online that several Senate Democrats are threatening to force war powers votes and disrupt the chamber unless Republicans agree to hold public hearings with key Trump administration officials on the reasons for the attacks on Iran. That doesn't sound like something the Trump administration is about to do. Does this bring ever more dysfunction to the Senate?
Yeah, I mean, this is just one more layer of dispute between Democrats and Republicans on top of layers and layers of issues that they're trying to fight through. And you see Republicans sort of, bouncing from side to side on this. Many of these issues are really stressing out Republicans who want to see government function, who want to see things move along, and want to support the president on the war, but have been given very little to go on. I mean, there have been many classified briefings, and this is the complaint the Democrats are making. If you're willing to sit with the entire Congress and tell us these things, frankly, that we read in the New York Times the next day, then what's the good of having a classified briefing? Because really what we are is the greatest press conference known to man, Congress. We communicate to the American public through these hearings, and that's why they want public hearings, because they want this administration to go on the record to explain to the public why they're doing what they're doing, not just at the Department of War in a daily press briefing, not just the president in the back of the plane. They want this stuff on the record in the Congress so that the American people can judge the consequences. It shows just how polarized the politics of all this is, and it doesn't stop at the water's edge anymore. It goes with war also.
Well, could it not also in some way serve the administration, Jeannie, when we're talking about the communication problems? Why not just go testify and make the case that you have arguably been making in press conferences, whether it's at the Department of Defense or President Trump last night?
Yeah, I mean, Kaylee, it couldn't get much worse from a communications perspective. So I do think, and I do hope the Democrats are successful in getting them there. The problem for the administration is there is no clear objective as to what they are doing, how long this is going to go on, why we are there. They have been all over the map. So imagine you drag these people in. How are they going to make this any clearer? This starts and ends with Donald Trump. In 90 minutes, he stood up there yesterday, and it was like you were reading some kind of 1984 George Orwellian newspeak as he went from one side to the other. This is almost over. It's not over. We're going to win. We haven't won. I mean, it was back and forth, and they won't be able to change that.
All right, Jeannie Shanzano and Rick Davis, Bloomberg Politics contributors, the both of them, our political panel today. Thank you so much for joining us here on Balance of Power. And we still have more ahead as we turn to Aaron David Miller of the Carnegie Endowment for Peace on Israel's factor in this equation. That's next on Bloomberg TV.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got stocks moving higher, oil lower, and we're just getting word that Energy Secretary Chris Wright's post on that Hormuz oil tanker appears to have been depleted. Now, you recall that post, which we brought you moments ago, said the U.S. Navy did escort an oil tanker through the Strait of Hormuz, a key development that could start to unblock millions of barrels of Middle East oil that have been trapped inside the Persian Gulf. But right now, the headline on the Bloomberg, Wright's post on Hormuz oil tanker appears to have been deleted. Bottom line here, West Texas Intermediate crude is lower. WTI down 14.5%, now with an $81 handle. Brent, the global benchmark, at 85.85, down now by 13.2%. The direction, though, clear. West Texas Intermediate crude down 14.6%. Stocks higher with the S&P trading up by 27 points now, up 0.4%. The Dow up 303, up 0.6. NASDAQ higher by 0.6%. The VIX just above 23 with a 10-year 4.12%. Spot gold up 1.8%, 52.31 a barrel. And again, West Texas Intermediate crude down 14.5%, 80.96 a barrel. AT&T is pledging to spend more than $250 billion over the next 5 years to expand its telecom network infrastructure in the United States. Shares of AT&T up 1.2%. Rival T-Mobile higher by 0.5%. Verizon up 0.6%. Recapping, S&P up 0.5%. West Texas Intermediate crude down 14.8%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
Charlie Pellet, thank you so much. Charlie will be back at the top of the hour, 2 p.m. Eastern Time, as we kick off Bloomberg Business Week Daily with another look at the markets here in a remarkable turn. We've been talking about the reversal in oil prices. We just saw a reversal of a tweet from the Energy Secretary. Kaylee, this is remarkable. This is the post that brought crude oil, WTI futures, below $80 a barrel. We had a 7 handle a couple of moments ago. It is now gone after the tweet was deleted. Chris Wright had said that the U.S. Navy successfully escorted an oil tanker through the Strait of Hormuz to ensure oil remains flowing to global markets. He even had a video attachment of him making that announcement. He said it occurred about 36 hours ago. Kaylee, the Energy Department, or Chris Wright himself, has deleted that tweet. You retweeted it at one point. It is no longer available.
No longer available. Of course, the tweet being deleted is not the same as the Energy Department coming out and saying that this escort didn't happen or that this wasn't successful. We do not know that for sure, but certainly the market is trying to take a cue here, knowing that it really has been very, very vulnerable to each and every headline that crosses about this. We saw the reversal that happened yesterday on the headline of Trump speaking on the phone with CBS, suggesting the war will be over soon. So this is clearly just a market that is twitchy.
Well, that's for sure.
We want to say
as the president says, has the yips. Right now, crude oil is down about 15%. We're still looking at big declines here today, but back above $80, just about $81 a barrel right now. Energy stocks haven't been moving a lot here as we wait for the next cues on what the president's talking about, essentially ensuring these shipments through the strait. But the strait outside of this ship is still largely, if not closed, unused.
Yeah, and remember, President Trump on True Social overnight suggested that if Iran does anything to stop the flow of oil within the Strait of Hormuz, that they will be hit by the United States of America 20 times harder than they have been hit thus far, going on to say death, fire, and fury will rain upon them. So we want to get into this now with Aaron David Miller, who's joining us from the Carnegie Endowment for International Peace, where he is a senior fellow. Welcome back to Bloomberg TV and radio. Aaron, it's great to have you. When you consider the rhetoric we have heard from President Trump just in the last 24 hours, let alone over the course of the last 10, 11 days, where are we right now on the escalatory or de-escalatory curve?
I mean, wandering all over the parking lot. This is a war of choice, not necessity. And wars of choice, wars of discretion. The metrics and standards for evaluating success are much higher because presumably in a war of choice, there was no imminent or immediate threat to the security and prosperity of the United States. And frankly, as of February 23rd, that statement still stands. The administration has toggled back and forth. I think they've settled, more or less, on the narrative that not only did the president and the Israelis help
kill these Ali Khamenei, the supreme leader. And by the way, this is a transformative act. There's no doubt about it. Iran is not going to be the same country after the decades rule of a guy who basically championed death to Israel, death to America, used proxies to spread Iranian influence in 4 or 5 capitals, and frankly bankrupted the country by the pursuit of a nuclear weapon, or at least a nuclear weapons program. But I think they've settled on a narrative that they have basically undermined, to use the president's favorite word, obliterated Iran's capacity to project its power abroad, and with the Israelis, taken a major whack at the instruments of state repression that have been used to repress and oppress demonstrations and the Iranian public for decades. Regime change? No. I think after 11 days, it seems to be clear that the headline is the trend line. That this regime, the IRGC, and remember, to control Iran, you need access to money, you need access to guns, and you need access to oil. And the fact is, there's only one organization, security services, and the IRGC, that has that sort of influence and power. So 11 days in, I mean, can we speculate? The war could be over next week. It could last for another several weeks. This is the problem with a war without defined objectives.
Well, so we have a new supreme leader. The regime is holding, as you're pointing out here, Aaron David Miller, and we wanted to talk to you about some of the sunlight that we're finding between U.S. and Israeli objectives. Does the Ayatollah's son, the new supreme leader, have a price on his head? Does he need to stay indoors for the foreseeable future?
Yeah, I would think, Hassan Nasrallah, the head of Hezbollah, the Israelis killed in the fall of 2024. His successor, Hashim Safaeddin, lasted 6 days. Maybe Mujtaba Khamenei will last longer. But I think, no, the Israelis are going after leadership targets. They live in the neighborhood. And on this one, look, let's be clear. We're Venus, the Israelis are Mars. The Israelis really do have an existential threat should Iran actually cross the nuclear threshold from a threshold weapon state to an actual weapon state. So they're in that respect, Benjamin Netanyahu, I think, would like to see the war last for another several months, so the Israelis can continue to degrade not just Iran's ballistic missile production and its inventory, but their leadership targets as well. But make no mistake, when Donald Trump decides the war is over, Benjamin Netanyahu will comply. Rarely has an American president, I worked in administrations from Jimmy Carter to Bush 43, and I'd throw in Obama and Biden into that mix. Rarely, if ever, has an American president had more leverage over an Israeli prime minister. Because for Netanyahu, the one organizing principle in 2026 is not Iran, it's not Gaza, it's not Lebanon. It's re-election. And the fact is, if the government goes to term in October 2026, or if elections are advanced, which they may be, until June or July, Benjamin Netanyahu needs Donald Trump as an active campaigner, not as a passive one, an active campaigner, which means that when Trump says jump, the issue for Netanyahu, maybe I'm phrasing it a tad too strongly, is how high. So no, if Donald Trump wants the war over and the Israelis to stand down or to de-escalate or push it into another phase, Netanyahu is going to comply.
But what about Iran? Is Iran likely to comply?
And that is the key issue. Will the Iranians let Donald Trump de-escalate? That is a critically important question, because what Iran has now established is, one, regime stability and the cohesiveness of the Revolutionary Guard, and two, that what we're calling horizontal escalation. They can't go up directly against the U.S. military or the Israeli military, but they can escalate horizontally over a discrete area, and they're demonstrating with a terrifying clarity the power they have, and they probably latent capacity, if they're holding stuff back, and I think they are, to basically make life extremely uncomfortable, both for oil markets and for the Gulf states who crave security and stability and thought when they allowed the Chinese, Saudis, to broker this détente between Iran and Saudi Arabia. That's what they were getting. And look, guys, in this part of the world, geography is destiny. And as far as the Gulf states are concerned, yeah, they can continue to rely on the United States, but it hasn't stopped the Iranians from disrupting life basically as they know it. The proximity guarantees vulnerability, and they are vulnerable.
It's great to have you back. Aaron David Miller, Senior Fellow, Carnegie Endowment for International Peace. We've been looking forward to this conversation, Aaron. Thank you for being part of it. I'm Joe Matthew in Washington, alongside Kaylee Lyons. The Tuesday edition of Balance of Power takes a strange turn today as we learn that the Energy Department has deleted the post that got the markets churning a short time ago for the better. We had a 7 handle on crude oil. And Kaylee, it looks like we've given that up, about $81, still down quite a bit, down sharply, 15%. But evidence of a U.S. military escort for an oil tanker through the Strait got investors' attention. That is what Energy Secretary Chris Wright was announcing in the post. It has since been deleted. So we don't know if that did occur or if there are more nuances around this story. But Kaylee, we're certainly pairing some of the losses that we saw before.
Yeah, so let's get into this now with Jeff Mason, who's a White House correspondent for us here at Bloomberg, here with us in our D.C. studio. Jeff, do we have a sense of whether this did indeed happen and maybe it's just the rollout of communication failed, or was this something that hasn't happened yet and they jumped the gun?
No sense yet. It's very fresh. I will say that there's a White House briefing coming up at 2 o'clock, so that will be an opportunity to ask directly at the briefing what the deal is. Here are a couple scenarios. Number one, it could be that it didn't happen. You're right to ask that. Number two, it could be the communication issue. Number three, and related to number two, it could be that the secretary got ahead with what is major news of the president. And that's always a no-no in the cabinet. And President Trump in particular likes to announce big news. You may recall that the day that the Iran war was announced, we were waiting for confirmation that the supreme leader had been killed. That confirmation ended up coming directly from the president because that was a major headline and he wanted to make it. It's possible that that's the case here. I don't know that. Just laying out some potential scenarios.
Do you get the sense that this administration is aware of how sensitive the energy market is to each word that's coming out of the White House? Because the rhetoric has been a little confusing for the last 24 hours.
True that. I think that the administration and the president himself are aware of the impact that this war is having on energy markets.
Sure.
Certainly aware of how important it is to bring those prices down. We've talked a lot on these shows and when we're together about the political impact of this war and the political risk of higher gasoline prices heading into the midterms for President Trump. So I think you saw some of that at play with his comments yesterday, suggesting that the war was going to end earlier than he has said, but then offering a contradictory comment on that later when he said that there could be even harsher attacks. So that's a long way of saying, Joe, yes, I think they do realize that, and yet it doesn't necessarily make them more careful.
Well, so regardless of what happened here, the fact that a post was made and then deleted, does that not just speak to the idea that across the varying cabinets within the Trump administration, there is a serious messaging challenge, an inconsistent messaging challenge when it comes to this conflict?
And on an issue that, as you just said, is super market moving. I mean, this is not just a message about something going on at the White House or a new event or whatever might end up on a social media post. This is something that is directly connected to the war, connected to people's businesses, and connected to financial markets.
So we're going to be hearing from the press secretary momentarily, top of the hour. We're supposed to have a White House press briefing, whether it begins on time or not. As someone who spent a lot of time in that front row, what is her job today, and what's the question you'd be asking?
Well, I think because of the news that we just are talking about, I think my first question would be just that. Yeah. Did this actually happen? Can you tell us what happened? You know, what ship it was? How did it go? And if not, then how in the world did it come out already and have to then be deleted by the Energy Secretary? Also, if it happened and you're confirming that, then why was the post deleted and what's the backstory there?
And would you expect an answer?
Not necessarily.
Okay.
Oh, Joe, you're putting me on the spot here. I think definitely she will come out with some kind of information about this. She can't really not come out without information about it, but we may not get all the backstory.
Yep. Well, we'll keep tabs on what is said in that briefing room with the help of Jeff Mason. Thank God you're on board, and thank you for jumping in here in the clutch with great analysis, as always. Kaylee, we'll keep our eyes on the Twitter feed, I guess, until the late edition of Balance of Power. God knows what can happen between now and then.
Yeah, and keep our eyes on the chart as well. WTI right now hovering just above $80 a barrel, and waiting for any further word from the Energy Secretary, from the President, or any other in the administration. We'll see you later on here on Balance of Power on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms, radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week Daily for this Tuesday, March 10th, 2026. Carol Masser, along with Nora Melinda, my co-host Tim Stenovic, is going to be along a little bit later on doing some great work down in Florida, talking about markets, prediction markets, and so much more. So looking forward to that. We've got a market, though, when it comes to the U.S. trade. Stocks climbing. We've seen a plunge in oil deepening, a very different trade from what we saw last week. The U.S. moving to secure shipping lanes throughout the Strait of Hormuz. And we've got some assurances from global leaders that is driving crude below $80 a barrel. So that is very different. We've seen WTI goes up as much as kind of just shy of 120 a barrel.
Right. So we really did see a surge, and it's interesting to see the activity that we're seeing today playing out in the trade. I know you and I have had our eyes on volatility in this market. Taking a look at the VIX index, we are seeing it hanging just below that 23 handle. So it seems as though maybe some nerves easing a bit more today, if you will.
I just think there's volatility in the VIX. So, we'll see what tomorrow brings. All right, there's a look at the trade. We're going to get more on it from Charlie Pellet in just a moment. Hey, ahead this hour, though, we're going to get an update on the president's war in Iran. Are we closer to an end, or are we... Who knows? We're all kind of guessing. Kevin Gordon, head of macro research and strategy over at Schwab, he's going to join us on today's Market Cracks. Widening, though, to that war, to AI and credit fears. There's a lot coming at investors. We're going to get into emerging markets, which has definitely been a trade that has outperformed the S&P 500 last year, and we're seeing it continue this year.
It's really interesting to see the diversification that we hear from very many experts in the market, thinking about opportunities outside of the United States.
Yeah, and it continues. So we'll see a little bit more about that, maybe some plays for everyone. Hey, and we mentioned Tim down in Florida. We're going to hear from his interview, his panel with the Kalshi CEO, who weighed in on the prediction market and really some of the conversations they're having with regulators as everybody continues to move forward. But first up, let's get a check on that trade and a little bit of a rally underway on this Tuesday. Charlie, take it away.
Hi, thank you very much, Carol Masser. Thank you very much, Nora. Energy traders and markets trying to sort out that tweet that was and then maybe wasn't. Now, oil prices plunged nearly 20%, down 15% now on WTI, only to then pair losses on conflicting information over whether the U.S. Navy did escort an oil tanker through the Strait of Hormuz. West Texas Intermediate did slump to trade below $80 a barrel. $80.31 right now. It is down 15% after Energy Secretary Chris Wright confirmed the news in a social media post. But prices came back from the lows after that post on X appeared to have been deleted. So again, WTI, West Texas Intermediate, currently lower by 15.4%, 80.13. That is the key takeaway on crude right now with a 79 print, 79.85 on WTI. Oil lower, equity markets higher with the S&P up 36 now to 68.31. That is a gain of 0.5%. The Dow up 378, up by about 0.8%. NASDAQ up 0.7, and as Nora mentioned, we've got the VIX at 22. The stocks, by the way, semiconductor stocks ripping higher, up by 2.5%. The 10-year, 4.12%. Gold up $80 the ounce, 52.19, up 1.6%. Bitcoin up 2.7%, 70,840 on Bitcoin. But crude, again, the big story. West Texas Intermediate down 15%, just above $80 a barrel. Keeping track on energy shares, the United States Oil Fund ETF, the USO on the ticker, it is down 6.2% among oil majors. ExxonMobil down 1.6%, Chevron down 1.8%, ConocoPhillips right now down by 2.7%. Carol and Nora, that is a Bloomberg Business Flash.
All right, Gata, you are all now caught up on the markets. Thank you so much, Charlie Pellet. All right, let's get to the latest on the U.S. war in Iran. U.S. officials signaled military operations were escalating against Iran, and there was little chance of diplomatic talks. The Pentagon said the U.S. and Israel are conducting their most intense day of attacks yet against Iran and will not give up until the Islamic Republic is beaten. Meantime, President Trump, as you know, did also speak about the war in Iran last night from Florida. His Defense Secretary, Pete Hegseth, also gave an update from the Pentagon this morning. The message, though, on this war, sometimes mixed.
We will not relent until the enemy is totally and decisively defeated.
Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay, and with respect
Very
to...
soon. Look, everything they have is gone, including their leadership.
As President Trump declared yesterday, we're crushing the enemy in an overwhelming display of technical skill and military force. We will not relent until the enemy is totally and decisively defeated.
And that, of course, was Defense Secretary Pete Hegseth earlier this morning at the Pentagon, and then there was President Trump making those comments last night in Florida. Is this war winding down or not? That is the question. It's a question global markets, global investors, really everyone is trying to figure out. With an update, let's head to the Bloomberg News Washington, D.C. Bureau and to Bloomberg News National Security Editor Ian Marlowe. Ian, I do feel like it is the big question. We're trying to read the tea leaves when it comes to the U.S. war in Iran. Is it winding down? Do we not know? Do we have any better feel about what, kind of where we are in this process?
Yeah, I think it's no one's fault that we're sort of all experiencing whiplash here when it comes to listening to different officials in the Trump administration about when this war is going to be over. In the early days, it was whiplash on why the U.S. was there, why they were waging war against Iran. Was it nuclear weapons? Was it missile, ballistic missile stockpiles? Those sorts of things. Sinking the Navy. Now we're sort of in a sort of holding pattern where every day it seems the Pentagon's chief, Pete Hegseth, is promising or pledging that this will be the most intense day of bombardment, since the war began about a week ago. And I think right now we just don't really have any clear idea. The comments that Trump made yesterday about the war wrapping up was on a day where oil swung all the way up to nearly $120 a barrel. So it was clearly motivated by the idea that there was sort of potential domestic pressure there because of gas prices and not wanting an endless war. And up until that point, with U.S. war goals being so vague, it's not clear there is an end in sight because they haven't really enunciated a clear end point for this. That's why everyone is guessing, and I think you see with each different official saying different things. Sometimes it's difficult to try and gauge that.
Well, it's interesting because if you look at the reaction in markets, it's clear that investors are hinging on every word that comes out of the president's mouth. But from your perspective, what chapter of the war do you think that we're in based on the people that you're speaking with? Are we maybe escalating, holding steady here? What are you gathering?
Yeah, I think from everything that we on our national security team and others from Bloomberg's bureaus around the world are hearing is that this is that the U.S. and Israeli attacks are sort of continuing apace. The Iranian retaliation, which of course affected global energy markets when they were sending these one-way attack drones, into Qatari energy facilities, Saudi energy facilities, threatening the Strait of Hormuz, which effectively remains almost entirely shut. The pace of the Iranian retaliation has maybe diminished slightly, but no one is really totally sure whether that's because they're conserving weapons in this fight, or whether they are, depleted or diminished in terms of their ability to fire them. And I think right now a lot of the observers tend to think it seems to be that they are holding their firepower, keeping the powder dry a little bit, because unlike back in June when the U.S. and Israel attacked Iran's nuclear facilities, and Iran responded with a massive volley all at once, and most of their missiles and other things were shut down or shot down. Now they're sort of sending them in consistent, different volleys at different countries, and it's a tactic that is potentially draining U.S. resources and munition stockpiles and their ability to actually shoot these things down.
Yeah, above and beyond the war itself, what kind of blows my mind is we continue to remind everybody that even though this, we just see the stockpiles of military equipment and weapons that many nations around the world have, including the United States. Hey, one of the things I want to ask you, and just the optics before we wind up, is we did see the U.S. Navy escort an oil tanker through the Strait of Hormuz. This oil, my understanding, not headed to the U.S. I think it might be headed to China or elsewhere. And I keep thinking about the optics as President Trump gets ready at the end of this month to go visit with President Xi. This war, I think many would still ask why. But I do wonder about the signal around the world, a message perhaps to China. Just to wrap up, some final thoughts here.
Yeah, I think, it's very clear that most of the oil and natural gas coming out of the Persian Gulf and going through the Strait of Hormuz is going to Asia. A lot of that going to China, some of it going to Japan, elsewhere. I think the market has not yet been convinced by U.S. pledges to keep the Strait open. The U.S. Navy escorts, the trying to get the Development Finance Corporation here in D.C., which is a relatively small agency, to try and take on sort of global insurance or reinsurance schemes to try and get these, ships moving through the Strait.
Right.
None of that has been convincing to the market so far. The only thing that's been convincing to the market so far is Trump pledging that the war is going to wind down soon.
Yeah.
And then, of course, today we had Hexas saying, it's the most intense day so far, and they're continuing, and the rest of it. So no one knows at the moment.
No, it's really, kind of mind-boggling. But as you say, there's more of a risk on trade, certainly, when it comes to the equity markets and some other asset classes. Ian, thank you so much. Bloomberg News National Security Editor. I do want to dig a little bit deeper into the markets. The U.S. war in Iran, the AI trade, talk of stagflation, and more that's coming at investors. A great voice. Kevin Gordon is with us. He's head of macro research and strategy at Schwab. He's right here in studio.
Hi, guys.
Hi.
Nice to see you.
It's a shame nothing's going on.
Just a few
so
things.
Quiet.
Just a few things.
So tell us how you and the team are thinking about everything. What really matters? What are you waiting to see if it matters longer term?
I mean, similar to what a lot of people are waiting to see, the sort of scale and the persistence of this. And I think especially in market terms, and these are always uncomfortable situations because you never want to have to think only in market and economic terms. There's always the humanity aspect.
Right.
But to some extent, they're actually tied together in terms of the economy, angle. So I do think that, from our standpoint, the ultimate impact to the U.S. economy, because that's ultimately, what we mainly focus on, but of course the global economy. I think that you could sort of see it in market pricing, both when we were going through the more aggressive risk-off scenario, but also even today, something like European natural gas futures versus U.S. I mean, you could see the more sharp decline in Europe versus what was happening, on the upside. That to me sort of explains and kind of hints at, the U.S. being a little bit more insulated relative to the rest of the world. But I do think it's, we have to keep in mind, even if oil were to not move much from here, it would still mark a pretty big increase over where we were just a couple of weeks ago.
Up like 60% year to date or
Absolutely.
something like that.
So the shock is still there. It's just obviously not as severe. So this is sort of where the emotional and psychological, part of it comes in. It's not 120, it's down to 80. But up from 60 is still pretty tough, especially for headline inflation.
Do you think stagflation? Do you even?
Well, to me, it depends on what definition of stagflation you want to assign, because if you were around in the 70s and the 80s and you use the unemployment rate plus the CPI rate as your definition of stagflation, we're still pretty far from that because unemployment is still quite low relative to history.
Right.
If you're going to use a time frame over the past, say, 6 months, and you're going to look directionally, where has inflation been trending, where has the labor market been trending, then you could say there has been a little bit of a stagflationary impulse because the unemployment rate has been grinding higher. Inflation's also been grinding higher, closer to 3%, a full percentage point above the Fed's target. So I think it just depends on, number one, the time frame you want to use, and then number two, also sort of the background conditions.
So which one do you use? So do you say yes or no?
I say there's certainly been an impulse of that. I think there's been sort of a hint of it in a tinge, but I don't think that it's anything to be, alarm. It's not capital S stagflation in terms of the 70s or the 80s.
So how do you play this market, given that we've been dealing with so many bouts of uncertainty? I mean, this is not the first chapter of uncertainty that we've been seeing recently.
For us, we haven't really adjusted anything, and we don't suggest that clients do the same, especially in these kinds of instances.
Nothing since the start of the year.
No, I mean, we've sort of came into the year relatively constructive on, outside of the U.S. from a stock market perspective, not against the U.S., but we just felt that, given some of the growth impulses you're seeing around the world prior to this, especially in Europe and parts of Asia, the weak dollar story last year, of course, was a really huge support to ex-U.S. stocks, but we sort of felt that was transitioning a little bit to the growth side of things, so you started to see a little bit of a broader base of support. Still feel that way today, so we haven't really changed any of that. I think that from a broad perspective, somebody who's looking at a lot of this geopolitical instability, the framework that I've sort of used for myself, and I think that most people, hopefully it's helpful over the past year, has been this distinction between what is the front page risk and what is the bottom line risk. Because at the end of the day, as uncomfortable as it may seem, if you're looking at this in a dispassionate way like markets are, they're really only caring about how much of the hit to earnings is actually going to manifest, if at all. So if this is a short-term conflict, which, yes, if we do get some energy spikes, not to be dismissed. But if it's ultimately not going to be a growth hit to the economy and just a little bit more of an inflation shock, I think that the market ultimately looks through that, as uncomfortable as it may be.
So how long does this war have to go on? Like, when do you guys start to say, okay.
Yeah, I mean, it's hard to, I think that a scenario of, Brent crude eventually creeping back up towards, I don't know, in the 80 to 90 range, but hovering there.
Okay.
I do think that puts more of a pinch on the consumer. And especially, I was actually just going through some great analysis from the Bloomberg economics team right before this, looking at sort of that break-even price for Brent and the tax refunds coming from the big, beautiful bill.
Yeah.
And we're essentially right here at these levels at that break-even point. So I do think that it starts to eat into some of that stimulus that's coming to the consumer, especially a consumer base that is devoting a much higher share of their spending and their income on energy versus, the wealthier share.
So based on that potential bear case scenario, how would you strategically realign where you put your money, where you invest capital?
Well, I don't think that there needs to be some sort of major realignment. I think that the realignment would come if there was a big shift in the growth trajectory of the U.S. Because coming into this, as weak as the labor market has been and as fragile it's been, there were a lot of signs of some stabilization.
Right.
Even if you take January and February combined for U.S. payrolls for both of those reports, I think you could make the case that, January was probably overstated in terms of the strength. February was overstated in terms of the weakness. So you add both of those together, you're probably close to that break-even rate for payrolls around 50,000, considering what the unemployment rate did for both. You have seen a little bit of a stabilization in private payrolls. Not to say that everything is totally fine, but I think some of that fragility was sort of easing by last fall. So as long as this shock doesn't affect that scenario and that picture for labor, which of course it could, but we haven't seen the signs yet because it hasn't been long enough for us to see. As long as that doesn't happen, then I don't think there needs to be some sort of major realignment for a portfolio.
What's more interesting to you? I mean, obviously, we just talked about the war in Iran. And again, taking out the humanity and the cost of people and lives impacted as a result. But there's the AI trade. There's the worries about private credit. What is it that you think is something investors should pay more attention to? Just got about a minute or so left.
I think AI from the standpoint of how it's starting to move through the economy and move through the market. And one of the distinctions and sort of points of emphasis we've been making has been, if you do believe that it's starting to diffuse throughout the economy, you're starting to see a lot of the benefits of this technology and this capture. It may not be the best from a cap-weighted index perspective, because if you thought that tech and communication services were sort of the big drivers and the big players at the outset, not to say that they don't participate, but if they're taking a little bit more of a back seat, giving way to the rest of the market, so breadth looks relatively solid, those other parts of the market are just not as big to power your traditional, cap-weighted S&P 500 higher, at least to the degree that we've been used to over the past couple of years. So not to say that the market does poorly, but I think that's an aspect to consider if you're a believer that this continues to move throughout the economy and benefit, the rest of the market.
I agree with you. I feel like the AI conversation is changing in a big way. And I've had conversations about vertical AI and the large language models. Maybe, we could be moving off of that in a big way. Kevin Gordon, thank you so much.
So good to see you guys.
Yeah,
thank
so
you
great
for having me.
Always.
In your new home, too. I love it.
You like what we've done with
I
the
love
place?
it. I love it.
Here's head of macro research and strategy at Schwab. Always a favorite when he joins us. Hey, coming up next, we're going to head to Tim Stenovec. He's down in Florida, my co-host. He's talking about prediction markets and more. That when we continue.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. The S&P 500 index has just turned negative, and West Texas Intermediate crude has now pared its decline to 10%. Lots of moving parts. A source tells Bloomberg there was no U.S. escort of an oil tanker through Hormuz. Lots of immediate market reaction. The Bloomberg Dollar Spot Index has trimmed its loss. Oil pairs losses amid that report of no U.S. Navy escort. West Texas Intermediate down 9.9% right now, 85.31 a barrel. Did dip briefly below 80. Brent, the global benchmark, just above 90 right now, down 8.8%. And as I mentioned at the top, S&P 500 index just turning negative right now. The S&P down by 0.1%. The Dow holding on to a gain barely, up under 0.1%. S&P, by the way, down 3 points. NASDAQ up by 0.1%. The VIX at 25. The 10-year 4.14%. Spot gold is up 0.9%. 51.86 of the ounce on spot gold. And again, West Texas Intermediate crude. Everybody's focused on what's happening with crude. WTI down 10% right now, 85.22 a barrel. Brent, the global benchmark, at 90 even now, down by 9%. Bitcoin trading higher by 1.7%. Bitcoin 70,185 on Bitcoin. Amazon has kicked off what is likely to be one of the biggest corporate bond offerings ever. Amazon shares higher now by 0.2%, and Salesforce is planning to sell as much as $25 billion of debt to fund a share buyback. Salesforce down by 2.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. Carol and Nora, that is a Bloomberg Business Flash.
Thank you so much, Mr. Pellet. Charlie mentioned we are watching the oil markets. This as Energy Secretary Chris Wright apparently said the U.S. Navy escorted an oil tanker through the Strait of Hormuz, announcing the news in social media on a post that was apparently deleted minutes later. Wright didn't identify the tanker in the post on X or say anything to suggest that a wider escort program is now in place. As our team is reporting out, the subsequent disappearance of the post and its accompanying video added confusion to what, as you know, has been a bit of a tense oil market, a volatile oil market that's moved around a lot, that is really looking for a confirmation of efforts by the Trump administration to unblock millions of barrels of Middle East oil trapped inside the Persian Gulf. In terms of the trade, Nor, we have seen it bounce around. We're still down about 10% when I look at the trade, but we have been down a bunch more. I think we went below $80 a barrel. Let me just pull it up on the Bloomberg. We've been down as much as 19% at $76.73 a barrel. We're still down about 10%, but now at 84 and change.
We've been seeing some really wild swings. I mean, everyone really hinging on every headline that's coming out as we continue to monitor developments in the Middle East, and it's certainly trickling through into markets as we're continuing to see this volatility playing out in oil.
And some would say concerns when an official is putting this out. And so obviously investors and all of us are kind of taking heed of it. All right, anyway, that post is removed, and we have seen oil markets still down for the day, but they're definitely off their earlier lows. We want to switch gears a little bit, talk about something that we talk a lot more about, and that is prediction markets. They allow people to bet on real-world events, traders buying and selling event contracts that pay out $1 if the event occurs. The industry has grown rapidly. Platforms such as Polymarket and Kalshi processing billions of dollars in volume every week, financial giants and sports betting firms taking notice. There are a lot of critics out there, though, as we know as well, that they say that prediction markets can have the same consequences as gambling and raise concerns about insider trading, manipulation, and the lack of consumer protections, despite being regulated differently than traditional gambling. And both of the prediction platforms are not the same. These are just some of the topics that are coming up at the FIA Global Cleared Markets Conference. It's underway in Boca Raton, Florida. And in the thick of it all is my partner and co-host, Tim Stenovic, who earlier hosted a panel that included really a who's who when it comes to global markets, including the Kalshi CEO, Tarek Mansour. And he weighed in on the environment right now for prediction markets and also working with regulators.
There is Kalshi, which is regulated, US-based, committed to the rule of law, under Biden, under Trump, under any administration. We will always be committed to this, and we'll be working with regulators for rulemaking. But there are others in this space that are based offshore in Panama that are doing, I honestly don't know what they're doing.
All right, that, of course, is the Kalshi CEO, Tarek Mansour. Let's head to Boca Raton, Florida, and to check in with Tim. I heard you saying it was hot and humid. I figured the sunglasses had to come out.
Loving it.
Tell us about the event.
I mean, you were right by saying it's a who's who. Everybody's here, from regulators, attorneys, the heads of some of the biggest brokerages, exchanges. On that panel that included Tarek Mansour of Kalshi, we had Terry Duffy of CME, Adina Friedman of the NASDAQ, Thomas Book of Deutsche Börse in Germany. We had the CEO of SGX, which is the Singapore Stock Exchange. So it's really a group of traditional, like you'd think about them as exchanges, brokerages, but also this new element. And you really touched on that, Carol, when you were talking about prediction markets, because that is really the conversation happening here right now. It's all about, how do we regulate these things, and what does it look like for a traditional, or, I don't want to say old school exchange, but a more traditional exchange to move into this new kind of world.
So did attendees and those speaking at the conference, did you get a sense of optimism or a more cautious approach when we think about the future of prediction markets?
Everybody's very optimistic right now. And you kind of look no further than the regulatory environment. Earlier in the day, I sat down with the chairman of the CFTC, Michael Seelig, and he and the Trump administration, to be fair, has really been seen as totally friendly to how these prediction markets operate. So Kalshi, for example, is regulated by the CFTC. That's different than a so-called gambling platform like a FanDuel or a DraftKings. And those gambling platforms do not like that. Those companies can't even operate in every state in the country right now. They have to get state-by-state regulation. The people who use those platforms, Nora, they have to be 21 years or older. Kalshi, meanwhile, you can kind of do the same thing, but it's a prediction, or so-called prediction. You could just have to be 18 years old. You can do it anywhere in the U.S., and you can make a bet, make a wager on who you think is going to be champion of the Final Four this year. So I would say that there's a lot of optimism around that. A lot of optimism, too, around tokenization, a lot of optimism around 24/7 trading and an always-on world that kind of comes from the crypto world. And in fact, earlier today, I sat down with Tim McCourt. He's CME Group Senior Managing Director and Global Head of Equity, FX, and Alternative Products. And I posed this question to him, guys. I said, how do you have your risk infrastructure in an always-on world? Because if we think about trading, there are breaks. There are ways when they can update technology. And, in an always-on world, that's different. Here's what he had to say.
I think when we look at the need for 24/7 risk management and accessing crypto, it's really working with our customers, our clearing members, and market participants to understand what their needs are, and then work with them in a thoughtful, intentional manner to deliver that solution in a way that not only comports with their risk management need, does so in a way that gives them the opportunity to meet their standards, to meet the needs of their end clients. And it's really working together with the ecosystem and all of our clients to make sure we do it in a thoughtful way and giving everyone advance notice to be prepared for May 29th.
So what does risk infrastructure look like in an always-on environment? Like, we're thinking clearing members, brokerage firms, compliance teams, tech vendors. Like, what does that look like at CME?
Yeah, I think, the way we're approaching risk on the weekend in this risk-on environment, and it's always being on for the uncertainty that clients are facing any given day of the week, it's really about taking all of that infrastructure that we've built, those risk protections, the way to access this market at CME Group from across the globe, and just availing it now on Saturday and Sunday. It's not necessarily building different protocols, but it's more about extending them onto the Saturday and Sunday session and taking all those lessons that we've learned from managing that risk and providing that trusted, transparent, and efficient solution that people have been accustomed to at CME Group, and just extending it a few extra trading sessions, but doing it in a way that delivers them that confidence for customers to manage their risk.
Well, that was Tim McCourt, CME Group Senior Managing Director, Global Head of Equity, FX, and Alternative Products here from FIA Boca. And what you'll notice he said is, and it's interesting because a lot of people have made the point that it's not as easy as flipping a switch to go from 24/7 to, or to go from, 23/5, as they call it here, to 24/7. But he basically said all elements are in place. So when there is regulatory approval, they're going to be able to go ahead, and he said there is demand from clients for this type of product.
Tim, I got to say, I was listening to your panel when it got away. It was a great discussion, and I feel like this is something that's increasingly creeping in when we talk about traditional markets, what's going on with prediction markets. But I feel like there was a little bit of tension battling about gambling, not gambling, and even the Kalshi head like pushing back and being like, well, what about these options, or what about this? Isn't that gambling? Like, it was really fascinating to see a little bit of the tension or hear the tension.
Yeah, it was a good moment, and I did what Carol, I have to say, what you are so good at during these panels, and that's getting the audience involved. And I thought to myself, okay, what can I ask the audience that's kind of controversial? And it's kind of simple right now, because the biggest question that this company faces is this gambling or is it not gambling? There are lawsuits in several states, like the state of Nevada is suing the company because Nevada is a gaming place. So it's in their best interest to try to promote companies inside of the state, and ostensibly this takes away from that. But you're absolutely right. So you might have seen Terry Duffy of the CME Group, and also Adina Friedman, the CEO of NASDAQ. They both raised their hand, and they agreed with about 30% of the people in the crowd that yes, making a wager on who is going to win in March Madness on Kalshi is considered gambling. And that is the tension. That is the big question that Kalshi is going to have to answer to, and that's the big question that regulators are going to have to answer. And many people, including Terry Duffy, think the Supreme Court will have to answer that question.
Well, all right, we're going to leave it there. Hey, listen, I can't wait to hear more and when you're back here, because I feel like this is certainly one of the big topics already of 2026. And it's just interesting to see how much investors, or maybe, do they want this? And I wonder where it all goes. But it's interesting to see the establishment like embrace it. Wear sunscreen, kiddo. I'm just going to say that.
I have been. Do not worry. Headed to the airport, so I'll see you guys tomorrow. Nora, thank you for jumping in for me. Appreciate it.
All right, good stuff. Good stuff. Safe travels. Of course, Tim Stenovec there at the FIA Global Cleared Markets Conference. Hey, just want to point out that underway, White House Press Secretary Caroline Leavitt at the daily press briefing making a lot of comments, and she has mentioned that the U.S. Navy offered to escort tankers when necessary. She said that the president is not afraid to use options on oil, that the initial Iran war timeline was 4 to 6 weeks, and says the objectives executed ahead of schedule in the Iran war. She did mention that post by the U.S. Energy Secretary Chris Wright was taken down, and she confirmed that the United States has not escorted a tanker through Hormuz. Let's actually head to Caroline Leavitt in the White House press room.
When those objectives are met, the president will dictate the end of these operations when he deems that Iran no longer poses a credible threat to the United States of America. And again, it goes back to, what does that unconditional surrender look like? Iran can talk all they want, and their words will be very empty when we've completely annihilated their navy, as we are doing, when we've taken out the threat of their ballistic missile capability, when we can firmly, finally ensure that they can no longer make a nuclear bomb to threaten the United States and our allies and our troops in the region. And that's what President Trump is ultimately seeking to do with respect to this operation. Jennifer.
There was a shooting outside of a synagogue in Baltimore. Do you know if the president has been briefed on that? And do you have any more details on what happened?
I don't, but we certainly will get you more details, Jennifer. And I don't know if the president has briefed, but I'll check on that when I get back to the Oval Office after this.
Sure. Thanks, Caroline. The president said yesterday for the first time that he had to strike Iran because he believes that Iran was going to strike U.S. targets within 7 days. And then he bumped that down later to 3 days. Where is he getting that?
Well, that's not the first time the president has said that he chose to launch Operation Epic Fury because he felt as though Iran was going to strike the United States and our assets in the region first. Again, I addressed this in the last briefing. This was a feeling the president had based on facts provided to him by his top negotiators who had been engaged with the Iranian regime in a good faith effort. The Iranian regime was lying, deceiving the United States of America, clearly trying to continue their nuclear program to create detonate a bomb that would, of course, threaten the United States of America. Again, their ballistic missile arsenal, they were rapidly and aggressively increasing that by the month to a place where they would essentially build immunity for themselves, where a future president or President Trump would not be able to launch this incredibly successful operation. And so the president, again, as I've reiterated and he has said, was not going to sit back and allow the Iranian regime to threaten or to attack the United States of America any longer.
But there are no U.S. leaders or Israeli leaders who are making those same claims. So is he making this up to justify his decision to go to war now?
The president is not making anything up, Nancy. He is looking at this every single day based on intelligence, based on facts, and based on intelligence that he himself and his negotiators have consumed based on their, again, negotiations with the rogue Iranian regime over the past year. And the president and his team tried in a good faith way to reach a diplomatic deal through peaceful means with the Iranian regime. And Iran chose this path to death and destruction. Iran wanted to attack the United States of America, and the president was not going to sit back and allow that to happen. He was not going to sit back and allow that to happen, and everyone in this room should be grateful for it. John.
Thanks a lot, Caroline. Two questions for you. One has to do with a follow-up to your statement that you made at the beginning of the briefing regarding the Safe America Act.
Sure.
Yesterday, the Senate Majority Leader John Thune spoke on the effort to potentially have a filibuster broken, the rules for the filibuster broken. He said the votes aren't there, one, to nuke the filibuster, and the votes aren't there for a talking filibuster. He says that's the reality. What's your reaction to what Senator Thune said?
Look, I think President Trump, the urgency behind his need to pass the Save America Act and his desire to get this country-saving legislation passed has been made quite clear. He wants all options on the table, and he wants the Senate to move as quickly as possible through whatever means necessary.
And then secondly, just regarding the president's trip tomorrow, looking ahead, why Ohio and why Northern Kentucky?
Well, why not? These are two great states with great Americans.
Just wanted to know why they were chosen.
Great states with great Americans. The president will be joined by lawmakers from both states who he greatly admires and respects and supports. And he'll be meeting with business owners in both of these places and talking about the economy, which is, of course, the utmost importance to him.
Caroline, thank you. Last week, the Energy Secretary issued a waiver for India to get oil, Russian oils during this energy crisis.
Yes.
Have you spoken to the President about it? What's the idea behind this?
Have I spoken to the president about it?
Yeah.
Yes, I have spoken to the president about it. And the president and the Secretary of Treasury and the whole national security team came to this decision because our allies in India, as you know, Lalit, have been good actors and have previously stopped buying sanctioned Russian oil. So as we work to appease this temporary gap of oil supply around the world because of the Iranians, we have temporarily permitted them to accept that Russian oil. And this Russian oil was already at sea. It was already out on the water. So this short-term measure, we don't believe it will provide significant financial benefit to the Russian government at this time.
I have one more question about Pakistan. You know, Pakistan is a neighbor of Iran, and Pakistan is also an ally of U.S. President has been praising a lot about the field marshal. Is Pakistan providing any kind of support in this war against Iran?
That I will have to check on with the Pentagon and get back to you. Sure.
The president said yesterday that President Putin told him he wanted to be helpful in the Middle East. The Kremlin put out a statement where Putin said, quote, "I would like to reaffirm our unwavering support for Tehran and our solidarity with Iranian friends." How does the president think that Russia could be helpful, if not helping Iran? And did the president push Putin on Russia sharing intelligence with Iran in this war?
The president and his special envoy Witkoff have both said that, of course, they've sent a message to Russia that if that was taking place, it's not something they would be happy with, and they hope that it is not taking place. As for further details about the discussions between these two leaders, I'll leave it to the president to divulge any more of that conversation, but he did confirm it yesterday and provided you with a little bit of the background and his view and his perspective, as he always does. Luke.
Regarding the missile strike on the Iranian school, how long does the administration expect that investigation to take, and will the White House or the Department of Defense release a full report of its findings once the investigation is complete?
The Department of War will do that. The investigation continues, and as the president said yesterday at his press conference, he will accept the conclusion of that investigation, whatever it may be. We'll go to the back row for some love. Sure, in the back with the glasses. Go ahead.
Regarding the shield of the
Sitting down.
Americas,
Caroline,
is
and
there
then you can go, but go first.
Okay, thank you.
Is there an update regarding
You
the,
have rough real estate back there, so I'm
is
trying to give you
is
some
there an
love.
update regarding Cuba, and also is an economic deal imminent?
Sure. I don't have any updates on Cuba for you today. Obviously, this is something the administration is actively dealing with. The president's made it quite clear it's his belief, based on fact, that the Cuban regime is bound to fall. The country is obviously in a very weak place, economically speaking. The people are crying out for help, and the president believes and knows that the Cuban regime wants a deal. So as you know, Secretary of State Rubio has been engaged in those conversations as directed by the president. I don't have any updates for you today, though.
Thank you, Caroline. Regarding the Shield of the Americas, the initiative by President Trump this weekend, big names, a lot of countries, but some notable absences. For instance, Colombia, which is a key ally with the United States in terms of counter-narcotics. And President Gustavo Petro was here at the White House, and he met with President Trump. Why wasn't Colombia invited to the Shield of the Americas?
I don't think we're seeing the level of cooperation we quite want to see yet from the Colombian government to invite them to the Shield of America's event in Pact, but we certainly hope that this newfound organization will expand and we can continue to invite additional member countries. But there was quite a few countries there. I believe there were 17 countries represented, 12 heads of state with the president over the weekend. They signed a defense agreement with all of our militaries to emphasize the need to combat drug cartels through Latin America in the Western Hemisphere, and ultimately, of course, to curb the illegal trafficking of drugs to the United States, which is the president's utmost priority in all of this. So it was a great event on Saturday, and we look forward to the coalition expanding. Kelly in the back.
Caroline, thank you. Good to see you. I want to get back to another question that was asked earlier. It talked about the political aspects, but there's also the ideological and the spiritual aspects of what Iran has said for 47 years. Death to America, death to Israel. And we've just finished talking about the fact that terror has been around the world. Iran has been the nexus of that in so many ways. Has the president stated clearly to the American people why this is such an imminent threat in order for Democrats on Capitol Hill and Republicans and the American people to understand how imminent the threat was?
I think he has, Kelly. I mean, you've heard from the president on an almost daily basis over the course of the past 10 days. You've heard it from me at this podium. You've heard it from the Secretary of War, the Secretary of State, the Vice President of the United States. You know, the president's top cabinet and his officials have been repeatedly explaining to the American public the threat that Iran has posed to our country in this moment, but of course, over the course of the past 47 years. And their words, again, chanting death to America, speak for themselves. Go ahead. You can follow up.
Why the division within the American people? I realize that we have people are talking about the War Powers Act. They're talking about all kinds of issues. But have people forgotten just how imminent that threat was? If they keep saying death to America and death to Israel, they mean it.
Look, I don't think the American people have forgotten, but I think Democrats on Capitol Hill, they have not forgotten, but they are just so plagued with this resistance to President Trump on everything that they do that, again, they can't even rally behind the common sense, bipartisan, longstanding principle of the United States of America that Iran absolutely poses a threat to the United States, that Iran is the world's leading state sponsor of terrorism. And I think that's reflected again in their voting pattern. In 2023, every single member of the House of Representatives, with the exception of one, I believe the final vote was 412 to 1 in 2023 for a resolution condemning Iran as the world's state leading sponsor of terror. And now in this year, under this president, in 2026, 53 Democrats voted against that exact same resolution with the exact same language. I don't think that's a change in the threat that Iran has posed to the United States. I think it's a change in the Democrat Party's thinking and their vicious hatred for President Trump. Danny? Sure.
National threat level, following on Kelly, what's the national threat level right now because of this death to America, death to Israel issue?
I believe the Department of Homeland Security and the FBI have repeatedly and continuously provided updates on the threat level to the homeland. I don't want to speak on it out of turn from up here, but of course, the federal government is continuing to coordinate and partner with local law enforcement agencies across the ground to thwart potential threats to the homeland. This is something the administration obviously takes very seriously. We are thwarting threats that, frankly, most Americans don't know about because they never make headlines, but that's the great work that the Department of Homeland Security is doing, and it emphasizes and underscores the point of why Democrats need to fund and reopen fully the Department of Homeland Security right now. Danny.
School. Why did President Trump say yesterday that Iran may have Tomahawk missiles when there are only 3 other U.S. allies plus the U.S. that have those missiles and therefore could...
Look, again, as the president said yesterday, he will accept the conclusion of this investigation by the Department of War. I know there's been a lot of speculation in the media about who may be responsible for this. We're not going to get ahead of the Department of War and the conclusion of that investigation. The president has a right to share his opinions with the American public, but he has said he'll accept the conclusion of that investigation. And frankly, we're not going to be harassed by the New York Times, who's been putting out a lot of articles on this, making claims that have just not been verified by the Department of War, to quickly wrap up this investigation because the New York Times is calling on us to do so.
Thank you. Thank you so much. Carolyn, with the DHS currently under a partial Democrat shutdown, does the administration have any specific concerns about potential impact on Homeland Security or intelligence monitoring of sleeper cells inside the United States? And do you have any comment on the bombing, the 2 individuals that bombed New York City or tried to?
Yeah, it was absolutely despicable to see that attack in New York City. I know the FBI is investigating, and the Department of Justice and SDNY have announced they are charging those 2 individuals and alleged terrorists, and I know they won't rest until justice is sought in this case. Daniel.
Thank you, Caroline. Appreciate it. Millions of Americans are filing taxes for the first time since the president signed the One Big Beautiful Bill Act into law. New reports say that new IRS data says that the average federal tax refund is around $3,800, a little bit up from the last period of last year. Does the president believe that the average federal tax refund increasing this year could provide a little bit more economic growth, something that he's been very focused on as the year progresses?
Absolutely. And Americans are going to start benefiting from the fruits of President Trump and Republicans' labor through the passage of the One Big Beautiful Bill and these historic tax cuts. We are midway through tax season, so just to provide an update from the Treasury Department that just went out moments ago, nearly 63.5 million tax returns have been processed thus far, 45% of the anticipated total number of tax returns by April 15th, so don't forget to file your taxes, people. And the average refund this year is more than $3,700. And we know that more than 27.5 million individuals who have filed their tax returns thus far have claimed at least one of President Trump's new tax cuts. Over 3.5 million returns have claimed no tax on tips. Over 15.5 million returns have claimed no tax on overtime. Over 9.2 million returns have claimed the enhanced deduction for seniors. And over 690,000 returns have claimed no tax on car loan interest. And another amazing statistic, nearly 3.5 million Trump accounts have been opened for children in our country thus far. So we look forward to, I know the Treasury Department continues to look forward to seeing these checks go out the door and into the pockets of hardworking Americans, and the president will be meeting with them himself tomorrow on the road in both Ohio and Kentucky, and we look forward to seeing you all there. Thank you, guys.
Thank you, Caroline.
All right, everybody, you have been listening to White House Press Secretary Caroline Leavitt at the Daily Press Briefing. A lot of things she commented on, including a lot of questions about the war, and a post specifically that had to do with the escorting of a oil tanker by a U.S. naval vessel through the Strait of Hormuz. Here's what she had to say.
I was made aware of this post. I haven't had a chance to talk to the Energy Secretary about it directly. However, I know the post was taken down pretty quickly, and I can confirm that the U.S. Navy has not escorted a tanker or a vessel at this time, though, of course, that's an option the president has said he will absolutely utilize if and when necessary at the appropriate time.
All right, that, of course, is White House Press Secretary Caroline Leavitt just moments ago at the White House with the daily press briefing. We care about this because we did see oil actually dip to its lows on that headline of a U.S. naval vessel escorting an oil tanker. We saw oil down as much as 19% WTI crude, down below $80 a barrel. We are still down on the day, but we're not down as much. Still a decline of about 11% at $84.16 a barrel. So we certainly have seen some reaction in the oil markets. And it's safe to say energy investors, global investors, looking for some clarity about this war, especially when it comes to energy markets that have really seen a lot of volatility, but really for markets overall. I want to stay on this for a moment and stay in D.C. And let's get to Joe Matthew. He is the co-host of Balance of Power. Joe, it does feel like we continue to see mixed messaging on the war, whether it's from Defense Secretary Pete Hegseth, from the president last night, Chris Wright, Energy Secretary, a post up, a post down, Caroline Leavitt then trying to clarify everything. Feels a little bit messy at the White House right now.
I think that's fair to say, and I'll just remind everybody, if you go back to that post that was deleted, Chris Wright said a large oil tanker passed through about 36 hours ago. So for some reason, the Energy Secretary thought this took place yesterday, that this was almost old news at the time that he was announcing it to a group of people in this video. All of that has been deleted, and I'll give some credit to Bloomberg's own Hadriana Lowenkron, who asked that question of the press secretary. Kind of interesting how little she had to say about this, basically referring further questions to the Energy Department. But you're right, as soon as that post hit, Carol, crude oil down to a 7 handle, and then it jumped back above $80 a barrel when it was deleted. So this kind of confusion is making and losing money for people today. And there are a lot of questions about exactly where the president is himself, having suggested the war effort yesterday was very complete, to use his words. And now Pete Hegseth, the defense secretary, says this is now the most intense day of bombing yet, and they are threatening much heavier strikes if the Strait of Hormuz remains closed. There is a report out there by CNN that Iran is considering, if not already beginning, the process of mining the strait, which would really change the dynamic here. And the White House will certainly need to have a concerted communications effort at that point.
Yeah, I have to say, to be fair, Nora, you actually sent me a headline too, or somebody, a terminal user who sent you some information about a report that the U.S. intelligence indicates, as you just said, Joe, Iran is preparing to deploy naval mines in the Strait of Hormuz. I mean, again, information coming, we were looking for confirmation, but to me it doesn't say that there's any end to this war, at least at this moment in time.
Well, that's true. And even Republican lawmakers we were talking with on the early edition of Balance of Power, Congressman Stutzman, for instance, did have to acknowledge that this is going to be a longer effort. And, we're likely not talking about days. The president was asked yesterday and pressed in a news conference, how soon could this end if we are very complete? And he said, not this week. That was a redhead on the terminal. That goes to show how close investors are watching this. But it's really something, Carol. You're watching the markets every day, and it seems like investors are really looking through a lot of the rhetoric here to try to bring us back to where we were before that kind of panic selling that we saw on Monday morning. So this is a really fascinating moment that we're in.
And, I think it's safe to say, we just talked with Kevin Gordon over at Schwab, this whole idea that despite everything, Nora, that's happened since the beginning of the year, as Joe mentioned, investors seem to be kind of sitting tight. And he said they really haven't changed much in terms of portfolios.
Right. And as we're kind of looking at how this is all trickling in the market, I'm curious, Joe, what is the strategy? What is the thinking here, especially given the fact that we are coming up on midterm elections? What do you take away from this?
Well, it's really interesting timing in that the Republican House Conference is in Miami right now for a retreat. That's why the president was down there last evening at Doral. And they're talking about messaging for the midterms and how to strike home the issue of affordability, which is the last thing anyone's talking about right now. In fact, we're talking about $3.50 gas. So there is a real cross current here with what Republicans would like to be talking about in many cases and what the administration is prosecuting in terms of this war, this conflict with Iran. At some point when we get further into primary primary season, this will become a more urgent matter because that is the issue that will be making voters' decisions at the polls.
Joe, what do we know about tensions within the White House and what we're hearing from President Trump's team? There was a great story on the Bloomberg about kind of how this is playing out among the MAGA faithful and not necessarily playing out well at all, but that within the White House, some of the president's chief advisors aren't so keen on him continuing this war. And I just wonder what we are hearing in terms of conflict there internally.
You don't hear a lot. I mean, this is really sort of the backroom conversation, right? And sometimes leaks come through Capitol Hill and back to us here in our Bloomberg newsroom. Look no further than J.D. Vance. I mean, he's kind of the face of this, having been, of course, an America First politician who and a veteran himself who had made the case against going to war with Iran repeatedly during his time in the Senate and on the campaign trail. And now he finds himself having to support the president, but also trying not to bog himself down as somebody who wants to be a serious contender, if not the front runner for president in 2028. But this is causing great confusion more broadly throughout all of MAGA. Steve Bannon's going to have a very different thought about this if you start talking about America First and longer entanglements. But it's fascinating to see even that part of the MAGA community give the president the benefit of the doubt, much like this market tries to on a daily basis in the hopes that this will be done sooner than later.
So is the administration intentionally leaving room for strategic ambiguity?
That's a great question, and I think that's always a yes for Donald Trump, which is why he's leaving all options on the table. It's not very often you'd ask a politician how they think about ground troops, and it's usually immediately ruled out. This White House has said, no, we're keeping that option on the table in case there is a need for more directed actions by, say, special forces to go find enriched uranium. And they're not saying that out loud, by the way, or maybe even to deal with the matter of Karg Island. All of this stuff has yet to be seen. We have to find out exactly what Iran's intentions are. Having heard from the Speaker of the Iranian Parliament, Nora, earlier today, who said Iran is not interested in a ceasefire right now. Even if the president thinks this thing is over, the enemy, as they say, also gets a vote.
Hey, listen, if President Trump isn't thinking about midterms, perhaps, what about the members of Congress who are, of course, not in session at this moment? But
that's right.
I'm just curious about what kind of pressure they might be feeling from their constituents when it comes to this war.
Yeah, it's a lot. They're getting a lot of questions about this, as many of them are home. And as I just mentioned, Carol, they're at that retreat in Miami right now, and they're huddling, talking about this very issue and how do we message around the war? Because at some point, if you're running for a primary election here and you're trying to resonate with voters at home, you got to talk about affordability. And with AAA showing over $3.50 for a gallon of gas, that conversation just got a lot more difficult. And as you've been exploring here on Bloomberg Business Week Daily, it's not just oil that's going through the strait, it's also fertilizer. And you put them both together and you've got the feedstock that goes right to the grocery store, right to the food aisle. And that's a big problem for anybody who's running for elected office in the majority, which is looking smaller by the moment here in Washington.
All right, great stuff as always. Joe, thank you so much. Looking forward to Balance of Power coming back at 5 p.m. Wall Street time. Joe Matthew, of course, co-host of Balance of Power. Catch it on Bloomberg Television and Bloomberg Radio. All right, we are coming up on the last hour of trading here on this Tuesday. It's a busy one as, again, investors, as Joe said, looking through a lot of the headlines, but it continues, no doubt about it, Nora, to create some volatility. We even saw stocks kind of bouncing around here.
Yeah, talk about a whipsaw. We are seeing the S&P 500 just above flat. It seems as though we are seeing stocks really trying to figure out the direction that they'd like to go. I'm also taking a look at the activity that we have been seeing in oil. We know it's at 84.25 if you look at WTI in particular. And then, of course, keeping an eye on Brent crude, that's at 88.81. So people really trying to figure out how to price all of this in, given the back and forth that we've been hearing right now as we think about the headlines.
Yeah, exactly. We're going to continue as we go through that last hour of trading here on Wall Street. When we come back, we're going to check in with Jitania Kandari, Morgan Stanley Investment Management Solutions and Multi-Asset Group Deputy CIO. We're going to talk emerging markets compared with the U.S. markets, kind of take a global look at the investment landscape and more. We're also talking a little bit of Apple. If you're watching on TV, the close is coming your way. And we continue right here on radio.
With insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
right, everybody, welcome back. This is Bloomberg Business Week Daily. We are just about 60 minutes away from the closing bell on Wall Street. We are across Bloomberg platforms, radio, YouTube, and Bloomberg Originals. We've got a market. I'm Carol Massar, along with Nora Melinda. Tim, as you know, Tim Stenovic, my co-host, down in Florida doing some great work on markets and prediction markets. He's going to be back with us Wednesday. But on this Tuesday, Nora, we definitely have stocks off. There are highs of this session. It's been a little bit more of a positive sentiment, but just barely. Call the S&P 500 flat at this hour. NASDAQ 100 just up about 36 points. Right. And watching some volatility once again when it comes to crude, which went below $80 a barrel, WTI. But now it is still down about 11% on the day, but now above 80 again.
Yes, a lot of waffling that we're seeing in this market, fluctuations back and forth. Take a look at some of the activity that we're seeing in small caps. I'm looking at the Russell 2000, down just below flat. So no clear direction that we're really seeing in these markets. Really
makes sense.
Minimal moves.
Makes sense considering like the kind of nonstop and sometimes contradictory headlines that we are seeing crossing the Bloomberg when it comes to the war in Iran. Coming up, we're going to get into Apple's new Neo laptop, a game changer. Our team says yes. We're also going to get into the tech space. You got to keep in mind that Oracle reports after the closing bell. We're going to talk housing and private markets with the CEO of Ballast Rock Asset Management. We're going to talk gold, oil, commodities, certainly top of mind on this Tuesday with Axel Merck. And then we're going to get into what some say is President Trump's new enemy in Iran. We're also going to talk emerging markets as we promised in just a moment. Quick check, though, on where we are in the trade with less than an hour to go. Here is Charlie.
Hi, thank you very much. You mentioned Oracle. Shares lower now, 0.9%. It reports after the closing bell. Right now, stocks higher. It has been a volatile session, a news-filled day, lots of moving parts, and yeah, we got you covered. The U.S. has not escorted an oil tanker through the Strait of Hormuz. That, according to White House Press Secretary Caroline Leavitt. You heard her remarks live on Bloomberg Radio. WTI, West Texas Intermediate crude, down 11% right now, 84.30 on WTI. Oil prices quickly paired losses after Bloomberg News reported that there was no U.S. escort of oil tankers through the Strait of Hormuz. You recall Energy Secretary Chris Wright posted about the escort on social media. Then his office appeared to have deleted that social media post. S&P up barely, up 0.5 point right now. The Dow up 0.2%. NASDAQ up 0.1%. The VIX at 24, the 10-year 4.14%. And again, West Texas Intermediate crude down 11%, 84.30 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, so appreciate it, Charlie Pellet there. Well, emerging markets, we want to talk a little bit about that because with everything going on, we continue to watch what has been some outperformance. Emerging markets as a whole up about 7% this year, gaining 30% last year, and that compares with a similar gain if you look at the world overall, backing out the U.S. last year. That group is up more than 2% this year. And then let's go to the U.S. As measured by the S&P 500, little changed so far here in 2026 amid a lot of volatility, and that's after gaining 16% in 2025. Bottom line, what's the takeaway? Emerging markets continuing to outperform certainly what we've seen in the U.S., at least as a whole. Let's see what our next guest has to say with everything going on. Jitania Kandari is Morgan Stanley Investment Management Solutions and Multi-Asset Group Deputy CIO, and she joins us in our Bloomberg Interactive Brokers studio. So patient as we went through the update by White House Press Secretary Caroline Leavitt. Let's just start there. How do you, the nonstop flow of headlines, sometimes contradictory, often contradictory, trying to figure out what the macro is really telling us?
Yeah, so I kind of base a lot of the decisions and thinking on history, right? What does history tell us looking at past oil crises? And what we are seeing is pretty much similar to what's happened in the past when you've had oil going up significantly when a geopolitical issue hits the tape. And typically, it's that first instance risk premium, and oil is always the first asset to react.
The first shock, kind of?
Exactly. If you look at the S&P, it's down only 2%, right? Right. Of course, emerging markets, Japan, Europe are down between 5 and 6% in the last week. But the transmission is clearly on the oil side, and I'd say that this reaction this time is higher than the median over different crises, so we are watching this closely. And for me, besides the conflict, the single most important thing is how long does the Strait of Hormuz stay closed, because that's where 20% of global oil supplies go.
So how do you price for that? Because as you mentioned, in some ways, this is a bit unprecedented. So you look back at history to be a bit of a gauge. But how do you price for the idea of this maybe being more prolonged than anticipated? How do you shift your view, if at all?
I think I'll zoom back a little and I'll say I think a lot of the geopolitics today is about resource asymmetries between US and China. So the big difference this time is US is self-sufficient in energy and US is an energy exporter and US has all the energy supplies with the Western Hemisphere and China has critical minerals, right? And China is an importer of oil from the Middle East. So let's keep that in the back of our minds. And the key is when does the shale tap open, right? Shale gets productive to produce at 65 plus. So you get supply from the US when prices go up those levels. So I think you need to keep all of this. Of course, if it's very prolonged and the strait remains closed, it flows into proxy militant groups and the Red Sea gets into question. That's like the worst case escalation ladder. I don't think we're there yet. That's not our base case, but that's how we kind of think about price ranges within a certain base case assumption.
So when you look around the world, and we've talked about the outperformance of non-U.S. markets, and we know that some of them have taken some pretty big hits here as a result of this war, where do you find the best opportunities? And then how does that compare to what you see in terms of U.S. opportunity?
Yeah, so I think the world is really multipolar. And therefore, opportunities are multipolar. Yeah. I mean,
but that's kind of always the case, right? Or no? Or
I think it's more pronounced because I think three things are happening. There are two spheres of influence, the West and the East, with U.S. dominating one, China, the South Sea initiatives and blocks there, the regional trade reconfiguration, the de-Americanization of trade agreements, and that's creating new supply chains, right? That's rejigging the infrastructure, the industrial capacity, the state-led industrial policies. That has created opportunities outside the world.
We just talked about, there's a story we're going to talk about with our Mark Gurman in a moment, about 30%, I think it is, of Apple's iPhones are now made in India.
Exactly. And so there is a lot of all of that going on. And I think even from the AI perspective, right, the story has to move beyond just the model creators. The way we've scaled with compute and algorithms and capital and talent, the opportunity is really beyond the model creators to who's really using it. And the different pockets of the world, we're seeing that application of the layers, both within the US and outside. So that's interesting. And as a portfolio manager, I think the key for us has been having anti-correlated alpha sources. So we have been positioned for a geopolitically charged world, for a multipolar world. What does that mean for all, energy and defense and that ecosystem? So a lot of opportunities. Emerging markets feed into the AI supply chain. Right. Where are the bottlenecks in transformers and chips? You have other countries that fit into the commodity supply chain because a lot of the new physical AI, which is embodied AI, needs commodities. Right. I think after this incident today, energy security is going to become a very critical national objective for most governments. So what does that mean for the energy supply chain, the nuclear supply chain, and uranium, which fits into that? So there is a commodity tailwind for some commodity countries on account of some of these things that are brewing in a geopolitical space.
We just have about 30, 40 seconds here. Do you have a favorite market, though, when you look around the world?
I think I have more favorite themes than markets because I think there are themes that span across. I do like financials outside the U.S. Because I think there are new credit cycles. They are deleveraged. I do like pockets of the geopolitical hedges, which I spoke about. I do like the AI in the application layer rather than the hyperscalers. I think models are proliferating, but it's the users of AI and how that is happening. So lots of themes that are promising at this time.
Continue hearing that about AI. It's moving along. Jitanya, come back soon. We would love to continue this conversation. Jitanya Kandari, Morgan Stanley Investment Management Solutions and Multi-Asset Group desks are joining us right here in studio. All right, from the global macro market to one of the largest market cap companies in the world, we are talking about one that actually turns 50 years old on April 1st. And according to our team, Apple, its new Neo laptop is a game changer for the industry. So we want to get into that and just take a look at all things Apple. And with us to do that is our Bloomberg News managing editor for let's try that again, for Global Consumer Tech. He is Mark Gurman, and he joins us in the Bloomberg News LA Bureau. Mark, good to have you here. Tell us about, you guys took a test drive when it comes to the new Neo. You guys liked it.
Yeah, we've been testing out this new MacBook Neo, $600, $500 with an education discount. It's a great machine. It uses an iPhone chip from 2 years ago, which is able to power you through some light 4K video editing, some light AI apps, but most importantly, this is for students. This is for people who don't need all the power of a MacBook Air or a MacBook Pro. They're basically doing web browsing, they're doing Facebook, they're doing Instagram, they're doing iMessage, they're doing email, they're doing documents, they're using Google Docs, they're using Gmail, right? All the basic apps that you're using on your phone, but you want that keyboard, trackpad, and bigger display. And the price point is quite aggressive for Apple. You know, traditionally, they've not done sub $1,000 machines. This is sub $600. So this is a pretty big deal for them.
I mean, I would imagine this is something that many people have been waiting for. I just think back to my college days, and you're going to find a laptop, and you know the MacBook Pros are always $1,000 plus, and it felt like an investment. So I'm curious, you know, as you got to do this test drive, what's different about this device as opposed to some of their main devices that we know very well?
Yeah, I mean, it has a slightly smaller screen than the MacBook Air, so a 13-inch screen versus a 13.6-inch screen. There's also the 15-inch model of the Air. The speakers are a bit weaker. The processor is clearly not as fast. It doesn't have a backlit keyboard. The display quality is not as good. But it will do pretty much everything you need it to do if you're a student or someone who considers computer work going on Facebook and doing email and some web browsing, right? I mean, 90% of the world, I would say, uses computers for very basic tasks, all things considered, when you compare that to all the things you can do with AI and video editing and what have you. So this is going to meet the needs of a lot of people, and I think this is going to put the Windows PC laptop market and the Google Chromebook market both in precarious positions.
Hey, is it all about, though, being a big revenue generator for Apple, Mark? And I also do wonder how it is, you know, in terms of kind of starting to bring a different part of the consumer base into the Apple universe. So they maybe buy this and then they buy something else.
Yeah, it's both. So it's going to accelerate Mac revenue for sure, because it's going to bring new people into buying the Mac. But more importantly, this is going to be a gateway drug, so to speak, to the Apple ecosystem. You'll buy this Mac, and then maybe you'll buy an iPhone, then maybe you'll buy an iPad, then maybe one day you'll buy a higher-end Mac, maybe an Apple Watch, maybe AirPods. And you know, once you get into the Apple ecosystem, how hard it is to leave the Apple ecosystem. So it'll make them revenue in the short term, but more importantly for them, it's going to make the ecosystem even stickier, because now, in many cases, maybe a person's first computer won't be a PC or a Chromebook, maybe it'll be a MacBook Neo.
Well, what other colors do they have? I'm looking at the article that we have on the Bloomberg terminal, and I didn't even realize that they had a variety of colors for a laptop.
Yeah, so that's a first for them, having sort of these more fun colors. So you have that flagship color, which is, they call it citrus. It's a combination of yellow and green. There's also a indigo blue, so it's sort of like a dark blue. That's my favorite one. You have your plain silver, which of course you need, and then you have your blush pink. To me, it doesn't really look too different than silver, but they swear it's pink. So that's an offering there too.
Mark, what pushed them to do this? I think that this is something that people have really been pounding the table for years, over a decade even. I'm curious, what made them finally do it?
I think it was that a bunch of moving parts and pieces came together for them to be able to do this. It wasn't that they were pushed to do it, it was that they finally had the pieces to be able to do it. Having the ability to run Mac OS on ARM silicon, so non-Intel chips, that was the big innovation of 2020. Apple moving to its own chips for the Mac, which meant rewriting Mac OS to work on its own in-house silicon, which is based on the iPhone processors, so the software story. The second piece, having those chips from the iPhone 16 Pro from 2 years ago being manufactured for the last couple of years. The longer you manufacture, the more chips you're able to create, the more efficient you're able to get the production process, and the cheaper you're able to build those processors for. So it's the software story coming together and the chip story coming together. And then the third thing is they've long been developing this new aluminum manufacturing process that's more efficient and cheaper, allowing them to save some of aluminum scraps and reuse it. So all these cost efficiencies and efficiencies was what was able to align for Apple to release this product.
Hey, so they've got this going on, Mark, and so tapping into another piece of the consumer market, if you will. But you write in your Power On newsletter over the weekend that the company still plans to push deeper into the higher end with more ultra devices. So they're not giving up on that.
Oh no, this is I would say this is a blip on the radar here. Obviously, they'll continue to invest heavily in this Neo line. I think eventually they'll expand the Neo line with new versions. Obviously, you have the iPhone 17e, so that's a mid-tier phone. This is Neo's a low-cost phone. New Ultra products, so not necessarily named Ultra, but in that higher tier. So you'll see a very high-end MacBook Pro with a touchscreen and OLED display tech in the fall. You'll see new AirPods as early as this year or next year with built-in cameras. Those will be a higher-end version of the AirPods Pro that exists today. They're working on a large foldable iPad. So Apple is trying to hit all price points now, but certainly the premium is the focus.
I just am waiting, Nora, and Mark knows this because I've talked about this a lot and Tim. I'm just waiting for them to get Siri straight.
Oh, please, that would be wonderful. I was just yelling at my Siri this morning.
I don't know. I don't even know where to go with this. Hey, you have another story out there on the smart home display. Another delay, or what do we need to read? Is this trouble, or is it just?
It's exactly what you said. It was that the new Siri needs to be functional, it needs to be released, it needs to work before this hardware product can come out. Because if you release the hardware product before the new Siri is ready, it's just not going to work properly, it's not going to function as intended. And in addition to having a lot of criticism around their AI, you're going to have criticism now around their hardware products as well. And so that's the last thing they want.
So why have they been struggling so much with Siri? I just want to dig a little bit deeper into that. I'm curious,
How much time do you have?
You said, which phone do I have?
No, how much time do you
have?
have?
How much time do you have?
Well, tell me what you know.
Well, this is a fundamental thing for Apple. They've struggled with Siri and AI development for many years. They didn't believe in AI being a core component of devices and device operating systems, even when companies were moving in that direction 3 or 4 years ago. They were completely caught off guard by ChatGPT. They had management issues. They had issues where they didn't get enough of the GPUs necessary for training. They overbuilt on their own processors for the Apple Intelligence Cloud. So just a string of different problems that all led to Apple Intelligence not being that compelling of a solution.
Always love checking in with you. Hey, Mark, thank you so much. Of course, that is our Bloomberg News managing editor for global consumer tech, Mark Gurman. When we come back, gold up again. We talk about it in a moment.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks higher, oil lower. Attention continues to be focused on the oil market, which was whipsawed amid the White House's acknowledgement that a post from Energy Secretary Chris Wright had erroneously claimed that an oil tanker had been escorted through the Strait of Hormuz. Right now, we do have the S&P 500 index just turning negative, down 3 points, down under 0.1%. The Dow up 0.1%, up 50 points. NASDAQ up 0.1%, with the VIX holding at 24. The 10-year 4.14%, the 2-year 3.57%. Gold is up 1.3%, 52.03 the ounce, and West Texas Intermediate crude 85.85 a barrel. WTI down by 9.4%. Bitcoin up 1.5%, 70,031 right now on Bitcoin. Coming up after the close of trading, we will be hearing from Oracle. Wall Street watching to see how quickly the company can convert massive cloud bookings from customers like OpenAI into revenue ahead of earnings. Oracle down by 0.6%. Nancy Tengler is Chief Investment Officer at Laffer Tengler Investments, and this morning on Bloomberg Tech, she was talking about Oracle.
I think today's call is going to be most instructive for shareholders, because what we want to hear from the company is what they're going to do about margins, how long it's going to take, what the real debt commitment is, because some of this has just been lines of credit that haven't been drawn on.
Again, Oracle shares down now by 0.3%. Nancy Tengler, CIO at Laffer Tengler Investments. Recapping, West Texas Intermediate crude down 9.2%, 86.07 a barrel. Spot gold up 1.3%, 52.07 the ounce. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Nora Melinda in for Tim Stenovec on this Tuesday. So we did see gold advance after President Trump signaled the war in the Middle East could be nearing an end, sending oil prices lower. We know we've been bouncing around a little bit, though, as we've gotten an update from the White House Press Secretary Carolyn Leavitt. Bullion, though, we did see up more than just about, or roughly around 3% today, more than $5,200 an ounce. It wiped out a decline that we saw in the previous session. We did have the president say the conflict would be resolved very soon. We saw a gauge of the dollar fall. We saw crude tumbling. Of course, again, we've seen a bit of a rehearsal of some of this. But keep in mind the WTI crude still up about 60% year to date. You look at the precious metal, gold specifically, it has still gained around a fifth this year. But since the war broke out, the volume of gold held by exchange-traded funds has declined. And we do want to point out that it gained about 56% last year. It is time now for a conversation on commodities, brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. So to get a free gold and silver info guide and learn how to add metals to your IRA or 401k, tax and penalty free, just head to goldencrestmetals.com/guide. That is goldencrestmetals.com/guide. Let's get to it. Great to have back with Nora and myself, Axel Merck, Chief Investment Officer at Merck Investments. He joins us once again from Palo Alto, California. How are you, and how are you navigating this environment?
It's great to be with you, and we certainly live in interesting times. I mean, one just needs to try to keep attention to just what you just said, all the things that happened in recent days. Of course, I'm not telling your viewers anything. I think that the relevance of all of this is the market interprets all of this as a shock, a supply shock, inflation shock, if you want to call it such, rather than interpreting it as a structural change. And so, of course, we don't know whether the war is over tomorrow or this or that. But if you look out on the oil prices in 6 months from now, oil prices come down rather significantly. And similarly, in the fixed income markets, the market, and whether that's correct, of course, nobody knows, but the market interprets this that they'll figure out some way forward. And regardless of the news, is there now an escort for the oil tanker, or are there going to be mines deployed in the Strait of Hormuz, or whatever it may be, the market believes that this is somewhat temporary. And of course, in the heat of the moment, that might be difficult to grasp, but that's at least what the market is saying right now.
Well, Axel, you said that the market's really interpreting this as a shock versus more of a structural change. What levers do you see in focus? What are the moving parts right now if you think about how investors are thinking about this temporarily as just a shock?
Well, liquidity has been driving the market, I would say. I mean, to just stay on that particular theme, and that's part of the reason why, quote unquote, everything has been going up and down. Obviously, the supply shock has been pushing up rates. You can't lower interest rates to fix a lack of supply, and of course the supply that is potentially inhibited is more than oil. There are fertilizers. Also for mining, we invest a lot in precious metals miners. There are some things on the copper mining side. We don't do much copper, but on the copper mining side, there are some important chemicals that are being exported from that region, and so there's a whole range of things that could be highly disruptive. On the good news side, businesses are entrepreneurial. They find a way to get access to the things they need. Overall, of course, China may be weakened medium term if oil isn't coming from Iran, and so there are those sort of things. But what we are seeing is that the mining companies just control what they control, and the same thing, of course, in other areas. You deal with the cards on the table, and you're trying to run your business. And even with these wild swings we have seen, as you mentioned earlier, right? The gold is up over 20% year to date alone. The miners are up substantially this year. And in a broader context, it seems like mining, with its very high margins these days, can compete actually very nicely with tech companies and other things. So it's, in that sense, there's a structural shift, but the kind of in the short term, the market thinks that this is mostly a supply shock.
You know, Axel, I think about this more and more with, as some of our guests come on, and we just had a guest where we talked about emerging markets, specifically Jitanya Kandari. She's over at Morgan Stanley Investment Management. But just this idea that what we're seeing in energy markets, I mean, it's different for the U.S. when it has got some incredible oil reserves and is much more energy independent. Having said that, it's a reminder to the world, for especially a nation like China, that isn't. And so it's just, countries around the world, governments around the world thinking about their national security, whether it's on energy and oil markets, whether it's on precious metals, whether it's rare earths, whether it's just basic commodities. And I just wonder about this grab to kind of make sure your security, you have national security on all of this, what that does to these markets. Does it put a floor under them? Does it drive prices up kind of longer term?
It makes them less efficient, I think, and it makes doing business more expensive. Because, of course, oil prices, yes, we may produce more than we need, but the price of oil is set globally, of course. And I think ever since we had the invasion of Ukraine, we've entered a new era since World War II. The peaceful period from World War II is over. What we are seeing, what we saw in Gaza, what we see now in Iran are symptoms of this new era. And as you point out, right, governments are becoming more interventionist. The Chinese, of course, have always done it, the Europeans to some extent. In the US, we do it now as well. And that means the cost of doing business is going up, because as much as the government will, of course, pursue national interests, that almost by definition is going to be less efficient than if the private sector were to allocate the resources. And I'm not suggesting that there isn't a good reason to do many of these things, but it means that your business is going to operate less efficiently. It means the governments are going to spend more money. It means government deficits are going to continue to be high. And I say that as a precious metals manager, right, that the reason why gold is so high is because the price of gold is so high is because investors are trying to figure out how do you diversify in an era where the Max 7s, we don't even talk about them anymore,
Isn't it amazing?
Are so expensive.
What is
that? And so to just contrast that, right? The reason why software isn't so hip anymore is because AI is eating the lunch of software, and AI businesses, they are very high cost investments. The margins are uncertain, and now suddenly on the mining side, the margins are fantastic, at least on the precious metals side. Obviously, the barrier to entry is reasonably high to develop these things, but suddenly we have a level playing field of old technology versus new technology, and in many ways that's fascinating. But the more interventionist attitude of many governments makes the way to operate less efficient, which can also push up inflationary pressures in the medium term.
So how does the activity that we're seeing in gold today compare to historical patterns, maybe past conflict-driven rallies?
Well, the last time we had this sort of extraordinary volatility was during the pandemic. Miners do flare up in volatility. What we've seen of very late has been quite extreme. But at the same time, the margins are really, really good. And so even if the price of gold could come down over 20%, 30%, the miners are still making good money. And the valuations in the miners don't reflect that. And it's one of the reasons that despite these fantastic gains there were last year, that I'm actually quite optimistic on many of them. Now, clearly, if we shut down trade through what's happening in Iran globally, then the folks who historically buy gold, including some foreign central banks, might need to use their resources for other things. But it's usually the reason why precious metals do well is not because market forces are allowed to play out, but because of government interventions to counter that. To then, when the market says, "Hey, we need to have disinflation or deflation," that money is being printed to counter it. I'm not suggesting that's going to happen in the U.S. tomorrow, but if globally the negative sentiment is going to spread, governments are going to get more active and to try to counter that.
So what's your advice to investors right now? I mean, a lot of folks have said we haven't changed much of our strategy since the beginning of the year, despite, the White House being, certainly on the move when it comes to geopolitical maneuvers, whether it's Venezuela, what we're seeing in Iran. People speculate, is Cuba next? Just watching very closely. But a lot of folks have said we've stand pat, especially when it comes to this war, because we just are waiting to see duration. When it comes to metals, when it comes to commodities generally, and I know I'm throwing it all in one bucket, but what's your advice, Axel? Where should they be looking, if anywhere, within the commodity space?
Well, first of all, the most important thing is that people have a strategy. And because if you don't have a strategy, you're almost certain to lose money. And the strategy doesn't need to be great, but have a strategy. And then beyond that, please don't deal in derivatives if you don't know what you're doing. The small print matters, right? I mean, you saw storage costs in oil. A few years ago, we had negative oil prices. Production is being stopped because they don't know what to do with it. They can't ship it. And so stay away from that. Dealing on the equity side is mostly simpler. Now, in gold, you can store physical gold, and of course, you have some storage term long term, but that's why it's one of these things that is simpler. The moment you go even to silver, you have industrial components, volatility is high, truly extraordinary volatility. And so it is something that if you're not familiar with something, it is sometimes okay to leave an opportunity off the table. In many ways, I'm a simpleton. I'm mostly focused on gold, and that just makes it easier. Stay with what you understand. And that said, of course, if you're afraid of what's happening in equity markets, well, cash isn't a bad thing either, right? It is not about just stocks versus bonds.
All right, we got to run. Hey, great to go around the commodity space with you. That is Axel Merck. He's Chief Investment Officer at Merck Investments. Quick check on gold right now, up about 1.7%, 51.93 an ounce. We're counting down to the close. We talk about the markets more when we come back.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We got a choppy finish. 20 minutes to go ahead of the closing bell. The Dow, NASDAQ, they're both higher. S&P lower. The big story, though, the slump in West Texas, intermediate crude, Brent crude as well. Right now, they are both down by 8.1% or more. Let's head over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are well off their session highs, like you said, in a choppy session. The Dow is currently down 6 points. S&Ps are down 11. The NASDAQ is off by 2. The U.S. 10-year yield is at 4.14%. Gold is in the green. Oil is in the red. But Bitcoin, that's trading higher by 1.5%. Among the main 11 S&P sectors, the leaders were telecom and the materials. Healthcare and energy were under pressure. And leaders to the upside in the Dow, Honeywell and Cisco, while Boeing and Salesforce led to the downside. Note that Boeing dropped as a result of plane wiring issues. And after earnings, Kohl's reversed gains of 14%. In the healthcare space, Centene plunged 15% on cautious comments. And wrapping things up, Oracle reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
All right, we thank you very much, Bill Maloney. To hear live breaking news over your Bloomberg, type SQUAWK, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Daddy, can I drive?
Yeah, sure, why not?
Do I look like I drive a minivan?
Shut up and drive.
Don't drive angry. Don't drive angry.
I'll drive. Shotgun.
This is the drive to the close.
If you had access to a car like this, would you take it back right away?
On Bloomberg Radio.
Well, the hits keep on coming. All right, folks, we're just about 18 minutes away from the closing bell on this Tuesday. Just want to mention President Trump out on social and saying if Iran has put out any mines in the Hormuz Strait, and we have no reports of them doing so, we want them removed immediately. If for any reason mines were placed and they are not removed forthwith, the military consequences to Iran will be at a level never seen before. If, on the other hand, they remove what may have been placed, it will be a giant step in the right direction. And again, this is coming from President Trump just moments ago out on social. And that is something like you gave me a heads up, and you had a Bloomberg Terminal user reach out to you a while ago in the last hour, right, about this.
No, absolutely. We had someone reach out to us on the terminal, but it's interesting to see these headlines continuing to come in. The story just continuing to evolve here.
Yeah, I'm looking at WTI crude, which has been kicked around in terms of the report that was taken down by U.S. Energy Secretary Chris Wright that said that the U.S. Navy had escorted an oil tanker through the strait. We saw oil really dip down almost 20% here in the trade today. We saw it bounce back. It's still down about 9.5%, but not as low as it was earlier. But that is kind of the market environment that we are living in. Let's see how Doug Sioka is managing for himself, his team, and for his clients. He is CEO of Kavar Capital. He joins us once again from Leawood, Kansas. Doug, it is good to have you back here on Bloomberg Business Week Daily. I feel like you and I have talked through many, many market cycles. This is an interesting one, and a headline can change the shape of the markets. Although some have argued, it does feel like, certainly on the equity side of things, that markets just want to head higher. How are you seeing it, and how are you weaving through all of this?
Yeah, thanks, Carol and Nora. Nice to be on. I don't disagree with that. I feel like there's somewhat of a persistent bid in stocks. I mean, when you think about maybe the 5 subcomponents that pulled the market out of the tariff liberation day Rose Garden disaster last April, 4 or 5 of the 5 are still intact. Right, the economy is still growing. Earnings are accelerating far faster than anyone had anticipated last year, than year over year into this year. Interest rates are lower. I mean, the Fed has cut rates 7 times. We do think Kevin Warsh might cut once or twice. A lot's going to depend upon the outcome of some of the geopolitical incursion that's taken place. You still have lower taxes. Like we talk about some of the money that's coming out of these tax refunds that's making its way into the stock market. And then regulation is lower. So you're seeing a lot of M&A activity. Those animal spirits are certainly alive in the market, although I think what's happened over the last 11 days has suppressed them a little bit for sure.
Well, I think it's interesting to hear a bit of this optimism. I think that, the market has gotten pretty comfortable with those double-digit year-to-date returns that we've been seeing back to back to back. And as we look at the S&P 500 so far, year to date, it's down about 0.2%. So not as much activity as what we're used to seeing in terms of the upside. But where do you particularly keep your head right now in this moment? Where do you see opportunity in this market as it stands?
Yeah, thank you, Nora. It's funny, just as a quick aside, but it's relatable. So Notre Dame, which is my alma mater, lost one of its luminaries last week, and Lou Holtz, who's not just a football coach, but every bit a life coach, and his advice seemed to transcend different subject matter. So we invoke a lot of his wisdom, even in the investment universe. And one of the primary quotes that I carry with me all the time is that life is 10% of what happens to you and 90% how you react to it. And the same should be said when you're managing portfolios, right? We are in a trifecta of tension, right? We've got complete absence of policy consistency from the Trump administration. We've got this narrative of AI eating itself, which is floating over into private credit. And we've got this interest rate inertia. So even though the index at the headline level has done so little year to date, we've had a lot of churn. I mean, I saw something that Lizanne Saunders, put out from Schwab that talked about through the first month and week of this year, the S&P was down 36 basis points, but the average stock was down 12% from its peak. And the average NASDAQ stock down 26% from the 52-week highs. Like, that's a lot of embedded volatility. And we think that presents tremendous opportunity, right? So the rotation is underway for sure. What we've seen because of the dependency on foreign oil, international stocks in the last week and a half have dropped 2 to 3 times that of domestic counterparties. What an awesome opportunity to put some money to work in that area. We've seen interest rates back up because a miscalculation, we believe, on the part of the Trump administration was that because the U.S. was oil independent, this really wouldn't have an impact on inflation. He spent 10 minutes in the State of the Union talking about the low price of gas.
Right.
Well, that's completely unwound. So you've seen steepening the curve. You see the backward interest rates with the expectation of higher inflation. We're now going to start to extend duration with high-quality corporate credits that move outside and complement some of the stuff that's taking place in the private credit market. Public credit markets to us are very attractive as we begin to extend duration.
I just want you to know I'm making T-shirts and hats for a trifecta of tension because I really love that. Doug, you mentioned putting new money to work. Do people want to put new money to work in this environment? I agree with you. When there's fear, right, that's where you can find some opportunity. But I'm just curious how willing people are to do so.
Yeah, I think very willing, Carol. I mean, we spent a lot of time last year talking about the absence of credit the market has been given for time served, right? Going through it, including 2025, we had 3 technical bear markets in 5 years. Okay, that is twice the historical average, what we'd expect. And because of the rotation and the absence of participation in the non-Mag 7 493, the S&P, small caps that have been way left for dead over the course of the last 4 or 5 years, call it, we are seeing expected returns that are greater in certain parts of the markets. That's steering some of our rebalancing. And provided we're disciplined as relates to lining up our allocations consistent with our goal that we're trying to obtain with our financial planning, yeah, clients are very much interested in engaging in this market.
So where are you kind of avoiding? Where are you kind of taking a step back from as it relates to your portfolio? Any sectors that stand out to you?
It's a valuation-driven proposition for us, Nora. So we found a lot of value right now in healthcare, which had been sort of the persona non grata sector because of some of the HHS propositions that had taken place when RFK was put into Trump's cabinet last year. So that's an area that we felt has been so neglected. We want to embrace it. Frankly, we're looking at taking the other side of the energy trade right now, right? It is interesting to look, like you guys mentioned on the lead-in, energy is down as much as it's down, but interest rates have not come down, which tells you it's not just an inflation play that was at work. We saw so much momentum in and out of the barrel of oil price between Sunday night and today. So we think that you definitely want to be looking around the corner because this is going to have a resolution. I mean, frankly, the political consequences for the Trump administration are just too high to allow this to drag on for much longer. And you saw the sensitivity, and Carol read that tweet before we got onto this segment. Like, Trump is laying some of these terms down with the expectation the market's going to react very positively, and positive in that regard means that the price of energy is going to continue to drop as soon as the Strait of Hormuz opens.
Yeah.
But in the absence of that, it's stayed a little bit sticky where it is right now, but that's going to change. I think looking at the other side of energy makes sense.
Yeah, and then there's always that thing that, people say, certainly the president watches the markets. That is something that he keeps an eye on.
There is no doubt.
Yeah. Great stuff. Doug, be well. Talk to you soon. Doug Sioka, CEO of Kavar Capital, joining us from Leawood, Kansas. All right, folks, we're counting down to the closing bell on this Tuesday. Just about 10 minutes to go. Carol Massar, Nora Melinda. We're back in just a moment.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are just under 7 minutes to go until we wrap up the trade on this Tuesday. Carol Masser along with Nora Melinda. It's been another fast and furious day. Busy, busy, busy.
Oh, it has. I feel like we've lived a week in just one day.
It's only Tuesday, Lemon, as they say. Hey, a couple stories, though, that are on our radar. I want to get to this one first because it really just kind of, I was like, wait, what? Salesforce planning to raise up to $25 billion to fund buyback. So they're planning to sell as much, as we said, $25 billion worth of debt. Company is targeting a U.S. bond offering of at least $20 billion, with the notes potentially being sold as soon as this week. Salesforce announcing a $50 billion stock buyback program and 5.8% dividend increase alongside a better than expected sales forecast. We got that on February 26th, but I'm just like, what? You're issuing debt? You know, investors like buybacks. Maybe that is a smart use of debt. I don't know. I guess it depends. I just
the last time that they tapped the bond market was back in 2021. They raised about $8 billion, and that was to help fund the acquisition of Slack. So it's been a couple years, but I mean, take a look at the action we're seeing for the stock year to date. It's down about 27%.
Yeah.
And it's just March.
Yeah, it's down another 2% in today's session. So, yeah, I get it. You do a share buyback, right?
Right.
Basic supply and demand, and you shore up the price of any equity, but